And yeah, the project is completely on track.
And what's the price point that you're going to play in? And you talked about competition. This is an increasingly competitive space. I mean, you've got the likes of Tesla in India struggling to sell.
Yeah, absolutely. I think if you look at our experience has been very positive. We acquired MG in India last year, and this year the Windsor, which is the first car that the JSW Group brought into the country, is the fastest selling EV in the country. For the last 16 months, we've been breaking record after record. And it shows that EVs in India, for them to work, you need to be at the right price point. If you look at the data, India sells about 4.5 million cars in 2025. Out of the 4.5 million, the maximum amount of cars, more than 3.5 million, was sold sub 15 lakh rupees. So it's very clear that you got to be in the 15 lakh rupee ballpark if you want to achieve scale. So our aim is to play in that 15 to 30 lakh rupee price point.
Okay, on that note, we're going to slip into a very short break. Up next, we'll get to developments from the White House on the other side. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now let's just focus and talk about the U.S. market. U.S. market tumbled on Tuesday as President Donald Trump escalated rhetoric over Greenland, threatening new tariffs on the countries opposing a potential U.S. takeover of the Danish territory. The Dow plunged nearly 900 points. S&P 500 as well as the Nasdaq logged their worst session since October 2025. The losses have now dragged both S&P 500 as well as Nasdaq into the negative territory for 2026. The comments also sparked a sell-off in the U.S. assets, pushing Treasury yields higher while the dollar weakened for them. Now, moving on to the European market, where did they close as well? They closed sharply lower in Tuesday's trading session. Fresh trade tariff threats rattled investor sentiments there as well. The French CAC index shed 49 points, while the German DAX lost around 255 points in the trading session yesterday. The FTSE lost nearly 70 points as well. The sell-off follows comments that came in from US President Donald Trump, who warned of tariffs starting at 10% and rising to 25% on 8 European allies if no deal is reached over Greenland. European leaders also have pushed back, calling for dialogue to ease these tensions. The pan-European stock 600 ended the session down around 0.72%, with losses across all major markets that we saw in the European front as well. But let's move on now and get to the latest update in terms of the commentary that's coming from President Donald Trump, who spoke at the White House in a press briefing marking the first anniversary of his second term in office. The US president spoke about legal uncertainty over his administration's tariff regime, saying that the United States may have to return billions of dollars collected over the past year if the country's Supreme Court rules against the contentious policies. Listen in.
I don't know where there's a case even there, but we've taken in hundreds of billions of dollars, and if we lose that case, it's possible we're going to have to do the best we can in paying it back. I don't know how that's going to be done very easily without hurting a lot of people, but we're waiting for that case anxiously.
Moving on to commentary on Greenland, Trump declined to detail what length he will go to in order to achieve his aim of making Greenland part of the United States. In response to a question asked how far would he go to acquire Greenland, Trump said, "You'll find out." The US president also said there was no going back on his plan, claiming Greenland is imperative to them. Now, moving on to updates on the Venezuelan front, Donald Trump actually said and shifted from criticizing Venezuela over its past release of prisoners into the US to praising the current cooperation that they are seeing from the country. Now, he also said that oil companies in Venezuela were preparing to make large profits and looking to open markets to Saudi Arabia. He also expressed enthusiasm of involving Venezuelan opposition leader in the nation's recovery process. More updates coming in from President Trump. The president also suggested that his proposed board of peace might replace United Nations, which he sees as unhelpful. Now, Trump praised the United Nations' potential, but faulted it for failing to resolve conflicts he personally settled. He advocated allowing the United Nations to continue due to its untapped possibilities. So that's the update that we have, or commentaries that we have coming in from President Donald Trump. But here is some opinion from US Treasury Secretary Scott Bessent on Greenland, as well as the US strategic interests as well.
This has been on the president's mind since his first term. It's been on the presidential mind for 150, 160 years. The U.S. has been trying to acquire Greenland. This is not something new, Joe. The U.S. has spent $22 trillion more on defense than the rest of NATO has. $22 trillion. That is approximately 2/3 of our outstanding government debt. So while the Europeans were building schools, having health care, we have been defending the world, and I think the president believes they should be paying their fair share, and he is trying to get in front of this. He's trying to get in front of it because Greenland is strategically important. It's strategically important for his Golden Dome project to protect the U.S.
On that note, we're going to slip into a very short break, but here we get two excerpts from our conversation with Sudarshan Venu, Chairman and Managing Director of TVS Motors, all the way from Davos. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now let's get you the key highlights from the World Economic Forum's annual summit underway in Davos. Industry will grow in double digits due to strong domestic demand, and EV penetration will continue to improve, says Sudarshan Venu, Chairman and Managing Director of TVS Motors. He tells Shireen Bhan that 2026 will see new launches. Listen in.
A lot has changed. The big one, of course, has been the GST cuts, and that really has unleashed demand for the auto sector, for two-wheelers in particular. Is that still holding up?
Yes, absolutely. I think the income tax cut for middle-income households, which happened last year, was one step to increase demand. Then there was the GST reduction. Combined with the excellent economic growth in India, demand was really booming through the Diwali season. And I think thanks to many of these measures, the economic growth is very good and demand continues to be strong going into January and in 2026 as well.
So what does that mean in terms of your plans, both ICE as well as EV?
I think it means double-digit growth for the industry, and hopefully we'll continue to grow faster. And I think ICE and EV are both growing very well. ICE demand has also been very good in the last 1 year. Many of the customers are upgrading into premium segments. Some of the scooter customers are also buying more premium scooters. So you are seeing growth of the premium sector in India on the ICE side, and of course more broadly on all sectors. And of course EV penetration will continue to grow. And EV demand is strong as well, both on two-wheelers and, as we spoke earlier, about three-wheelers.
Yes, let's talk a little bit more about the EV pecking order, which has seen a significant change with the large incumbents, you, Bajaj Auto, now at the top of the pecking order. So as leaders on the leaderboard now, do you believe that you will be able to fast-track EV penetration and EV growth?
I think we have consistently invested in a portfolio of electric vehicles over the last 5 years and even before that. So you have TVS iQube, you have TVS Orbiter now, you have the three-wheeler, you have the three-wheeler for delivery and the electric bicycles as well. We have a full range of electric vehicles. We definitely believe that the EV penetration will grow, and we will definitely invest behind it. Our focus has always been to launch products that are attractive and delight customers.
Yeah.
And I hope customers are, happy with it and continue to buy more.
Products that make money for you as well?
I think margins eventually in EVs have to come to a good level. It is improving already. Pricing of batteries and other components has come down. And I think with time, EV margins will be better.
What kind of time are we talking about?
I think in a few years' time.
Okay, that's all the time we have on this edition of Power Breakfast. Thank you so much for tuning in. Up next, of Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi. Morning.
Hi, morning.
Hi, morning. Yesterday you missed the cascading sell-off. Yeah, where were you? This is your sign that you can't leave closing bell.
What did you guys do?
400-point fall in a span, 300-point fall in a span of 1 hour. Unbelievable. You know, the way the levels were just being taken off.
That's right. You know, people very, very nervous now, wondering which part of this correction are we in, start or the end? You know, the hope is that we're closer to the end. But I think when you're putting money, you'll have to think, if I'm putting money today for the next 5-7 years, which is the asset class I'm going to look at? And then I think you get your answer out there. That's personally what I'm doing.
Yeah, time horizons in that sense matter. Well, let's just take it from the top then, right? In terms of what you need to know as we begin this new session. So basically, US came back, right? US markets were shut on Monday, so they came back after this extended long weekend yesterday. And they were down 2% on the S&P. The Nasdaq was down about 2.5%. So in a way, I mean, the sell-off on Wall Street is a bit of a catch-up to the turmoil that we've seen, especially in European indices, etc. So that's the change. WIX, the CBOE WIX, the volatility index hit the highest since it's done so since November. Precious metals rallied, gold up 2.5%, silver prices up about 1%. And you also had 10-year bond yields in the US, which went up 7 basis points to 4.29%. So basically, I mean, you know, the long-term 200-day moving average, the 10-year bond yield is taken that out. Now, the story actually started yesterday during Asia with the Japanese bond market seeing an absolute bloodbath. So the very long end of the bond yield curve in Japan, that is the 30-year and the 40-year, yields on both those tenors jumped between 25 and 30 basis points. Actually, both went up over 25 basis points. The reason, of course, is the snap election, which has been called, and both the ruling, the government in place now and the opposition, both are promising fiscal expansion, tax cuts, without, of course, finding the money for it as of now. So, and that is the reason why the market actually got very, very jumpy. And, you know, for a market like Japan to move up, a rates market to give a 25 basis point move, it's absolutely unheard of. And we're at, 4% kind of levels now, especially if you look at the 30-year tenor. The Japanese finance ministry actually called for market calm and you know, the usual kind of stuff. This morning, the rates market is trading much better, but they're not retraced significantly or anything of that sort. So I think the story is this, and then it kind of showed up in U.S. Treasuries. So U.S. Treasuries sold off, as I just said, 7 basis points higher on the yields, and then it showed up in equities as well. So but it began in right earnest with, of course, what happened in Asia. Now, this is largely a symbolic move. I'm just still with the bond market in the U.S. A Danish pension fund. It's not a very large pension fund. The way pension funds go, and that's the reason why I'm saying it's largely symbolic. And they openly came out and said that we're going to exit our U.S. Treasury positions by the end of the month. So there's this sell America, sell U.S. kind of trade. Some people have been talking about it. And I think this is, in a way, it kind of ties in with that. There was the other thing, right, which is the no Supreme Court ruling on Trump emergency tariffs once again. And by the way, now you don't have a date till the 20th of February. So 3 times now, no ruling. And by the way, some are of the belief that the longer the Supreme Court in the US takes to rule on this, the lower the chance that they are actually going to strike it down or partially strike some of these tariffs down. But anyway, we won't know at least until the 20th of February now. The big market-moving event, and it's not exactly, it's obviously not true that President Trump needs a stage to say what he wants to say and do what he wants to do. But nevertheless, he's essentially going to be standing up on that stage in the World Economic Forum in Davos and make a speech. It's our time, 6:30 in the evening. There's a Bloomberg story which says it's essentially going to be addressed at affordability and with an eye to midterms, lowering costs, etc. But will he talk about Greenland and some of the other hotspot issues? I think we'll need to see. And he could be he's always been market, not always, but he's been market moving in the past. His posts and tweets, etc., certainly have been. And I think in that sense, this is a risk to be watched out for. Now, just to come to our market, absolutely brutal sell-off. And by the way, it accelerated. Just look at yesterday's chart, right? Till 12 noon, nothing. And then 12 noon onwards, it just became like a one-way decline. 1,000 points in the Sensex, 300-odd points in the Nifty. Mid-cap and small-cap indices fell very sharply as well, between 1.5% and 2% each. The question is this: are we at the end of the fall? And there are those who believe that, yes, we are at the end of the fall. And think about it. The point is the Indian market has not done at least nothing. I mean, for the last year and a half now, whereas global markets have continued to rally hard. And we're in that same kind of phase, right? Too much supply from everyone. And there's only one buyer, which is the retail investor in India through SIPs and mutual fund investments. And everybody else has been on the other side. As with the global markets having had very strong performance, as they start to see a bit of a wobble, we participate towards the fag end. That's the argument to say that, well, we're at the end of this fall, not at the beginning here in India at least. It's not as if the market sees a ripping rally higher, but maybe it's not the start of a fresh one. Let's hope that is the case. Unless, of course, I mean, global. The only reason I can see if we see a large fall from here is if global markets start to capitulate as well. And we've not had US markets, for example, fall 10% for a while. And they're sitting on very, very substantial gains. So that is still a debate that is to be had. The other thing, of course, is if this is a big global flight to safety, look at the dollar, right? The dollar index, etc. It's not rising. Usually money goes back home, and home is dollar, and the dollar isn't moving yet. So that gives some comfort, not too much, but I think it bears watching. Supports, I'll just leave you with levels. For the Nifty, 25,318 is basically just the swing low that we saw. The last big swing low we saw, it's close to where we are. And then it's the 200-day moving average, which is 25,114. For the Nifty Bank, we are still above the 20-day moving average, which is 59,587. And there's that big intermarket divergence as well, right? Financials looking much stronger relatively as compared to the Nifty, which of course has been hit by names like Reliance and others as well. So that's the picture. GIFT Nifty gives you a quick sense of where we are likely to start. It's about 10 points higher. Very, very undecided. F&O positioning, stats, how are we looking? Nigel is walked across to the wall. Nigel, over to you.
Well, as you said, Prashant, the reaction is what we're seeing in global equity markets. But the problem or the reason was the yields both in Japan as well as in the United States moving up. And that's what's caused global sentiment to get hit a little bit. Coming back to our markets, yesterday the FI sold closer on 3,000 crores. But the DI buying, well, that more than offset the FI selling. So the FI selling was not that much to see the kind of fall that we saw in yesterday's trading session. So part of the fall yesterday, if you just pull up a chart, will be attributed to the weekly expiry because we fell off the cliff, particularly in the last hour of trade. But the FI sell number is not that much. But you take a look at the small cap chart. Well, stocks saw big selling in the final hour of trade yesterday, and there were clear signs of capitulation that we saw. The hope is that, we're moving towards the end of this phase and not the start. Otherwise, this mid and the small caps could be in for a harder knock. Mundo, the FIs on index futures, well, what did they do? They went ahead, they added close to 8,500 short contracts. The short positioning is at around 91% odd. See, the FIs, they're piling on the shorts, and they're getting follow through on the downside as well. So what the markets need is, the Nifty doesn't need to run away. It just needs to consolidate. They will not get follow through on the downside, and then you're hoping for a bit of a bounce. In short, this market needs to stop falling. If that's the case, then it's giving you some kind of hope. Otherwise, the bears are getting follow through on the short side. How's the positioning looking on index futures? Well, now you have the FI short positioning at around 2 lakh contracts. While the DIs, they are long at around 1.5 lakh contracts or thereabouts. Both these two at the highest that we have seen, extremes on both sides all the way since March 2025. The Nifty indicators are moving towards, the extremes. However, the structure is broken. And that's the problem for the Nifty. The PCR at around 0.7 odd. The Nifty RSI as well has slipped below that 30 odd mark, which sometimes suggests we're getting into that oversold territory at around 25 to around 30 or thereabouts. So both those two indicators are indicating we're towards the extreme. The problem is the structure. And because of that, the bounces that we see will actually get sold into. The options data comes up for you on the screen. You have the 25,300 call, well, fairly active in yesterday's trading session. Aggressive writing is what you're seeing. The premium coming down from more than 200 rupees to around 150 rupees. While you have the 25,000 put as well, that premium was holding at around the 70 rupees odd. So punching in that level, since there is some writing at around the 25,000 odd mark, you have the 200 DMA at around 25,100. That's the important mark. You don't want this mark to get broken decisively because now we're trading below the 20, the 50 DMA as well. So that's the important mark. Shouldn't get broken on the downside. Well, support comes in at around the 24,900 going by the options data. This band shouldn't get broken, otherwise in for a deeper gash. The Nifty Bank, as we said, well, that's been doing a relative outperformance. Yesterday it ended a little below the 20 DMA. This 59,000, 59,500 is important because the 50 and the 20 DMA come in that range. But otherwise, the recent low of around 58,500 shouldn't get broken. So you're hoping that you see a bit of a bounce, but I think first the market just needs to consolidate it, stop falling. That'll give bulls some kind of hope.
Got that. I think that is the big question, right? Are we towards the end of some sort of trend selling, or is this the start of a new downtrend, perhaps even in global markets? Are we going to see a bit of a reversal? James Knightley, Chief International Economist at ING, is now joining us on the show. James, thank you very much for joining in. If you look at just purely the market action, the price action yesterday on Wall Street, it appears to be, at least the consensus seems to be for now, that it's more episodic volatility driven by headlines rather than a prelude to a deeper crash. But the question is, because of Trump's policy uncertainty, are the fundamentals of the US economy in some way shifting? Can the fundamentals perhaps, result in a deeper correction that we will see in the stock market in the US after a very long period of resilience?
Yeah, well, there's a lot going on right now. So we've got the geopolitical uncertainty tied to Greenland and Denmark and the threats against Europe. And of course, you've got then the overlay of the economic uncertainty relating to that with these threats of tariffs and the potential re-escalation of a global trade war story too. And then on top of that, as you rightly said earlier, throw in Japan as well. There's fiscal concerns in Japan with new elections set for Japan, with the prospect of a fiscal giveaway when debt to GDP is already well in excess of 200%, at a time when, of course, there's also this idea that Europe could weaponize its holdings of US assets as well. So there's a fiscal dynamic, there's an inflation dynamic tied to tariffs, and a portfolio dynamic as well, tied to this idea that Europe could weaponize its $10 trillion worth of assets it holds in the US market. So, as I say, there's a lot to go on. So we are going to be really closely watching Donald Trump's speech to see if he does try to de-escalate. Certainly his team have been, Scott Bessent and co have been trying to calm tensions a little bit. But of course, the president tends to be a little bit bombastic. So we'll just have to wait and see what he says.
Yeah, and James, it's not as if there's great popular support domestically in the US, right, for this Greenland plan. So it may actually eventually just lead to some kind of a compromise. I don't know. I mean, but do you think he may use the Davos platform to de-escalate? I mean, and kind of the question is, even if he kind of comes out and says, well, we're all friends and we're the same side and et cetera, it may calm nerves for a while, but has the damage been done in that sense?
Well, there is a sense that would be the end point. Donald Trump will push and push and push until he gets what he feels that he can get away with. But of course, this time around, Europe's already been through this once. They've already thought that they had a deal in place on tariffs, then that's been ripped up to some extent in their belief. Is Europe going to be as willing to take him at his word on this? So there is this concern that this, may get worse before it gets better in terms of, the mutual pain, because that's what it is likely to be. We are seeing these concerns in financial markets, both in the US and in Europe as well. But if you put barriers to trade up as well, if these tariffs do come through and Europe does reciprocate in early February, then again, that creates more economic uncertainty for US and European corporates. And we already know that the jobs market is cooling quite notably in the United States, and that could see the jobs market lose further momentum. So there are some real risks here for the US economy and for the European economy as well. And that does, of course, feed through into valuations in both equity markets, bond markets, and the dollar too.
All right, James, so you believe that Trump goes ahead with these tariffs on the European Union and he doesn't chicken out this time, right?
Well, I think, it's also down to what Europe does. I think Europe is likely to be much more robust in its response this time around. They thought they got a deal. That deal has been seemingly discarded. And we now have the Denmark and Greenland element to it as well. So I think there is going to be much more reluctance within European leaders to just try and just sign anything. I think there will be much more discussions about a broader agreement coming through. So that just means I would suggest that the risk is this takes longer to come to a resolution, and that leads to more market uncertainty for quite a long period of time, I think, unfortunately.
All right, and we're only a year into Trump's presidency. 3 to go, so that's a long time. James, what are you making of the spurt we're seeing in gold prices? Just looking at a trend overnight about the past bull cycles that we've seen in gold. And it's rallied big time in the past. But it had these periodic 5, 10, 15, 20% pullbacks as well. This time around, there's no sign of that whatsoever. It appears it's telling us a bigger message, with regard to the dollar, getting weaker. And also maybe that risky assets are in for a bit of a tougher ride. Your take?
Yeah, I think that's right. I think also, historically, we would typically expect treasuries to be a safe haven, treasury yields are rising, the dollar to be a safe haven, the dollar is actually selling off as well. So the pool of, so-called safe havens, as it were, seems to be shrinking. And gold is certainly there. Even crypto, Bitcoin has historically been used as been viewed as a potential safe haven, but that's still falling too. So, as I say, the pool of safe havens has shrunk significantly, and gold and silver are reaping the benefits of that. And until we get clarity on the economic and geopolitical environment, there seems to be little to prevent further gains right now.
Got that. Thanks very much, James, for joining us. It's a pleasure, and we'll hope to catch up once we have the speech from President Trump later today, and whether he uses that opportunity to de-escalate in that sense. Hopefully, he does. Well, more global voices essentially is what we want to get you. So this is, from Davos, Blackstone's chief, Stephen Schwarzman, spoke with my colleague Shireen Banan, the top sectors to watch in India in 2026 and more. Listen in.
We'll continue adding companies at an accelerated rate because we'll have the monies to do that. In real estate, there's always exciting things to do as data centers are developing. There have been a series of announcements, as you know, of what people hope to do. We're one of those hope-to-do people also. We've already been building some. Whenever you operate with a country that's on the right track, there are always new opportunities that you didn't see. We did something in the money management business there. That's done really well. Something in the housing business, that continues to do well. So, India has a very stable political structure now, and it's doing the right types of things. So we're finding an increasing number of things to do.
Okay, well, one of the top voices in the global world of finance. Let's take a quick look at what's coming up here in terms of interaction. So 8:35, Devin Choksi of Devin Choksi FinServ coming up to talk about markets in some specific stocks. 9 o'clock, Nuvama's Abneesh Roy to discuss the latest developments in restaurants brand Asia. It's a story which we broke here. We'll also talk about US health results. 9:20, Kotak's Pratik Gupta will be a market master of the day. 9:40, Management of Engineers India will join us to talk about the numbers. There is the quarter gone by. Macquarie Capital's Kunal Dhamesha will be chatting with us at 9:50, talk about the pharma sectors, QSQT expectations from the quarter. 10 o'clock, Sunil Singhania will be our big market voice, and he'll talk to us about where markets are headed from here. Towards the end of the program, Lata speaks with the former past secretary and CERC chairman PK Pujari and Nikhil Negani of Bernstein on how Indian power discoms have turned profitable as a whole for the first time.
Time to slip into a short break, but we'll get stock specific on the other side. We'll run you through our top 10 segment. For the time being, highlighting the stocks. Restaurant brands Asia, Persistent Systems, AU Small Finance Bank, Credit Access, Grameen, They'll be reacting to positive news flow, while United Spirits, SRF, Mastech, IndiaMART, Bazaar Style Retail and Cupid will be reacting to negative news flow. Take that break, we get into further detail on all of these names.
Welcome back. Asian markets are firmly in the red as they begin Wednesday's trading session. Cuts of about 0.5 to 1% for the key indices. This is following the 2% rout that we had in Wall Street, where Wall Street suffered its worst single-day session decline since October of last year. There you have it. Taiwan down nearly 1%. The GIFT Nifty will also come up for you on your screen. But let's drill it down to stocks. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. But first up, let's congratulate Vivek, because the restaurants brand Asia story has played out. Take us through the details and what more has transpired in terms of the finer points.
Well, good morning. That's right. So in line with our news breaks, on November 24th of last year, as well as yesterday, what we've actually seen last evening is that Inspira Global, which is promoted by Ayush Agarwal, a part of the promoter group of Ajanta Pharma, is now going to go ahead and acquire a controlling stake in Restaurants Brand Asia. Remember, RBA operates the Burger King brand in India, and Inspira Global has QSR presence in India via the Chinese Wok as well as the Big Bowl brands. Now, what are the deal contours? First up, Inspira Global will infuse close to 1,500 crore rupees in Restaurant Brand Asia. 900 crore will be done via preferential allotment of equity shares and 600 crores through preferential allotment of warrants, both of which will be done at 70 rupees a share. The second step of this particular deal will be that they will be acquiring the entire 11.2% stake owned by the private equity Everstone Capital, and this will be done at a price of close to 460 crore. And lastly, given the change that there will be a change in the controlling stake, there was also an open offer that has been announced last evening. They will be looking to acquire an additional 26% stake in the company at 70 rupees a share. Now, MK Global has written on this particular deal. They say that the likely capital infusion goes ahead and significantly strengthens the balance sheet and should drive a re-rating. Remember, Burger King or RBA trades at a significant discount to its peers.
Okay, all right, Vivek, congratulations on that. The burgers are due. Thanks, Vivek, for that. Rima, but a couple of IT numbers came out. Persistent Systems, numbers look good.
Persistent numbers are fine. So the company's actually reported a strong quarter, a revenue growth of 4.1%, ahead of consensus expectations of 3.7%. The company's adjusted margins stand at 16.7%, again, higher than expectations of 15.5%. Reported margins and the bottom line has been hit on account of the wage bill. But adjusted margins are a beat compared to expectations. Now, what's interesting is the company says the reason for the improvement in margins is AI platform and tools-driven pricing model drove a 150 basis points increase in margins. But they went on to say that this will not be repeated in Q4 because any gains that they see will be reinvested back into the business. But AI platform and tools-driven pricing model driving a 150 basis points increase in the company's margins. They also went on to say that they're progressing on track to achieve their guidance of $2 billion of revenue by FY27 end and $5 billion by FY31. Numbers are fine, but the problem is in the case of Persistent is the high valuation. The stock trades at close to about 36, 38 times forward multiple, higher than most of the other peers.
Okay, all right. Thanks a lot for that, Rima. Hopping across to Mangalam, United Spirits. Mangalam, how are the numbers?
No cheers this time around for United Spirits. Why do I say that? Because one, volumes were below expectations. EBITDA was a miss largely because the company spent a little more on advertising, and revenue has been in line on higher realization. So if you look at the reported numbers, revenue is close to 3,700 crores this quarter. The street was working with a number of 3,650 crores, so largely in line. EBITDA 618 crores, the poll was 640 crores, so there's a miss. And that is a miss on the margins as well by about 70 basis points. And the net profit has come in at 529 crores versus a poll of 497 crores. Prestige and above, there the volumes have actually dipped by 2% as against expectations of 1 to 2% growth. And even the popular business volumes are down 9% versus expected 0 to 1% growth. The gross margins have improved and the realizations have improved as well. But the company spent 36% more on advertising and promotion this year as against last year. My sense is that because the festive season shift was in this quarter, maybe they had to spend a little more. So ad spend is a percentage of sales at 14% versus 11%, seeing some red because of volume disappointment.
Got that. Thank you very much for that. Gaurav, it's over to you on AU Small Finance Bank and Credit Access Grameen. How are the numbers?
Well, as if you look at the numbers for AU Small Finance Bank, they were actually great. And the reason being that if you look at net interest income, that increased almost by 16% on a year-on-year basis. PPOP, which is pre-provisional operating profit, that remained flat because OPEX was high. But at the same time, if you look at profit number, that increased almost more than 20%. And the reason being that the credit cost was low. So let's first talk about what were the key positives for this quarter. First, if you look at net interest margins, they have expanded almost by 25 basis points on a sequential basis. Now, this jump is one of the highest that we have seen in third quarter for the bank so far. Apart from that, if you look at credit cost, now that has improved almost by 40 basis points from 1.2% to 0.78% for the quarter. And at the same time, let's also not forget that the overall 9-month FY26 credit cost stands at 1.1%. Now, what is positive again is that management reiterated their guidance that by the end of FY26, the whole year credit cost is going to be 1%. So there is a further decline to credit cost is what they are suspecting. And at the same time, if you look at the other segments as well, MFI and credit card, both the segments, we are seeing some improvement in the asset quality. If you look at ROAs, now they stand at 1.6% and management also guides 1.8% ROAs in the coming year. So definitely good number here. When it comes to Credit Access Grameen, there also we saw improvement in numbers, and specifically these numbers when we are talking about is net interest margins and credit cost. Now net interest margins here expanded almost by 60 basis points to 13.9%, and at the same time credit cost that declined almost by 300 basis points on a sequential basis if you look at the annualized number. Now going ahead, they are also saying that the credit cost is likely to decline further, although in fourth quarter we may see the stable credit cost, and at the same time net interest margins will also have some room for growth. Remember the growth guidance for this quarter, the growth was just 8%, but they have maintained their guidance of 20% growth in loan book. So that is also something positive. So all in all, good numbers and at the same time positive commentary from the management. And on back of that, I believe if the market stays strong today, both the stocks can actually open in green.
All right. Thanks very much for that, Gaurav. Appreciate it. Well, SRF is the next one. Reported number. Sonal is here. Sonal.
The company reported numbers during closing bell yesterday and held a conference call later. The commentary did not put out a lot of positive comments as far as recovery is concerned. They spoke about persistent pricing pressure from Chinese competitors across some of the core product categories. However, they say that Chinese players will find it difficult to sustain at these levels, so they expect a reversal, but not very soon. As far as the agrochemicals segment is concerned, there was some positive commentary because they've started seeing some green shoots there, and they expect fourth quarter to be much stronger than the quarters before. But yes, there are tariffs uncertainty in the US markets, which may continue to create short-term volatility in the fluorochemicals business. They say in the packaging films business, they are seeing recovery both in BOPP and BOPET. However, they do say the business continues to be impacted by margin pressure in belting fabric, again because of Chinese imports and US tariffs, and management is cautiously optimistic on demand. So there's no commentary on further recovery that the management is expecting. Citi has a sell rating with a target price of 26.75. Morgan Stanley has an underweight rating. Even Jefferies has an underperform call with a target price of 26.40. So no commentary on recovery is something that the street might not like from the management today.
And Jefferies also points out, Sonal, that the stock outperformed the Nifty by 29% in 2025 on the back of the refrigerant gas strength. But today, as you pointed out, because of the conference calls, the company sounded a little downbeat about the recovery. The stock could be under pressure. A quick word on Mastech and IndiaMART. Now, IndiaMART's top line went up by 13.5%. Margins came in at 33.4%. And profits, though, went up by 56%. But the problem in IndiaMART has been the fact that their paying subscribers continue to deteriorate. And once again, in the current quarter, on a sequential basis, there is a drop in the paying subscribers. So that has been the problem for IndiaMART. Nomura has reduced call. They say there was an unexpected reduction in the paying subscribers. The company is experimenting with digital advertising, marketing, but because of this paying subscribers, they have a reduced call and they've lowered their PAT estimates by 2 to 4%. Jefferies, on the other hand, though, has upgraded IndiaMART to a hold. Not a buy, a hold, so maybe they see the risk-reward fairly favorable. Mastech, on the other hand, has reported a very weak top line. The company's revenues have declined by 5.5% on a quarter-on-quarter basis. There you have it, $102 million versus $108 million. So that is disappointing. Margin performance, though, has been very strong, 16.1%, and this is after accounting for the wage hike impact. So weak revenues, strong margins for Mastech.
Okay, all right. Thanks a lot for that, Rima. Well, hopping across to Mangla. Mangla, Nimesh had given us an insight that this was likely to take place. Bazaar-style retail, getting a big fund infusion coming in for Cupid. I'm sure you must be trying to figure out what kind of synergy benefits as well, but the street will not like it.
Well, it's very interesting because, 331 crore rupees coming in from Bazaar-style retail into Cupid. Preferential warrants convertible at around 328 rupees per share. Post-conversion, Cupid will hold about 11.3% stake in the company. Remember, Bazaar-style retail, the stock has, in this market, moved nearly 40% in the last 5 or 6 trading sessions, all the way up from 245, 247 rupees to about 331 rupees itself. And the conversion price is 328, 18 months from now. So maybe the street will see an adjustment for that, opening in the red for Bazaar-style retail. For Cupid, the interesting part is that, whether it gets the front that Bazaar-style retail has on the storefront, etc., to expand their sales in India or not. And from Cupid's standpoint, they get the leeway of 18 months as well. 331 crore, they pay about 75, 76 crores at the start for them to pay 18 months later. So it'll be very interesting to see where it goes. The street will find it unusual to start with, but synergies will be extremely crucial. Expecting some red on Bazaar-style retail, maybe a milder red or a slight green on Cupid as well, because the nature of the deal is very small as compared to their overall business.
Okay, well, Mangalam, thanks very much for that. Here's a quick recap of the top stocks that we're focusing on. So, Restaurant Brands Asia, Persistent Systems, AU Small Finance Bank, Credit Access Grameen, Cupid are some of the names on the green side, and with the negative news flow are United Spirits, SRF, Mastech, IndiaMART, and Bazaar-style retail. So we'll see how all of them open up. We'll take a quick break. We are back. We'll connect with Devin Choksi of DR Choksi Finserv with some fundamental conversation. Stay tuned. Coming up.
Welcome back. You're tuned in to Bazaar Morning Call. Well, let's get a couple of earnings then reactions on the show. We have J&K Bank. That's the first management on the show. The bank reported a strong set of numbers in the second quarter. The profit after tax, the deposits as well came in healthy, although the NIMs saw a slight dip. We're now joined by Mr. Amitabh Chatterjee, the MD and CEO at J&K Bank. Well, we're going to be focusing on three focal points. Quarter four credit cost to be negative, the ROE expansion levers for FY27, and what's the possibility of the QIP in FY26? Well, Mr. Chatterjee, good morning. Welcome to the show. Let's start with the third point. Are you going ahead with the QIP? Do you think you should be doing it at this stage? And if you could tell us, why do you want to do it?
Very, very good morning, and thank you for having me here. You have a point there. The numbers are good, profit picking up and likely to pick up further in the coming years, coming quarters. So, yes, we have approval from our board. We are prepared for it, but maybe not this quarter, maybe next quarter or the quarter after that. But we are looking at our steady credit growth. And based on that, we will be taking a call as to when to go for the QIP. Otherwise, we are ready for it.
So QIP most likely in H1 of FY27, not in Q4 of FY26?
Yes.
Okay. You know, the reason why we're persisting on asking this is because your valuations are less than, many of your peers. There is no immediate need for capital infusion. Your CRAR is about 15%. Your market price today is still lower than the QIP price of 2 years ago, which was about 107.6. So why push right now and dilute?
Very true, very true. You are right. And we will take a call based on going forward what we see. Since we have had a pretty good year this year, we had taken a call based on our numbers, probably third quarter or fourth quarter of last year, where we felt that we needed. But now at the moment, since the bank has been doing so well, we will take a call maybe sometime later, H1 of next financial year.
You know, Mr. Chatterjee, you mentioned that the Rural Infra Development Fund deposits will be maturing worth around 3,000 crores next year. And your PSL profile suggests no further need for fresh RIDF deposits. So over the course of the time, do you still think this QIP is required for the bank?
You have a point there. See, we were not in such a position earlier. We had introduced one product this year which gave us this position. All the previous years we were required to invest in RIDF. So in spite of the RIDFs maturing, but we still had to invest more on that. So now we are in a position, as per the PSL positions now, we have become comfortable. So the decision to go for a QIP was based on the past history what we had. But since we have done so well during this year, we still hold on to the decision, but maybe we will take a call sometime later.
That's right. You know, to be fair, you did take the board approval for QIP in November of last year. And as you say, things changed after that. What about loan growth? Very strong, 18%, but your guidance is only 12 to 15%. Why not up the guidance? And for FY27, how would loan growth look like?
In fact, if you remember in the last call itself, I had mentioned that the credit growth is likely to be 12 to 15%. The offtake was good, and we had made certain changes in our processing. So the bank really did well in credit growth. And the best part is the combination of retail and corporate has been equal. And the contribution from both our home territory as well as the rest of India has also been equal. So since we could achieve what we strategized in the beginning of the year, so at the moment, I think I'll still say that the guidance for credit growth will be somewhere between 12 to 15%. Maybe there can be an upside. That also depends on how well we can improve our deposit position and CASA, of course.
with more questions, but we'll leave it there for now. It's a pleasure having you with us here, bright and early this morning on CNBC TV 18, sir. Thank you, and good luck. That's J&K Bank with some perspective. We take a quick break here. We connect with Deven Choksi on the other side. Stay tuned. Welcome back. 15 minutes to go for the pre-open session. Hormuz is here with the big movers from yesterday. And, bulk of them on the downside, I imagine. Hormuz, so take it away.
Morning, Prashant. Yes, bulk of them on the downside indeed, and it was difficult to find stocks that were in the green in yesterday's session. But you start off with the index because that was the one that was in the spotlight all through the trading session. The top losers on the Nifty, Eternal being one of them reporting results today, Bajaj Finance being the other, Sun Pharma being the third one, all of them seeing trading volume significantly higher than their 20-day average. Eternal had over 8 crore shares that were traded, 3 crore shares was the 20-day average. Even Bajaj Finance had close to 1 crore shares being traded. Sun Pharma's volumes were 2.5 times its 20-day average as well. And you look at the delivery-based selling in all of these names. Eternal had selling with close to 1,300 crores, Bajaj Finance over 500 crores, Sun Pharma almost 600 crore as well. So significant delivery-based selling in all of these names and on significant volumes as well. Now, the one name that stood out in yesterday's session was Jindal SAW, and it continues to extend its gains for the second session yesterday. It was up around 17-18% on Monday as well. Now, over the last two sessions, that the stock itself is up around 21% compared to the broader markets, which are down around 2.5-3% over the same period across Monday and Tuesday. And even though there were shares worth almost 1,200 crores that were traded on Jindal SAW in yesterday's trading session, the delivery volumes were left a lot to desire because only 9.5% of those shares were marked for delivery. And lastly, Kaynes Technologies, it was the fifth straight day of losses for the stock. Has declined in 7 out of the last 8 sessions, but the declines have been on insignificant volumes. Now, the last 3 sessions, the volumes that you have had has been lower than than the 20-day average on each of the last 3 sessions. And even in yesterday's trade, 12.5 lakh shares were traded. The 20-day average is 15.5 lakh shares. And even out of those 12.5 lakh shares, 2.5 lakh shares were marked for delivery. And that too is lower than the 20-day average delivery volume, which comes up to around 3 lakh shares. Now, the stock itself has had a not so promising start to the year, down around 14% in the month of January, is Keynes Tech.
All right, Hormuz, thank you very much for that. Appreciate it. Devin Choksi is with us with his views. Devin, I mean, there's got to be a bigger question about the market itself, right? Because if you're trying to do something against the broader trend of the market, then more often than not, you're sort of whipsawed, and that's true if you're in either sides in that sense. So, what's the bigger kind of trend here? And the question is this the market kind of finally capitulating, bottoming out? I'm talking about India. Or are we just about starting to bleed? What's your sense?
Yeah, Prashant, good morning. I think the Indian markets included, we are basically victimized at this point of time due to the global actions. The currency dollar is basically, I think, coming under threat with most of the investors globally, including sovereign investors. And that's where probably I think they're trying to get rid of dollar assets. And that's where I think probably the collateral damage is getting extended to other asset classes, including emerging market equity. For force, I guess I think most of the global investors are selling out Indian equity largely to, I think, balance their portfolios in form of, I think, the dollar-related damage which is happening to their portfolios. And that's where probably I think technically the market is getting a little weaker compared to, I think, the fundamentals of the companies in the business. In fact, I think all of us squarely agree on one aspect. The business conditions in India probably has been, I think, extraordinarily robust at this point of time. Corporate earnings, I think, unquestionably, I think some of the best earnings that we are experiencing at this point of time. Unfortunately, I think due to this carnage which is happening in the dollar currency, and as a result of which, I think the collateral damage is extended to market like ours. You and me, I think, equally guessing on this subject as to till how long this will continue. We do not have the handle on it. But very unfortunate part is that I think we are still a victim of this situation. Our market should have possibly, I think, found out the way to not have this kind of, I think, situation. But unfortunately, I think that's not the case. I guess I think only patience is required at this point of time. Since the fundamentals remain absolutely strong and convincing, some patience is required at this point of time to hold on to your investments, good quality investments.
Well, that's right, Devin. I'm wondering, is it a valuation reset? Is it an earnings reset? Is it a sentiment reset? But patience will be the key. And, over the longer term, equities have shown that it's actually made you money if you get past these kind of turbulent times. You've got a few stocks, though, to talk about the event. So let's get straight to that. There are two large deals that we here at CNBC TV 18 were talking about. My colleague Vivek, he was on top of the Restaurant Brands Asia deal. And now we know the Ajanta Pharma promoter has gone ahead and, bought that stake from Everstone. What's the view? The burger market itself is very, very competitive. And in India, you always link a burger to McDonald's. So what kind of difference can they make? Any view on this deal? And then, if you have a view on the other one, which is a smaller one, the Style Bazaar as well as Cupid deal that was announced.
Good morning, Nigel. No, I don't think that I think immediately I have any view to offer on this subject, frankly. All said and done, I think any kind of acquisitions, I think, which are happening in this particular space is largely aimed at some amount of consolidations. I think that is what I would like to see. But how much it could possibly result into the impact into respective companies, maybe some more time required to analyze this aspect.
Okay, all right. So no big call on any of these stocks. It'll be interesting to see, how they react today, because Style Bazaar in particular is up, I think, 35-40% in a matter of a few days. Let's talk about some of the larger names, though, that came out with a set of numbers. Rima was telling us Persistent System. Those numbers at least look pretty okay. The growth was better than expected. We have seen that some of these stocks are not very, very cheap. But your view on Persistent Systems, or do you like something else from the tech pack?
So mid-tier IT companies are largely, I think, the victims of, I think, a higher amount of valuations. And that includes, I think, Persistent as well, in my viewpoint. I guess I think there is nothing wrong with the business. There is nothing wrong with the earnings, etc. And they're giving fairly good visibility for the future earning as well. Though I think we may not probably have to buy it because I think the valuations are remaining expensive. So it has been seen in case of L&T, Mindtree as well. I think there also we have seen the same situation. Mid-tier IT companies are actually, I think, getting corrected more on the valuations at this point of time. Maybe I think that process may continue for a longer period of time because we have seen a large part of the valuation building happening over the last 2-3 years, which is required to get corrected on time correction as well. So that's what I think we are likely to experience in many of these companies.
Okay, all right. Let's talk about a couple of other names. United Spirits, the stock has seen a correction from the top. All the alcohol companies actually have seen a bit of a derating. Post that sin tax that came in on ITC, or the duty hike that we saw, there's fears that something will be done even on the alcohol side of things. But I understand that's a state subject. It's not a center subject. Though the valuation derating is taking place. United Spirits came out with its set of numbers, and Mangalam told us not as good as what the street expected or worse than what the street was working with. Your view on the stock, it's seen a good correction from the top, and there is that IPL deal as well that's in the works. So your take.
So I think when the valuations are high, I think the reasons are going to be many to correct these valuations. I think there can be any other reason I think that one can apply to it. However, I believe that I think when the companies are putting it at significantly higher valuations, there is little scope for making any kind of errors. And that's margin of error, as we call it, as I think is not available in most of the companies. So yes, I think today the investor is desperately wanting to recover the losses. As a result of it, even some of the holdings which have been held in the portfolios by investors, I think are now coming under pressure. We are seeing across, I think, many other companies, the portfolio offloading is taking place in some of the companies which were up till now, I think, very convincing investment opportunity for some. I guess I think only the time correction could possibly now solve the answer. Maybe the price correction will be simultaneous, but I think time correction would be painful as I see it in some of these names.
Oh, yeah. I mean, Devin, I had a sort of slightly a strategy question, right, in your portfolio. And what happens is many times, people are they're watching. The market has been largely consolidating, right? The index, the Nifty, is still about 5% away from its highs, only 5%. But the damage, the median stock on the NSE 500 is down 25%. The median stock. It's not the average cut, but the median return now is minus 25. So, and then you get days like yesterday where there is much more significant damage. You kind of sort of lulled into thinking that, okay, it's a little bit of time correction and, let's ride it out, etc. Does it make sense to, and I've been saying this, and at least reflecting feedback from lots of institutional mutual fund managers, most of over the last 1.5 months, actually I shouldn't say most, but many have gone into large caps. I mean, just to hide, right? And maybe Nigel mentioned ITC. That's a case in point. It's got a very strong dividend. So you, in a way, also get paid to wait. Names like REC and many others, right? So is that would you actively advocate something like that? So you go through your portfolio, what you have, I mean, and be more active about it at this point in time. What's your sense, Devin?
Yes, I think for some time, Prashant, I think we have been, on this subject. And we always say that I think the large cap companies, which are large in size, of course, I think with profits as well, I think those companies are finding favors in the portfolios of investors, including the mutual fund investors, largely because of the fact that I think the valuation comfort is far more higher compared to, I think, their peers in the mid-cap and others, where I think the valuations have been actually, I think, factoring the growth which is not there. And as a result of which, I think those companies had to get corrected, which is now happening. The money is getting shifted out of some of the expensive mid-cap valuations company to the large cap companies, which are showing a reasonably good signs of, I think, growing at 15% plus rate of growth in their profit performance. And at the same time, I think they're available at compared to the mid-caps and small caps particularly, I think they're available at a valuation which is far more inexpensive, as I would call it as. So frankly, downside in the stock prices is less in some of the large cap. And you mentioned name of ITC. I think there are several other companies, including likes of Reliance, which has shown the character of, I think, showing 2 lakh crore of annualized EBITDA profit with this quarterly result. I would think that I think the money will smartly shift into some of the large cap companies. So the victims would be, I think, the expensive mid caps, I think, which are still putting at higher in premium valuations.
Okay. All right. Devin, well, we've got that. Thanks a lot for joining in and giving us all of those views. And Devin, we got a compliment coming in from one of our viewers. They're saying markets have done lots in the last few years, but Devin is looking absolutely the same. So kudos on that, Devin. That's a compliment that's come in on my personal message. Have a good day.
Thank you so much. Thank you.
Well, time to slip into a short break. Come back. We'll get the pre-open rates. We'll also connect with Nuvama's Abneesh Roy to discuss the latest developments in Restaurant Brands Asia, as well as United Spirits earnings. We'll also connect with our technical experts on the other side of the short break.
Welcome back. Over the last 15 days, the Nifty has lost in excess of 1,000 points, and in the process has also broken multiple support levels. Yesterday, we managed to hold on to that 25,200 mark, but precariously close to our 200-day moving average. The GIFT Nifty for now is implying maybe a flat with a positive bias to begin trade with. Best time to introduce our experts, technical experts Sudarshan Sakhani and Mitesh Thakkar on the show and get a sense of how we might open up for trade. Gentlemen, good morning. Thank you very much for joining in. Are we closer to this make or break level, 25,000, 25,100? What's the sense from here on? Mitesh, go first.
Yeah. So, good morning. I think the first level, and a very important level on the weekly chart was around 25,400. We closed below that, so this is not a weekly closing. So in that sense, there's still a few days left to figure it out. But if we don't start getting past 25,400, my sense is that there will be some kind of a negative breakdown on the medium-term charts, and then while the first minor support is around 25,000 itself, there's a good chance that 24,500 broadly could be tested, and then we'll look at a further level. So for the time being, 25,400 is the level which I'm watching for. The put call ratio in the short term is about 0.58 or 0.59. I think that's extremely oversold, so pullback could happen. But as I said, the key on the upside is getting past 25,400 and capturing that level.
So till then, there's no trade, Mitesh, on the Nifty?
That's right. So till then, I would just wait it out and figure it out. We already have some put options on the Nifty, which are slightly longer dated options. So that is possible. But for the timing, I think, a fresh trade, I don't have a fresh trade right now. But in case you get closer to 25,400 on a pullback and there's lack of strength, then I think a fresh shorting trade will kind of emerge.
Gentlemen, morning, Sudarshan and Mitesh. Sudarshan, what about you? I mean, you've been, of course, asking to stay away, and staying away is what buyers are also doing at this point. What's the trade if there's one?
Yeah, good morning. See, the trade is to stay away. What happens is, Prashant, when we are sort of controlled by news, then levels are not important. There are no make or break levels because there is nothing to make or break. It is Mr. Trump who will decide it. I'm just saying it in a lighter way. So news controls the market. When that is happening, we don't try to buy the dips. We don't try to do bottom fishing. We do nothing but step aside. At some point of time, this market will say, okay, I'm forgetting about the news. I'm not going down anymore. We'll have to wait for that event to happen. It's too early. So stay away from the Nifty completely.
Yeah, stay away from the Nifty completely. Sudarshan, just one more thing, right? This, look at the Nifty Bank Index, right? It's still above the 20-day, whereas the Nifty is kind of breaking all kinds of levels. So there's a bit of an intermarket divergence. How is that useful to keep that on one's radar at all as an indication of whether this rises, that falls more? What's your sense?
No, you're quite right. In fact, the Nifty is at the verge of breaking its 200-day moving average, while the bank is not. You're right. So what this tells us is that whenever the market begins to show a signs of a rally, it will first focus on the banks. Not today, but whenever that happens, the bank will be the first to run up.
Okay, got it. Sudarshan, what about individual ideas, trades, stocks?
Well, Hindustan Zinc is my only buy with a stop under 665. There are short ideas, but you have to short them on some small rallies. PI Industries is a short with a stop above 32.25. Tata Elxsi is a short with a stop above 5,500. And DMART is a short. I'm pretty downbeat on DMART with a stop above 37.30. But sell only on small rallies.
Sell only on small rallies. Got that. So Hindustan Zinc is the buy in that sense. Mitesh, what about you? What are your stock-specific ideas?
Yeah. So I have a mix of buys and sells today. I think, clearly there is a chance of a pullback, so some longs have been considered as well. I would, sorry, just a minute, yeah. I would go long on Dalmia Bharat Cement. That's one stock which did well even in a falling market yesterday. So keep a stop at about 21.64. Look for targets of 22.60 or thereabouts on the upside. And Angel One, the structure is very good. It's had 2 days of pullback. There's a good support at slightly lower level. There's a gap over there. So Angel One is a buy with a stop at 2584 for targets of around 26.70. And on the sell side is Eicher Motors. It's given some kind of a breakdown. So at a pullback close to about 7,200, which is about 0.3% higher than here. 7,200, 7,210, sell with a stop at about 70-80 and a target of around 70-50 can be looked at. And similarly, Ashok Leyland, it's broken that minor pivot of 184, 185. So on a pullback around, say, 182 half, sell with a stop at 185 half for a target of around 175, 176.
Got that. Mitesh and Sudarshan, thank you very much. We'll speak again, but that's the view, the broader setup, which is also important because it's not just about finding the right stock here and there. You've got to be with the broader trend as well, and that's essentially what we're trying to decipher at this point. Rupee, of course, is the other problem point, right? 91.08. Just think about it. For years we've been kind of used to a very, very reasonable range. Used to be 20-30 odd paisa kind of range, broad range I'm talking about, not about daily or weekly ranges. And the RBI was always there in that sense. To smoothen out the volatility, at least that was the experience of the last many years. Actually, it was quite incredible. It was such low volatility that people and it turned out to be a big boom time for those in the forex markets. I think starting 2020, 2021 onwards. But I think now, of course, that all that is kind of in the past. You've got all this stuff happening globally. You've got some local headwinds as well, which is, I guess, making a big difference at this point. So 91.15 or so. So it's another 0.25%, depreciation on the rupee, which means its dollar rupee is appreciating, which means the rupee is lower compared to it. So that is the rupee as well. For foreign investors, remember, the reason why this matters is, if you are able to take a call that the rupee is going to be significantly lower, say by the end of the year, you buy now at this rate, at this dollar rupee rate, and then the rupee falls more, when you're selling and taking the money out, to the extent that the rupee has fallen, it leaves you poorer as a foreign investor. So that is the other, that is the issue why it's kind of linked with equities as well. So And the other, of course, point to note, it's all interlinked, is that FIIs themselves in equities have sold $3 billion this year, YTD, year to date. That's it, right? I mean, we are still in January. That is influencing, of course, what's happening. Not very much money coming in, dollars being taken out. And that, of course, is putting pressure on the dollar-rupee rate. More demand for dollars, less demand for rupee. So it's like a cycle. It's like a vicious cycle in that sense, which one hopes, is closer to some sort of a bottom rather than the beginning of another trend in that sense. Well, I think an acquisition is coming through. Satin Credit Care is they're up on your screen. They're buying Q Trino Labs. More later on this one. But the big deal yesterday, of course, is which we reported on, is basically confirmation of the CNBC TV 18 news break, is the fact that Restaurants Brand Asia, which is the operator for Burger King, has got a new owner. Is going to get a new owner. We'll have, and of course, there's also United Spirits numbers we want to talk about. Abneesh Roy is with us, Executive Director at Nuvama Institutional Equities. Abneesh, good to have you with us here. How would you read this, and what does it mean for Restaurant Brands Asia? I mean, since it listed, it's never had an up year. I mean, I think the year it listed, it was up. Otherwise, I mean, for the last 4-5 years, it's been just one-way slide. Does it change the trajectory for investors? What would you make of it?
Sure. Good morning and thanks. I'll first take United Spirits and then I'll highlight on the RBA. On the United Spirits, we continue to have a stance more towards staples rather than sin sector. So we have seen in cigarette and liquor the same issue, that both central and state governments are going for very high taxation. So United Spirits stock, we expect some more near-term softness, some more near-term correction, because Maharashtra has seen a double-digit decline, and that has led to overall EBITDA and volumes being soft. It's still a decent performance ex of Maharashtra, and Andhra is also coming to the base. So this quarter, if you see what has happened, Maharashtra will again remain an issue for at least 2 more quarters. And UK FTA is also delayed because it needs the UK Parliament approval. So long-term story remains good. IPL value unlock is also something which can happen. But near-term, I think United Spirits stock, even in Q4, will see weak number because of Maharashtra. So we continue to prefer Nestle, Marico, Britannia, etc. From a valuation perspective, HUL, Colgate looking good. Coming to RBA, definitely 3 things. It removes the overhang on promoter sale, because the entire promoter, that P stake sale, now that overhang goes away. Fund infusion of 1,500 crore is a positive. Plus, if you see Ajanta Pharma, the promoter group, it's not Ajanta Pharma, the company, the promoters do have presence in that space, so there'll be synergy benefit because they do have Chinese Vogue, Big Bowl, etc., and Momo company. So there'll be some synergy benefit from supply side and overall understanding. But definitely the 2 structural issues, which I think you also highlighted, that stock hasn't done that well. Those, I think, continues to remain, right? The margin profile is suboptimal. The positioning is again something, because the promoters were not that very much involved in the fundamental side, because that stake sale was there. I think now that concern will get addressed, that what is the positioning of Burger King, because clearly McDonald's is there and there are so many other options for consumer. So I will say it's a positive development, but next 1 year we'll see on the transition with the new promoter how that happens. The management churn, what happens. In the entire QSR space, we continue to prefer Jubilant Foods, but I think there is a challenge overall. In the broader retail space, we like Titan, and QSR will be underweight on the broader perspective.
Yeah, the stock is down 50% in the last 5 years. It was at 120 and now down to 65. So a lot depends on the strategy now of the new management and how they plan to use that fund infusion of 1,500 crore to expand operations. What are your estimates of growth for Restaurants Brand Asia vis-a-vis peers in the QSR space, and how are the valuations?
I think valuation is clearly quite favorable because the stock hasn't done well. If you see in terms of EV to sales, because that I think is a key metric, it's almost 1.5 times kind of multiple EV to sales. Yeah, margin profile and overall profitability has been disappointing, because clearly overall positioning strategy wasn't challenge. So I would say that yes, in the near term, some relief rally can come. But long-term structural issue of margin and positioning, I think that continues to be a monitorable. So we would prefer Jubilant Foods. Yes, near term, I think the Q3 will see the GST 2.0, that benefit come into place and festival benefit. But in that space, I think Jubilant Foods is the best run company currently. But Burger King and RBI will be more of how the new promoters are able to have the synergy benefit and the positioning and margin challenge which continues to remain.
Yeah, no, absolutely. So in this space, right? I mean, it's generally a space, the QSR space, which is done very, very poorly across the board. If you look at price performances, anything you'd like to bet on, Abneesh, within the QSR space right now?
Yes, as I said, in the broader retail space, Titan is something which I think looks much more better. In the QSR space, yes, Jubilant Foods is growing faster than most other players. But again, there also, if you see broader challenges, there of too much of competition, right? Now with RBI also seeing fund infusion of 1,500 crores, they will again become aggressive both on discounting and store expansion. So net in QSR space, the competition and the e-commerce, quick commerce kind of a overall space that is providing more options to the consumer. So as of now, yes, Jubilant Foods is the best place, but we'll prefer Titan in the broader retail space.
What's in this Cupid bazaar style retail deal, Abneesh?
No, we don't cover that company, so we'll not be able to comment.
Is ITC a good buy at current levels?
Currently, yes, valuation comfort is high, and next 2-3 months, you will see the price hikes come in 2-3 tranches. The dividend yield is 5%. FMCG is seeing good recovery post the GST cuts, even in paper, the Birla paper business, etc. But issue is currently investors will not see a big trigger in terms of volumes, right? There is a volume decline which is going to happen, and it could be in the range of 5% plus volume decline for the cigarette industry because of such high taxation. So it's more of a valuation 1 to 2 years call you'll have to take. Can there be some bounce back? Yes, that is possible given the sharp correction. But there is the BAT stake sale. We'll continue to monitor the overall FI selling. So we'll continue to prefer growth stocks currently. So Nestle, Britannia, Tata Consumer, Marico are looking better. And even in the staples, other space like HUL and Colgate, we will see recovery in terms of business in Q4 because of the GST transition not being there. ITC more of a 1 to 2 year call someone will have to take.
Abneesh, we leave the conversation here for now. Thank you very much for joining in. 9-10 calls coming in now from our technical expert, Sudarshan.
DMART, consider going short in DMART with a stop above 37.30.
Mitesh?
Yeah, I'll go with the sell on iShare and would look at targets of around 70.50.
2 sell calls then at 9-10. Let's go across now to Sudarshan for the brokerage call of the morning.
Morgan Stanley has come out with a note on BHEL. It maintains the overweight call and increases target price to 304 rupees per share. It says the company should see 70% market share in the power segment and expects execution to improve and legacy contracts to be completed in the few quarters. And industry segment could see traction over transportation, transmission and the defense. Credit Access Grameen has seen 2 upgrades. CLSA has upgraded the stock to buy and target is 1450 per share. It says non-MFI mix could be higher than 15% FY20. And details of redesigned business model and strategy in the next quarter that it's expecting. Second, HSBC has upgraded to buy, increases target price to 1630 rupees per share. It says Q3 performance is underscored by margin expansion, sharp decline in provision, expects stronger performance in FY27 than implied by guidance, and has increased FY26-28 EPS estimates in the range of 7 to 13%.
All right. Got that. And so there's, I think, Morgan weighing in on the steel stocks as well, right? You want to take that up?
Correct. So Morgan Stanley has come out with a note on steel. It says it remains constructive on steel spreads expansion, and it has upgraded JSPL to overweight and increased target price to 1250, downgrade sale to underweight, maintains overweight on Tata Steel and maintains overweight on JSW Steel, and also says that domestic steel prices have received significant policy uplift, and China anti-evolution is in the medium-term. It's a medium-term theme, and global macro favors are also supportive for these companies.
All right. So thank you very much for that. Rima, you want to talk about Persistent?
Well, persistent numbers are fine, and this is a company which has been growing very well at 3.5%. This quarter, the company's top line growth was 4.1%. Adjusted margins came in ahead of expectations at 16.7%. That was a beat. And what was interesting is the company spoke about an AI platform tool resulting in a pricing benefit which boosted margins by 150 basis points. We'll try and get more details on that. Reported numbers on the margin and profits are looking a bit amiss because of the labor code. But the problem for Persistent is the valuations, because stock trades at 36, 38 times forward multiple. So higher than, say, a Coforge, higher than many of the large cap IT companies, even higher than, say, an LTI Mindtree, which yesterday sold off despite good numbers, again, because of valuations being 30, 32 times. Persistent is even more expensive.
Okay. All right. Just a couple of seconds to go for market open. Just counting down. And look at the Nifty in the pre-open, right? Another 90 gone, 380, almost 400 gone in the Sensex as well. So 25,140 on the Nifty, 59,400 on the Nifty Bank. The Sensex is at about 82,000. The small cap index is down about 1/3%, and the mid cap index will come up on your screen. It's 1/3% gone there as well. So Nifty is now flattish. We'll see if there's another wave of selling which hits, or is there any interest on the other side. But we're at 25,200 and tentatively so at this point. Nifty heat map gives you a quick sense of where we're likely to start. I mean, for what it's worth, it's just the first couple of seconds out of the gates this morning. But market breadth is deeply in the negative. But I think we should wait before we start to focus on it. Eternal, Sun, JSW are on one end, and you got Bharti, Aisha, Shriram Finance, which are on the other end, and you got 25 up and about 20, 22 down, and some stocks still opening up. So that's the picture at this point in time. So under 25,200 now, and a bit of selling emerging. We're down about 50 odd points. Rima.
Well, from the start of the year, the Nifty is down in excess of 3.5%, while the mid-cap index is down 4.1% in the last 4 trading sessions. This is the 3rd consecutive day where the markets, at least to begin with, have opened in the red. On the way down, Bharti Airtel is a drag today. That's down 1%. Year-to-date, Bharti Airtel is down 6%. This is a stock which has done so well. It's up nearly 150% in the last 3 years. So profits are being now taken where you are making them. ICICI Bank is another case, an example. Stock down close to about 3/4 of a percentage point. ICICI Bank selling off. IT continues to be on the back foot. You've got red to begin trade with Infosys, HCL Tech. Both these names are down 0.5%. TCS2 lower by 1/3 of a percentage point. BEL, Shriram Finance, Apollo Hospitals, Axis Bank, Kotak Mahindra Bank are some of the other stocks where you are seeing softness. 2 stocks, Reliance Industries and HDFC Bank, once again should come up for your new screen. They've been the big laggards in the large cap space. Reliance Industries opens flat, and so does HDFC Bank. On the way up, Eternal and Dr. Reddy's. Both these 2 companies report numbers later today, and there is buying visible in them. Eternal is up 2%, and Dr. Reddy's is up nearly 1.5%. In fact, a place to hide maybe the pharmaceutical index. The Nifty Pharma index is the only sectoral index for now. Actually, along with that, even metals now. Nifty and Pharma is seeing buying today. The Nifty Pharma index is up 1%. Sun Pharma, Dr. Reddy's, Cipla gaining close to about 1 to 2%. And the other pocket of strength continues to be metals, where buying is visible in JSW Steel. Hindalco should also come up for you on your screen. All in all, it's a flat start. So after 2 days of big gashes, the start has been on the quieter side and consolidating for now.
Quick couple of points, Rima. On the Nifty itself, we have gone down to closer on the 200 DMA, and normally the first time it gets visited, it gets defended. So we have bounced off that mark. A reference point today will be the 20 DMA, which is roughly around the 25,100, and today's day's low is around 25,130. So that's a crucial mark you'd want to defend. In terms of the broader markets, the breadth of the market is still weak, but it's actually it's improving a little bit. I'll tell you what, the first hour of trade could still be tricky because some of those MTF books could get squared off. Some kind of squaring off is what we'll see. That's typically what happens. And then maybe see a bit of recovery. So keep an eye out on that with regard to the broader markets. The good news today is some of these good earnings reactions, well, they are getting a positive reaction. Credit Access Grameen, Gaurav told us those numbers were good. The stock is bursting away. It's up close to around 6%. AU Small Finance Bank, that as well is doing quite well, in today's trading session. So good numbers are being rewarded, and those stocks are trading in the green. You have J&K Bank as well that's trading in the green. So pretty good going out there. The market is at least taking note of some good news. BCCL, like we saw yesterday and the previous trading session, it starts off in the green with massive volumes. Let's see whether or not it can hold in the green. A couple of stocks, though, have bounced up after seeing a big correction. MRPL, it's moving up on large volumes. That's up close to around 4.5%. So just keep an eye out on that particular name. And I think TBZ as well, that's another stock actually that came on the radar. That's up 4.5%. And the volumes are quite large on that name as well. So just keep an eye out on that. On the flip side, Jindal SAW as well as JTL, both of them did see a big surge in the last few trading sessions. They have come in for some profit taking. And it appears Shoppers Stop is getting a clobbering post its numbers. Stock down close to 10%. Net, a decent start to trade. Some consolidation, some kind of a pullback is something that the bulls would want. Not falling more is something on the wish list. Prashant.
34 points, right? I mean, it sounds like it seems like such a relief, right? So 80, 85 off the lows this morning, but it's just, I mean, initial rates coming through. Prateek Gupta is with us, CEO and co-head at Kotak Institutional Equities. Prateek, good morning. Good to have you with us here. You know, we've played around with that liquid oxygen analogy for a while, but it seems more liquid than oxygen now, Prateek. What's happening? And it's as I was saying earlier, right? I mean, it's a confluence of things all coming together at the same time. $3 billion of FI sales, and just this is early January still. Of course, that's leading to a pressure on the rupee, and that consequently, in turn, pressures the equity side. What's your sense? Are you getting a sense that this is global markets are going to crack now? Let me put it bluntly. We know what's happening here, but global markets have been very strong. 25 was a great year. Are you getting an overall sense that that is going to start to shake up a little bit?
Good morning, Prashant. I think that is actually the bigger issue globally, the overall global economic uncertainty, and more importantly, geopolitical uncertainty, given what's going on with policies around statements almost every day by the US president. And I think the key marker to watch for is global bond yields. Now, yesterday we had the Japanese bond market blow up. Japanese bond yields went up to almost 2.4%, almost double from where they were last year. And that's obviously caused a little bit of a mini earthquake over there. Imagine in India, if our bond yields go from 6.7% to say 13% in a year's time, what kind of impact that would have. So far, the Japanese market is holding up, but that's one big concern. Likewise, in the US, the big fiscal deficit they're running, the current account deficit. The bond market is what you really need to watch out for. So far, even yesterday, the US bond yields were relatively well behaved. All these bond yields have been moving up, inching up, except in Japan, where they've gone up very sharply. But in most other markets, it's been somewhat stable. And also, I think the broader issue for India still remains that India is still seen as neither a high growth market in the current environment, nor are we seen as a cheap market. And we don't have any AI plays like the US or China or Korea or Taiwan. So we're sort of in nowhere land right now. And that's what's unfortunately leading to the persistent FII selling, which we've been seeing $3 billion this year, already in the first 20 days of January. And last year was $18-19 billion. And that trend, unfortunately, doesn't seem to be changing for the time being. So we are in a little bit of I would call it a cautious space right now. We're at the bottom end of the zone. But I think globally the bond yields is what you need to watch for. And the other thing I would also mention, by the way, is the commodity space. That's obviously also we're seeing a pretty sharp spike up in commodities, and that trend we think will continue, which is also unfortunately a little bit negative for India.
Yeah. So we ask you what's the pipeline for deals and IPOs and QIBs. Is the pipeline for FI? I mean, you'd get a sense, right? You're talking to on your desks, etc. You get what's the interest levels one way or the other. Is there any interest from foreigners? No. I mean, it's just still sales interested in selling more. I mean, is the pipeline large, big? What's your sense?
Yeah, the pipeline is very large, obviously, even right now. A lot of issuers, whether it's the PE funds or the promoters who are looking to cash out. And there are some large deals in the pipeline. Some of them are in the public domain. For example, the NSE is talked about getting its NOC from SEBI. And there are many other such large IPOs in the pipeline. So some of these large IPOs are likely to attract a lot of foreign investor interest, obviously subject to valuation pricing at that point in time. But bulk of the IPO demand is still coming from the locals, somewhat limited interest from the foreigners. So that trend hasn't changed. But is the pipeline strong? Yes. Obviously, valuations have adjusted down compared to where we were, let's say, even back in October, November. The valuation expectations have come down, and the buyers, the local mutual funds, the local insurance funds, etc., they've become a bit more discerning, a bit more demanding on valuations, and that's obviously there's a little bit of negotiation that goes on between the buyers and sellers, but that's going on. But we've seen prices come off a little bit, and that trend I think will probably continue given this environment we're in.
But Prateek, do you see fewer deals coming to the market because valuations have corrected or readjusted? The market sentiment has been hit so hard. So the pipeline is strong, but are companies pushing back on their plans to hit the capital markets?
No, at least as of now, no, because we are still seeing companies pushing ahead. We are still seeing, the filings taking place with the SEBI. So far, no. But yes, if this continues and the environment worsens further, then yes, there could be a risk. But as of now, no major pushback, no delays. Obviously, you'll have the odd one or two companies here and there which will be delaying their plans, saying they're not happy with the current valuations. But most of them are actually, as of now, proceeding with their IPO pipeline.
Hi, Prateek. Good morning. Good to see you. And Prateek, the next big event is going to be Budget 2026. Any hopes out there? Because otherwise, you don't know what Trump's going to do next. TACO is not existing for the last few months. Otherwise, at least he was backing out after announcing something. Some hopes in Budget 2026. Your expectations?
So I'd say, Nigel, the good news is expectations going into this budget are relatively low. There is not that much room for fiscal stimulus. Maybe, if anything, the government needs to reduce its central fiscal deficit a little bit by maybe another 5-10 basis points in FY27. We've already run out of monetary stimulus. At best, you might get another 25 bips of a repo rate cut. So expectations going to this budget are low, but we think actually there is still a lot that could be done in terms of what I call a governance stimulus. What that means is things like deregulation, simplification, fixing things like in the inverted duty structure and so on. The one theme I would highlight, and this goes back to Prashant's point earlier about the rupee, I think the rupee has come under pressure. Our forex reserves have been coming off, and frankly, these are not our own reserves. India doesn't have a current account surplus. These are, frankly, someone else's money. We are holding all the FIs and FDIs and so on. So I think watch out for steps which will be supportive of things like exports, import substitution, getting more FPI flows into the country, getting more FDI into the country. This could be whether it's tinkering around with foreign limits, or maybe they do something for capital gains tax for foreigners, something, whatever. But basically, watch out for steps which would be rupee supportive and positive for capital flows into the country.
Prateek, if this Trump policy uncertainty persists, we still don't hear back from a Supreme Court from the Supreme Court about whether Trump's tariffs are valid or not under IPA. And this unpredictability flip-flop continues. If that is the base case for the next 3 to 6 months, how do you think global markets, US markets, emerging markets, and India markets in this context will perform or behave?
So firstly, at least based on our conversations with various global experts, they believe that the US Supreme Court, even if it reverses the Trump tariffs, they'll figure out some other way to continue with the tariff regime. So that should be maybe just a temporary relief. They can always come out with some other law in the constitution and pull that out to use to impose tariffs on various countries. So, or they can pass a new law. So that may be just a temporary relief. So the base case, it probably is going to be that you will see higher volatility across the globe. And that also, therefore, I would argue that India in that context is relatively, I would say, given that we have already corrected a bit and maybe a little bit more, but our macro outlook is still somewhat stable. Whether it's the the inflation is under control, growth is not great, but it's okay. It's 6.5-7% expectations going into the new financial year. Inflation is okay, like I said. Currency, hopefully the worst is over, and if the government can come up with things to attract more FDI and FPI, that may stabilize the rupee. And if we get these FTAs signed with the UK, EU, etc., that may help kickstart the export engine to some extent. So it's not going to be an easy environment for India. It is going to be a very choppy environment, which is why this year, I think from a portfolio strategy, we're recommending a somewhat of a defensive stance, be cautious, protect your capital first. Don't expect very strong returns in this calendar year, at least not until things, we get some more clarity on what's going on with the US.
Prateek, but overnight we had the EU chief talking about the deal with India will be the mother of all deals, with regard to India and Europe. How good will this be? Suppose we get that mother of all deals, but the father of tariffs is saying that the deal with India is not really happening. In this sort of a scenario, how do you see things playing out? I mean, so we have to thank God for small mercy, so at least we're getting a deal done with Europe. Your comment on that?
Yeah, as you said, I think the mother of all deals may be good, but may not be good enough until the father of the tariffs figures out, turns a bit more positive on India. That's clearly impacting both local and foreign sentiment. So you need the father of all tariffs to turn more favorable on India. Until then, I think the EU deal and the UK deal, there'll be nice sort of lollipops, or not lollipops, I would call them nice, very good steps in the long term, but they'll take time for India to ramp up, our exporters to ramp up their exports to EU and UK. US is still the biggest market in the world, and if you're not sort of favorably well positioned over there, I think it's a problem. But I think, having said that, the EU and UK FTAs, all the other FTAs which the government is doing, the UAE, the Australia, and so on, those are very, very good steps. They will take time, but those are what the government those steps are very important for boosting our overall export engine and diversify away from the US, which, as you said, until the father of all tariffs turns more favorable to us, we have to sort of keep working on the other countries.
Just a quick one to this, Prateek. If you did a straw poll at Kotak, is the market price correction wise done? 5%, 10% more? Where would the majority land?
So as far as the large caps are concerned, I think we are almost there.
Okay, almost done. Broader markets? Yeah. Sorry, rushing you because we were rating.
No, I think mid caps and small caps, we think there's more downside. These stocks are still trading at a 30-40% premium to the large cap index. Valuation, the prices have corrected, but earnings have also corrected. We've seen earnings downgrades, and therefore small mid caps would still be a bit cautious.
Got it. Thanks very much, Prateek. Speak again soon. Thank you very much for joining us here on CNBC TV 18. Well, let's quickly get you the highlights, more highlights from the World Economic Forum's annual summit underway in Davos. My colleague Shreen Ban caught up with the IT Minister, Ashwini Vaishnav. It was a power-packed town hall with global Indian IT services powerhouse, TCS, Infosys, Wipro, and the top bosses at each of these companies. Listen in.
The India AI mission has an allocation of a little over 10,000 crore rupees. Separately, you, of course, have the semiconductor mission, both of them running in parallel. As you look at the AI tier cake today, where do you believe India is best poised, best positioned, and what will be the next steps in this journey?
The AI stack basically has 5 layers. The application layer, which is where the AI would be used. Second is the models layer. Third is the semiconductor, the chip layer. Fourth is the infra, data centers, and fifth is the energy layer. We have to play in all the 5 layers, given the size of our economy, given the way our country and our people are so tech savvy, the way our people have adopted technology in the past, the way our IT services, and all the three big leaders, top leaders from the IT services are present here. They have been providing services, IT services to the world. So I think, and we are at this point of time working on all the 5 layers. Of course, our very big focus will be on making sure that our IT services companies, they keep that momentum and they provide the AI-enabled services to the world.
Kriti, let me start by addressing the issue with you from the lens of what TCS is doing. And you aspire to be the world's largest services, AI services tech company. But from your own lens, as well as the imperatives for India, what should the next chapter in our AI journey as a country look like?
See, if you look at from what the traditional lens, most of the Indian companies are good at, the traditional services companies. I agree with what the minister said. Like he talked about the 5-layer approach, and what in TCS we call it the infrastructure to intelligence. There are multiple layers from infrastructure. There is a model layer, there is application or the agent building layer, and the experience layer on top. And while many of the IT companies in India have not built their own models, but we should not lose fact that the value actually comes in understanding the business context of our customers, ensuring the data for our customer data works for them. And I think that's our core capability. And most of us are focused on that, and you'd see us delivering value from that.
So there's going to be no change. You're not going to go the LLM way.
I'm not saying there won't be change, but don't underestimate what we are doing. We somehow seem to underestimate or brush aside saying, you guys are not doing models, so your legacy. No. What we actually do is making a real for our customers. Model is one component, but making the models work and work for the customers is the most important. That's where the value is.
Well, speaking of value, and to Kriti's point, there was a lot of gloom and doom around the fate of the Indian IT services sector and what AI could potentially do. But each one of you in your conversations with me have said you see this as a tailwind, but you also see this as a reset. Salil, talk me through what this reset is likely to mean for companies like yours, but more importantly, for the sector and for India at large.
So I think AI is genuinely something that is changing both our company, but the industry and India. What we see are huge, large value creating pools of opportunity. There are 6 of them that we've identified. For example, there's a whole set of work on AI engineering. There's a whole set of work on software development and modernization. And those combined have a large value that all of us, all the industry, for the benefit of India will enjoy. And those are growth vectors that we see coming in the coming years. Yes, there are other places where we see some shrinkage, but this growth we see over the next several years compensating for it. So there are practical examples, as Kriti was saying, as the minister was describing, in terms of where we can help global companies. For example, if you're doing something on modernizing the infrastructure, those things were not affordable for companies in the past. Today, with agents, they will take less time, less money, and those become much more affordable, and we are starting to work on those areas now.
Rishad, just to take that forward, because I think the question that's being asked today is, what is it going to do, not just for global growth, but what is it going to do for growth in India? What kind of tailwinds does this provide? And more importantly, the ROI question as well, because, significant investments are being made. What is the realistic return on investment period that we're talking about?
So first of all, Shreen, I think the way you should think about the services industry is any technological change, I believe is good for the industry, because to make that technology relevant inside of large organizations that are complex and messy, that have legacy, that have data that doesn't speak to each other, that's not organized, that are buying companies, that are spread out across the world, you need partners to make that happen, right? So the opportunity for both India as well as for companies in India is to really take this and make large organizations adopt it, right? To Kirti's point, to make it be adoptable, you have to move from these general purpose, highly plateauing LLMs to be highly contextual, to understand the context, to understand the domain, to understand the workflow, to understand the data, to bring it to life on scale. And I think that's a huge journey and an opportunity for companies like us, all the way from thinking about the AI advisory story to all the way to making it real, right? With a very strong DNA of having safety and trust and strong governance, fairness, lack of bias, etc., and change management, very implicitly a part of the DNA of the process as opposed to an after-the-fact element. I think India separately also has a huge opportunity as a country to demonstrate scaled adoption with speed, showing it in many, many specific areas, right? Areas of education, healthcare, governance. So there's a huge opportunity both to take this story, to take all the infrastructure investments that have happened and to make it be consumed both with India as a story, as a market, but also us taking it to our global customers. And so I'm quite excited as to how this journey unfolds over the next 3 to 5 years. It's also a question of how bumpy it can be. And maybe it can be a little bit bumpy, but there's a huge opportunity. The last thing I will mention is just the element of talent, right? We've been a talent destination to the world for the longest time. And I think there's a huge opportunity for us to continue being that talent destination with AI. And our investments, both as companies, but as a country, will be incredibly important to keep that differentiation because there is no progress on AI without the right relevant scaled skills around AI.
Very interesting conversation there. But for now, it's time for a break. On the other side, we'll be joined by the management of EIL to discuss their business outlook as well as the big order win that the company won in Nigeria.
Welcome back. Let's turn to the corporate part of the show then. We have Engineers India. That's the next management on the show. The company recently bagged an order from Nigeria's Dancourt Group for refinery expansion. The contract is valued at around 3,200 crore rupees. To discuss this and more, we have with us Ms. Vartika Shukla, the CMD at Engineers India. Well, ma'am, thanks a lot for joining in. Just highlighting to our viewers first what we're going to be focusing on, the order book breakup, domestic versus exports, the 20% growth guidance, is it intact for the coming fiscal? And diversification beyond the oil and gas space. Well, appreciate you joining in, ma'am, and congratulations on this big order. Give us a few details, though. What kind of margins will you enjoy on this order? What is the timelines as well? And revenue recognition with regard to this order. Please go ahead.
Thank you. It's a pleasure for me to be on the show and share one of the most significant milestones that our company has achieved on a global platform. We have actually built the first train of the Dangote refinery in Nigeria, which is about 650,000 barrels per day. And based on the services we rendered, we have got the highest order in our history ever for close to about $360 million, which will entail the engineering, procurement, construction supervision, and complete project management for doubling this capacity from 650,000 barrels per day to 1.2 million barrels per day at that location. Additionally, we are also implementing at the same location for an order value of about $70 million, 4 trains of one of the highest capacities of urea, which is 4620 TPD per train. 4250 TPD per train. What it brings to India and to EIL is that we are able to export our services as a repeat client who values the technical excellence and the integral offering that the company has from concept to commissioning. It also has a time frame of about 3 years. So we see the revenue growth coming from this project execution for a period of 3 years or so. If you've seen our half-yearly results, we are already up in terms of our revenue recognition based on the previous orders that we have received in the last couple of years. And this large volume international order which we have puts us in the order inflow this year is something like 65% from international territories and about 35% from domestic sector. So we will be in times to come have a significant volume of international revenue in both the top line as well as the profits in the bottom line.
Okay, so 65-35 is the mix of the order inflows in FY26. Ma'am, what's the order book now? It was at 13,100 crore as of Q2, and the total order inflows that we've seen so far in FY26. And what could that number rise to as we close out this year?
Sure. So we did a record order inflow last year of about 8,214 crores. This year, as we are still having about, about 2.5 months to go, we are already touching 7,600 crores of order inflow. Please also remember that these orders, international orders, are in dollar terms, and they would commensurate, they will convert to rupee terms with the fluctuation of the currency. But today our order book is an all-time high. We've broken all records. It is close to about 15,800 crores as a total, with about 40% of our order book as of now from international territory.
Okay. You said this order, this large $360 million order from Nigeria will be executed over the next 3 years?
Correct.
Right.
Correct.
So for FY26, you still have about 2 months to go. What will be the contribution? And is there a case that you will beat your own guidance of 25% on the top line that you had shared?
So these projects are long gestation in the terms of execution. It's typically 36 months to 40 months is what we would see as we go forward. And it follows a kind of an S-curve in its execution, wherein it is in the initial stages when the engineering work happens, we don't have much of ordering and, CapEx commitment happening in the first 6 to 8 months. So we see for the next financial year, it converting substantially to the turnover. In this financial year, it will be a modest impact in the turnover, and the guidance we have given on a 25% uprise in the turnover in comparison to the last financial year is maybe marginally up, but not significantly.
And since incrementally you are getting more international orders, what does this mean to your overall margins? Because last time you gave us a split between turnkey and consulting. But now as the mix shifts towards more exports, international orders, what could the consolidated margins look like?
When we work in the two segments that we do, largely the oil and gas complex mega projects, and also some of the other, chemical fertilizer projects, and the other segment which we do in urban solutions, infrastructure, etc. The margins depends on the complexity of the, projects. So we have already seen an upward swing in our margins in the half-yearly results that we had, shown last year. Last year, in fact, September 25. In the quarter, we had a margin of 11% in comparison to June of 7%. And on an overall basis, on the half year, we were up by 1% on the operating profits and margins. So we do see a very strong projection of a similar kind of margin in the overall, both the consultancy and in the LSTK, we are obviously more competitive and our margins are slightly lower. But consultancy segments, we've shown margins of about 25 to 28% very consistently over the last quarters. And this overseas segment, again, is a high value and high complexity project, which will definitely bring in a lot of skills which are valued much more than, the conventional LSTK or the some of the urban solutions that we offer. So we do see robust margins going forward, even though our international segment will be significantly higher than last financial year.
Thank you, ma'am, for joining in. That's Zubair coming in on EIL. Moving on now to our special segment, Quarter Se Quarter Tak. Let's get you up to speed with what to watch from the big pharma earnings, and it begins with Dr. Reddy's later today. Ekta?
Thanks for that. Well, pharma companies are expected to deliver steady revenue growth in Q3 aided by domestic formulations. EBITDA may remain muted due to the competition that we would see in the US. The US generics market has largely remained stable with the flu season providing support. High base for Revlimid generic, which is the cancer drug, is likely to weigh. The street is expecting a decline in sales for the likes of Dr. Reddy's and Cipla this quarter. Lupin is likely to possibly outperform on the back of traction in key products, while Sun Pharma's specialty portfolio is expected to drive US growth. Domestically, sales growth of around 8 to 9% is expected, though margins may be pressured due to the labor code implementation. Ajanta Pharma Eris is expected to lead with double-digit growth, while the likes of Glenmark, Alchem are estimated to post mid to high single-digit growth. In the CDMO space, watch for global innovators spend picking up. Divi's and Loris are expected to deliver around 15% growth, but do watch out for the margins for Piramal Pharma, which are expected to improve sequentially. Now, the key focus areas this quarter would include the obesity drug opportunities, US pricing pressure, onshoring of manufacturing in the US, the Biosecure Act, and progress on key launches. Let's leave you with a valuation table in terms of where things stand with regards to a lot of the pharmaceutical companies, with the likes of Sun Pharma, Dr. Reddy's, Cipla, a lot of them trading very close to where they were around 6 months to a year ago.
Thank you very much for that. Kunal Dhamesha, Pharma and Healthcare Research Analyst at Macquarie Capital, now joins in. Kunal, just beginning with Dr. Reddy's, because that's the first one off the block. As Ekta was saying, that US sales will be impacted because of the Revlimid base. That's known. How much of that will be offset? I mean, and is that already in the price?
I would say, it's definitely going to be lower sales in US on a sequential basis. Though I still believe that there'll be some tail end revenue coming from generic Revlimid in this quarter, and it will completely become immaterial in the quarter 4 of FY26. But there'll be some contribution. Now, it's very difficult to kind of pinpoint what that contribution is, but we are building some contribution, and that is going to still support the quarter 3 earnings. Over and above that, what we see for Dr. Reddy's is the other businesses, like domestic business remains strong, double-digit growth that we are expecting in quarter 3. Similarly, the other emerging markets like Russia and other emerging markets, there we are seeing a lot of currency-related tailwind. So on a year-on-year basis, let's say average ruble INR rate has depreciated by around 34-35%. So such a strong currency tailwind is also going to support the performance in this quarter, primarily due to the translation gain.
All right. Hi, Kunal. Good to see you. And just going to get back to this quarterly's expectations. But I want to ask you about Sun Pharma. These various reports are indicating that they are looking at a big bite in the United States, a possible $9 to $10 billion acquisition. What is your reading? For the time being, it's still in a bit of a flux. But if it does happen, then what's your take?
I think we'll need to look at what valuation it does happen and what strategic and financial rationale that company is looking out of this potential purchase. So it's difficult to comment anything at this point in time, but certainly going to be a big transaction if it goes through. But we'll look for more details.
Done at these sort of valuations, though, $10 billion, would it be, they're looking at too big an acquisition, or do you think we'll have to further see details and then only take a call?
I would look at more details and then take a call.
In all the pharmacy, back to Dr. Reddy's, I was just seeing the valuation plate that Ekta put up. It's the cheapest of the lot. FY27 PE is about 20.5 times, lower than Sun Pharma, 28 times. Cipla is closer to 24, Biocon 37, Lupin is close to 24. So in the pecking order, there you have that plate. Valuation-wise, which one do you think is most attractive or risk-reward is favorable?
I would say valuation-wise, a lot would depend on the post-Revlimid earnings on FY27 and how the GLP-1 opportunity plays out, especially for players like Dr. Reddy's, where I believe that Street is slightly more optimistic on what they can do on the generic semaglutide, especially in Canada. But we have seen some bit of disappointment on that front. With Canadian Health Canada issuing the notice of deficiency, and then their expectation of getting the approval, to be the first player in the market, could be questionable now. But we'll keep on monitoring this trend. But I believe, at least for Dr. Reddy's, probably generic semaglutide is where consensus expectations can moderate for FY27, and hence what valuation we see around 20.5 times. Could actually be higher with the lower earnings. So between the pack, I would prefer Lupin, which is where there's no generic Revlimid related cliff, and they have strong contribution coming from generic tolvaptan, which continues with a limited competition at this point in time. But it is a well-known fact, no one is kind of extrapolating that tolvaptan into FY27. So to that extent, FY27 earnings are de-risked, and even in the domestic business where they are one of the top player in anti-diabetic, I think they could be a key beneficiary of the GLP-1 genericization in India.
Interesting. Lupin, right? So I understand, Kunal, then out of in your coverage universe, Lupin ranks the highest as a conviction idea?
Yes.
Right. Do you have coverage on the entire CDMO space? I mean, companies there?
Yes, I do cover.
And again, I mean, that was seen to be as this secular theme. Is that road still clear? Again, which is the best one to play there?
Sure. So I would say after the Biosecure Act became law in the December, the biotechnology companies of concern is linked to the 1260H list, which gets published by the US Department of Defense every year. Typically, for the last 4 years, it has been published in the first 2 weeks of the January. We have not yet seen the updated list for 2026, but I think all eyes are on that list. And if the key Chinese CDMO companies are included, like WuXi AppTec, WuXi Bio, etc., gets included in those lists, then I think the road becomes much more clearer for Indian CDMO companies for the next 3 to 5 years, because they can see that incremental contracts, especially on the manufacturing side, which could increase the sector growth rate itself from low teens to high teens level, in my view.
Yeah, no, absolutely. And you have coverage in hospitals as well, right?
Yes.
Kunal? Again,
yes.
Best bet there?
So I have a cautious view on the hospital sector because the entire sector is entering into a strong capacity expansion cycle. So 8 large listed hospital currently has 40,000 bed capacity, and their next 3 to 5 year guidance is to add 20,000 beds. So they are versus that, in the last 7 years, these same 8 companies have only added 4,000 beds. So you see there is a 5 times capacity expansion coming in the next 5 years versus the last 7 years. Which eventually will get absorbed over the next decade. But I think initially it will cause some bit of drag on profitability, which is not well factored into consensus estimate at this point in time. And valuations for my coverage companies like Apollo and Max still remains well above their historical average plus 1 SD. And hence I remain on sideline for both these stocks.
Okay, all right. Kunal, appreciate you joining in. Looking forward to chat up with you as the pharma earnings do come in. Well, by the way, guys, just looking at the broader markets, a few stocks have seen a good recovery. Walchand Nagar, the stock was in the red. That's popped up in trade. So good recovery is what we're seeing on that name. Credit Access Grameen, that's the earnings reaction of the morning. Locked up close to around 10% as we speak. So fantastic move is what we're seeing out there. Supreme Petro as well, that's another stock. I think it was down 7-8%. That one as well has popped up. So there are a few winners. The screen is still looking very jittery. But from the lows, some of these stocks have recovered on decent volumes as well.
No, absolutely, and some of them are up on your screen. You mentioned credit access, and I think there's more. Maybe actually I can...
There's an upgrade on credit access. CLSA has upgraded the stock to a buy with a target price of 1450. HSBC has also upgraded credit access, where the target price has increased to 1630. So numbers are good, and then there are these upgrades.
It had actually rallied all the way to about 1500 late 2025, and then it had a very sharp fall back to 1200. But from the depths of, all the doubts around where this MFI cycle is going to, and the depths on this stock was around 750, 800 rupees. I mean, it is still doing very well, relatively speaking. So it's been kind of the winner, the highest quality name in the MFI space. Sudarshan is here with his, take on markets, which have had a weak start to 2026. I mean, 25 was bad, and 26 not exactly a good one either so far. So take it away.
So, well, if you had thought that after muted 2025, we would have a better start to 2026, well, that's not the case. It's the weakest start for Indian equities we have seen since 2016. Well, that's in the last 10 years. And it's the third straight year that we are seeing a negative return for Indian equities. And it's been just 13 trading sessions, and Nifty is down more than 3.5%. And this loss has led to BSE-listed companies erasing market cap of more than rupees 20 lakh crore. Now take a look at the move of some of the major indices. Nifty is down more than 3.5%. Same for Sensex. Nifty Bank has relatively outperformed its flat for the month so far. Major pain has been seen in the broader markets. Nifty Midcap Index is down 4%. Small Cap Index is down almost 6%. Which are the top Nifty losers? Well, 33 of 50 Nifty stocks have so far this month have given negative returns. And of those, 4 stocks are down in the range of 10 to 9%, and 19 stocks are down in the range of 4 to 9%. And top Nifty losers, ITC down 19%, Reliance down 11%, Trend down 10%, Geo Finance 10%, Wipro 9%. And if you take a look at the data of last 1 year, Indian market has been the biggest underperformer. In the dollar terms, it has given positive returns of just 4%. And if you compare Indian market with global markets, S&P is up 12%, DAX is up 32%, CAC is up 17%, Nikkei 33%, and same for Hang Seng. So we'll have to see how the next few days pan out, and it all depends on what kind of commentary we get from one man, and that's one and only Donald J. Trump.
So thank you very much. We could have ended that last plate with a picture. So 6:30 p.m. right is today, when he'll be making his speech in Davos at the World Economic Forum. Remember last year, I think there was a speech from President Trump, but it was, of course, made from the U.S. This time it is very much him leading the largest ever contingent to the US, to the World Economic Forum. So that is that. KPI green at the bottom of the screen, some numbers coming through as well. Siddharth Rai is with us with some technical trading ideas. Siddharth, good morning. Good to have you here. I mean, just the setup and what would you want to do?
Hi, Prashant. Good morning, and thank you for having me on the show, first of all. See, Prashant, if we talk about Nifty, there are 2 ways to look at the index right now. First, on a positional basis, Prashant, the structure in the index has been completely distorted over the last couple of sessions. And now I think that the room has opened for a move towards 24,800 and 24,600. So it won't be a good idea to be going contrarian and to be buying at these levels, even though the market seems to be oversold. But having said that, Prashant, in the very short term, because we saw an extensive sell-off in the yesterday's session, there can be a small short covering towards 25,300, 25,350. But that will only be an opportunity to take fresh short positions on the index, because as long as we're below 25,400, 25,450 in Nifty, the structure is very weak. And as I said, the room is open for a move for this fall to extend towards 24,800 and then 24,600.
Okay, all right. Not sounding very optimistic. If there's a bounce, maybe in fact it's a shorting opportunity, going by what Sid is saying. Sid, but individual stocks, they'll call for attention, right? Give us those ideas.
Yes, sure. Hi, Nigel. See, 2 stocks, and I think it's a good time to be having a balanced approach in markets. So one stock we have to buy, and the other one we have to short. The first stock which we have to buy is Tata Consumers. See, over the last 3-4 sessions, the stock has consistently tried to give us a breakout, but because of the overall sentiments of the market, it goes up and comes down towards the ending of the market. But I do think that eventually we'll see this stock moving to above the 1200 mark, and then a fresh momentum will begin. So Tata Consumers can be bought right now. The spot is around 1185-ish. We can buy it here. The stop loss will be at 1165, and our targets being above 1200. Just like I said, the first target 1220, the second target 1245. The second stock is L&T Finance, and this one we have to short because the structure looks very weak. There was a very important support in this stock around the 287, 288 mark. For the last 1 week, it was able to maintain the support, but today with a very, very sharp fall, this support has been broken, and I think this fall will be extending from here. So L&T Finance, we can go short on this one. The January futures are trading around 283 right now. We'll go short, and the stop loss will be at 295. And our targets being the first target 260, 260, and the second target 255.
Got it. Okay, all right, Sid. Thanks a lot for that. By the way, just keep an eye out on the bottom of your screen. We had a new listing, Amagi Media, listed, I think, at a 10% discount, but quickly that got bought into. Keep in mind, this is a issue that got oversubscribed by around 25 to around 30 times, on the whole. So a bit of a recovery is what we're seeing from the lows. And I think KPI Green, as Prashant mentioned, numbers look pretty impressive out there. Promoter entity as well has taken warrants, I think, at around 470 rupees or thereabouts, 1 crore warrants, just reading their last release. So that one as well has perked up. Numbers on a year-on-year basis look good. And the promoter issuing warrants as well had given some confidence earlier. Time is to slip into a short break, though. On the other side, we'll be joined by Sunil Singhania, founder, Abacus Asset Manager, to help us out with what's the perspective from the markets from here on.
Okay, welcome back. Markets, of course, trying to find some direction. It's been painful and a tough start to 2026. Well, we have someone who's seen markets across cycles. Sunil Singhania is founder at Abacus Asset Managers. Sunil, good morning. Great to have you with us here. Thanks very much for joining us. And of course, Sunil is someone who's also now launched a mutual fund. He's got a flexi cap running. He's got a liquid fund running. And of course, I mean, the IPO happened. The NFO raised about 2,500 crores on the flexi cap side earlier, towards the end of last year. Sunil, so, I mean, the question top of mind for many out there is simply this. Is this the are we close to a bottom, or and one can live with the ambiguous answer on that, but people are more worried about the second option, which is this the start of something bigger on the downside? How do you respond to that, and how would you answer that?
Good morning, Prashant, and very surely I think 26 has started off with a lot of news flow, a lot of concerns. And, obviously, on the face of it, things seem to be obviously very challenging and very stressful. But having said that, I think a lot of parameters are starting to show signs of, I would say, scare at the peak. The number of new lows which we hit yesterday was almost 750, 800. It's a good indication. I think 52-week lows after a not so great year, particularly for broader markets, point that a lot of investors are giving up and just throwing up stocks. On the other hand, on the global side, yes, I think this Trump mania has been reaching peak. But now I would say the good thing is that almost all countries have started resisting it. So, US is 25% of the world's economy, and maybe in the next 10, 15 years, that 25% will fall to 17, 18%. So I think now 75% of the world economy is almost in sync that, it is going too far. And I would say that that itself is, again, going to lead to a lot of other permutations being made. We heard the EU chief talk about the mother of all FTAs being signed with India. I think we have a budget coming in. The macro parameters are pretty steady and healthy. Balance sheets of corporates are pretty steady and healthy. Obviously, the external environment is such that growth is right now on the corporate profit front stuck at 9-10%. But looking at the scare and looking at the kind of views and news flow coming in, I would stick my neck out and say that, it's time now to start investing. In fact, last 1 week, we have been quite aggressive in investing.
Sunil, many have sort of shifted their portfolios on the institutional side to large cap heavy. I mean, some have openly said, well, it's time to kind of sort of hide, and if you can find high dividend paying stocks, you get paid to wait in that sense. Is that something you're doing as well, or I mean, just large caps versus mid cap, small caps? When you say that it's time to start to nibble and get in, where exactly?
So, Prashant, I repeat again and again, it's not about large cap, mid cap, or small cap. It is about stocks where there is visible profit growth and valuations are not out of whack. In fact, some of the biggest losers have been some very large companies. And, I think the last 10, 15 days also, we have seen so many index stocks fall by more than 10%. So it's not that it is only the mid and small cap. Yes, on the small cap side in particular, stocks had moved up significantly in terms of their multiples. And earnings have not kept pace with the expectations. So, selectively you see stocks having fallen more. But I would continue to say that, focus on companies where you have a little bit more visibility in terms of earnings and where you're not, paying like an abnormally high multiple to buy into it. There were a lot of momentum stocks, and, momentum is very pleasing if you're on the right side and equally painful if you're on the wrong side. In fact, there are so many stocks which people would have jumped to buy at these prices even 3-6 months back. But it always happens, a falling knife no one wants to catch. And I would say that even on the mid and small cap side, we are at least being a little bit more proactive and trying to see where we can get value in this, really fearful times.
Sunil, how would you characterize yesterday's price action, what we saw? There was panic selling. We almost thought there's capitulation taking place in the way the mid and small cap collapsed in the last 1 hour. Are people throwing in the towel? What have you heard based on what's the price action over the last couple of days?
So it always happens, I think investors wait, and then there a time comes when they really get fearful. And I think the call that time is that, kind of a scenario, sell what you can sell, at least create some cash. That always happens. I think it's the reverse in the bull market where you have 750, 800 stocks touch new highs and everyone wants to buy. I think we are on the reverse right now. We have so many stocks at 52-week lows and everyone wants to sell. So I think it's a phenomena. There is also a margin funding trades which get unwound, particularly in the first 2-3 hours, you have a lot of those kind of trades which are forceful selling, which you might see even today. I don't know, but it always happens. So it's a way of life as far as the markets is concerned. We have seen this kind of scenario earlier also. This time it is the entire world which is facing this mania, not on the equity side, but at least on the news flow front. Hopefully, I think sanity will prevail, and that might be the trigger which the market is looking at.
All right, Sunil, good to see you in, and good to hear your comments as well. Give some comfort to investors as well. The problem is the recency bias, right? What we saw a couple of years ago when the SMEs did very, very well, there was a rush out there. Now, in the recent past, gold and bullion has done well, and there is a bit of a rush out there. So if you're speaking to, say, an investor who's allocating fresh money today, and is looking at the bullion market and then looking at the equity market as well, what would you tell them? What would the advice be as of now? And also, since you're deploying money, could you give us the top 2 themes for 2026?
So one is, if someone asks me about gold and silver, I am very honest in saying that I did not predict the rise, the meteoric rise. So I'm not the person to go to predict what we should do right now. But again, as you rightly said, Nigel, there's a recency bias. And what has happened in the last 1, 2, 3 months, we continue to believe is going to happen going forward also. I think we have seen a crazy kind of move here. As long as there is scare and panic in the world, I think these are, safe haven kind of an asset. But from these levels, I would say the probability of going up and going down are maybe even. But I would be honest, I have not been an expert in predicting their rise up, so I don't think I'm capable to predict what is going to happen in the future. As far as our preferred picks is concerned, I think they remain the same. We continue to be pretty optimistic on financials. I think this is one sector where earnings have been pretty good, asset qualities are good, and visibility is also pretty good, not only in fund-based but also in non-fund-based financials. We continue to like Pharma. It's not done anything. In fact, it's been at the receiving end last few weeks. But I think, again, it's a sector where both domestic pharma as well as global pharma, the growth on the revenue front looks pretty good. Yes, there have been some concerns over likely tariffs even on the pharma side, which is suppressed price, but we would be quite optimistic there. And metals, I think the trade has worked well for us, but we don't go beyond 8-9% allocation to that segment because it's deep cyclical. But that trade has worked well for us, and it's to some extent insulated us from the pain we have seen in some of the other sectors.
Sunil, I know it's a unknowable, but 10 days out, we have the union budget. And lots of, because there is so much pain all around, the median stock in the NSE 500 is down 25% from its 52-week high, even as the Nifty is down only 5%, right? So, lots of chatter, talk amongst market participants. I'm sure you would have noticed on what, if some relief can be provided on taxation front with regards to equities, etc. But government revenues are also under pressure. That is also a fact. So how would you think about this, the budget, and should we expect any help at all? What's your sense?
So again, Prashant, I think this is the first time I'm seeing that no one is talking about budget, even though it's only 10 days away. And I think that is great because the expectations, frankly, are not there at all. And it's a good thing because, budget, frankly, from a tax change perspective has become less and less relevant with this GST Council and all. Now, on the income tax front, capital gains front, there have been some tweaking, and obviously the market did not like it when it was done. I don't know whether there is any thought there or not, but I would say that if the budget continues with its last 3-4 years approach on a more planned expenditure while maintaining fiscal prudence, I think that is what the market would be looking at. But the best thing is that because the expectations are hardly there, at least the possibility of disappointment is very, very low.
I think. Well, that's well put, Sunil. Possibility of disappointment is low, prices are down, sentiment is down and out. So we'll see what happens, but keep expectations low, and you perhaps may just get surprised on the positive side. Thank you very much, Sunil, for joining us here and talking to us. As I said, it's been a tough start to 26, but as Sunil said, and this is the time to look for opportunities, of course, very selectively, and this is not large caps or mid and small caps. Look for earnings growth certainty and, of course, some valuation comfort as well. Thank you very much once again, Sunil. We'll take a break. We're back on the other side. Our special segment is the Economy Ladha in conversation with the former Power Secretary and the CERC Chairman. We also have Nikhil Nigania joining us on this discussion next. Discoms as a whole have turned profitable for the first time, I think. So that's the focus, the key point. Ladha, up next.
Fly Emirates, fly better.
Welcome to It's the Economy. There is gloom all over. So I thought I'll cheer you up that at the grassroots, there's something positive happening in the economy, and that's in India's power sector. It starts the year with a couple of very big positives. First, Indian Discoms, for the first time, distribution companies, have collectively reported profits of 2,700 crores in FY25. This against losses of over 25,500 crores in the previous year, FY24. And if you go back up to FY14, it is, losses of 67,000 crores. Second, the government has passed the Shanti Act, or the Nuclear Power Act, which allows private nuclear energy production. Thirdly, experts are expecting that power demand will be far better in 2026 than last year's ultra-low demand. To get a perspective on the sector, I'm joined by two experts, Mr. P.K. Pujari, absolutely the best expert, former Power Secretary and former CERC Chairman, and Nikhil Nigania, an excellent power analyst from Bernstein. Gentlemen, thank you very much indeed for joining me. Mr. Pujari, this is very much your terrain, sir. I'm bowling a half volley to you. How is it that Discoms, which have been a curse of losses for the 3 decades that I've been a journalist, are suddenly reporting profits?
Morning, and I think extremely good news. And this is the culmination of all the efforts that have been put in by the government in terms of policy and regulations, and the discipline that has been brought into the governance of the Discoms. So extremely positive news. And hopefully, though of course we are talking about total gross collective positive for the Discoms, but there are also accumulated losses which has accumulated over the last few years. So now that this first step has been taken, I think the focus should be on 1 or 2 counts. One is that we are talking about the total profitability of the Discoms as a whole. So there are a few Discoms which are still making losses. So the focus should be on that. And gradually, the focus should be on wiping out the accumulated losses so that their balance sheet becomes positive and they can basically stand on their own strength on the financial matters. So it is a good sign, very positive outcome of efforts of last so many years both on part of the government and also regulators.
Okay. Do you know if there is anything in the works to remove the accumulated or lessen the accumulated losses as well? And what would your suggestion be?
It is a long journey. I think we are just starting to look at it. In between the various reforms or initiatives that the government has taken in terms of cleaning the balance sheet of the Discoms. A few steps have been taken, but I think the process should continue. But one thing, if you look at the numbers, the AT&C losses still seems to be on the higher side. So if the focus...
AT&C is 15%, sir, compared to, high 20s that we were used to a decade ago.
But the best ones, we can still reduce it to the single-digit figure. And that will give a tremendous scope for Discom to really reduce their losses, increase the profitability, and gradually basically wiping out the accumulated losses. Along with that, cost-reflective tariff. So tariffs should also be addressed, of course, factoring into the efficiencies of the Discom. So we can't pass on the efficiency of the Discom to the consumers.
That's true. Anyway, we now have the Supreme Court order asking that regulatory assets be reduced in 4 years. Hopefully, that will be of some use. Nikhil, does this start a virtuous cycle? The rating that Discoms got used to be uniformly, below BBB, going to C as well. I think only Gujarat GER's, the Gujarat Vidyut Vitaran was the only one which used to get an A rating. Does this start a positive cycle in terms of they get cheaper funds and therefore they are able to remove their historical losses also?
No, absolutely. I mean, I didn't think in my career I'll get to see Discom turning profitable on a cumulative basis. See, while the further details are still awaited on specific Discoms, and Mr. Pujari also, as he mentioned. So if you look at the four most loss-making Discoms, Tamil Nadu, Maharashtra, Telangana, and Rajasthan, we checked for the data in FY23 to now. Most of them, except Uttar Pradesh, saw a big turnaround. So UP is the only one which saw 11,000 crore loss even in FY25. Tamil Nadu, Maharashtra both reported profits. So to your point, it's a very specific Discom to Discom event. There is still a long journey to be covered. But definitely positive for Discoms, should help them get cheaper funds. And it's one reason why, if you look at companies like PFC, REC, their loan book growth slowed down because Discom needed lesser loss funding or working capital support.
Okay. I think I am older than you, and in my 30 years in journalism, I have not seen this phenomenon. And I have reported 2 cycles of NPA losses for banks, in which a sizable chunk came from the power sector, and power Discoms were the original mischief makers, although the people who defaulted were the power generators. So yes, I think you don't just upgrade the Discoms, you have to upgrade banks and people like PFC and REC who have given them money. Mr. Pujari, what about nuclear power? We only have the Act now, and it's a very big relief that liability has been, civil liability is now under control, reduced considerably. The recourse is not there to equipment suppliers. How do you see this panning out? When will nuclear energy become a source, an important source? Does it take a year, 2 years?
The good thing is that I think we realized with the renewable coming into the system, we need to also push for nuclear, because with the thermal and hydro capacity being limited, thermal has its own issues and problems. Good thing is that the private sector has been now allowed sort of entry into the sector which was totally controlled and dominated by the government of India. So it is a small step, and we still have a long way to go. In fact, I was talking to 1 or 2 parties who are interested in the nuclear energy sector. They are also taking the steps very cautiously and looking at how it pans out. And one thing is good that government has, in the Santi bill, what has been put in place is a very, very cautious sort of approach, and starting with like, for example, limited to operations and power generations, equipment manufacturing. So maybe with experience and with confidence building both on the part of the government to trust the private sector, and the private sector learning to work in a very, very, very highly regulated sector, how it pans out. I think we need to watch, and it will be a slow process, but it could bring. And we have taken that step for the first step.
Okay, and the other, I'm trying to squeeze in the other important issue. The CERC has told RE companies, renewable energy, in fact, all power companies, that you cannot reserve transmission unless you show us a PPA. And it clearly looks like Discoms are not signing PPAs in a hurry. They seem to have enough. Will we see bad loans in REs, or will we just see lower renewable energy, lower power generation this year, or new power plants this year?
I'll respond.
Yes, sir.
No, see, if the connectivity is basically also given on the basis of various factors, including the EOI. I mean, basically the intermediary like SECI or NTPC, they used to take out the bid, and based on the bid, they used to issue the LOA, and based on that, connectivity used to be granted. And it is
now that is not enough, according to the proposal.
Now, subsequent to that, these bodies used to have the PPA and PSS signed. Now, the PPA is not coming. So, I mean, you wait for the PPA and then connectivity comes. There are issues there. And of course, the counter is that in a situation where there is a transmission constraint and people have or entities have been given the connectivity and the projects not coming in, and this not really intentionally, but they squat on those connectivity space. It is a great problem. So what I presume that this will going to delay the projects, but there is a way out. If I can suggest something, like for example, UI has been given, and it is a responsibility of these bodies like NTPC and SECI to really get the PPA and PSA. Suppose you can specify a time. I mean, obligation on these bodies saying that within 3 months, 4 months, 5 months, you get the PPA. If the PPA doesn't come, these entities can be given an option saying that you want to bid the project and get out, fine, you are allowed to go out, or you go for the merchant power. I mean, basically, you take the risk, and same EOI, you can use it. So once that is there, I think there will be less confusion, and that we can bring in the concept of bank guarantee, saying that, okay, you finish the project in 3 years, 4 years, 5 years, and if you don't do it, then I'll encash your bank guarantee. So there is a sort of assurance that they will do the projects. I think there is a way to work around these issues to balance both the connectivity issue and the projects coming.
Okay. Well, unfortunately, we have to get back to market since it's a day when stocks are at 3-month lows. They are at October lows. So, Nikhil, would you have the courage to recommend what stocks people should buy at all in the power sector now that there is a seminal change in the quality?
No, absolutely. See, on the nuclear point, I think the beneficiaries are the biggest one on the generation side will be NTPC, who's looking to place a bulk order for nuclear power equipments. On the construction side, L&T, clear beneficiary. They are the ones building these nuclear plants in India, and these are massive projects.
Yeah.
So those two continue to be our preferred names, especially in a volatile environment. A company like NTPC could be a good place to hide. So those two are the ones we'll recommend most. On renewables, we remain cautious for the reasons you mentioned. Transmission is a big bottleneck, and there are other headwinds we see near term.
Okay. All right. At least we'll leave it on that positive note. Markets in jitters, but there is a cold wind blowing from Greenland across all markets. And the rupee is a particular victim today at 91.36 as we speak. Thank you very much, gentlemen, for giving us a shade of good news in what is otherwise a bleak financial setup at this point in time. We have to wrap up on Bazaar on that note. Chartbusters come back.
Earnings-led moves on the likes of United Spirits and Persistent Systems. United Spirits delivers a miss on margins and volumes despite a beat in profits. Meanwhile, a steady show in the third quarter fails to buoy Persistent. New labour codes dent both margins and profits. High valuations too weigh in.
And we told you first, and now it's confirmed. Inspira Global, the owners of Chinese Wok, pick up Everstone's controlling stake in Restaurant Brands Asia. Additionally, Inspira will also inject 1,500 crores.
Cupid announces a strategic investment of 331 crores in retail chain operator Bazaar Style via subscription of convertible equity warrants. Transaction priced at 328 rupees per share. Cupid set to hold 11% stake in the company. Both shares under pressure.
Credit Access Grumman, that's the start today. That, reports good set of numbers. Brokerages, they upgrade the stock following the good showing, both in margins as well as credit costs improving. While IndiaMART delivers a 56% growth in profits, the shares are up 2.5%.
Earnings disappointment drags shares of Shoppers Stop down by 6%. Exceptional losses dent profitability. Management marks uneven discretionary demand coupled with elevated pollution in the national capital for a weak show in the third quarter.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the Nifty actually has taken a bit of a nosedive yet again. So we're at the low point of the day. The problem today is that now we have breached the 200 DMA as we speak. And the other problem is the Nifty Bank. That was holding on to the 20 DMA. Now that's breached the 59,000 odd mark, which means it's trading below the 20 as well as the 50 DMA. Mangalam, but this is actually on expected lines. Going by yesterday's price action, the first few hours of trade are going to be difficult. Some margins as well will be, margin calls will be triggered. And there'll be some squaring off that we'll see in the first couple of hours. The hope is post 12:30, you see some kind of recovery. For the time being, there's a bright red all across the screen.
Take that point, Nigel. There is a fair amount of uncertainty, not just in our markets, but equities globally as well. And we see that with the kind of action that we've seen in the price of gold and silver as well. Typically, anecdotally, these moments of extreme high panic, etc., are actually the ones which do suggest that the market at some point bottoms out. Not to say that it may happen today, tomorrow, day after, but nearer to the bottom than we would have expected, largely because, there is a peak amount of fear, and that's reflected in the kind of move that we're seeing in the India VIX as well, 5.5% higher for that index. A bunch of triggers lined up ahead for Indian domestic equities to do a lot better. Let's see how the story pans out. But for now, we are taking as it comes for immediate market actions, globally as well as locally too. But amidst all of this, there are companies which are reacting to better than expected numbers, and one of them is IndiaMART Intermesh, reported better than expected numbers in the third quarter, even as churn in subscribers continued. Dinesh Agarwal, who's the CEO at IndiaMART, joins us to discuss the numbers, and we'll obviously focus on one, the fall in paid subscribers, the trend out there, the churn in silver tier subscribers, when does that normalize, and finally the outlook on collections and margins for the next couple of financial years as well. Thanks a lot for joining in. It's a good set of numbers after, many quarters of some sort of uncertainty around Mr. Agarwal. Interestingly, it also comes a few days after, an important fund, Nalanda Capital, has gone ahead and bought stake in your company as well. So maybe, good times continue is what the investors' bet is. But more importantly, we'd like to look at what the promoters' bet here is as well. The last time you joined us, you did say that subscribers should rise by about 2,000 per quarter. This quarter, they declined by 1,000. Could you explain to us, because it was of lower working days, or was it because of the silver price changes, silver tier price changes? And when do we expect this 2,000 subscribers per quarter addition to come by?
Yeah, I guided in the last quarter con call also that we have taken the price hike in the silver subscription from 28,000 rupees to 500 to 32,000 rupees. And we expected that next 2 quarters, the gross additions will continue to be a little subdued. And given that, we have received less number of gross addition, and that is resulting into slight lower net additions. And I believe that by the end of March, we should be over of that. And from the first quarter of FY27, we should be able to come back to that 2,000 net addition mark.
2,000 net addition per quarter, right?
Yes, sir.
All right, Mr. Agarwal, the other question is, these paid subscribers that we talk about, paid suppliers, do you think the market is saturated actually at around, say, 220,000 to around 250,000? And that's the first part. And the second part is, do you think that at some point of time you'll move to a transaction-based fee that could help your revenues in turn?
See, we don't see there is any saturation in the market as of now. As I said in the past couple of years that we have had certain blind spots which we corrected over the last year or so, quality of inquiry, intent of buyers, and you can see that repeat buyer percentage is increasing slowly and slowly. And as the number of buyers increase on the platform, I think there is enough demand on the supplier side to come on the platform. In fact, most of our gold and platinum subscribers are seeing higher amount of upsell and better retention rates in the current quarter. And that is why you see better collection from customers as compared to the 8-9% that we had for many quarters.
No, we take that point. And transaction-based is not something that you're looking at, right?
Not currently, yeah.
All right, not currently, so you don't rule it out entirely, but as of now, it's not on your plans. On gold and platinum, they're doing extremely well. I just wanted to know about the churn in the silver as well. Is the churn, the worst of the churn behind us, or maybe the fourth quarter we see a little more? If you could quantify that.
Yeah, I think the churn remains elevated at the silver level. There is no up or down in the last 3-4 quarters. We expect that since the changes in the buyer side and in the changes in the inquiry quality has been done in the past year, I expect that next year there should be some respite in the silver quarter churn.
Okay. What about the ARPUs? What does that move up by?
ARPUs are moving consistently. If you really see 6 to 8% historically also, and even this particular quarter, they are moving consistently up.
Got it. Give us a few more details, then, sir. What is the cash in your books right now? 2,500-3,000 crores?
Yeah, cash on the books is right now on the consolidated basis 3,050 crores, 51 crores to be precise.
So utilization will be interesting then. You have more inorganic plans? Or do you think you want to return some money to shareholders? Some investors have seen the stock half from the top. Now there's renewed interest, and you're signaling that maybe the next 2 quarters odd, you see a turnaround. Do you intend to return some cash to your shareholders?
We have been a good cash return. If you really see in the last 5 years, we have returned close to 1,300 crores back to the shareholders, and we continue to do that. Similarly, on the inorganic side, we have acquired about 600 crores in the Busy Infotech as well as in the life keeping. So 2 companies that we have acquired, and we have invested for the minority stakes another 700 crores. So I think we continue to trade cautiously on both sides while we are cognizant of the fact that there is an excess profit that needs to be returned to the shareholder as well as to be invested for the growth of the company.
Every time there is an excess profit, it has to be invested for the growth of the company as well, if not, returned to shareholders. So what avenues of growth are you tapping is what medium to long-term investors would want to look at, not just the next couple of quarters?
We continue to look at B2B opportunities in the SME sector as well as in the software SaaS sector. And we continue to see more opportunities in the accounting side, taxation side, HRMS side. So multiple avenues are there. We understand software well, we understand subscriptions well, and we continue to invest in that side.
Okay, just finally, to clarify this, you had earlier seen 10 to 12% growth in your collections for the full financial year. The third quarter, you've done about 17%. You stick to the 10 to 12% growth guidance?
Yes, I think this is first time we have broken after the 4 or 5 quarters. So let us wait for 1 or 2 more quarters for the trend. Otherwise, my guidance would be still 10 or 12 quarters.
And any early trends on, what the next year could look like in terms of revenue, margins, and overall growth?
I think given the we are on a run rate of about 400 crores collection per quarter now. So effectively about 1,600 crores for this particular quarter, 16 to 1,700 crores, and similar growth coming on the for the next year.
Got it, Mr. Agarwal. Appreciate you joining in. Wishing you all the best for the time to come. One of the few stocks that are trading in the green, IndiaMART, and Mr. Agarwal is sounding quite optimistic. An eye on the Nifty, though. We're heading gradually towards the 25,000 odd mark. We've reached the 25,050 mark. I'll tell you what, slip into a short break. On the other side, we'll focus on the new listing, Amagi Media Labs. That makes the debut. A little bit weakish one, but we'll understand. What about the business outlook from here on?
You want to talk business? Meet me in the On-Board Lounge.
The Nifty is under severe pressure right now, but what we'll do is we'll, meanwhile speak about the primary market action as well. In a market like this, obviously listings will make a big debut, and Amagi Media Labs listed with a discount of over 10% to its issue price. Bhaskar Subramaniam, who's the co-founder and MD CEO of the company, joins us to discuss the way forward for the company. Congratulations on the listing, Bhaskar. In an extremely volatile market situation where the Nifty is actually testing that 25,000 mark and mid and broad caps are seeing a wider sell-off, you've managed to list, but that itself is a milestone, a mild discount notwithstanding. What the street really wants to know from here on is the growth prospect for the business. The first half of this year, you've done margins of about 8%. That's shown some signs of operating leverage come by, and your revenues have compounded by over 30%. Do you think this 30%, 25 to 30% sort of rate is sustainable on the top line? And what's a peak margin for businesses like yours? Because SaaS margins generally are much, much higher than just this 8%.
No, thank you very much for having us on the show, right? So if you look at it, Amagi, as you know, is a media technology software SaaS company. And our business is global, right? So again, if you look at it, we're in a very early phase of the transformation of this whole market and the business itself. If you look at it, the biggest growth area for us is what we call modernizing to the cloud. All of the media business starting to move into become software-centric. So there's a big tailwind for us going forward in terms of what's the growth engine that is in front of us. Having said that, if you look at the last 2.5 years, the company has not only focused on growth, but and on profitability. It's always an and for us, if you look at it. So we balance both growth and profitability. You've seen us doing greater than 30% CAGR growth over the last 2.5 years, and yet demonstrate that the operating leverage of the business is starting to work. We see that as a continuing trend line going forward as well. If you look at any vertical software SaaS companies, eventually from a stable state standpoint, they're roughly anywhere from 20 to 25% margins. That sort of is the stable state businesses that has actually come through. And directionally, that's where we need to go as a company as well.
Okay, all right. Hi, sir. Good morning. Good to see you in. What about your geographic diversification? America and Europe are a big part of your revenues. I mean, almost all of it. Going ahead, how does the mix look like? And with Mr. Trump in office, it's just 1 year complete, 3 to go. Any kind of risk to your business?
Two parts, right? If you look at it, Margi's business is a global business. So essentially, every TV channel, content creator, of sports producer or news producer worldwide is our customer. So to that extent, it's a broad-based global business. Historically and otherwise, if you look at it, United States looks as the largest market today, even as a media business generically, not only for Margi, but as a media, the depth of the market is much, much higher. So roughly, we are mimicking the market's depth in terms of the percentage of what we see from a contribution for our business as well. Having said that, Margi has been kind of expanding globally. Over the last 18 months, we've expanded into Brazil, France, Germany. We've just started Japan, Korea, Australia. And of course, we see India as a large growth market over the next 2 to 3 years, for example. So clearly, there'll be a broad basing in terms of the revenue contributions across the globe. That's going to happen. Trump and the policies, obviously, we don't control. We don't have any sort of, and as you know, our business is not impacted by tariffs. And we continue to see the growth. Ours is a mission-critical software that every company in the world needs it. So to that extent, we feel we're immune to that sort of change at this point in time. And we don't get impacted right now. We don't continue to see any such challenges today. We don't outsource humans, people, services. We are a software technology company. We continue to see progress from here on. It's really about innovation, and the customer value that we bring is going to be core important for us in the next 2 to 3 years.
We take that point. You know, you did say that biggest growth area for you is the company modernizing the system to the cloud itself. If you could give us a sense of what the penetration is at right now and what the total addressable market here is, and what your potential revenue could be in the medium to long term out here. And I also ask this because while there is a lot of headroom, markets like India and globally, they're known to skip generations as well. So oftentimes when we look at a potential TAM, that gets negated by a new technology which has come in, and the need for that product or that service or solution itself being rendered futile.
Okay, I want to reiterate that Margi is the new technology that's changing things, just to give you context as well, right? So if you look at it, moving to the cloud and investing in AI and agentic infrastructure, that's where Margi is really spending its time and effort and money. And that's a reason for us to win the market today as well as we move forward. Having said that, if you look at it, for us, the market is, as I told you, global. And if you look at a TAM is roughly about $17 billion. Out of the $500 billion in media entertainment spend, $17 billion gets to spend on technology. Roughly 10% of that is actually moved to the cloud and new software. So the big change is in front of us. The biggest tailwind for us is the 90% transformation, out of which 40 to 60% transformation we're expecting to happen by 2029. So the biggest growth is in front of us, number one. Number two, if you look at it, AI is a big transformative force. Like every other industry, media is going to go through that as well. And Margi is very well positioned as a platform strategy, what we call glass-to-glass strategy, to really go accomplish this for our customers. We're already in trials with multiple different AI products for our customers, and we're very, very excited in the investments we're making and the change and the transformation that we can bring to the business. So we're kind of leading the technology change for the world in the media business, using AI as a big transformative force.
Okay. All right, sir. Appreciate you joining in. Thanks a lot for giving us that view. Wishing you all the best, and we look forward to having you on the channel yet again. By the way, when we're having that chat with the management of Margi, I think what was flashing on the bottom of your screen is important. Niket Shah, well, there's been a bit of a rejig that's come in on, in Motilal Oswal, so I think we should get that flash up for you on the screen. Niket has been with the group for quite a few years on, and now there's an internal rejig that's taking place.
Yeah, he was the CIO of Motilal Oswal AMC, and now has been transferred internally itself, and was instrumental in increasing the AUM by a large bit as well. But the street is taking note of that via a bunch of stocks as well. Some of the large holdings of the funds that he would manage directly included the likes of Kalyan Jewellers, which is now down about 10%, and from its peak it's down about 32% as well. So if you look at Kalyan Jewellers, it's now down 10% this week, down about 16%, and from its peak down about 35%. If you look at the shareholding of Kalyan Jewellers, right, Motilal Oswal Midcap Fund last December held about 6.3% stake. Now it actually holds about 9.05% stake. So their stake has increased. And at the same time, if you look at retail shareholding, that has increased. And promoters, they bought stake in 2024 from Warburg Pincus. And promoters' shareholding is currently 62.75%. 25% of that is pledged. So with a bigger decrease in that, if the promoter's stake is pledged, then there could be a bigger decline out there as well. But speaking about bigger declines, the Nifty's breached that 25,000 mark for the first time since October 6th.
That's a slam dunk, actually, Mangalam, that's taken place just in the last 30 minutes or so. And this was on expected lines, right? The first few hours are going to be very, very challenging. There'll be margins that will be triggered. Yesterday, there were some signs of capitulation as well. The Nifty has now decisively breached that 200 DMA mark as well. That was around 25,100. And just as we started the show itself, there's been a sharp slide even from there. Few stocks that have come in for selling. There's Max Healthcare, Geo Financial, Eternal. All of them have seen a sharp decline. And the problem is the Nifty Bank. That was at least holding one end up for all these trading sessions. That's lost close to around 1,000 points or thereabouts. A few factors playing out here. The rupee has weakened yet again. 91.4 is the last time I checked. So the rupee weakness will obviously, put further pressure because the FI selling just gets mounted on. And that's what we've been seeing. So the rupee needs to stabilize, first of all, to see any kind of change in terms of the FI, positioning in the Indian markets. And also out here, we're only talking about the headline index, the breadth of the market. That's turned in favor of the declines. 5 stocks declining for 1 stock that's advancing. A very, very difficult morning of trade, Mangalam. But hopefully by noon, we see some kind of sanity, Mangalam.
Well, the lines are at the furthest point this morning itself. And our ticker team tells us over the last 2 trading sessions, 15 lakh crore of market cap have been erased in just the last trading session and a half so far. And the Nifty right now, just about 24,950. It's a hot knife through butter. You're looking at a lot of these bigger names as well. ICICI Bank down about 2.5%. That's causing a notable downward pressure on the Nifty Bank, which is now down in 4 digits. Moments ago it was 900 points, now about 1,050 points. LTI Mindtree not doing too well. Apollo Hospitals, Adani Group stocks. So it's not one particular sector stock which is going in for selling. It's broad-based. The only sector which is holding up right now are the safe haven assets. So you have something like an HUL, which is marginally in the green right now, and a couple of these metal names like JSW, Steel, etc., or maybe some bit of Sun Pharma as well. Traditionally seen as safe haven purchases, IT, Pharma, as well as FMCG. But IT obviously is seeing a bit of a slam dunk on account of growth worries, global concerns. The Nifty on the verge of breaking the 24,900 mark as well. So it is definitely intensifying, and that intensity is perfectly captured in the India VIX. When we started the show, it was up, 4, 5, 6%? Now zoomed up to 13%. The Nifty holding at the day's low. What we'll do is...
Very, very aggressive selling, Mangalam. I don't know whether someone has a couple of dealer desks have just pressed that sell button, and that's why you're seeing such a sharp fall on very, very large volumes as well. Some of these stocks are down, and some of the frontline names as well. So let's see whether, Mangalam, we can see some sanity. But otherwise, the look is not good. As you said, 24,900, that needs to hold out. Otherwise, we're going in for a deeper decline. 24,900 going by the options data, and 25,100 at around the 200 DMA. Well, I'll tell you what, we'll wrap up on this edition of Chartbusters, but you stay glued to the screen. The team of Trading Hour comes up next.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I am Hormus Fatakia. With me, Mangalam Malu. Ritu Singh joins in from Bangalore. And after a bit of a nosedive that the markets just took, the Nifty is looking to go back towards that 25,000 mark. The last two trading sessions, the BSE listed companies have lost almost 16 lakh crore in market cap across yesterday and the first couple of hours of today's sessions, promising to be a very, very choppy ride already, Mangalam.
It's a choppy ride. In fact, it's been a choppy start to this calendar year itself. The Nifty is down about 4.5%. And Ritu will talk about the rupee in greater detail. But the way the rupee has been selling off as well, the FI is selling, etc. If you adjust for the currency, the Nifty is already down about 6-7% for the start of 2026, the calendar year. The rupee holding around that 91.4 against the dollar. Across the board, there is selling. The Nifty below that 25,000 mark, below 200-day moving average. The market breadth tells you that 2,400 stocks are in the red for about 472, which are in the green. There is a bit of a perfect storm playing out in the market right now. Earnings not necessarily picking up for a lot of the large sectors, large weighted sectors. Alongside that, we have the massive FII selling that continues, and more importantly, geopolitical tensions are at peak as well. All of this perfectly captured in the way the India VIX is higher. One would say that it's not as high as what we've usually seen the India VIX to be, but volatility hasn't been as high either, so it's now adjusting to what seems like the new normal right now, up around 14 for the India VIX, up in 10%, the level is 14. Typically, one would see buying for safe havens, and that's exactly what's taking place right now. Mild green on a couple of these FMCG names, a couple of these pharma names, but that's pretty much about it. The greens are far lesser in number and far milder in quantum than the reds are. And if you look at the big decliners in the frontline index, there are a lot more. In the broader markets, the pain is even sharper. Kalyan Jewellers down 10%, Coforge down 5.5%, SRF, despite decent numbers, down 5%. 197 Communications, which is basically Paytm, is down about 5%, another 5% after seeing a big gash from the top already. So across the board, there is a fair amount of selling. Ritu.
Well, Mangalam, I mean, if you look at the market breadth, I mean, about 2,400 stocks are declining for just about 490 stocks that are advancing. I mean, the broader market, of course, breaching all kinds of levels you were talking about. And the rupee, like you said, yeah, it's not really helping matters. And one wonders whether that'll contribute further to the pressure that the markets are seeing. At 91.38, that's a new record low, actually, for the rupee that we've seen. The lowest level, the previous low was on the 17th of December. Now it's far worse. And, it's been very light touch as far as dollar selling from RBI is concerned. So no, not much support coming in for the rupee. Previously, we'd seen them step in around 90.70 kind of levels as well, 90.30 kind of levels as well. Now 91.38 on the rupee. That's another spot of bother for the markets, Mangalam. But we have guests joining in to take us through, what's really going on.
Oh, and let's welcome both of them. We do have Manish Hathiramani joining in. Alongside that is Gautam Baid as well. Gautam will obviously speak about the fundamentals of the market, and typically, the market bottoms out when the panic is at its peak. Are we there or not? But for the very near term, let's get in, a chart check on the Nifty. Manish has been fairly instrumental in calling, important levels on the frontline index. So first we go across to Manish and then Gautam. Manish, 25,000, we're below that, but markets trying to make a mild attempt to recover above those levels. We're below the 200-day moving average as well. Your call on the Nifty.
Hi, Mangalam. Thank you so much for having me on the show. Well, just to go a little backwards, last week when we were on this channel, we did speak about Nifty being sideways with a downward bias. Thereafter, we broke the lows of 30th of December. We were then talking about a target of about 25,150 that has got achieved today. Now, what I'm really concerned about is this whole band of 24,950 to 25,000. It's only 50 points when we talk about it, but it's exceptionally crucial. If we fail to close above these levels and we spend a couple of days trading below these levels, I feel the Nifty can go down to 24,500 to be precise. The upside resistances are now capped at 25,600 to 25,700 levels.
So upside 25,600 to 25,700. Downside, under what conditions do you expect it to go between 24 to around 24,400 to 24,500?
If we close below 24,950.
If we close below 24,950. Till then, it remains a no trading zone. Gautam, let's come to you. Fundamentally, what have you made of the earnings so far? What's, what's the sense like right now? There is a fair amount of uncertainty, but I'm sure, there are a few pockets which offer value in this correction because, as they say, right, you become greedy when the world is panicking.
That's very true, Mangalam, but you have to be greedy in the right places. So this is the market for bottom-up active stock picking, and you have to focus on areas which have got good earnings growth visibility for the next 1 to 2 years, because those are the very stocks that will bounce back to all-time highs as soon as this ongoing correction gets over. So look at the microfinance cycle turning around. You can look at microfinance focused small finance banks. You can look at gold financiers. You can look at silver producers. Those are the kind of earnings which are showing strength. You're already getting initial indications of strength and good earnings from the auto ancillary space as well. Look at the kind of numbers reported by C8. I think that's a precursor of the very good string of earnings which will come out from many auto OEMs and auto ancillary names. So focus on bottom-up stock picking, be very selective, because the broader market this year is also expected to be pretty narrow. Although this is a very good juncture to put fresh capital to work, the percentage of stocks in the NSE 500 and BSE 500 below their 200-day DMA is now approaching 30% and below. Typically, this is the area where the broader markets bottom out, and from here on, selective stock picking should give you very good results.
We'll get to those selective stocks in just a bit. Manish, Gautam, stay on, because one of the other important factors behind this market volatility has also been the currency. The rupee, after a few days of quiet moves, is now back at record lows, and 91.39 and 91.40 is where the currency currently is at. And Lata is now joining in with a lowdown of what has been transpiring with the currency over the last couple of days. Lata.
I don't have a news story to tell. The reason the rupee has been weak is people are selling off Indian stocks and buying dollars and repatriating it out. And this is yet another process. Over the last 2-3 days, we've been seeing 3,500 and 4,000 crores. Only yesterday it dipped a little south of 3,000 crores. But it is quite clearly a seminal $500 million moving out every single day practically after the market started in right earnest in 2026. And the sentiment is extremely bearish on the street. So importers will go ahead in a hurry and buy. Exporters will not sell. All that is abetting. There is one guy supplying dollars, which is a Reserve Bank. But they won't do it when there is a tidal wave of people buying dollars. You would not want the foreign guys who are exiting to get a good deal for their dollars. So, you allow it you allow them to buy fewer dollars when they move out, and therefore the Reserve Bank is just supplying in driblets. There is really no end that you can talk about. The sentiment has turned bearish because in 2026, and today in particular, we are the only markets where the currency is so weak. The rest of the markets, the Thai baht or the Filipino peso, are all not showing weakness. Not even the Indonesian rupiah, which has been otherwise a weak story. Even that has not been falling like our currency has been falling. And that the same lack of performance is showing in equities. I mean, ad nauseum, we've been saying that Indian indexes are down nearly 5% in the past 2 weeks of 2026, whereas the Korean index is up about 15%. So it is clearly a backlash that is coming in, and the story goes on. The Reserve Bank will not want to stop the process when there is determined outflow. And therefore, we have to live. A bearishness at one point in time becomes big enough for people to come in and buy the currency. At the moment, we are just waiting for that. No good news to report.
No good news to report, neither on the markets, neither on the currency. Lata, thank you for summarizing that for us. The Nifty still fighting to hold that 25,000 mark on the downside, still well below the 200-day moving average of 25,114. Going back to our guests, Manish, Gautam, thank you for waiting by. Manish, to you again. Better part of the start of the year, the Nifty's losses were capped because of the Nifty Bank's outperformance. But now with the Nifty Bank also breaking below those important 59,500 levels on the downside, where do you see that going next, and would that be one of the reasons why the Nifty does end up eventually falling towards that 24,500 mark?
Well, Hormuz Bank Nifty was showing some kind of resilience when it was closer to the 60,300, 60,400 mark. We failed to cross that, and in fact, we took a U-turn from there. There was a strong support around that 59,100, 59,200 levels. That is also broken down. We are now expecting the Bank Nifty to test 58,100.
Well, Manish, I just broadly wanted to get a sense of, whether you think we're seeing a shift from what is a corrective phase to a sustained downtrend. And how much of a role do you think the rupee is playing in this downfall? I mean, is it adding to that risk-off sentiment?
Well, I won't be able to comment much on the currency because from a technical perspective, we are not correlating the two. However, we are in a definite short-term bear market. I would be looking at any kind of rise to look for opportunities to go short. As I said, unless we are not able to get past those capped resistance levels on the upside, we will be looking for short signals.
All right, you would be looking for short signals. For now, the Nifty is actually, managed to recover above that 25,000 mark, holding slightly above the 25,000 mark by just a smidge, still about 100 points below the 200-day moving average. That's as far as the technicals are concerned. But, Gautam, you did say that this is the time to perhaps look for opportunities in some of these gold financiers, NBFC spaces, also a lot of these silver-related plays. We've seen those stocks do extremely well. I just wanted to understand from you if you have any inkling on what's the kind of cash that the industry is, the deployment industry is sitting on the average, and what about you?
Well, you're talking about the US markets, Mangalam, or the Indian markets?
The Indian markets.
In the Indian markets, you're seeing very selectively, certain mutual funds like Parak FlexiCap, for example, is sitting on more than 20% cash. There are other mutual funds who are holding various levels of cash. So basically, the cash levels is a outcome or a byproduct of the opportunities which the particular fund manager is seeing in the market at a given point of time. So the cash levels will vary as per fund house. As far as our PMS is concerned, at Complete Cycle Stellar Wealth, we are fully invested in the current market and we have deployed all the cash that we had over the last 1 month. So I think we have got enough opportunities to generate alpha from here.
And what's client behavior like right now? Because, from the Indian equity market standpoint, the SIPs have been fairly resilient, over 30,000 crores in the month of December. Before that as well, for the last few months, between 27, 28,000 crores. But typically, it so happens that flows follow markets and not the other way around as usually is expected. Do you think because of this underperformance, because of this decline, the SIP investor will start to waver? I mean, have you seen signs of that in PMS investing? At least we get a inkling into what the investor mindset or behavior is at these levels.
Mangalam, there is a common investor tendency called recency bias. So investors tend to chase what has worked in the most recent past, in the most recent few quarters. So you're seeing a lot of rush towards gold funds, silver funds, and ETFs. And many people are going to, basically reduce or stop their SIPs. This happens in every bear market cycle. The investors tend to, basically go towards, things that are working in the present moment. So there's definitely a shift happening which is right now very subtle, but which is underway. And many retail investors in particular, as well as some HNI investors are now exploring the foreign equity markets. They're also exploring gold and other precious metals. So that shift will definitely happen. However, the underlying flows into equities continues unabated. However, for the broader markets to outperform and to get back investor interest, the avalanche of IPOs, the primary market has to slow down a bit because that has sucked out a lot of liquidity from the broader market. So the retail investor sentiment towards mid-cap, small caps will revive only when this particular category of the market starts outperforming again. And mid-cap, small caps as an asset class requires liquidity to outperform. So unless liquidity starts flowing back to the small cap, mid-cap space, it will be a very narrow market till that time.
Thank you so much for detailing all of those factors for the market fundamentally as well as chartically. Manish, Gautam, thank you so much for joining in. There's some sense of relief which has come by on the markets from the panic lows that we saw. So the Nifty has actually recovered about 135 points from the lows. And for the Nifty to recover, you have to have the usual suspects putting their hand up, right? So from the lows, Reliance has, moved about 0.8% higher. And we have HDFC Bank as well, which has recovered about 0.9% from the lows. Most of them are still in the red, but there has been a minor recovery. HDFC Bank off lows, Reliance, the intraday chart comes up for you as well, off lows, and that mirrors the intraday chart of the Nifty. Obviously down 200 points, but significantly off lows as well. Where this goes from here and this smidge of a recovery, does that get sold into once again or not is the big question. We'll take a short break, come back, focus on the markets, a lot of stock-specific action. Stay with us.
Down 177 points on the Nifty. Bank Nifty leading that fall, now down about 800 points as we speak. It's a sea of red across the market, and Mangalam joins us now to bring us the cues from the F&O space. Mangalam.
A sea of red with few waves of green, Ritu, one would call it, because the Nifty Bank has recovered about 300 points from the lows. Even the Nifty itself has recovered about 100 points from the lows. But there is a sell-off, no two ways about that, and that's reflected in the kind of divergence that we've seen between the red line and the green line in those crisscross lines. There is no crissing or crossing right now as we speak. The lines further apart, 2,500 stocks in the red for about 500 stocks which are in the green as well right now. The volatility has spiked as well. The India VIX at around 14. The important part is that the Nifty is below its 200-day moving average. Formidably broke that today and now still meandering below that. 25,114 is the Nifty 200-day moving average. And the Nifty Bank as well, which led the decline, has now with today's decline fallen below the 50-day moving average of 59,269. A lot of the put writers were caught on the wrong side over the last two trading sessions, and they have begun to unwind their positions. Remember, yesterday was expiry, and these are early days in the next cycle. There as well, unwinding happening tells you that maybe at higher levels we aren't expecting the market to go back to that 25,500, 25,600 in a hurry. Call writers are active. Again, early days in a series, Call writers still active at a premium of 125 for 25,200, telling you that around 25,350 thereabouts, there could be some bit of supply. Right now, the fight is for the 25,000 mark. The 25,000 call writers, very active. 235 is the premium. 25,000 put writers, equally active, premium of around 120 rupees. What does this tell you? That today's low of around 25,900 and 25,835 thereabouts is an important support, panic low that has been made right now. Put writers are back at the 25,000 mark, but call writers at 25,000 do not want the market to cross past that 25,250 odd mark. We have the put call ratio, which is at the lower end of the range at 0.71, but not to panic levels of around 0.61, 0.62 that we've seen earlier as well. One stock I'm looking at, Kalyan Jewellers, 12% lower now, a lot of short positions being added. The stock is usually prone to getting into F&O band, so that is one of the parameters that I'll be tracking, if not today, then over the next few trading sessions, whether Kalyan Jewellers, after this big decline today and in the last few trading sessions, goes into F&O band or not.
Kalyan Jewellers, 8th straight day of losses for the stock, and there are a lot of other factors as well driving the recovery in the market. 24,919 the panic low made in today's session. Nimesh is here with us. Before we get to him on the other big deal announcement that came in overnight, he's hearing something on the market recovery as well. Nimesh, tell us more on that first.
So, Harmas, couple of things. As Mangalam pointed out, the sharp recovery that we saw, I think the first 2 hours was a bit of margin pressure as well. Yeah. Normally, the margin calls get done by 11 a.m. And exactly after 11 a.m., we've seen a bit of a recovery in the overall market, in the mid-caps, in the bank Nifty as well. So I guess that explains a bit of recovery, that the margin calls the first couple of hours have been taken care of. So I guess that explains a bit of recovery. Also from a market perspective, I spoke to a lot of guys in the dealing rooms before the market opened. The feedback was there is a bit of marginal buying today at the larger FI desk. I'll cover that in the closing bell as well. But my sense is towards the end, there's going to be an MOC basket as well at a leading FI desk. So again, from a flow perspective, even if you look at yesterday's numbers, this panic is not from institutional investors. It's largely from retails, HNI investors, and the so-called PMS, AIFs, which have started to underperform. They are seeing a bit of liquidation now, and that's putting pressure in the broader market name. So that briefly explains the pain in the broader markets. But I guess the recovery also explains that it's largely that the first couple of hours of margin pressure seems to be out of the way.
All right, we take that point, and if there is an MOC purchase that comes by from the FIIs, the last hour will be very crucial to track, largely because, once the pain of the margins have gone by at 11, between 11 to 12 is no major trade sort of hour. But after that 12 p.m., we have the European markets that open, we have all the other markets that open as well. So whether those FIIs come by and buy this time around or maybe sell this recovery that we've seen from the lows will be very crucial. But individual stocks, they always capture our attention. And today, it's bazaar-style retail and Cupid. Yesterday, there was a very interesting deal that was announced where Cupid invested in bazaar style, and Nimesh had an inkling of that. Nimesh, can you explain to us, the rationale behind this? Because on the face of it, looks like, they're different. They're absolutely different.
So, the fact is that this was part of my deal sheet chat a couple of days back. I'd hinted that a listed entity is going to buy a stake in bazaar retail. It's kind of, first of its kind of a deal. An FMCG company is buying a stake or putting in money into a retailer. So I guess it's a win-win for both. For bazaar retail, the stock hasn't done anything in the last say 1 year or so, and now you've seen a bit of a kind of money infusion. So the entire 300 crore plus is going to come as a warrant. So it's over a period of 18 months. Only 25% will come upfront, and the remaining will be paid over a period of time. What this will mean is for Cupid, being an FMCG company, they get an access to a retailer wherein they can push their products. Mangalam, you can add a bit further. I think they're having some 250 stores right now, bazaar retail, style retail, and I'm told that they have a capex plan, which would mean that probably in the next 18 months they'll go to almost 500 stores. So a ready 500 store access is what Cupid gets through this deal. The fact that Cupid is only paying 25% right now, the rest will be paid over 18 months, so they have a cushion as well. And my sense is this is the first leg of the deal. There could be a transaction where the promoters may also buy some stake into bazaar retail. There wouldn't be an open offer for sure, is my sense, but they'll have a bit of a say and a control in terms of the businesses and all. So that probably is the strategy for Cupid, to buy 12% or 11 to close to 12% via warrants, and maybe the promoters of Cupid will also buy something from the open market and take some stake. Less than 24%, so it doesn't trigger an open offer as well. Also, it's been structured in such a way that there is no risk of inter-party, inter-promoter deal as well. So Cupid can sell products, via the retail format in Bazaar Retail, and Bazaar Retail gets funding, the money for growth capex.
It'll be very interesting to see how this pans out, because the large part of Cupid's revenues currently come from outside of India. If they want to increase their India presence, they will do that, and 250 stores is what they have first half of this.
I'm sure, Mangalam, they'll have some bit of strategy of taking Bazaar Retail as well overseas, because that's a vacuum, right? I mean, that's something which they can actually do, and Cupid has an experience of global markets as well. So maybe I think that's all been thought about when they've thought of putting money via preferential into Bazaar Retail.
All right, Nimesh, thank you for explaining that to us. For now, the stock's down sharply. The mood of the market, and obviously, the stock Bazaar style retail has seen a big 40% rally over the last 5 trading sessions already. Take a short break, come back, focus a lot more on the markets and individual stocks.
Fly Emirates, fly better.
Welcome back. You're watching us here on Trading Hour. There has been a recovery from the lows. The Nifty meandering around that 2550 mark right now. Though there hasn't been any major gain from there or a major decline from there either. The one stock which has been selling off from the word go is Kalyan Jewellers. As Hormas pointed out, 8 straight days of a decline, but today it is even more pronounced. Part of that could be attributed to the fears of, the internal change that has taken place at Motilal Oswal AMC as well. But this week, after today's cut, the stock is down about 16%, and from its highs, it's down about 36%. The important part is that, the stock, if you look at the shareholding pattern of the company, between last December to now, Motilal Oswal Midcap Fund has increased its holding from 6.5% to 9.05%. Franklin India continues to maintain their stake. Sundaram Mutual and Government of Singapore have actually reduced their stake. Sundaram Mutual now is sub 1%, and which is why it's not reported as a major shareholder. Government of Singapore down from 2% to 1.75%. promoter's stake as of December 2025 is 62.75%. But here too, between last December to now, the pledge on their stake has actually increased from 19% to around 24%. Remember, the promoters had bought 2.3% stake from Warburg Pincus at 535 rupees per share in August 2024, because of which they had pledged their equity. And now that pledge has increased over the last 1 year from 19% to 25%. A bigger decline from current levels would perhaps lead to invocation of that pledge, and as a result of which we could see further downside on the stock. So that's something we need to monitor, and monitor more so because the retail shareholding of Kalyan Jewellers has increased over the last 1 year from 5% to closer to 6%. The number of shareholders as well increased from nearly 5.6 lakh to 6.6 lakh. So because there is a fair amount of retail shareholding in Kalyan, with one institution holding about 9%, and there being a management change, internal change, rejig in that institution, with the promoter's stake being pledged around 25%. All these factors are, suggesting the kind of decline that we've seen on Kalyan Jewellers. The only thing that I'll be watching out for over the next few trading sessions is whether the stock goes into F&O ban or not. Because otherwise, fundamentally, no reason for the stock to be falling so much at a time when gold prices are high. All the jewelry companies are reporting stellar quarterly updates. Ritu.
Interesting update there, but the stock remains under pressure, Mangalam. But we'll, try and find some green on this sea of red that we've been talking about. And Credit Access Grameen, now that is one stock that is up and about. In fact, it's one of the top gainers in trade now, up about 10.2% as we speak. Why? Because, the company is back with a bang. It's reporting profits again. Net interest income has also risen about 13%, and it's got upgrades as well from the street. Gaurav is joining in to give us the details on that stock. Gaurav.
Well, as for Credit Access Grameen, if you look at the market, it's actually difficult for today to find the stocks which are actually trading in green. And if you look at Credit Access Grameen, it is up more than 10%. And the reason being that a very strong set of numbers is what they have reported in third quarter. First, let's look at the numbers. If you look at net interest income, that increased almost by 13%. And if you look at PPOP, that increased by 9%. Company also reported profits worth 252 crores versus the loss that they had reported worth 99.5 crores in third quarter of FY25. And the reason being why the stock is up is that first is net interest margins. They have increased almost by 60 basis points on a sequential basis to around 13.9%. And the second biggest reason is the credit cost. Now, the credit cost has come down sharply by 300 basis points on a sequential basis from 8.5% to 5.5% in this quarter itself. And the main reason being that they are actually seeing better collection efficiency. They are seeing the stress which is coming down in the MFI segment, and that is the reason why market has taken it in a very positive way. This is not just about this quarter's numbers, but if you look at the numbers going ahead, management also gave confidence there as well. So they are confident on maintaining that 20% growth target for FY27, and at the same time they also say that the credit cost for fourth quarter, it will remain stable. But if you look at the trends and the collection efficiency trends seen so far, if they continue for the next 3 months, there is a possibility that the credit cost guidance will be brought down. In fact, currently also the credit cost guidance is given at 4 to 4.5% versus what it is right now at 5.5% for the company. Other than that, they are also saying that the net interest margins will be moving towards 14 to 14.5%, which is currently at 13.9%. So there is room for NIM improvement as well. And as a result, if you look at ROAs, they are targeting 4 to 4.5% ROAs. All in all, if you look at brokerages, they have also upgraded the target for the company. And as a result, we are seeing 10% increase in the company despite the sharp fall in the broader market.
Gaurav, thank you for that update. One name that is bucking the trend there, Credit Access Grameen, 10.5% higher, the top gainer on the Nifty 500 in today's session. A couple of names before we go into that break. CEAT is now down 5.5% as we speak. SRF is now down 6% after the management commentary with regards to pressure from the Chinese counterparts. 6% lower now on SRF. And in light of that, Navin Fluorine too is down close to 5% in today's trading session. Take a short break and continue our conversation on the markets and our big story on the other side as well.
Welcome back. You're watching us here on Trading Hour. Let's talk about the big story of the day, which is Restaurant Brands Asia actually selling the promoter stake to a new owner. And Vivek, who broke the story first in mid-November and gave us the contours as recently as yesterday as well, got it absolutely right. He's with us here to talk about what the story was, what the details of the deal are, and then we'll obviously take it forward with what it means for the entire space. Vivek, burgers.
Well, that's right. So our viewers will be aware, we told you about this particular story on November 24th. Yesterday, we told you about the contours of this particular deal, and largely in line, in fact, almost in line with what we reported yesterday morning is what the detailed deal contours were. So, number one, Inspira Global, promoted by Ayush Madhusudan Agarwal, who is part of the promoter group of Ajanta Pharma, but this particular deal has taken place under his own office, which is called as Inspira Global. Now, why is he interested in the QSR space? He already has some exposure there. He operates Chinese Wok, Big Ball, as well as the Momo Company brands. And remember, RBI, like we've been talking all throughout the day, operates the Burger King franchisee in India. The deal controls, it's a three-step process. Number one, they're infusing close to 1,500 crore. 900 crore will be done via preferential allotment of equity shares, and another 600 crores through preferential allotment of warrants. And all of the prices for the allotment will be done at 70 rupees a share. The second part is, what we reported on November is that Everstone Capital, the private equity player, is exiting their entire, a little over 11% stake at 70 rupees. And given the fact that there is a change as far as the management control is concerned, they have also made an open offer for 26%, again being done at 70 rupees a share. So to yesterday's close, it is a 10% premium. It's been a very volatile trading session. The stock has cooled off, but at one point of time was higher by almost 5%, Mangalam.
Take that point. Thank you, Vivek, for that. Meanwhile, there are some visuals of juicy burgers coming on the screen as well. There you have it. Burger King is what it is. But just speak about the QSR space in general. Burger King, notwithstanding right now. On Jan 1st, we had the big Devyani Sapphire merger, which was announced. Thereafter, we had on Jan 7th, the Jubilant Foodworks update that came by as well. Their same-store sales growth came down. A lot of burgers out here, but I have to tell you one thing about, Burger King. As an investor standpoint, the IPO came in 2020. The issue price was 60 rupees per share. There you have it, Jubilant Foodworks on 7th when they updated. The QSR like for like is coming down, and Jubilant Foodworks has been the leader out there. The issue price was close to around 60 rupees. Thereafter, it ran all the way up to 120, 130. From its peak, it's down 60% as well. So from a purchaser's standpoint, it is available at a deep discount, because if you look at the valuations, they come up for you on the screen. Jubilant Foodworks, the valuation is 23 times EV to EBITDA. Restaurant Brands is 8 times. It's a sharp, deep discount to the market. But there are a lot of challenges as well. There is overall slowdown in the consumer sentiment. There is intense competition from existing and new brands. There is competition from food delivery players itself, and the macro trend of healthy eating. You called for burgers in the office today. Not many had a full burger. A lot of them had just a small little bite. And, for Burger King or Restaurant Brands Asia, they have about 533 stores right now. Their same-store sales growth has too been fledgling between 2.2 to 2.5% over the last couple of quarters, and this on a favorable base of negative same-store sales growth. So improving that will be crucial. The second thing will be the India business. Their margins are 14%. The Indonesia business, they're a drag on the margins. Their margins as of the first half was negative 1.5%. So improving their execution versus McDonald's will be crucial. Scale up of BK Cafe, which is basically a play on McCafe, which they're doing to increase their store sales, etc., and increasing their delivery will be important. But more importantly, focus on India versus Indonesia, which is a margin drag, will be something that would be an opportunity for the buyers as well. For the sector, recovery post GST 2.0, will that happen? There'll be potential listings as well. There's Cure Food, Subway, Wow Momo, all of them. And competition from food delivery apps which are starting captive kitchens is something that we will be tracking very closely as well. But I'd like the director to, go back to the big camera just to show those fancy visuals of those burgers. Vivek and Hormaz, I'm vegetarian, but I have to say personally, I prefer the Burger King burger and the McDonald's fries. What about you guys?
I agree with that. Burger King burger. Actually, I'd prefer the aloo tikki along with the fries as well. You need, in a market like this, you need comfort food. So yeah.
What about you, Vivek?
Today we had the Burger King burgers, and think it was slightly better compared to the McDonald's burger that we generally have.
What we'll do is we'll ask you to, order McDonald's burgers as well now, and then probably thereafter, what we'll do is we'll, do a taste test as
On
well.
his next news break.
All for the viewers, all for the viewers. We don't have any personal interest in, asking Vivek to give us so many treats. We'll obviously deliver some to Ritu in Bangalore as well. But for now, what we'll do is take a short break, come back, focus on the markets. The rupee is at a record low now, 91.5 for that one. Pankaj Tibrewal of Ikigai Asset joins us on the other side. Stay with us.
You want to talk business? Meet me in the Onboard Lounge.
Welcome back. The Nifty remaining above that 25,000 mark. There was a very minor recovery we saw earlier, but now, continuing to be down about 180 points. Let's bring in our next guest to put in some more focus on the markets. And we have Pankaj Tibrewal, the founder and CIO of Ikigai Asset Management, joining us now. Pankaj, thanks for your time here. What do you make of what's going on in the market right now? How much of it is, foreign cues versus the weak domestic earnings and the rupee sell-off? New record low today, 90.5. It's crossed that level. How much is that adding to the sell-off pressure?
Yeah, thank you. I think markets over the last few days are unnerved by the events which are happening geopolitically, and especially the comments coming from various leaders across the continent. And I think that's unnerving the markets, that what is going to play going ahead. We believe that, and as we have been saying, that the world order would undergo a change. In the interim, that could be a little painful, but I think the way domestic economy is shaping us, we believe that over the next decade or so, India's growth will be at least double of the global GDP growth and will be the fastest growing economy. As far earnings are concerned, in the very short term, I don't think it's bad. It's quite in line with our expectation, adjusted for the labor code provisioning, which most of the companies are doing. Most of the IT companies reported decent numbers. Banks reported decent numbers. And now the entire earnings season for a broader market is starting off. So we are quite hopeful for a double-digit earnings growth for broader markets. And we believe that FY27 should see earnings acceleration from 8.5% of Nifty growth this year to about 12-13% next year. So just adjusting for the geopolitical noise and the US market correction, I think domestically we are well positioned. This is the first time that 10 days away the budget is there, but nobody is talking about it. And I think in this market, what will be important is risk management, which we have been saying for time and again, that make sure that you are not running only after narratives, making sure that the basic hygiene and the basic principles of investing is carried on. And I think if you are doing that, in the interim, there could be some drawdowns. But over medium to long term, your portfolio should do well. And our sense is that this will be a great time whenever we have seen sell-offs because of the global events are the best time to invest in the markets. So I think after a long time, I am seeing on the screen a lot of opportunities emerging where businesses are strong, franchises are strong, promoters are good, balance sheets are good. I think finally what will matter is those and earnings growth over a period of time. I think if those things are intact, don't get too carried away by the noise, and this will be, I think, a great time to increase your allocation to equities.
Deploy some capital when the street is so scared and there is uncertainty. Pankaj, you know, that's classic investment advice. But you alluded to a few ideas that you think are looking better in this decline right now. What would they be? What after this fall is looking more attractive now and with fundamentals relatively unscathed?
Yeah, so I think overall the banking pack looks to be decently poised. Across private sector banks, we have seen some correction as well. That segment looks to be okay. Pharma, I think we have seen some correction across CDMOs as well as domestic generic companies, domestic pharma companies. Those are looking quite good. Auto and auto ancillaries, I think the momentum continues. And that part has seen correction over the last 15-20 days starting January. So there could be buying opportunity emerging in those. And some select cap good names where we believe that the visibility for the next few years is very, very strong, driven by a strong order book. And there we believe that valuations have started to look a little attractive compared to the past. So these will be our focus area. And one or two contra calls, which I've been mentioning, is one is the metals. Now it's no more a contra call, but I think metal continues to be good because we believe that every country will use resource as a geopolitical tool negotiation. And whatever we are seeing on Venezuela, Greenland, is nothing but a resource grab and the insecurity which US is having towards, taking those resources under their control. So I think resources will become more and more valuable as you move ahead. And hence, I think commodities should be some part of your portfolio. And chemicals, we believe, is at a very interesting juncture where many chemical companies are now trading almost zero return over the last 5 years. And with the China's deflation policy or anti-inflation policy, we believe this is one segment which can be a beneficiary of it. And last but not the least, consumer durables and home building products, I think, are coming at attractive levels. One good season on summers this time, you could see a meaningful rebound in many of those names on the consumer durables as well as home building improvement products. So I think many across sectors from bottom-up basis, I think stocks have started to look attractive. If one takes a 2-3 year call, I think I would strongly recommend that over the next 2-3 months, people should increase their equity allocation.
But Pankaj, does the EMS companies also fit into either your contra bets or your preferred bets? After these names, be it Keynes, be it Dixon, all of them have been smashed 30, 40, 50% from their record high levels. Have valuations now come down to levels where you could feel like you can nibble in a bit?
So if you go back to my previous interviews or previous interactions, we have been very, very careful about the EMS companies, except one or two. because most of these companies were showing growth on P&L. But when you look at the balance sheet and cash flows, 5 years cumulative operating cash flows of few of the companies in this space were zero or negative. And we believe that top line is vanity, bottom line is sanity, but cash in bank is reality. And whenever these cycles unfold and such corrections happen, the first, people get uncomfortable with companies which don't generate cash flows and which are dependent on external capital for their growth. So we are very circumspect about such companies where we believe that growth is driven just by external funding, not by internal accruals and cash flows. So in the EMS space, we believe that there are only a couple of companies and a handful of companies which warrant investment decisions. The rest will not lie in our framework at least.
Metals, you said ferrous or non-ferrous? Because ferrous is not doing as well as some of these aluminum / silver / copper plays.
Yes. So ferrous, non-ferrous, we have seen a very sharp run-up on copper and aluminum now, followed by zinc. I think that's the first pack which has moved. And just to give you data, I think over the next 18, 19 years, the world will need copper, which we have used in the last 10,000 years, assuming a global GDP growth of 3%. So the incremental change which is happening across non-ferrous involving copper and aluminum is extremely positive. And there's a demand-supply gap which is starting to build up. And from a non-ferrous side, I think we have started to see coking coal prices increase. We have seen some uptick in iron ore. And also in the domestic market, the ground feedback over the last 20 days is that there has been an increase of 5 to 6 rupees per kg on steel prices as well after the safeguard duty. So the market at the ground level is extremely buoyant right now. Maybe restocking demand is happening. But I think in the fourth quarter, our assumption is that if this continues and sustains, many of the steel companies will throw positive surprises as you move into the fourth quarter earnings. So we believe third quarter will be subdued because steel prices were subdued. But since 20th of December, I think the steel market has turned around and we are seeing incremental positive news on the pricing side.
Just a quick 2-3 word answer before we let you go, running out of time, not questions. Pankaj, despite the correction, are there any no-go zones in the market right now?
I would say that please avoid narrative stories. That this
Would they be
happen,
in the real world right now?
Yes, absolutely. There are many stories on renewals that, they were trading at exorbitant multiples, assuming that the growth will be stupendous, but cash flows and balance sheets not supporting them. So stay away from those, follow basic rule of investing, and also manage your portfolio on a diversified and sizing position. Risk management becomes extremely important in such volatile situations. I have always been saying survival is important, growth is accidental. So survive in such market crisis, you will grow over a period of time.
Pankaj, thank you so much for sparing time and joining us today. Insightful conversation on your views on various sectors. Take a short break, back with more on the market. Stay tuned.
All right, you're watching us here on Trading Hour. If you look at the market, the rupee weakens 40 paise against the dollar. 91.5 is where we are. The Nifty, after testing levels of sub 25,000, has actually recovered a little, but still the fight for 25,000 continues between bulls and bears. If you look at the broader markets as well, there has been a little bit of a recovery. The India VIX from a high of almost 14 has cooled off a little bit, but all action will now move to the second half of trade, where the first half margin calls, as Nimesh pointed out, were taken care of. The second half is where the FII action begins. So where that goes is something we'll leave the team of Trading Hour to monitor and tackle with. Thank you for watching.
Stocks take a beating with midcaps bearing the brunt as Trump heads to Davos, where he may talk about Greenland. The rupee too skids to a record low as investors root for safety.
The promoter group of Ajanta Pharma strikes a deal to take control of Burger King franchisee restaurant brands Asia, and Cupid seals an investment deal in Bazaar-style retail, even as Zydus Life and Sun Pharma are seen making significant overseas acquisitions.
SRF slips as pricing pressure from Chinese rivals weighs. United Spirits dips as volumes miss the mark. Shoppers Stop is hit by weak consumption, while Vikram Solar sees orders and revenue slip sequentially.
Gold and silver surged to record highs as investors flocked to safe haven assets as geopolitical uncertainty could cloud global economic outlook. The sell America dollar trade and yen's dip on Japan's fiscal worries add to the mix.
The who's who of India's IT industry tells CNBC TV 18 they see a big opportunity in AI beyond making models in helping industry adopt the technology. But some express concern over the impact of advances in technology that can have on jobs. Good afternoon. Welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Ekta Batra and Vinny Motiwala. Hey girls, good afternoon. Well, today is the day we broke that 25,000 mark. The bulls and bears are fighting now because yes, we've recovered from those levels, but still it's a sharp cut that we're seeing from the highs of the day. In fact, now the Nifty is above that 25,100 mark. So the recovery has been quite swift as well. But across the board, it's a red looking screen. In fact, all the sectoral indices are in the red as we speak. So yes, it's a 540 recovery on the Midcap index, almost a 200-point recovery on the Nifty as well. But what happens in the second half is something we'll discuss in the show. The FIIs take control in terms of them waking up and starting looking at the Indian markets. But yes, a lot has happened already. But yes, there seems to be more.
Absolutely. There seems to be more. Do not forget, we'll have a lot of commentary that comes in from Davos as well when Trump lands there. But that is what is keeping the markets on their toes as well, right? That global uncertainty that still persists. And that is why that fall in the market is what we're seeing, the fall in the rupee that's come in as well. So that is a bit of a concern. And I would just like to see the advance decline ratio as of now. Where is that headed as well? Because obviously today we're seeing more stocks that are going to be in the favor of overall declines versus advances. And the gap is still wide enough, right? It may be a slight bit of a recovery, but doesn't seem to be a bit of a respite coming in, at least on the broader end of the markets.
Well, yes, absolutely. We've started the year on an extremely negative footing on a year-to-date basis. The Nifty is down around 4% The Midcap index has fallen 5.6%. The BSE small cap index is down around 9% So it's been extremely weak. The rupee, like we mentioned, is the second worst performing currency in Asia month to date. But nonetheless, let's kick off the show with Persistent Systems, which is in focus. It's reported what was a good set of Q3 earnings with the constant currency revenue beating estimates. Joining in to discuss more about the earnings is Sandeep Kalra, who's the CEO of Persistent Systems. Mr. Kalra, if you can start by explaining this AI platform and tools which driven pricing model which drove your margins this quarter.
If you look at the company per se, we delivered 4% quarter on quarter in dollar terms, 17.3% year on year, leading to $422.5 million. Now, within this, if you look at it from a profitability perspective, there were puts and takes. There was a one-time new labor code related impact, which is impacting everyone in the industry. The impact on our EBIT was 2.3% and on our PAT was 1.8%. Barring this impact, our EBIT would be 16.7%. Factoring this, our EBIT came at 14.4%. If we look at the PAT side as well, our PAT would have been outside of this 13.4%, and including this, obviously it declined and it came at 11.6%. Now, to your point, what you're looking at is the impact that we called out because of our AI platform impact in the quarter. Now, the way we are looking at the AI side of it is there are three legs to the stool. We are using AI for technology builders, where we are using our SASVA platform. And then there are two other platforms that we have built, iAura and GenAI Hub, which are basically aimed at the enterprise side of the house. Over the last several quarters, we have been seeding multiple relationships on the AI side. And we have had certain good wins, multiple of those in the last quarter and the quarter gone by, which are now ramping up. Now, depending on the nature of the deal, if we are using our IP and we are bringing in process improvements, we are implementing that upfront to be able to use lesser number of people to deliver the outcome. There are different business models that we are bringing in, depending on what the customer also is amenable to, and that's what we called out.
Hi, Mr. Kalra. Good afternoon. So I just want to understand, so is it going to be pricing or AI productivity benefits that one will see? And will the adjusted EBITDA margins actually sustain at these 16-17% range levels?
2-3 parts to it. Number one, what we have done is this. Let me just go in a little bit more detail so that it's a little bit more clearer. When we have developed these platforms like SASVA or iAura or GenAI Hub, these are things that can accelerate. These are things that can, let's say you're developing an application or a product, they can bring in much more productivity. With the same number of people, you can do much more using the technology. So for example, if you are doing application modernization, you're using AI to reverse engineer the earlier system, and then you're using AI as various forms, right from writing the requirements to converting that to technical to even helping the engineers code it better, faster, and so on, the full life cycle. That's what we are doing. And when we do that and we price that, we price for the total cost of ownership, including the money that we are charging for the IP and reusable components that we bring, and then obviously the manpower base. We don't differentiate that in certain contracts, and in certain contracts where the customer is amenable, like private equity organizations, where they are wanting to take upfront the charges, etc. So it will depend. So to your point, will it be an ongoing exercise every quarter? May not be. We don't want to give you any forward-looking guidance. All we can say is we have improved the profitability using this, and our endeavor would be to make sure that we remain in the 16 to 17% EBIT for the near future, and the rest we will keep investing back in the business.
Okay, no forward-looking guidance, but let's understand what the demand environment is like right now, Mr. Kalra. We are seeing a lot of geopolitical noise. Is that denting spending, ramp-ups as well from clients?
Yeah, so I think people are getting used to a noisy macro. And as far as we are concerned, our focus on building our capabilities, whether it is AI or otherwise, our focus on our top 100 customers, understanding what they are looking to do in their own businesses, we have had very good wins. If you look at our annual contract value, we won more than $500 million in the quarter. And from that perspective, look, we are seeing from our customers pretty decent traction. Now, macro is not in our control, but within that, how we react, we've done well, and we will endeavor to do well.
All right, sure. Constant currency revenue growth was strong at around 4.1% in what was a seasonally weak quarter, Mr. Kalra. What was the key driver, according to you?
Yeah, so look, the CC part will depend company to company. Our revenues predominantly are US based as of this point in time. We are roughly about 81-82% from the US, about 8.5% from Europe, the rest between India and Australia. That's broadly the mix. So, these currency movements that lead to this constant currency calculations, they are macro related things, nothing that we control.
Right. So, there's a step up in deal wins as well. So are you participating more in those large deal wins or more deals that you're looking at?
So look, if you look at our journey year on year, in the last 4 years, we have had a CAGR, the compounded annual growth rate of 25%, approximately. Now, what that means is, obviously, we have had a significant increase in revenues. If you look at our customer base, we have had significant number of customers go up in the different categories. So, for example, if you look at the greater than $75 million category, we have 4 customers today, as compared to lesser number many years back. Similarly, across board, whether it is greater than $5 million customers and so on and so forth. So as we have grown, as we have become more significant to our customers, we are being invited to bigger bids. And yes, we are winning bigger bids. And we are a significant challenger to our bigger peers in our industry. All of them are good companies, but we are winning unfair share of the wallet share from our customers. So that is what is leading to the growth.
Okay, so does that mean you're on track to achieve your aspiration of that $2 billion revenue by March 2027 and $5 billion by March 2031?
So first part, are we confident of our, achievement of our aspirations, etc.? We are on that journey. We will be on that trajectory, hopefully, and we'll deliver in the timeframes that we have said. We have said $2 billion by FY27, $5 billion by FY31. And we have also said there will be a small inorganic component in the FY27, and we'll build it up. So from that perspective, pretty reasonably on that journey. FY27 looks good. We'll let the time pass by. And those are run rate basis when we exit the March quarter in 27. And we are putting the foundation for the $5 billion. And given our history, I'm pretty reasonably sure we'll try and achieve our aspirations on time.
Okay, all right, Mr. Kalra, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Persistent Systems. That stock down around 3.7% in what is a weak market. But what really stands out besides the equities is the rupee, which has hit a new low. We now have Dheeraj Nim, who is the economist and forex strategist at ENZ Research, joining in to discuss the levels that he's probably tracking for the rupee. Now, remember that the rupee is the worst performing Asian currency, or second worst performing Asian currency on a year-to-date basis, that is on a month-to-date basis in 2026 already. Dheeraj, hi, thank you very much for taking the time out. Well, 91.5, a lot of the Forex strategists were probably predicting this level, by mid or end of this year, but we're already at those levels. What's your sense in terms of what's driving this weakness, which is very sudden and severe, you would have to say?
Well, thank you very much for inviting me on the show. Look, I'm one of those strategists who were thinking that such levels would be achieved later in the year. But of course, directionally, we possibly have got it right that the rupee has a bias to weaken further. Now, technically, we are in an uncharted territory. 91.5 was our end FY27 forecast. But of course, with the current momentum, we think that 92.5, 93 could also be well within reach if the pressures remain. Now, what is leading to this weakness? I think it's a two-part answer. The first is, of course, outflows from the Indian markets have continued. Look, earnings season stress is quite visible, and also the global risk jitters around, the US-Europe tensions over Greenland and what happened in Japan. So the global cues also remain quite unsupportive of emerging market currencies, and the rupee had already been under pressure. But I think there's a bigger reason to reckon with here, and I believe this weakness had been brewing for quite some time, and it's not all of a sudden. Of course, such levels look sudden, but over the past few sessions, rupee had been gradually weakening, and I believe that is more to do with the real money flows, such as from corporate hedging demand and so on and so forth. Now, this to me is expression of the broader view that the rupee has a weakness bias, even at the current levels. Okay. Now, the bigger question is, why has the RBI not intervened? Because the last time rupee hit such levels, 91 and so on, they had come down rather heavy-handedly to bring the USD INR down. But I think since it is not to do so much with speculation, the RBI is tolerant of this rupee weakness.
Okay, so you're expecting no intervention coming in from the RBI in the next policy meet or even before that. We do have a lot of geopolitical events. We have Donald Trump who will be speaking today. So, of course, geopolitics is taking center stage. But any other domestic cues that investors should be watching out for that could impact rupee movement even further, Dheeraj?
Well, I think we're running into a rather busy time even domestically here. Of course, earnings are going on as we speak, and they have been an important cue to foreign investors who've been rather disenchanted with the India economic story, which otherwise looks quite stellar, at least on the paper. Now, what we're also seeing is that the fiscal stress is becoming a theme as we discuss, the contours of the upcoming budget and what's happening at the level of states. So I think a budget season, as is usually the case, would also be a very busy one as far as the currency is also concerned. And then we head into the RBI. We do expect that, given the kind of tightness domestic liquidity conditions are experiencing currently, it is, of course, natural for the RBI to let go of the exchange rate a little bit more so that they can refocus on domestic liquidity situation, which to our analysis has become a bit concerning.
Sure. Dheeraj, that's on rupee, but also talk to us about the bond yields, right? Now, the Japanese bond yields also are soaring over there. We saw them move higher. How should we be looking at our Indian bond yields and overall bond yields?
Well, Indian bond yields have been under pressure for quite some time for a different set of reasons and not so much global cues. And several reasons. One, of course, includes the INR weakness and expectations of further INR weakness that has kept foreign bond investors, somewhat at bay. The second reason we've been highlighting is the increasing fiscal stress in the system, given the substantial shortfall in tax revenues and the government switch from fiscal deficit targeting to debt targeting in the upcoming fiscal year. There's generally a sense that fiscal consolidation efforts at the level of the general government and not just central government are going to slow down. Of course, we have the stress in terms of states' finances also playing out in the market. The third reason is, inflation, although is currently very, very low, it is expected to rebound. And that rebound can actually be also causing some upward pressure on the bond yields. So there are multiple factors, but for India, it's largely domestic. As far as the Japanese yields go, look, it is their fiscal situation, which has, and also, investors cutting down their losing trades that has contributed to the increase in the JGB yields. Fiscal situation more so because they have plans to cut taxes and raise spending, which have raised questions about the financial management of the government finances. Now, this is actually feeding into the broader environment of risk aversion globally, or risk jitters rather. But of course, what's happening in Japan and what's happening in the US have consequences for the rest of the world. But I would believe that at least Indian yields currently are driven more by domestic factors than global.
Okay, just quickly before we let you go, this target of or maybe this target that you have of 92.5 to 93, by when or what would be possibly the key catalyst that could possibly get us to those levels, and a timeline that you might have in mind?
Well, let me clarify at first. I'm not saying 92.5, 93 is my target. Currently, our target was 91.5, but as of today, we stand corrected on those levels. So we'll have to relook at our forecasts. But my sense is that unless we see a material acceleration in some of the domestic growth indicators in nominal terms, for example, nominal GDP, and unless earnings stress abates and there's some rebound happening there, the outflow story can very well continue. And insofar as net FDI remains a bit of a weak point and current account deficit risks widening in FY27, unless there is some abatement of trade frictions with, the rupee will remain very vulnerable to those outflows, and it could continue to weaken.
Take that point, Dheeraj. Thank you so much for joining in today with your thoughts at the outlook on rupee levels and what's driving the moves that we are seeing in the macro market. That's the word coming in on rupee, but we'll slip into a short break. As we do that, the countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact on policy decisions from the finance minister. We bring you a power-packed lineup throughout January and on the day of the budget. Helios Capital Sameer Arora for all things market, followed by JP Morgan Sajid Chinoy to discuss the macro signals. We also get you insightful analysis from industry veterans, and Dinesh Kanabar and Ashok Wadhwa for the tax rhetoric.
Welcome back to Halftime Report on CNBC TV 18. The markets have seen a significant recovery from the day's point, whether you look at the Nifty, Bank Nifty, even the broader end of the market. That has seen a recovery now. 25,150 is what the Nifty is trading at. But a lot of stocks today are moving around in trade as well. Let's go across to Vivek to give us that list of passing stocks. Good afternoon, Vivek.
Well, good afternoon. What a sharp recovery we've seen, especially in the last half hour or so. Advanced decline ratio, which was very negative, just around 40-45 minutes back, has improved quite significantly. Individual stocks are what we are tracking. Eternal, ahead of the results, one of the top gainers as far as the Nifty is concerned, over 2.5% higher. Credit Access Grameen, a very good set of numbers. Asset quality has seen a sharp improvement, and credit cost too has improved almost 300 basis points sequentially. That stock higher by over 11%. J&K Bank, again, a good set of numbers. Loan growth quite strong at 18% on a year-on-year basis. That stock too doing quite well in the session. But a whole host of laggards today. First on the list is Kalyan Jewellers on very high volumes today. Stock down over 11%. The top NSE 500 laggard. The entire EMS pack, most of them seeing significant selling pressure on high volumes. So names like Dixon, Amber, PGL, most of these names are under significant stress today. Restaurants brand Asia, you did see the deal come about. Open offer coming in at a 10% premium to yesterday's close. It's been a very volatile session for the stock. Stock down almost 7% from the intraday highs. SRF again yesterday moved lower by almost 3.5% post the results. But today, on the back of slightly muted commentary on pricing, that stock lower by over 6%. And lastly, L&T Finance Holding was a sharp mover post results, but today has given up most of the gains and amongst the top mid-cap laggards.
Okay, all right, Vivek. Thanks very much for that. Well, significant recovery which has taken place in terms of the broader markets as well. So the mid-cap index is now just down 1% as compared to an over 1.5% fall when we started the show. So there's been a significant recovery which has taken place both for the Nifty as well as for the broader markets. We'll take a short break, but our in-house experts, Hormuz and Sonal, will give us their statistics and perspective on the broader market pain and what investors should watch closely on our What's Trending segment. Stay tuned.
Fly Emirates, fly better.
Welcome back. Well, let's focus on what's making news in our What's Trending segment. It's been a rough start to the year for the broader indices. The Midcap index is down around 5% this year already. More than 70% of stocks are in the red this month, with 11 out of 100 stocks trading at or near their 52-week lows. To break down what's driving this weakness and where the opportunities might lie, we have our in-house experts, Hormuz and Sonal, in the studio to give us their perspective on the broader market pain and what investors should watch closely. Hormuz, over to you first.
You know, there has been some respite from the panic selling earlier in the morning, but this respite comes after a significant amount of pain that you have seen in the first 13 trading sessions of the year. And in just the first 13 sessions, the Nifty is down 4%, the benchmark index. The broader markets tell you an even deeper story. The mid-cap index is down 5, the small-cap index is down 6.5, and just to jog your memory back, 6.5 to 7% is what the small-cap index had declined in all of 2025. We have seen that fall in just the first 2 weeks of the year. Now, if you take a look at the number of stocks as well, there are down 10% or more, 4 Nifty names, 25 on the mid-cap 100 and 33 on the small-cap 100, which means almost 1/3 of the index is down 10% or more when it comes to the small caps. You take a slightly broader gamut of stocks on the Nifty 500, 430 names are trading with losses on a year-to-date basis. That's the kind of sell-off that you have seen in the broader markets. And if you break it down into the returns aspect as well, more than 11 stocks are down 20% or more, and at least 300 stocks are down anywhere between 5% to 20%. So it's almost 1/3 or 2/3 of the index that is down anywhere between 5 to 20%. Of course, that does not mean that everything is down. There are some opportunities as well. 7 names on the Nifty 500, predominantly being metal names, we'll talk about that in just a bit, are up 10% so far this year. Now you take a look at the underperformers. Tejas Networks was the worst performing stock on the small cap index last year. It's continuing that underperformance this time around. Cohance is down 26 as well. Godfrey Phillips, ITC, of course, because of the news flow that you got at the first day of the year, down 25%. It hasn't recovered from that. Newgen Software, after yesterday's move, is down 24. Elcon Engineering is one such name as well. Disappointing earnings reaction, down 23% in just the first 2 weeks of the year. Now, if you take a look at the outperformers, most of these names are metal stocks. Look at Jindal Saw is up 14. Nalco, Hindustan Zinc are up around 13% each. PSU banks have done well. Union Bank is up 13% as well. Emcure Pharma is one name that has sprung up in the list of gainers on the Nifty 500. That's up 12%. You go to the BSE 500, here too is no different. There's 425 names trading with losses. You break it down into a further returns aspect as well. More than 12 names or 14 names, in fact, are down 20% or more. And here too, 290 stocks down anywhere between 5% to 20%. And 8 stocks have outperformed so far, returns of 10% or more. And most of those names are the ones that we just saw earlier. But here in the underperformers list, you look at Allied Blenders is down 30. CE Infosystems or MapMyIndia, much hyped IPO, down 25. HBL Engineering down 22. Signature Global, the entire real estate pack has been smashed so far in the first 2 weeks of the year. Sapphire Foods as well, down over 21%. So the indices are reflecting the pain, but when you break it down into specific stocks, the pain gets even larger in the broader markets.
Absolutely, it does get even larger in the broader markets. Thanks so much for that, Hormuz. But let's also focus in on mutual fund performances as well in 2026. And Sonal is here to decode how broader market is actually impacting these mutual funds. Sonal, over to you.
Well, you know, at the outset, I would like to clarify that we should not look at mutual fund returns on a year-to-date basis or one-year basis if we are looking at long-term investments. But nevertheless, since we have seen this massive fall across the board, that is something that's seen in some of these small-cap and mid-cap funds as well. Just list them down. The LIC mutual fund has seen the biggest fall in last 1 year. Year-to-date, it's down 8%. Similar is the case with Motilal Oswal small-cap fund. We have Squant small-cap fund. There is James small-cap fund. Quantum small-cap fund is one of those which has seen lesser fall, 3.5% there. Sundaram Small Cap Fund is the other one which has seen a smaller fall, or the fall is not as much as we are seeing in the benchmark indices. At the same time, Quantum and Sundaram are the two mutual fund houses that have seen a gain in the last 1 year. So they are not seeing massive cuts like the other mutual fund houses or the EMCs as well. Now, I looked at some of the holdings of the funds which have seen the biggest YTD fall. LIC Mutual Fund is that one. Apollo Microsystems is one of their holdings. Hormus spoke about Allied Blenders seeing a massive fall. That also is a holding in LIC Mutual Fund. There's Arvind Fashions, Naveen Fluorine, Precall, Shakti Pumps, Sirma SGS. This is one stock which has underperformed. So this explains the reason for underperformance in LIC Mutual Fund. Then I picked up Sundaram Small Cap Fund because that is one of the fund which has actually seen some return in the green in last 1 year. So wanted to talk about that as well. They have something like an MTAR Tech, there's Affle, a lot of IT and IT related companies there, RateGain Travel Tech. We have EID Parry, PNB Housing Finance and SJS Enterprises. If we talk about the mid-cap funds, the story is similar. Some of them have seen, most of them actually have seen year-to-date fall, but some of them have seen a gain as well on a 1 year basis. So the names are the likes of HSBC mid-cap funds, Invesco India mid-cap fund, HDFC mid-cap fund has seen a 10% increase. We have Mirae Asset mid-cap fund which has seen a return of 10.5%. So mid-caps have not done as badly as small caps have done in terms of mutual fund performance. Let's look at Quant mid-cap fund because that has seen the biggest fall year to date. They have Aurobindo Pharma, Tata Com, Premier Energies, IRB Infra. Premier Energies did see a massive return during listing, but it did come off from those levels. HDFC mid-cap fund, which has seen 10% return in last 1 year, has the likes of Union Bank of India, which was an outperformer in Hormuz's list as well. We have Maxfin, Federal Bank, HPCL, which is up 30% in last 1 year. So some of the names which connect with the mutual fund holdings as well. Quickly, let's take a look at the cash holdings for a lot of these mutual funds. PPFAS again tops the list. They have 22% cash in their AUM right now as of December, followed by Quant. We have Vitok at 12.5%. Even Motilal Oswal has 10% cash in their mutual funds right now. Trust Mutual Fund has 7.2%. HDFC, MF and Quantum also around that level. So yes, there are cash levels. Some of them have reduced it, but PPFAS continues to top the list with 22.5% of their holdings in cash as we speak.
Okay, all right. Sonal, thanks very much for that comprehensive breakup in terms of what's taking place for mutual funds. Just to put it into perspective in terms of the broader market pain for today, we have around 245 stocks on the BSE which are in lower circuit. We'll take a short break now, but Mangalam will focus on the F&O setup today. Stay tuned. Welcome back. Well, further recovery for the markets. In fact, the Nifty is just about lower by around 32 odd points. Maybe if this continues, we could probably even try to make a dash for the green at this point in time. And the advanced decline ratio is improved a tad bit. Let's see whether that's sustained. That should come up for you in terms of the graph. Currently around almost 1,400 stocks decline, advancing to around over 2,900 stocks declining. As you can see, there's a little bit of a narrowing which has taken place in the advanced decline ratio. But what's taking place on the F&O desk? We have Mangalam joining in to tell us more. Mangalam.
Well, the market is off lows, no two ways about it. The Nifty at 25,200. We have the Nifty Bank, which has recovered a tad as well. The Midcap Index too has recovered, though we're in the red, out of the woods, but perhaps not necessarily entirely out of danger. But for what it's worth, you know, today's low and the panic low that we made on the market and the dramatic recovery after that gives us important reference points for the future as well. 24,920 will be an important point to track as we go forward. And for the Nifty Bank, today's low of 58,279 will be extremely crucial too. Important part of today's recovery is that, you know, the Nifty is actually in this recovery after having breached the 25,114 mark, which is the 200-day moving average, has now reconquered that and formidably reconquered that. It's above almost 85 points above the 200-day moving average. And the Nifty Bank, the 50-day moving average of 59,269 is an important level as well. The Nifty Bank broke that, and now we are making an attempt towards conquering that once again as well. But the question is, with this recovery, should we build on further gains or not? Well, the answer to that will lie in what happens with the call writers at 25,000. With the market having recovered, the put writing has resumed at 25,000, which was an important support earlier. Had breached that, there was a panic low. Thereafter, the market recovered. 25,000 put writers back in the fray. Premium sub 100 rupees, telling you around 24,900, closer to today's low, is an important support for the frontline index. But 25,000 call writers who were very active in today's trading session as well have now begun to lessen their positions. Has that caused this up move towards 25,200 or not is something we'll know as the day progresses. But the 25,200 call writers are still active. 75 lakh shares outstanding out there for a premium over 100, 200 rupees right now. So telling you between 25,350 to 25,400, there is still possibility of some supply likely in the market. Yes, there has been a dramatic recovery. Could we see it cross past that 25,350 to 25,400 mark is something that we will have to monitor very, very closely. The Nifty put call ratio as well, from extremely oversold levels of closer to 0.7 has now come back to around 0.8. Heavier put writing from here on would again take the market back into the supply zone, which may come at around that 25,400 to 25,500 level.
Okay, thank you so much for that, Mangalam. But let's also bring on board Pritesh Mehta, Executive Vice President at Yes Securities, joining us on the show to talk to us about the checks on the market and individual stocks. Pritesh, good afternoon. Dramatic recovery like we've seen in the market as well. After the dramatic fall, a good recovery. Today, what is the important level that we should watch out for in terms for the close for the Nifty, and what will it mean going forward? If we manage to close near those day high levels, 25,270, what will it mean?
Thanks for having me. Now, see, there are too many things happening around in the background. Market is reacting to plenty of noise coming from US. Japanese bond yields have rallied sharply in the last couple of months. But I'm more concerned with the internals of the market. Yes, yesterday we saw Nifty top 10 equivalent index going below the 200 moving average for the first time since the month of October. But this kind of move tends to result in a downside, but we have not seen that. Yes, it did mark a lower low, but thereafter we see a recovery. So I'm a bit optimistic from here on. Yes, risk-reward ratio is quite favorable, and 24,900 is a level that we need to keep an eye on. 24,850, 24,900. There are cluster of supports coming in this zone, and I think it is more of a tactical move. We can say 25,500 is possible in the short term, but I think this is the range which is going to play out of 600 points, 24,900, 25,500. That is the short term range we need to talk about right now. Nothing more than that.
Okay, a massive recovery. Nifty is now in the green, up 11 points. And we have seen a recovery of 320 points from the lows of the day. Eternal, Interglobe Aviation, a lot of these metal names are leading the recovery. So we'll have to just see whether we sustain in the green or not, because we've seen a very choppy session in the last couple of trading sessions. Pritesh, we do have some individual queries for stocks that have come by. Rupesh Singh is writing to us from New Delhi. He holds 100 shares of Coforge at 890 rupees a share. He wants to know the short-term view on the stock. What's your take here, considering whatever we are seeing in terms of volatility? He's sitting on decent profit of around 74,000 rupees.
I think, see, IT, if you look at IT as standalone index, was it has done well recently. But when you look on a relative basis, I think there is more space to on the upside for IT. So I think rather than focusing more on these particular stocks, there are better opportunities in the IT space. Something like Birlasoft, something like HCL Tech can do much better from rather than Coforge. So I think it's time to take some profits home.
Okay, all right. Thanks very much for joining in and taking us through all of that, all of those details, Pritesh. On the tech side, well, we do have some positive, news coming in for Interglobe Aviation. That stock is down up around 1.8%, where the government is looking to remove the caps. Remember that this was following the severe disruptions with Indigo in December 2025. So now we are seeing that stock spike up on the back of that news, up around 2.3% at this point. But that's on Interglobe Aviation. We're going to take a short break. Up next, we're going to connect with the management of Ceneris Pharmaceuticals to discuss their Q3 performance. Stay tuned. Welcome back. Let's get talking to a couple of companies then. Ceneris Pharmaceuticals reported what was a strong set of numbers. The revenue jumped 64%. The profit was up around 86% on a year-on-year basis. Stock is up around 3% today. Remember, numbers came out during markets yesterday. We have Swapnil Shah, who's the promoter and the managing director at Ceneris Pharma, joining in now. Swapnil, hi. Thank you very much for taking the time out. Well, it seems as though you're probably going to exceed that guidance which you had given earlier of around 50% top line growth and 100% profit growth, margins at 24 to 26%. 9 months, you've already exceeded that. So just tell us, are you looking to revise it upwards, and what are you looking at in terms of an exit rate for FY26?
Well, we are most likely to outperform our guidance. How well? I think probably the next few days would have a better understanding. But so far, what the run rate looks like, I think we're most likely to outperform our guidance for FY26.
How much? And when you say for the next few days, what are you linking it to?
So we were starting our the plant. So plant has already been acquired. So Apnar Pharma that we acquired, I think we're looking to get some revenues out of Apnar within this quarter. And as we anticipate the scale that we want in this quarter, if we achieve, then most likely I think there will be an outperformance on our guidance. So I think so far looks good. Let's see in another 15-20 days.
So Swapnil, you spoke about Apnar Pharma acquisition, which is on track. You do have the third manufacturing facility line in the US, which should be operational in Q3 already. The fourth manufacturing capacity, which should be operational by FY26. When will it start showing in your P&L? What is the revenue at peak utilization?
So we've already started our third line in the US, as you already know. The fourth line is we kind of pushed it a little bit because we've acquired Apnar, as you know, in about a month back. So I think a lot of capacities that we were utilizing in the US will be moving to Apnar, which is likely relatively slightly low margin. So we have the advantage of low cost manufacturing from India, and this manufacturing is optional. It doesn't have to be made in the US, right? So we get both. So we get the capacity open in US for a high yield business, and we get Apnar manufacturing done at a low manufacturing cost. So it's kind of win-win. So that's there. And coming to fourth and Apnar, I think let's see how Apnar scales up. We expect about 120 odd crores revenue coming out of Apnar in next 12 to 15 months. And based on that, I think we'll decide how soon we want to kind of scale on the fourth manufacturing line from the US. So we are keeping those controls in check to see when we can execute that part.
Okay, so right now you all have not started that fourth line, which we are planning to open by the end of FY26, right?
We've kind of pushed it.
Okay, pushed it, right.
Few months, yes, because our capacity came in.
Okay. What about, your emerging markets? That's done very well, right? In terms of margins, also sharp improvement there. Could you give us your growth expectations there from the emerging markets as well as the guidance that one could expect here?
So emerging market is going to be very strong. This quarter, it's emerging market, if you see historically also, second half of the year is always done better. And this quarter also, so quarter ending March 2026, is also going to be very strong from emerging markets. So as we've been stating over last few months that once we see those registration getting those commercialization, emerging market will continue to perform better. So what we have seen in last quarter will continue quarters forward. So I think from the guidance standpoint, we are most likely to cross 150 crore of revenue from emerging market this year, and that could be anywhere between 180 to 200 next year. So that's again a significant growth, and more so we got a 56 product registration approval last quarter. So subsequent to next couple of quarters, all the product registration approval that we got will get also commercialization. All in all, very strong emerging market growth also we anticipate in next few quarters.
Okay, that's interesting that you're expecting emerging markets to drive the growth. Just quickly before we let you go, Swapnil, how are you cashing in on this entire GLP-1 craze and phase which is taking place? There are so many companies which are tying up, marketing, distribution tie-ups as well. How are you participating?
So we are currently playing the GLP sector through our emerging market business. So we have Ribulus, we have Ozempic, we have Wegovy, all 9 strengths as we speak today, all being developed and filed in a lot of emerging markets as we speak. In fact, we have more than 16 markets where we have already filed the semaglutide, all nine strengths as we speak, both orals and injectable. I feel that's going to be quite a bit business that it will generate. But are we going for a US regulated market play where all the large companies are kind of competing against each other to grab that share? The answer is no. I think we are good playing it in emerging market space that we are in and continue to show that growth and continue to have significant revenue coming out of those 20 odd markets that will eventually file semaglutide in.
Okay, take that point, Swapnil. Thank you so much for joining in. The street likes what you are saying. The stock is up 4% in an otherwise weak market. So that's the word coming in from Ceneris Pharma. They are expecting to cross their earlier guidance of 50% top line growth and more than 100% profit growth in FY26. Slip into a short break. We'll get you more on the markets and stock specific action on the other side. .350 recovery from the lows on the Nifty. We do have the mid-caps, which are underperforming. But yes, again, it's a massive recovery from the lows of the day. Eternal, Adani Ports, Interglobe Aviation, Reliance Industries are leading the recovery. So what happens in the next half of trading session? Keep tuning into CNBC TV 18 for more action. We'll take your leave on this edition of Halftime Report.
Cool.
It is a sharp recovery on Dalal Street with the Nifty and Sensex trading at the highs of the day now. The mid-caps and the banks are also recovering from the lows of the day. The rupee, meanwhile, slumps to a record low as investors root for safety.
The promoter group of Ajanta Pharma strikes a deal to take control of Burger King franchisee restaurant brands Asia, and Cupid seals an investment deal in bazaar-style retail, even as Zydus Life and Sun Pharma are seen making significant overseas acquisitions.
SRF has slipped as pricing pressure from Chinese rivals continues to weigh on the performance. United Spirits has dipped as volumes have missed the mark. Shoppers Stop is hit by weak consumption, while Vikram Solar sees orders and revenues slip sequentially.
Gold and silver surged to record highs as investors flock to safe haven assets as geopolitical uncertainties cloud global economic outlook. The Sell America dollar trade and yen's dip on Japan's fiscal worries add to the mix.
And the who's who of India's IT industry tells CNBC TV 18 that they are seeing a big opportunity in AI beyond making models in helping the industry adopt the technology. But some express concerns over the impact advances in technology can have on jobs. It's a dramatic reversal on Dalal Street. In just a couple of hours, the Nifty has recovered from panic lows to the day's high. Good afternoon. You're with us here on Business Lunch. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. And it's a very good afternoon for the markets indeed, especially versus this morning, right? Nifty and Sensex now in the green. The mid-caps and banks recovering marginally, but recovering quite a bit, but in the red still.
You're waiting to say that word.
Yeah, I was.
But yes, indeed, it's been that kind of a day, right? 24,919 was the low that the index made, and it's a 360-point recovery from the intraday low for the Nifty. So 50 points higher is where we currently stand. And Supreme Industries is one name that has come out with results just a few minutes ago. The company has maintained its FY26 volume growth guidance to be between 12 to 14%. That is one factor that you need to account for. The stock saw a bit of a spike and now has declined again from the highs. It has maintained its plastic pipes volume growth guidance to be between 15 to 17% and the overall volume growth guidance to be between 12 to 14%. So some choppy moves seen on the stock as of now. The numbers they have also so guidance has been maintained overall for Supreme Industries. We'll get you more details as the show goes by. But Arundhati, other than what has been the recovery on the index, one stock that has been leading that recovery has been Reliance. It was a very sharp recovery from the lows of the day. There is a bullish note coming in from CLSA as well earlier in the day. So Reliance is contributing. But what else is on your list today?
Hormuz, if you see those banking names, right, those big banking names which are holding up in yesterday's session are now leading those losses. You've got big private bank names like ICICI Bank, Axis Bank and HDFC Bank, all of them in the red. We've got Kotak Mahindra Bank, which is in the green, but ICICI Bank is the top loser on the Nifty today. That metal pack has managed to inch its way into the green. We've got Hindustan Copper, Hind Zinc and JSW Steel, all of them managing to gain between 1 and 3%. But in stock-specific action, as Hormuz pointed out, Reliance is leading the gains on the Nifty and has recovered over 2% from lows. And meanwhile, Kalyan Jewellers is the top mid-cap loser, seeing cuts of over 11% and has fallen for 8 straight sessions, while SRF is under pressure on weak earnings. And the fact that it is likely to miss its chemical business growth outlook also weighed on the stock.
And that has been the story of the morning. Kalyan Jewellers now down for the 8th day running. SRF too seeing losses of around 5%. So of course, make no mistake, there are still plenty of stocks that are bleeding in the broader markets. And Supreme Industries has now recovered from the lows of the day, now just 0.5% lower on the stock. But the other major story today has been the fall in the currency. It has touched a new low, 91.50. Is where the currency fell to, now 91.56. So now even further as we speak, and that is on sustained foreign selling of Indian equities and poor sentiment across the markets. And despite the markets recovering from the lows, the same can't be said for the rupee, even as the RBI is said to be intermittently supplying dollars according to dealers. Lata is here with more on this. Lata, good afternoon.
Well, it has been a bad last 48 hours for all asset classes. So rupee, which as an asset class was already under pressure, felt the worst. So again, nothing new about the reason why the rupee is falling. There has been incessant FPI selling of Indian equities, buying dollars and repatriating it, and much the same is continuing to happen. And it kind of compounds because when you're expecting, when you see those FPI sell numbers, importers come and book dollars for future purchases, exporters refuse to sell the dollars they've earned, all of this exacerbating the fall. I just want to add another technical factor. You know, the month ago, contracts entered, sell-buy contracts entered into by the Reserve Bank in the NDF market matures in the earlier part of the day. So today's month ago dollars, contracts mature. Many banks find themselves short at that time. It matures around the 1 p.m. period. And therefore, at that time, there is a heightened buying of dollars. That also adds to the pain. So the expectation is that once that 1 p.m. Rush of buying dollars is over, the dollar fall, the rupee fall or the dollar rise may kind of peter out. And now the stock market also is showing signs of stability. So possible that the worst of the fall is behind us for the day. We live in that hope. And the additional factor, of course, is that a falling rupee actually corrects distortions, helps exporters, stops imports from coming in, or rather makes imports expensive, and therefore domestic industry does better. So falling rupee has a lot of advantages for the currency. The problem is that when it is a concerted fall and there is an expectation of further fall, even investors who want to bring money will wait. So a stability will help, and that's what one is waiting for. One hopes the stock market is giving us good tidings.
All right, Lata, many thanks for those details. The rupee hitting a fresh low, and hopefully the worst is behind for the rupee for the day. But moving on, 2026 has seen the worst start for the market in the last 10 years. Before we go to Sudarshan for the market data, here's some opinion from market veteran Sunil Singhania on the current state of the Indian market.
A lot of parameters are starting to show signs of, I would say, scare at the peak. The number of new lows which we hit yesterday was almost 750, 800. It's a good indication. I think 52-week lows after a not so great year, particularly for broader markets, point that a lot of investors are giving up and just throwing up stocks. On the other hand, on the global side, yes, I think this Trump mania has been reaching peak. But now I would say the good thing is that almost all countries have started resisting it. We have a budget coming in. The macro parameters are pretty steady and healthy. Balance sheets of corporates are pretty steady and healthy. Obviously, the external environment is such that growth is right now on the corporate profit front stuck at 9-10%. But looking at the scare and looking at the kind of views and news flow coming in, I would stick my neck out and say that, it's time now to start investing. In fact, last 1 week, we have been quite aggressive in investing. And it's not about large cap, mid cap, or small cap. It is about stocks where there is visible profit growth and valuations are not out of whack.
Sudarshan is joining us now on the markets, which have had a weak start to 2026. Sudarshan, tell us more.
So it's a good recovery we are seeing in the market. Nifty, led by Reliance Industries from the intraday low, has gained almost 200 points. But nevertheless, if you look at the 13 trading sessions data, it's the weakest start for our Indian equities that we have seen in the last 10 years, or say since 2016. And it's the third straight year that we are seeing the negative returns in first 13 trading sessions, in which Nifty is now down almost 4%. And this loss has resulted in the market cap loss for BSE listed companies, and so far we have erased market cap of more than rupees 25 lakh crore. Now take a look at some of the indices which have seen a major fall. So frontline indices, Nifty is down 4%, same for Sensex, down 4.4%. Nifty Bank has relatively outperformed, it has slipped 1.6%. Major pain has been seen in the broader markets. Midcap index down 6%, small cap index has fallen 7%. What about the top Nifty losers? So if you take a look at all the 50 stocks, 33 stocks have given negative returns so far this month, and of which 6 stocks have seen a fall in the range of 10 to 19%, and 17 stocks are down in the range of 4 to 9%. Top Nifty losers, ITC down 19%, Trent down 13%, Reliance down 12%, Jio Finance down 10%, Adani Enterprises down 10%. Now, this was about January 2026. If you take a look at the data of last 1 year, Indian market is the biggest underperformer. In the dollar terms, it has given the returns, positive returns of just 3%. S&P 500 up 12%, Hang Seng up 31%, DAX 32%, and same for Nikkei. What about going forward? So over the next few days, on one thing that will matter the most is the commentary that we get from one man. And that's only one person, Donald J. Trump.
Only Donald Trump is what is grabbing headlines right now, globally, locally, Davos, everywhere. Sudarshan, thank you for that update there. Take a short break. More news and updates on the other side. Stay tuned.
Fly Emirates, fly better.
Continues here from Davos 2026. We are bringing you all the live action. As I told you, today is D-Day. It's Donald Trump Day. But what we do now know is that because there was a technical snag on Air Force One, President Trump had to go back and board another aircraft, the backup aircraft. And so there is going to be a delay in his arrival here in Davos, perhaps by about 3 hours or so. That's as per Scott Bessent. But of course, we'll be tracking all the action. Well, a group that is in many ways linked to what President Trump does or does not do, what he says or he doesn't say, is the Wellspun Group. And joining me today are BK Goenka and Dipali Goenka. Thank you very much. I understand this is the very first time that the two of you are doing an interview together.
Absolutely.
One of the many firsts here on CNBC TV 18. But let's start with what the expectation is from President Trump and the new world order that he's trying to set.
No, I think there is a lot of concern and also inside, everybody's mind, the issues that what is going to be next. And I think the whole world order, as you said, is going to be different, looks different. And I think this is going to be a new norm and new world. And I think the whole thing is being rewired, if I can say that. And the situation, I think what we have to see is that how the whole part of Europe is going to pan out, going to react on this particular reaction on the Greenland.
Greenland threat, yes. You know, we don't know and we can't preempt what he will say or do, but we should talk about what is in your control, and that is business. So what is business looking like at this point in time, and especially in a world of tariffs, but also in a world where oil and drill, baby, drill is also the new norm? What does it mean for your business specifically?
So I think for us, different situation in different businesses. I mean, Dipali will talk about textile, but when I talk about oil and gas pipeline, I think in US we are looking very, very good. And thing what is right now is that overall the demand from the AI sector, particularly data center, the power demand, even if that happens 20%, what is being discussed, I think there is absolutely good visibility in US for next 5 years from the angle of the requirement of the energy, you know, whether it is coming from the gas or it is coming through the renewable, it is going to come through the ultimately from nuclear, which is long drawn. But I think next 5 years going to be 80% coming through the oil and gas.
So what could that potentially mean in terms of revenue for you?
I mean, we are already in expansion phase and we are almost tripling our capacity in US, and accordingly, I think
investment
of almost $500 million overall in US and Saudi. And within US, we are doing around $400 million. So that's going to triple our top line, as well as hopefully, I think, we'll see a better bottom
line as well. But, you know, one of the other developments that's taken place is, of course, what's happened in Venezuela, and President Trump making it absolutely clear that U.S. oil companies are going to go all in. Of course, oil companies so far are a bit more apprehensive on what all of this is going to mean in terms of putting money on the ground. How do you see this development and what it could potentially mean?
I think immediately, if you see nothing going to happen there. I mean, it's in anything what is to be, you have to develop the oil and gas area. It takes 3 to 5 years. So I think we have still time to go. But yes, a lot of buzz there. But on the ground, really, things are not yet settled.
Things are not yet settled. Okay, well, we will talk.
A conversation there with the management of the Wellspun Group, and continuing our coverage there from the sidelines of the World Economic Forum in Davos all through the day. By the way, just before we take that break, look at the currency again. 91.67 is where it stands now, extending its losses even as the markets have staged a bit of a recovery from the lows of the day. But since then, it's been a one-way downward move for the currency against the US dollar. 91.67, and on cue, the recovery in the market is also getting sold into. So from almost touching levels of 25,300, we are back down to levels of 25,200, still significantly off the lows of the day, Arundhati.
Absolutely. And speaking of Davos, right, the most anticipated presence at this year's World Economic Forum is US President Donald Trump, but we'll get more details on that in just a bit. It's time for us to head into a short break. More news and updates on the other side. Welcome back. You're still with us on Business Lunch. The most anticipated presence at this year's World Economic Forum is US President Donald Trump, who is en route Davos after the Air Force One plane returned to the US due to a minor electrical issue. According to a White House official, the US president has now chartered a smaller 757. The president was scheduled to speak at the Davos summit tonight at 7 p.m. Indian time. However, US Secretary of State Scott Bessent has now confirmed that his address has been delayed by 3 hours. Amid the rising rhetoric on Greenland, Trump also said he has a lot of meetings scheduled in Davos to discuss the territory and suggested he could use tools beyond tariffs to get control of the Arctic island.
And amidst all of these Trump tariff threats, reports say that the European Union is likely to suspend the previously agreed US trade deal. CNBC's Dan Murphy with more details.
The European Parliament is reportedly set to suspend the approval of a trade deal negotiated with the US back in July. Multiple reports now suggest the suspension will be announced in Strasbourg today. As part of the agreement, US tariffs on most European goods were set at 15%. That's half the initial level, while the EU agreed to invest in the US and make changes that were expected to boost US exports. Speaking to our US colleagues here in Davos, the US Commerce Secretary Howard Lutnick said he did not expect the US-EU trade deal to change.
I don't see it changing. I don't see it changing, and if it did change, it wouldn't change in the benefit of Europe. That means they want cars the way they have it. They want pharmaceuticals the way they have it. It's been very successful. I mean, think about it. Their stock market's up strong double digits. It is. Right? So why would they mess with that? They really need to understand that they should keep the pressure and temperature low. This is just, let's talk to President Trump and let's talk together.
Meanwhile, the European leaders addressing these rising tensions at the World Economic Forum in Davos and warned of a changing world order. Listen to what they had to say.
Plunging us into a downward spiral would only aid the very adversaries we are both so committed to keeping out of the strategic landscape. So our response will be unflinching, united, and proportional.
Without collective governance, cooperation gives way to relentless competition. Competition from the United States of America through trade agreements that undermine our export interests, demand maximum concessions, and openly aim to weaken and subordinate Europe, combined with an endless accumulation of new tariffs that are fundamentally unacceptable, even more so when they are used as leverage against territorial sovereignty.
An American hegemony in particular helped provide public goods, open sea lanes, a stable financial system, collective security, and support for frameworks for resolving disputes. So we placed the sign in the window. We participated in the rituals, and we largely avoided calling out the gaps between rhetoric and reality. This bargain no longer works. Let me be direct. We are in the midst of a rupture, not a transition.
Blackstone's Stephen Schwarzman also spoke to Shireen Bhan on his top sectors to watch in India in 2026. Take a look.
We'll continue adding companies at an accelerated rate because we'll have the monies to do that. In real estate, there's always exciting things to do as data centers are developing. There have been a series of announcements, as you know, of what people hope to do. We're one of those hope to do people also. We've already been building some. Whenever you operate with a country that's on the right track, there are always new opportunities that you didn't see. We did something in the money management business there. That's done really well. Something in the housing business, that continues to do well. So, India has a very stable political structure now, and it's doing the right types of things. So we're finding an increasing number of things to do.
And with that, we take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. The Nifty, well, it was around 90 points off the highs of the day. It's come down to that now. The rupee, though, continues to remain at record lows. Midcap radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. What a massive recovery we saw around 12:30. A bit of it is sold into, but I don't think there are much complaints from the bulls as well. We are above that 25,200 mark. After slipping below that mark, we are closer to 24,919. So it's a massive recovery from there. But Rupee continues to extend its losses.
That's right. Good afternoon, Sonal. So many cues that we're tracking overnight. Important events, important developments from Davos, as well as the kind of volatility that we're seeing in the markets. A lot of cues, a lot of earnings, something that we're digesting. A lot lined up on the show. Very important corporate conversations as well. So let's start off with the top headlines. Market recovers sharply from lows led by heavyweight Reliance Industries, but still remains volatile. Midcap index and banks continue to remain in the red, but sharply off intraday lows.
IndiaMART into May share surge 5% today after the company's Q3 profit surges 56% while revenue jumps over 13%. The management tells CNBC TV 18 that they expect respite in silver segment churn next year.
SRF slips over 6% today after the management in its Q3 conference call says that persistent pricing pressure from Chinese competitors has weighed on the performance and that they remain cautiously optimistic on the demand.
Kalyan Jewellers shares tanked nearly 15% in trade on heavy volumes. Motilal Oswal Midcap Fund holds nearly 9% stake in the company, while the promoter pledge remains nearly 25% as of December 2025.
Vikram Solar declines over 7% following its Q3 results. The company's order book remains muted, but also declined sequentially. We will be speaking to the management shortly. Stay tuned for that.
Okay, all right. Those are the top headlines that we are tracking. We do have some managements lined up on the show as well. But mid-caps, they continue to be the talking point. This is our special segment, Mid-Cap Movers. We have Gaurav to take us through the mid-caps that are moving around in trade. Gaurav.
Well, yes, it is actually a volatile market today. And if you look at some of the movers, first let's talk about some of the gainers today. First is Rossel Taxis. If you look at this stock, the volumes are very strong. And at the same time, if you look at the move, it is up more than 10%. MRPL is yet another stock with strong volumes and a strong move here. Credit Access Grameen. Now, this stock is specifically in focus because since morning, we have seen this stock moving up. And the reason being that strong asset quality and at the same time, management is also very firm about the growth and asset quality outlook going ahead. Supreme Petrochem and Sunrise Pharma. If you look at these stocks as well, we are seeing strong volumes. And in fact, let's not forget that Sunrise Pharma just a few minutes ago came on CNBC and said that they can actually exceed their FY26 guidance. We are seeing some rise in this stock. Other than that, if you look at the losing side, we are seeing Kalyan Jewellers, who has not only been a top loser, one of the top losers with strong volumes, it also hit its 52-week low level. Apart from that, we saw Shoppers Stops, Aarti Surfactants and SRF. All of these stocks are seeing some kind of pressure with high volumes and some kind of pressure on the lower side for continuous 2 days in a row. Apart from that, let's also talk about some of the mid-cap stocks who are actually or who were at their 52 weeks low. And we've got Tata Chemical, AB, Aditya Birla Fashion and Retail, Balrampur Chini, Godrej Properties. All of these stocks actually hit its 52-week low. In fact, let's also not forget Godrej Properties was there yesterday as well, reaching its 52-week low. So it has reached its new 52-week low today. Other than that, we are seeing some of the stocks which are actually reacting to their results. First is Tata Communication, Thangamil Jewelry. These companies will come up with their results today. If you look at Anandraj as well, we are seeing some kind of gain. And lastly, let's not forget about Bajaj Consumers. Now, the company will come up with the result, but as of now, we are seeing some pressure. Stock down more than 4% today.
Well, thank you so much, Gaurav, for joining us and giving us a comprehensive list of all of the mid-caps that are moving around in the session today. Well, moving on, an important conversation like we promised. Supreme Industries reported a mixed set of Q3 results just a couple of minutes ago, with the profit and margin falling during the quarter. But the management has managed to maintain its FY26 volume guidance. To discuss the numbers and the outlook going forward, we have with us MP Taparia, the Managing Director at Supreme Industries. Good afternoon, sir. Thank you so much once again for joining us. Well, what has given you the confidence to maintain the guidance as far as FY26 is concerned, and any early signs of guidance that you could provide for FY27, sir?
Good afternoon. Thank you very much. We are quite seeing good demand prospect in the last quarter. And that's why we are able to maintain that volume growth will be between 12 to 14%. And piping demand will grow between 15 to 17%.
Okay. Take that point. So you also indicated that EBITDA margins for FY26 could be between 14.5% to 15%. At the 9-month mark, your margins are at 13.7%. You're confident there as well that you'll achieve that guidance? Also asking because we spoke about that reversal in pricing in PVC. Is it the reason why you are confident?
In the 9 months, there was too much erosion in all the polymer prices. So now we have reduced the margin guidance. We anticipate it is going to be between 13.5 to 14% this year.
Okay, so EBITDA margin guidance has been revised onwards to 13.5 to 14% from the earlier 14.5 to 15%. Is that correct, sir?
Yeah.
Right. So the other point that we want to understand from you is that, as far as global markets are concerned, we understand that there has been an increase taken by the Chinese authority as far as VAT is concerned. Now, for the Indian market, does that mean you will enjoy higher market share, and can there be a recovery on prices due to this development?
We are quite happy that we will be growing by 15 to 17% in plastic piping segment. Our systems are all well accepted, and we anticipate, as we have grown 16% by volume in plastic pipe system in third quarter, we are confident that we will be able to achieve the volume guidance what we have given now.
Sir, wanted to understand where pricing is currently, and as my colleague also just mentioned, what's happening in China, just trying to understand with the ADD that was going to be imposed, the pricing that we are seeing in the domestic markets, are you going to see recovery in PVC pricing? Has it bottomed out? What kind of growth did you see in Q3?
No, we do not see any possibility of imposition of ADD now. That is not possible. But definitely the Chinese price also started inching up. Chinese government announced some withdrawal of incentive on export of several items, in which PVC was also there, which is going to be effective from 1st April of this year. And that's why the Chinese exporters have increased their price to some extent. In Indian market also, the PVC prices have gone up, and Rupee also going down, and we are very much dependent on import. So we believe that the worst is behind us.
So we understand that in the last 2 months, there have been a few price hikes that have been taken by the domestic PVC players. So going forward, how do you see pricing pan out? Where are they currently?
No, the prices were only going down continuously up to December. Now only from start of this year, 2026 January, the prices started inching up slowly but surely.
Okay, and this trend is expected to continue, Mr. Tapadia, the increase in prices from here on?
Sorry?
Do you think prices will continue to see an upward movement the way that you've seen it in January?
Now, we have seen that many producers in the world have curtailed their production, and some of them have closed also their operation completely, because making PVC has become very unaffordable. So we believe that when such thing happens, that there is no chance of prices to go down, and we are seeing the crude prices are also maintaining above $60. So we are very firm, and now in India the season is going to be full swing. The demand coming from agriculture, housing, infrastructure are very robust going forward. And the consumption demand will be more in this quarter and second quarter of this year. So we do not believe that there is any chance of erosion in PVC price now going forward.
Okay. Take that point. If you can quickly tell us, sir, what is the kind of capex you have planned now that you're talking about strong demand? You do have a lot of it already in place. Any fresh capex you'll be announcing? Will it all be funded again through internal accruals?
Anyway, we have got enough capacity in place. This year we have invested around 1,200 crore. 1,030 crore assets are already up and running. So we have got adequate capacity in other segments where we are operating this year.
Okay, Mr. Tapadia, once again, thank you so much for joining us, and we wish you all the best for a strong Q4 as well as a good FY27. Well, we'll now slip into a short break. We'll get chatting with the management of Vikram Solar on the other side.
Welcome back. You're still tuned into Midcap Radar. Let's now focus on Vikram Solar. The company reported a strong set of earnings in its December quarter, with profits seeing a multifold jump while margins expanded significantly. This is on a YOY basis. We're now joined by Gyanesh Chaudhary, the CMD at the company, to break down the numbers. Most importantly, talk about the outlook going forward. Mr. Chaudhary, good afternoon. Thank you so much for joining in. While YOY the numbers look really strong, if your revenues are up 7.8%, your EBITDA is up 141%, it's a sequential decline. Profits are down 24%, EBITDA is down 12.5% on a quarter-on-quarter basis. If you can explain what's happening there, because we've been talking about overcapacity in the sector. Is that impacting realizations and pricing? What is the current pricing trend for solar modules?
Thank you so much for having me. I think we're looking at a quarter which is in isolation, but as Vikram Solar, our 9 months EBITDA stands strong at a 20+%. And that comes from resilient and strong order book and delivery quarter on quarter. So as far as the between the quarters, the so-called dip in EBITDA is concerned, it's more to do with working in a resilient market and making sure that we are able to meet the demands going forward. So we have no doubt that we'll be achieving our forecast at the year or the end.
Okay, Ganesh, first up, thank you once again for joining us. I believe you're seeing it for the first time post the IPO listing as well. See, the first thing what we want to understand from you is by now it's well known that there's quite a lot of competition in the market, and investors have been bracing for a dip as far as spreads are concerned. There's been a slight moderation of spreads on a QOQ basis. Going forward, can these levels sustain, or do you expect realization and spreads to moderate further?
Thank you, Vivek. It's great to be back. As far as the industry is concerned, I think the resilience comes from the fact that there is so much of demand that is still waiting to be had. We have a strong order book, as I said, but also the macroeconomic factors are not slowing down. We see that there are a lot of government contracts and tenders getting awarded. The DCR mandate is coming on stream as we speak. So all of this combined leads to a strong, fiscal next year and also Q4. Basis whatever is happening from the China quarters, what we see is that in the short term we saw supply chain volatility because of capacities in China getting constrained and all of that. But this phenomenon will be well taken care of as soon as Indian capacities come, and also going forward we are seeing prices hardening in solar modules. So this is more a story of resilience, as I said, than actual dip.
We do get that point because there has been a lot of focus on renewables. But as Vivek also pointed out, while we are seeing a lot of demand come by, the supply has also increased. And that's why maybe the near term looks on the downside because of lower realizations. Is this a trend that will be short term, or do you think it will have a larger term impact? Because while we are seeing a lot of enthusiasm around the space, at the end of the day, if it doesn't flow to the bottom line, that would impact returns for shareholders. So trying to understand the long term picture here.
Exactly. Thank you so much. The way I see it, this oversupply is more of a phenomenon that is being built out basis the absolute numbers that are coming out. But when we dissect it basis technology and capacity utilization, you will see that the companies which are doing well are the ones that are achieving higher capacity utilization, sweating the asset more, as well as working on technology which is far superior than the others. While we see that the market is now split between mono PERC technology and TOPCon N-type technology, Vikram has taken a conscious call and moved completely into N-type TOPCon technology because it is better yielding. The LCOEs are better for our customers, and therefore this will drive the wave of newer purchasing decision making. So I think when you talk about capacity, we must also take cognizance of technology along with it.
Okay, Ganesh, the other question is, we want to understand how the rise in price as far as silver is concerned is impacting. We believe that will have an impact as far as EBITDA margins are concerned. Can you quantify that impact for us? And how does, do you have enough inventory so that going forward you could probably manage this a little better? And the second question is, so far you've been largely domestic focused, but, significant portion now of your order book is on the export. So what kind of realizations and margins can we expect there?
So we've seen a great phenomenal change in our overall cost stack, and this is true for all large manufacturers like us. We've seen that our competitiveness with China has greatly improved, which was earlier impacted because of capacity utilization or availability of large equipment manufacturing infrastructure. So with all of that, now with us, we feel that we are ready for expansion beyond we just call US, but now we talk about Europe, Middle East, and other regions because the competitiveness has increased. Further, when China comes up with their announcement that they're going to take away VAT on solar panels, therefore the differential gain that the Chinese manufacturers had is going to be gone very soon. That gives Indian manufacturers like us a larger play to play in the international market. As far as silver is concerned, yes, it's a concern, but there are multiple technologies at play which are currently under various stages of commercialization. It will help in reducing the silver consumption. But also one very important factor we cannot forget is that this industry works on this sort of volatility. In the last 20 years, we've seen many such cycles. But as far as silver is concerned, it's a part of cell manufacturing or cell as a raw material, and it is usually a pass-through. So when there is significant change in buy-side pricing, it usually is a pass-through to the ultimate IPP or the developer.
Understood that. Well, a couple of targets as far as capacity expansion is concerned. At the end of FY27, where will you stand? We understand that you've moderated your module capacity addition guidance by close to 2 gigawatt. Is that a near-term phenomenon, or going forward, that will come back on stream soon?
Great question, Vivek. We are a technology company, and we thrive on latest technology in solar manufacturing. And for us, absolute capacity is just a nameplate. So when we say 17.5 by FY27, we would still be able to come to that point with a lot of upgrades in our existing lines going forward while investing in new lines. So at the end of this year, we will be at 15.5 gigawatt, and with various improvements, process improvement, technology upgrades, we will end up at 17.5 irrespective of any significant capex even.
Okay, take that point. Thank you so much for joining in today with your thoughts and the outlook on the business going forward. That's the word coming in from Vikram Solar. The stock is low by 8% as we speak. Strong YY growth, but sequentially, there has been a dip in margins. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that. Welcome back. Well, from the broader markets, SRF is one stock which is at the day's low. The numbers were reported yesterday, but the commentary is something which is spooking the markets. They did indicate that the pressure from Chinese competitors across some of the core product categories is something which is impacting specialty chemicals margins, even in their nylon cord fiber or their technical textiles. That is one issue, along with US tariffs, which is leading to some pressure. So that is one stock that should be on your radar. But other than that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Closing bell when we return.
Cool.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Thanks Hang is managing to hold on to a very flat start. Nothing much of an up or down that we're seeing there.
I mean, the sell-off on Wall Street is a bit of a catch-up to the turmoil that we've seen, especially in European indices, etc. Yeah, Nifty is now flattish. We'll see if there's another wave of selling which hits, or is there any interest on the other side.
I think the key marker to watch for is the global bond yields. Now, yesterday we had the Japanese bond market blow up.
I think 26 has started off with a lot of news flow, a lot of concerns.
Post 12:30, you see some kind of recovery. For the time being, there's a bright red all across the screen.
Quite clearly a seminal $500 million moving out every single day practically after the market started in right earnest in 2026.
A ready 500 store access is what Cupid gets through this deal.
Because of the global events are the best time to invest in the market.
What a massive recovery we saw around 12:30. A bit of it is sold into, but I don't think there are much complaints from.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Rima. In a short while, Prashant will join in as well. But it's that sort of a day for the markets. We were down close to 250 points out. We've recovered a little bit, but still very, very skittish, Rima. And I think the story of the day is really the Indian rupee. That's not pulled back a good deal. Until we see weakness out there, that's going to be a bit of a problem, because those hopes of FI flows coming back, they go out of the window if you continuously see this rupee depreciation. From the day's low, it's pulled back a little bit. Yes, I know. But otherwise, even after this pullback, you have 3 stocks that are declining for 1 stock that's advancing. So you'll have to say the pullback that we saw today was from extremely oversold levels. I think on a closing basis today, if the bulls can at least conquer the 200 DMA on a closing basis, they'll feel a little bit better, but very, very skittish.
Indeed, and even the Nifty Bank is under pressure, right? So while the frontline indices have managed a recovery, the Sensex nearly 1,000 points from the session low, the Nifty Bank is still down close to about 630 points. The advanced decline ratio is still in favor of the losing side. At peak pessimism closer to 11 o'clock, we had an advanced decline ratio closer to 1:7. Now it stands at 2:5. So, but as you can see, once again, in the last 30 minutes, the gap between the two is widening. We've still got 1.5 hours of trade to go. It's been a roller coaster ride. The first half of the trading session, a lot of weakness. But in the second half, there has been a recovery. How durable is it? How much can it extend itself? Sandeep Tandon, founder and CIO at Quant Mutual Fund, is now joining in, perhaps just make sense of the kind of moves that we've seen in the market since the start of the year. Sandeep, this is not quite the 2026 beginning that we were hoping for after the underperformance of last year. 3.5–4% lower now in a span of 14 trading sessions, and on the Midcap index, closer to 4.5%. And the rupee, that continues to weaken, 6 consecutive sessions of losses. How are you all at Quant assessing the weakness?
So if you recollect in your own program in Market Forum, I talked about that after difficult 2025, we are entering into fragile 2026. And we talked about this year we'll remember as a PE contraction phase globally. Okay, this is what our macro analytics was endorsing, and it is moving in that direction, where we are seeing PE contraction and we have seen a sharp sell-off happening in the expensive stock. So the way I look at in the market is a phase which we have to live with that. Okay, we have seen very easy phase for last many years. If we are in a challenging phase, you have to rebalance and reposition your portfolio in such a manner that you can face these challenges and still generate alpha out of it. But we have to also understand in the context which we are in right now. Okay, obviously, logically, we are always bullish on the long-term perspective, but from a medium-term and near-term perspective, these are the challenges which we are facing. And it's not about India-centric. The challenges is more on the geopolitical front. There's a battle between US and China, and other countries are a part of that collateral damage which is happening, and it's a dollar supremacy. So it's a much larger thesis which we have to, if I have to sit down and discuss the macro, this is the way it's playing out. Now we have to play it very intelligently. Okay, when I say intelligently, let's understand, if we talk about that, we are talking about a PE contraction phase, and why we are saying PE contraction phase. Let's understand that first. The most important thing is that the risk appetite, particularly in the global equities and developed market, has started shrinking. Liquidity cycle has also peaked out globally. So we are in a phenomena where we can expect the peak space can continue. Now, let's say how to take advantage of this situation. Obviously, the first thing is that we think that growth stocks logically will underperform and value will outperform. And within value, we have to identify the opportunity. So the way we have constructed our portfolio in today's context, the first priority is liquidity. So our portfolios are very liquid. B, safety is the second priority, and third priority is the return. That's the way we have defined the broader thesis. And within that, we are trying to identify all the stocks, let's say for what has not performed in last 1, 2, or 3 years, which are attractive, reasonably valuations are there. They're relatively under-owned. I'm not saying you will find some completely under-owned stocks right now, relatively under-owned. And some of the stocks are now reaching with a frustration in the market and relatively hated zone. So these are the names which we want to capitalize, and given the trend which we are seeing globally, so I will be playing a very stock specific, and we're also playing from a short-term and medium-term perspective rather than saying everything is long-term.
So liquidity, safety, and then returns, right? That's the thesis you're going with, right, Sandeep?
Yes.
Okay, just one quick word then. The mid-caps, do you think they're going through a healthy shakeout? Or do you think there's a structural derating taking place on the mid and the small cap space?
So Nigel, let's understand, okay, last year or last few years, mid caps being the way AMFI defines mid cap is only 150 stock technically, okay? So when you have only 150 stocks and everybody is chasing them, and the extraordinary money has come to the mid and small portfolio schemes in the mutual fund also, and global also people were chasing. So obviously the valuation of the mid-cap space particularly has been very, very stretched. Okay. And if that is the case, and we are talking about the contraction phase, then I think the derating in some of these stocks, which has become very expensive, and we have started accepting that this is the expensive names and will remain expensive from a longer term perspective. I think those are the names where we see vulnerability is very high. After, let's say, 40-50% correction, some of the names, somebody comes and tell me I will be buying opportunity, like the EMS space or something like that. But I think it's the beginning of that trend. Okay. So I don't see that this pain is over in the overvalued stocks. Now this challenge comes or the opportunity comes. How you use this opportunity? See, when market falls, everything falls. Okay. But when market recovers, the good stock will bounce back first. So we have to understand, the question comes how you define good. Every cycle is slightly different from the previous one. So this cycle, the way we looking at the market is all about how to capture these opportunity when, let's say today, yesterday or last 3-4 days, we have seen good amount of panic happening, and market obviously has broken certain technical levels, which a lot of people track from a behavior perspective. And obviously when these levels start breaking, people started believing the structure breakdown. And there is no debate on that, but the structure of the market has become very weak. Now, we all understand, see, we there for just 6 months or 2 months from a portfolio when we invest from a longer term perspective. And we always talk about investors and asset class. Equity and asset class is long term, and investors are long term. So we have to look at from a longer term perspective. I think it's a brilliant opportunity if you can switch your portfolio, rebalance your portfolio, and without any hesitation. You should not feel, oh, I am booking a loss now. I have seen this price at the peak. Now it's down 30%, 40% from the peak. And this is the where psychological games comes into picture. People are not able to book profit. What we have to look at, okay, even 30% correction, whether this stock has potential to bounce back or will give me that desired alpha. If you are not seeing, given the environment which I'm talking about, I will like to rotate. This is what exactly we do at Quant, okay? And we do it ruthlessly in that sense, because the moment you bring your emotional attachment, association, then the problems start. If you are convinced about the cash flow, if you're convinced about the valuation, convinced about this is opportunity from long term, then you have to switch to these names and get out from the all most expensive and over admired territory stocks.
Sandeep, we'll chew on that thought, but request you to just hold on for a moment, because we have Hormus and Sonal, both of us joining in, to just put light perspective on the broader market pain that we've seen and what investors should be watching very closely. Hormus, you go first.
Well, you know, when you usually see such kind of moves across the year, but we are just first 2 weeks into 2026 and we are already witnessing the extremes of the market. You take a look at the Nifty, down 4% as of now. The mid-cap index is down 5%. The small-cap index is down 6.5%. Just to jog your memory back, the small-cap index was down 7% in all of 2025. It's down 6.5% in just the first 2 weeks of the year. Now, to take a look at stocks that are down more than 10%, 4 of them on the Nifty, 25 of them on the mid-cap 100 and 33 of them on the small-cap 100. So almost a quarter of the mid-cap index and a third of the small-cap index has stocks trading 10% or more lower. Now you break it down into a slightly broader gamut of stocks on the Nifty 500. Here too, 430 stocks are trading with negative returns on a year-to-date basis. Now on a returns front, if you take a look at the number of stocks that are trading with losses of more than 20%, already there are 11 such names. Almost 300 stocks are trading with losses of anywhere between 5% to 20%. That's the kind of fall that you're witnessing in the broader markets right now. It's not as if everything is down. There are some outperformers as well. You take a look at least 7 names, predominantly mostly metal names that are up at least 10% or more so far. Now you take a look at the underperformers. Tejas Networks was the worst performing stock last year. It's continuing that in this year as well. Cohance, Godfrey Phillips, Newgen, Elecon, all of them down anywhere between 23 to 25% so far this year. Now the outperformers. We spoke about Jindal SAW over the last couple of trading sessions. Metal names, Nalco, Hindustan Zinc, PSU banks have done well as Union Bank, and Emcure Pharma too finds the name in this list of outperformers. Now going on to the BSE 500, and here too 425 stocks trading with negative returns so far in 2026. And breaking it down, 14 such names are trading with losses of 20% or more, and even at least 300 names in this index as well are down anywhere between 5% to 20%, and there are 8 stocks that are trading with gains of more than 10% as well. Here the list of underperformers is even more stark. Allied Blenders is down 30%. CE Infosystems or MapMyIndia, one of the most touted IPOs, is down 25 already. HBL Engineering, Signature Global, the entire real estate space has been smashed so far this year, and Sapphire Foods as well, after the merger announcement, has only extended its losses, if not more. So that's the kind of pain you're seeing in the broader markets. At the index level too, there is pain, but when you go break it down into specific stocks, that pain grows even louder.
Okay, all right. Thanks a lot, Hormus, for that, all the complete list of stocks. But let's also focus on the performance of mutual funds in 2026. Sonal is here to decode the pain in the broader markets and how it's impacting the mutual funds. Sonal, I want to listen to this.
Thank you so much for that. But at the outset, I just want to say that before investing in any mutual fund, the YTD return or one-year return should not be looked at. But yes, since we're talking about this massive mid and small cap fall, that is seeing an impact on mid caps as well. So in the small cap segment, we have LIC mutual fund, which has seen an 8% decline year to date. It's a 16% decline in last 1 year itself. It's followed by Motilal Oswal small cap fund. There's Quant small cap fund, JM small cap fund, which is down around 12.5%. There's Quantum small cap fund, which has fallen lesser. It's down 3% year to date, and Sundaram small cap fund falls in the same category. It's down 4% versus other funds which have seen a bigger fall. And Quantum and Sundaram are these two funds which have actually seen a positive return in last 1 year, unlike the other small cap funds. So I just thought, let's take the one which has seen the biggest fall and also take the one which has seen a positive return in last 1 year. So let's look at LIC mutual fund small cap fund holdings. Hormus was talking about Allied Blenders being a big decline, seeing a big decline in last few days, and that is a stock in this particular fund. We have Apollo Microsystems, there's Precall, Naveen Fluorine, Sirma SGS Tech. This is one stock also which has seen a sharp fall. On the flip side, Sundaram small cap fund has seen a positive return in last 1 year. That has the likes of RateGain Travel Tech, there's Apple, Craftsman Automation, PNB Housing Fin, SGS Enterprises, and EID Parry. Let's talk about the mid-cap funds, because they've not fallen as much as small-cap funds have fallen in last 1 year. In fact, some of them have seen positive returns as well. So we have the likes of Con mid-cap funds, which is down 7%, Helios mid-cap funds, which is down 6.3%, HSBC mid-cap. But these are also the funds which have seen some positive returns. For instance, Mirae Asset mid-cap fund has seen return of 10.5% in last 1 year. We have HDFC mid-cap fund, which is up 10% in last 1 year. Again, we do the same exercise, look at holdings of some of these funds. For instance, Con Midcap fund has Premier Energies, Tata Com, there's Auto Pharma, IRB Infra to name a few. On the other side, we have HDFC Midcap fund. Hormus spoke about Union Bank being a big gainer. That comes into this list. We have HPCL, which is up 30% in last 1 year, Indian Bank, Coforge, to name a few. Now, let's talk about the cash holdings by some of these AMCs. This is a percentage of their overall AUM. PPFAS tops the list again. It is around 22.3%. It is followed by Quant MF, which is also sitting on cash holdings of around 12.6%, followed by White Oak, Motilal Oswal, Trust Mutual Fund. HDFC MF has around 6.8%. Quantum MF also has some cash holdings. So this is just to tell you that, of course, the broader market fall has impacted mutual fund investments as well. And these are some of the top funds in that category.
Thank you very much, both Hormus and Sonal, for that. Sandeep, let me just take up one of the points that Sonal was talking about. The Quant Mutual Fund has a cash holding of about 12.5%. Is that correct, or is that as of December and in the last 2 weeks you all have been deploying?
No, it is marginally improved only. So it is not declined. Actually, we have booked some profit. So it's the cash level has actually moved up.
Okay, got that. And just, we started this discussion talking about the broader macros in the global markets, etc. I mean, now the big risk is that maybe the global markets also there could be a trend reversal. Maybe they will also correct, because up until now, the mother market, US, has been very resilient. There may be some complacency in the way they have digested everything that's been thrown at the market. How big a risk is that globally there is a shakeoff?
So this is the point which we have been highlighting. The worry is not India. My worry is global market. My worry is US. And my worry is even NASDAQ also. Okay. So all this AI stock, which has done extremely well, I think that is the risk. And I said on the forum, I talked about NVIDIA could be the best shot for this year. Now, the way we have to look at is that obviously India has underperformed for last 6 quarters or so. We had a negative correlation in this market, which means if global market corrects, we can also correct a bit, which is the case right now. But what is very important is that we have a probability, I will say, based on our analytics, that India in 2026 will outperform the global market, which will be the inverse what we have seen in the past. So it's a very important takeaway with a lag effect in money shift to India. It's a very normal thing, if your risk appetite is peaking out in these markets and India risk appetite is on the lower side and it has been lower on lower levels for a while. I think money tends to shift. It may not shift on immediate basis, but with a lag effect of quarter or month sometime, maybe let's take a quarter sort of thing, then I think money will shift to India. So if somebody asks me how you see year 2026, yes, challenging, but whether it can give you positive return if you have patience, the answer is yes, India will outperform. And if you construct your portfolio, some of the areas which we highlighted, you have potential to actually generate alpha out of it. Only thing is that you have to get out of your personal biases which you have built or last 2 years from the stock the sector has given. So people are still carrying those memories and say, this is the stocks which have done extremely well and these are best performing stocks or sector. So I will look for buying opportunity. That may not be very effective this year.
All right, Sandeep. So you're talking about a PE de-rating, possibly that, PE contraction actually. The globe could be in a bit of a flux. NVIDIA could be one of those top short calls, but India could relatively outperform if you have some patience and in the coming quarters, if the flows do come back. That said, Sandeep, if you have to turn decisively positive, what would that trigger be? There's this hope of the trade deal. Number-wise, it doesn't mean so much, but sentiment-wise, it means a large deal. We have the budget that's coming up. And obviously, the hope is that earnings actually return to the low teens to mid-teens. So if you return decisively positive, if you could state down a few factors on our markets.
See, first of all, the trade deal, obviously, it's less important from numbers perspective, but more important from a behavior perspective or psychological perspective. It's something which is hurting and disturbing. But let's say what can change, okay? So I have highlighted this year, the risk will be on the dollar value where dollar can spike, which can affect global equities. If dollar continues to remain weak, and this call which we are making fails, because right now this year is all about dollar supremacy battle, which we are seeing with what we saw in Venezuela, what is happening in the Middle East and some of the areas. This is the pain point. If that thesis fails, the risk does not play out, then that will be act as a big trigger for equity market and emerging market in particular. That's the one trigger. Second thing, if government does something drastically, okay, on the taxation front or the budget, which I don't believe so, but if something like how GST thing happens, and if that is the case, and they can do some changes on the long-term thing, which is the expectation from the market, that can be a game changer. But does not look like, because government has been very clear how to make changes in from both long-term and short-term and different asset classes. And third most important trigger obviously is about earnings. We believe that September to December quarter earnings have bottomed out, including the tech space. So base effect will also play a very important role. The second half, which we talked about, will be slightly better because of the GST and the tax rationalization. So I think going forward, I'm more optimistic on the earning cycles, which will pick up actually as compared to when we turned negative in July 2024. We thought that the cycle has peaked out and it played out quite well. So I think we are again in the early stages. The key driver for the market is always about earnings. And if you believe that earning momentum can gather up, or certain sector, certain pocket where you see visibility, let's say sector like energy space or the banking space or the insurance space. So many sectors are there where we have seeing a clear signs of visibility in terms of earning expansion, and the P are not that high. Rather, we can see a peak expansion also some of these names. So I think that then you get a winner in these space.
Okay, all right. So, in terms of themes, you're talking a little bit about banking, pharma, energy as well. I recall when we had the forum, I'd asked you if you had to buy between two stocks, a staple stock at 50p or an EMS stock. Between the two, it would be staples. But otherwise, if you pick up your top theme where you all are relatively overweight in comparison to the index, which would that theme be?
Right now, we are significantly overworked on financial, and within that, banks, the private sector banks, because we think public sector bank has played out as an opportunity now in private sector banks, and insurance company, which are in the deep neglected phase.
Okay, banks and insurance companies.
And in the mid and small cap, you gave the broad framework on how one should construct their portfolio. But can you break that up into a little, sub-themes or segments? Which ones do you like? Which ones? I know it's a lot to do with individual stocks, and you've spoken, at length about that's the way to generate alpha in a market, challenging market like this. But just some broad ideas in terms of a sectoral tilt to mid and small caps?
So in some, obviously, if we're talking about, let's say, pharma as a theme or power as a theme or consumption, like Nigel talked about FMCG, so you have to drill down in 95 stocks in the mid and small also. There are many stocks which have been neglected for a while. They have their earnings, because of earnings compression, they have corrected a lot. And with the GST benefit, we believe there will be a potential on that side. So which means you have to dig and you will get some opportunity, provided you should have some amount of patience, But the challenge in the industry market is people who are so used to in last many years for the quick returns, and which you don't get, then people tend to get frustrated because the markets are not working. So if you go back and say we used to be very happy with 12-13% CAGR numbers, so you have to bring down your expectation, and the market looks good from a medium to long-term perspective, provided we are also willing to change our mindset and our approach in identifying the sector or stock, and because the expectation level has been significantly high, and that is something has to be toned down.
Okay, all right, Sandeep. Well put, and a good note to end this conversation on. I think that 2020 to around 2023 odd mark, at that time people got very used to that 15, 20, 25% returns. So moderate your expectations, and then in fact, the markets could actually look up from here on. Appreciate you joining in, Sandeep. Wishing you a good rest of the day, and we'll catch up soon. Thanks for joining in.
Yeah, thanks for inviting.
Well, time to slip into a short break. On the other side, we'll turn the focus on Kalyan Jewellers and Eternal. They are some of the top stocks that are moving around.
Fly Emirates, fly better.
Welcome back. Still tentative for the markets. Indices are down close to about 0.4%. This would make the third consecutive session of declines for the equity markets. But as that intraday chart will tell you, after breaching that psychologically important mark of 25,000, going all the way down to 25,900, there was a remarkable recovery between 11 and 1 o'clock. But now, markets are still looking a bit iffy. Midcap index down 1.5%. How should you position yourself then in the last hour of trade? Mitesh Thakkar is now joining in. Mitesh didn't quite get to the 24,400 mark to initiate a fresh short, but it's been all over the place. Very, very volatile trading session. What's the trade that you've taken today or you recommend?
So, good afternoon, Nima. I think the idea remains that, we have a strong chance of heading towards 24,650, 660 zone, thereabouts, give and take a few points. Also is the fact that now I think the marker on the upside has shifted to 25,400, 25,380. I think any bounce is closer to that level would be a shorting opportunity. And until we start getting closing above 25,400, 450, I think I would maintain a negative stand. So still a weak market for me, despite the fact that, I'll tell you, my sense that some kind of jump is also coming from the fact that the PCR was extremely oversold in the morning at about 0.58. It will still get oversold. So I think there's still a chance of a bounce back coming. But again, the structure is weak, so I would not want to go low. But I think once the bounce back plays out, around 25, 350, 400 zones is where I would explore shorting opportunities. On the stock side, sorry.
No, that's it. We want your stocks well put in terms of the setup. And you've been maintaining that, right? That you're not very confident that the market's going to bounce. And now you've given us that level as well, 25,450. That's a crucial mark on the upside if you have to feel good. Otherwise, slippy slide to around 24,650. Individual stocks, Mitesh, go for it.
I have a sell on Indus Tower with a stop at 421 for targets of 400. And BPCL is a sell with a stop at 357 for targets of 335.
Got it. All right. Thanks a lot for that, Mitesh. Well, let's hop across to Mangalam. He's here to tell us about Kalyan Jewellers. It's lost its sparkle today. Mangalam, tell us more.
Not just today. In fact, Kalyan Jewellers is down for 8 straight sessions, and today it's down in double digits. If you look at this week itself, the stock's down over 15%, and from its peak, it's down over 36%. The important part is that, there are three major reasons why the stock could be lower. One is that the churn that has taken place at one of its top fund holdings. So if you look at Motilal Oswal Midcap Fund, that held about 6.3% stake as of last December, that stake has increased to about 9%. If you look at other institutional investors, Franklin has maintained its stake at a little over 1.3%, whereas Sundaram Midcap Fund has decreased its stake to sub 1%, which is why it's not visible in the latest shareholding pattern. And the government of Singapore too, their stake has come down from about 2% to 1.75%. So churn in some of the largest shareholders of the company at the top of that is something that's spooking the street. The other part, with the stock having declined, remember the promoter stake, which is at a little under 63%, 25% of that is pledged. Remember, this number same time last December was around 19%. So over the last 1 year or so, the promoter pledge on its stake has increased from 19% to 25%. Remember, in August 2024, the promoters had bought about 2.5% stake from Warburg Pincus at 535 rupees. That's when the pledge on their stake was created. So with a big decline in this stock, could there be some of those incremental pledges being called for, and as a result of which could we see further downside on Kalyan Jewellers or not, is the big question. And this question is important because nearly 6% of the company's stake is held by retail investors. 5% was the number same time last December, and now the numbers moved to 6%. And if you look at the number of retail shareholders as well, it's grown by about a lakh, 5.59 lakh last December. Now that number has gone up to 6.6 lakh. The only thing that we'll have to monitor now from here on is that with this underperformance and the huge rise of shorts in the stock, does it go into F&O ban or not? We've seen periods of big declines in Kalyan Jewellers, and this is even more so at a time when gold prices are higher and all these companies are reporting stellar quarterly updates. So this is definitely more technical in nature than fundamental, and the stock continues to decline.
Got that. What about Eternal making big moves ahead of the Q3 numbers? Typically comes out by 3:15. Yep. So anytime now, yeah, go ahead.
Anytime now, it's making big moves, and but just to put those big moves into perspective, it's up around 6% ahead of numbers today. But the stock from its peak has actually, despite having moved about 5% today, corrected about 23% from the top. The revenue that the street is working with, 14% quarter on quarter. Remember, same time last quarter, the second quarter, that was. There was a big jump versus estimates year on year because the company had changed its inventory model for Blinkit. So we have to be mindful of that. Look at the numbers quarter on quarter. The street's working with a 14% up move on the revenue, 15,500 crores. The EBITDA jumps by 26%. The number you're looking at is around 300 crores. And the net profit at around 102 crores. These are all numbers quarter on quarter because year on year, the reported results are not comparable due to change in Blinkit inventory model, which was earlier third-party inventory, now will be owned inventory. Food delivery, net operating or net order value should grow anywhere between 12 to 15% year on year, and Blinkit GOV will be up 120 to 130%, or NOV would be up 120 to 130%. Either way, that's the GOV that gets captured in the reported revenue because of the new models. I'll be looking at the trend for the food NOV growth and whether there is a decline in Blinkit's EBITDA losses despite the investments that they're making in quick commerce. Any commentary around gig workers will be very crucial. And another number that I'll be watching out for will be the cash balance on their books as well, as all the competitors have gone ahead and raised funds. Eternal at the end of the last quarter had about 18,300 crores of cash, which is pretty comparable to what Swiggy has post its QIP and what Zepto has as well, as per reports.
Okay, all right, Mangalam, thanks a lot for that. By the way, keep an eye out on a few stocks. I think there was some news on Raymond's redevelopment project in Badala with revenue potential, I think, of 4,000 crores or thereabouts. What volatility. The stock went into the green and it sold off quickly from there. I think the intraday chart should come up for you of the stock. The Raymond stock should come up for you on the screen. It was spiked up and it's come back down. So, it went to 455, back down to around 440 rupees. That's the kind of volatility you're seeing today. And Thangamayil Jewellers as well. I think it came out with a set of numbers. Immediately the stock spurt up close to around 3-4%. And then it sold off. It was down close to around 3%. And as we speak, it's more or less flattish. So big moves. Intraday stocks are moving today nearly around 6 to around 10%. And it's being considered a bit of a norm. Well, You've got some news at the bottom of your screen. JB Chemicals, Nikhil Chopra has resigned as the CEO of company. That's a transition, new promoter coming in there. I think that was more or less on expected lines. The street was expecting this to happen. Well, we'll take a break, come back, continue to focus on markets, and we'll focus on select stocks as well.
Welcome back. The conversations continue here at Davos 2026 as we count down to President Trump's arrival, which is now going to be delayed by a few hours on account of a technical snag, and he gets to Davos later than what was expected. But to talk to us about all things tech and AI and what that means specifically for Indian IT services companies like Infosys, joining us here in Davos, Salil Parekh. Always a pleasure, Salil. Thanks very much for joining us. You know, you're fresh off a third consecutive quarter of a beat and raise. How confident do you feel now about 2026, given all the uncertainty?
So thanks for having me here, Shireen. I think we are seeing a good outlook for the next year. What we shared a few days ago, financial services, we see next financial year better than this financial year for us. Already in this year, we are starting to see discretionary work in financial services, which is good. I'll come to some of the other industries. And energy and utilities, we see a better outlook for next year than this year. Then we see a lot of work in AI. We've identified 6 areas where we see a lot of growth opportunity over the next several years. and some of that will start to happen next year. And then overall, as you mentioned, we had a good quarter, an increase in the revenue guidance, and a steady execution with our margin guidance. So we feel quite good going to next year.
Well, let's double down on this AI opportunity in the AI landscape. Salil, you're pitching AI, your enterprise here in Davos. That's the theme and that's your tagline here for Infosys. But what does that mean exactly? Now, if I take a look at some of the numbers that you've thrown our way, you say that over 90% of your top 200 clients, you're working with them on some AI project. You're working on about 4,600 AI projects today. But when you say AI, your enterprise, give me a sense of what this opens up for you as a revenue opportunity the next few years.
So there, Shireen, what we are seeing is, to give you a couple of examples, one in software development, which is our core area of activity, we see working with third-party agents and agents that Infosys has built, the ability to work with our clients, large banks, large utility companies, telcos, to increase the speed of doing software development and reduce the time. So a huge change. Another example we are seeing is a lot of companies have old technology platforms, starting even with COBOL. Now with AI agents that are available today and what we are building, you can compress the time and reduce the cost. What that does is many companies who are hesitant to take on those projects because of the economics are now doing those. We are actually working with some companies in executing that. So that's a new area of tech work which is available to us, which wasn't before.
Okay.
Now, these are not things which sound exciting, but they're big revenue opportunities.
And incremental new revenue opportunities.
Exactly. So these are all new revenue opportunities. In fact, in February, we will do an investor day where we will outline in a little bit more color what the specific revenue opportunities are.
Could you give us a little bit color before you get to your investor day on what these revenue opportunities could potentially look like?
So what we are seeing is a good set of these 6 revenue opportunities. Another example is in customer service, where we see a lot of AI agents working to change how customer service works, customer experience, even more than customer service. Then there is, we will also share, there are some places where there is a compression in revenue. What we are seeing across the industry in terms of tech services. And what we have started to see now is the growth opportunities larger than the compression opportunity over a number of years. And that's what we want to showcase in that investor day.
So what could all of this mean in terms of added revenue? I mean, are we talking about, $1 billion, $2 billion, $2.5 billion over the next few years? I mean, what could all of this size up to?
So for Infosys, we will outline that this will give us a growth opportunity over the next years. As you've seen, in the last few years, the growth has been lower. Now with the last 3 quarters, things are coming back. With what we see also on the economic side, I mean on the global GDP, we've seen, for example, the US GDP numbers have been good.
Yeah.
We hear that the interest rates will further come down. With all of those, we see that typically spurs tech spend. And then we have the AI opportunity. So those are the things we'll outline.
So what are the expectations now as people go into finalizing budgets? What are you picking up from the clients that you are dealing with in terms of what it could potentially lead to?
So there, what we sort of were discussing earlier, in financial services and energy utilities, we see our next year growth better than this year. The next year revenue better than this year. So that's already a good signal. The rest, we are still working through it. We still see difficulties, for example, on some of the retail, some of the telco, high tech. But on balance, as an overall picture, we see a lot of opportunity.
Again, and I know it's hard, but I'm still going to try, quantify this AI opportunity. I mean, what is the size of the market that you're going after, for instance, and what could we realistically expect you to deliver over the next few years when we talk about this big AI opportunity that you, your peers, everyone's talking of?
Yeah, so there, we will highlight that in this investor day by going into each of the 6 buckets. What we see today is more that the growth over the next 5 years is something we are looking forward to in making sure that if we pivot our work to it. So part of it is also making sure we make the right investments. We are putting a lot of effort into building out capability, building out the partnerships, and making sure that our own people are skilled in that area, and that will give us the growth.
So, well, hard to quantify the AI opportunity as of now, but companies are preparing for it for the long haul, making the right investments. But back to the markets, a sore point today is the continued weakness in the Indian rupee, touching new low after new low, and today the low was 91.73 against the dollar. Lata is now here to just take stock of the kind of foreign selling, the sentiment that's affecting the equity markets, and what the RBI has been doing. Lata?
Well, the story is familiar. Foreign funds are selling Indian shares, buying dollars with that money and repatriating it. And that's the same thing. At the rupee was already on that weak wicket where capital flows are not able to bridge the current account deficit. But what has exacerbated it is this kind of risk-off in the last 24 hours across all financial markets that hurts an already bearish asset even more. We did see the Reserve Bank supplying dollars, but when there is a cascading selling of buying of dollars by foreign funds who are marching out, the Reserve Bank wants to preserve the ammunition, so they weren't supplying in huge amounts. Another factor is that month ago contracts entered into the NDF market is maturing, and that leaves a lot of Indian banks in short dollar positions. That creates pressure around 1 p.m. when you have the fixing of the dollar rupee rate for the day. That added to the pressure. So we saw the rupee at its weakest around 1 p.m. There is little to redeem the pressure on the currency. We can only say that at the moment, the rupee fall also has strengths. We mustn't look at it as a matter of despair because it makes imports expensive and therefore protects domestic industry from cheap Chinese imports fundamentally. Because while we have fallen in the last year or so, about 5.5% versus the dollar, versus the renminbi, the Indian rupee has fallen nearly 12% in the last 8 months or so, or in the past year. Therefore, this has its positive payoffs from the import scenario. Exports also become more attractive, but that, of course, are usually annually renegotiated contracts. Short point, when there is a sudden sharp fall, all these positives kind of pale into insignificance because even those who want to bring dollars don't bring in. Exporters stay back. They want to sell later. Importers rush to cover. And foreign investors also wait to see how much the currency falls. Why would they want to bring in something when the asset is depreciating? So sudden sharp falls don't help anyone. But in the long run, the answer to all the instability or differences in prices is a falling rupee. It's also a solution, but not when it is a sudden sharp fall.
Thank you, Lata, for explaining that. As you said, it's a familiar story, what we've seen transpire in the equity markets, in the currency market, the rout in the equity markets, and the persistent FI exodus is not hurting. Mayuresh Joshi from MarketSmith India is now joining us on the show. Mayuresh, in the last couple of days, we've seen markets indices give up 4-5%. Individual stock levels, it's been a fall of more than 10% in so many large caps also. How have you used this opportunity to rebalance your portfolio? Where have you bought? Have you trimmed your positions anywhere?
Afternoon, Rima. No, I think there has been quite a rebalance at MarketSmith India. I think we got stopped out on a few positions. We booked out on a few positions as well. But I think a couple of sectors which are still doing relatively strong, in our opinion, as we see our institutional software refinery exhibiting a few sectors showing very strong trends. One is within the consumption basket, FMCG players. FMCG players not only will act as a defensive basket in these volatile times, but with expectations of better numbers expected to come through in this quarter and the coming few quarters as well, both in terms of volumes and value. I think you can probably expect some element of relief happening on this front as far as the EPS, RS rating and earnings generally are concerned. The second pocket selectively has been the strength in PSU and mid-private sector banks. Our own sense is that numbers have been very encouraging so far. And going forward, again, I think with asset quality pressures remaining benign, capital adequacy remaining extremely strong, and expectations of stronger growth dynamics displayed on the balance sheet, I think a few of these players might actually exhibit strength. Metals had a strong show, specifically base metals. Our own sense is at this juncture, ferrous players might start making a bit of a comeback within the space itself. The drawback duties that have probably got announced in terms of safeguard duties will not only aid top line growth, but also utilization levels should start inching up higher than 80%. With a lot of captive mines at the disposal of a lot of listed players within India, absolute reported EBITDA and the EBITDA per ton should start showing signs of improvement. Our own sense is if the EBITDA improves anywhere between 1,500 to 2,000 rupees, you should see an incremental 3 to 5% increase in terms of EBITDA. And on long-term averages for ferrous players in general, they used to trade at 6 times EV/EBITDA. Our own sense is that they should come to a normalized level of 7.5 times. So I think these are the spaces that might actually do well for a mix of factors based on each individual sector.
Okay, all right. Got that. In fact, we want to talk a little bit about those ferrous names, but just pull up Dalmia Bharat. The numbers have come in, and they're coming more or less in line with what the street was working with. So on the top line, we have the revenue number that's coming at around 3,500 crores approximately. That's more or less in line with what our poll threw up. And also in terms of the operating profit, it's ballpark around 17%. So on a year-on-year basis, that's actually been an improvement, which was on expected lines. However, on a sequential basis, there was some pain as well. The stock is reacting more or less flattish because in the last few days, the markets have corrected, but Dalmia Bharat actually has been unmoved. The reason is that in the coming quarter, the street believes that things will improve from here on, and East India has seen a lot of pressure on pricing. You know, the pricing has down close to 10% on a quarter-to-quarter basis. But now there is hope that there'll be some kind of recovery. So in the last few trading sessions, we'll try to get you further details. But for now, it appears more or less in line. The optimism is on quarter four's numbers. So let's see whether or not they can deliver. Pricing is good. Demand has been quite strong as well. And they've delevered their balance sheet. But since Mayuresh spoke about steel companies, well, let's tell you what Morgan Stanley had to stay on steel. They've come out with a few stock calls. On JSPL, they have an overweight trading target price of around 1,250. They have an underweight actually on sale. 140 rupees is the target price out there. And they maintain their overweight both on Tata Steel as well as JSW Steel. And those target prices come up for you on the screen. The factors at play. They remain constructive on steel spread expansion from here on, which is good. The domestic steel prices, they have recovered significantly post the policy tailwind that we saw. So that's good news as well. You know, some brokerages have also written that we have seen price increases, but there's more to come, which is heartening to see because so the top line growth will be there as utilizations levels pick up and as pricing as well improves. From the China perspective, they say China's anti-involution is a medium-term theme. So that could be another tailwind because we know that China, they have been exporting non-stop close to around 10 million tons on a monthly basis. And finally, they're also going to say that the global macro factors remain supportive. So put all this together, Morgan Stanley, fairly optimistic on the prospects of steel stocks. Mayuresh, I think, you predicted or you preempted what I was going to talk about. So you already told us that you believe that steel will improve from here on. But tell us about cement. Dalmia Bharat has come out with its numbers, not expected to be any great shakes. But it seems the street actually is looking ahead from here on. They are saying quarter four is going to be good. Volume growth was good in December. That's continued in January. I have my ear on the ground and I believe that demand has been good. But what is heartening to know is that price increases have gradually been pulled back. And if this globe is going to go into a flux, you want to focus on domestic themes. So would cement be on your list?
Collectively, yes. Afternoon, Nigel, to you as well. I think numbers have been pretty much in line with expectations. I think the numbers which have come out so far, Dalmia Bharat, more or less in line, as you rightly pointed out. JK Cement was a decent set of numbers, as pointed out, and there are plans to probably take it to 40 MT over the next few years, in the next 3 to 4 years, probably seems to be on track. Therefore, our own sense is that as volumes improve, as realizations improve for the sector as a whole, with input costs remaining benign, and a lot of these players are doing backward integration as far as their power requirements are concerned, and the captive mines thereof as well. That would largely lead to a better EBITDA number on an absolute basis. And relatively, I think as leverage starts kicking in on an EBITDA per ton basis. The kind of additions that they've probably done, both in terms of quicker capacities in general for the industry as a whole, and generally capacity expansion, which are also close to either logistic or hubs which are probably more favorable for transport. I think that probably also ensures that efficiencies start kicking in. And therefore, with all these levers in place, I think the next few quarters should be pretty interesting for the sector as a whole. So I think, again, when we look at our EPS rating rankings at Markets with India, I think a couple of stocks which stand out. JK Cement from the Midcap pack is a definite standout. that we probably got. Among the large names, Ultratech probably remains on our watch list.
Quick word, Mayuresh, Restaurants Brand Asia, it's been a rank underperformer since its listing. In the last 5 years itself, share price is down 50%. But with a change in ownership, a fund infusion of 1,500 crore, would you bet on a turnaround and buy the stock?
Rima, not at this juncture, because I think it's gone through a terrible phase of underperformance, and numbers have been nothing great to write home about. And therefore, I think the entire re-rating of this stock will be based on numbers which will start coming through and consistent improvement on thereof, which will give the forward multiple something to speak about. But at this juncture, I think both these aspects are not in favor of Restaurants Brand Asia. So I think give it a pass at this juncture.
Okay, all right, Mayuresh, meet me for a burger. Sometimes it's on me. We'll decide the brand later. But thanks a lot for joining in. Have a good remainder of the afternoon, and we'll catch up soon. We'll take a bit of a breather on closing bell. Stay tuned. Abacus Assets, Aman Chauhan will be joining in on the other side. Stay tuned.
Welcome back. 30 minutes to go to wrap up trade. 25,150 on the Nifty. But what about the F&O positions and the trends? Nigel has now walked over to the F&O desk.
Well, Rima, we've seen a bit of a bounce, and the bounce has come from extremely oversold levels. But otherwise, the markets are still a little bit skittish. And I think first we need to see some kind of stability with regard to the Indian rupee. That's the key trigger from here on. We can't have this depreciation non-stop. Just a couple of months ago, we were holding at around 88, and now in no time, we're close to around 92, which is a bit of a worry. So that's one crucial factor. The VIX, it's spiked up, but it's still very far away from those fearful levels. So it's holding at around that 14% odd. I think the next mark on the VIX that the traders are looking at is around that 16, 17 odd mark. Till then, I think still believe that maybe in fact we could go through, get past this stage with a bit of consolidation. Here, the call writers continue, and they're having a blast. 25,300 call. Just take a look at the premium. It's eroded by close to 32% after nearly halving in the last 5 days or so. So that's now down to around 100 rupees. Pull up the 25,000 put. Now there, the premium has gone up by around 50%. Premium last I checked was close to around 90, 95 rupees or thereabouts. So there is some signs of writing on those levels. So the important mark will be today's low, 24,920. That's the first reference point, 24,900, 24,920. On the upside, going by the options data, and where we earlier took support, that will become a resistance now, 25,400, 25,500 odd. Individual stocks, though, they are doing a thing of their own. Samudra Motherson, that's actually seeing a mild short covering bounce in today's trading session. So good going out there. Eternal ahead of its numbers. There is seeing some fresh buying out there. So there is some built up on the long side out there. And finally, on Pharma, that's one of those pharma companies, actually, they're seeing good amount of shorts that are creeping into the system. So there's a big surge in terms of open interest. The stock is down as well. The shorts are sniffing something. So for the time being, we live to fight another day. 24,900 is important. First reference point on the downside. A bounce in the lows, but not out of the woods. Back to you, Rima.
Thank you very much for that. Aman Chauhan, fund manager, Abacus Asset Manager, is now joining in. Aman, just earlier today, we had a chat with Sunil, and he was saying that he'll stick his neck out, and perhaps this is a good time to look at individual stocks, even mid caps, small caps, large caps, which meet the criteria. So weigh in with your assessment of the kind of fall that we've seen, persistent pressure in the rupee. Where are we headed at a headline level? And what have you all been doing? I mean, particularly the portfolio that you manage.
As far as the rupee is concerned, even we are surprised negatively as to the way it has been depreciating, because on the economic side, things are improving. Trade oil is low, so it's not that something that we have a big pressure on the trade side. And hence, that is something which has been a worry for us also, because that dampens the sentiment across the board. Right? And that is one of the major reasons why we are seeing the sell-off in the markets today. It's not that FI selling has happened just now. It has been there since some time now, right? So the panic that we see over the last 10, 15 days is not just linked to FI selling. Overall, the sentiment has not worked on, and people need trigger. We feel there's enough liquidity in the market. People are looking at market. They have the cash with them, just holding on. Once they see markets starting to stabilize, to move up, when they start seeing money being made, they'll all come in. And somebody has to take a call. And that's what Sunil mentioned, that some sectors, some stocks, they're down 30-40% from the peak. Definitely, what we did not buy earlier because of valuation reasons now seems to be back to 30-40% lower, and one should start to look at it. These are panic times. This is when somebody has to utilize or make good of the panic, and that's what he mentioned. That's what we believe in.
Hi, Aman. Good to see you in. Well, markets are tricky, right? But at these tricky stages, when you get the stocks that you want at your prices, and hopefully those prices are here. Otherwise, in fact, there could be further pain for the remainder of this year. That said, let's talk about a couple of sectors and themes. Banks, that's a consensus buy. Banks as well as financials. How are y'all approaching that pocket? Are y'all overweight out there, or are y'all underweight? And what's the preference between, private, public, NBFCs, or within that, there are a couple of themes like gold financiers, if you like?
So you can say we are equal weight to overweight. In some portfolios, we will be overweight. Preference is private versus PSUs, though we own top PSU banks also. Within financials, we also like NBFCs and across the board, including the capital marketplace. So we have some AMCs, some wealth management companies, some broking companies in the portfolio, continue to own them, like them. On the fringe, we have added to mid-cap banking names also in the recent times. And the outlook, as you all have been discussing, has been pretty good on this side. And you're right, it's a consensus trade and seems to be working as of now.
So these are the things that, themes that you like, but particularly in the last 15 days, where do you think the correction perhaps has come to an end? The valuation derating may have bottomed out. and you have actually bought stocks or themes. Can you give some more color on that?
Broadly on the EMS front, I think correction is more or less behind us. Things should start to look out. Cement names also, if the demand has to pick up from Jan, Feb onward, that's what people have been expecting, that ahead of the March and demand picks up, the government spending also picks up, then even cement stocks which have corrected have a good scope to move up. Metals have been doing well, so that's not, I'll not say there's a big opportunity there, though constructively we are pretty positive on that sector. With rupee continuing to depreciate, there can be a trade or there can be bonds in IT also, especially the mid-cap IT name, because then the growth rate is also pretty decent, right? So, and plus they benefit from the currency. So some mid-cap pharma names, they have corrected 20-25%. This is more of a quasi defensive sector. If you have a 25% drawdown in a pharma name, and there are some names out there which are corrected more than 20-25%, that clearly looks like a buying opportunity to us.
Looking at the Dalmia Bharat numbers, Aman, and as you mentioned, cement could be a counter trend. We have been just covering this out here, that with the globe in a flux, you want to look inward. And when you look inward, you want to see a couple of sectors that are actually coming off a rough patch. The last 4 months were rough for cement. Now demand seems to have picked up, both trade as well as non-trade, and pricing environment is improving. What will your approach be? I'm sure if you could name stocks, it would be brilliant. But otherwise, what do you like? The East companies, where pricing took the hardest hit and now they're bouncing back. Or do you like the large cap names, the big daddy? Or maybe you want to play some of these takeover candidates. How are you approaching the theme?
So we have the big daddies, when also we are centrally paced. We don't have a very clear preference towards east or north or south per se. For us, it's more of bottoms up stocks individually where we see earnings tractions better than what the industry would be. So in the portfolio is more of large names as well as some central names. East is also something that we like, but these stocks are not very liquid for us to get into them, and hence not part of the portfolio. So in nutshell, more of individual names rather than having a preference for a certain region.
Okay, all right. Coming in late into the conversation, guys, but
jumping straight in.
Jumping straight in, right? And well, thank you very much for joining us, Amit, and good speaking with you. Well, I think D Street Chatter is next, and Nimesh is now joining in with what he's picking up. There's been a sharp recovery from the day's low, but at one point we were up 50 points. So at the day's high, the Nifty had bounced about 400 points. Some of that sheen is gone. But what's happening? Nimesh, take it away.
Hi, Prashant. So a small bit of recovery in the last couple of minutes of trade essentially could be to the fact that there is an MOC buy basket at a leading FI desk. I spoke about this at 11 a.m. as well, that post 11 a.m. There was a bit of a pullback because of the margin calls got triggered in the first couple of hours, and there was a bit of buying as well. So maybe that's playing out in the Nifty. But broadly, from a broader market perspective, there is a lot of pain and clearly signs of capitulation now. The mid-cap index is down another 1%. But there is a lot of lot of pain in the broader market stocks, the mid caps and the small cap names, and now there is clear capitulation from retail, HNIs, family offices, HNI, even for that matter, small PMSs and all. It looks like there is a bit of selling coming from those sides. So that's clearly in the broader market names. As I said, a small MOC basket buying, so maybe it will have an impact in the last half an hour of trade. But purely, there is technically we've broken some crucial support levels. So till the time it bounces back to about 25,450, doesn't look like there will be a very strong momentum for this market. Today, the buying seems to be largely in large cap names and a bit of selective into the PSU bank stock. So that was a color as far as flows are concerned. But I guess barring the Nifty pullback, the bigger pain seems to be in the broader markets.
Nimesh, anyone is thumping the table and saying this stock or that stock?
Very difficult, Prashant, thumping the table. People are...
Nobody's pointing to, this, look at this, look at that, and the stocks are being thrown away. No, nothing of that.
No, nothing yet, Prashant. I mean, there is a bit of scare now. Clearly, the kind of sell-off we saw in the broader markets.
I think they're slamming the table and saying what's going on.
Nimesh, the other thing.
Today, Prashant, in the last 4 hours, I'll tell you, the feedback is every sort of investors had a bit of a relief. Okay, I sold out and the stocks have fallen, so wow, it's a relief for me. And if there is a pullback, there is a pullback, so there is a relief for me. So, in both sense, it's just a small relief, but there is a lot of pain beneath. So I don't think anybody is right now in a mood to say thumping buy or give a thumping idea.
Yeah, no idea.
No idea.
But that is typically a good sign, right? I mean, no one. But you used the word capitulation a few times, and usually what comes after capitulation is a period of consolidation, and then maybe things start to look better. Has the rupee come up in conversations with
it has, Prashant. It has. So that also has an impact on the overall sentiment and the fact that FIs are not going to buy. If they're not large sellers, they're at least not going to come and buy India market. Also, the fact that a lot of dealers who advise the global funds, they seem to be believing that right now none of the global investors are in a mood to buy India market. There is so much momentum in Korea, other Asian markets, and they're doing so well that nobody's looking at India per se at this point in time. So clearly, India is out of the favor for the FIs. And what is the painful point is that there is a lot of capitulation from retail HNIs, super HNIs, and the newer sets of PMS and AIFs who have not seen this kind of volatility in the last 4 years.
Okay. Now let's get to stocks, because there are stocks, Nimish, right on your list. What are they?
Oh yeah, so the first stock on my list is BEL. A bit of a contra buying is what I understand now from larger FIs, and especially when leading long-only fund seems to be accumulating in the last couple of days. Could be a play for the budget as well, because there is a bit of sense that there will be some focus on the defense side, at least in this budget. So that is something which at least some of the global funds seems to be playing. So that's clearly playing out in BEL. So that's the first name. But again, large part of my stocks are largely to do with the flows. So nothing much in terms of M&A. Large part of the M&A is what we've covered in the last many days. But so BEL clearly is one stock which stands out. The second name is HDFC Bank. Again, I'm saying a bit of contra buying because some long-only funds are active buyers, and also one of the leading family office has actually turned buyer in HDFC Bank at current level. So the broad sense is, as I said in the beginning as well, the large flows are largely biased towards the large cap names and to some extent the financial names. So that clearly plays out. So HDFC Bank stands out in terms of flows today. Again, Prashant, there is not much in terms of very delivery-based selling or very large delivery-based buying. It's very, very selective and very, very, very specific, is what I understand from a flow perspective. Raymond Limited is the other name. While you spoke about Raymond Realty doing good today, but in Raymond Realty, I understand one of the FPI holder, who's a sovereign fund, they've been selling off late, and hence you're seeing a bit of pressure on Raymond Realty as well, Raymond Limited as well in the last couple of days.
And as I think Sunil Singhania was with us, Nimesh, no mention of the budget, right? By this time, it would be frenzy. Budget mein kya raha hai, ye ho raha hai, wo ho raha hai, nothing, zero.
Nobody, I guess, is right now talking about budget, Prashant. Everybody's looking at their own portfolios and crying.
Okay, all right. But it's true. I mean, it's a powerful psychological feeling, right? When you sell and then stock goes down, well, the call was right. But then it goes up, and then you're thinking, well, maybe not so much. Selling begets selling, and there's that feeling, I think, which is also, of course, crept in, that if this is going to be and it's been, I mean, at the day's low, it looked like, I mean, just add yesterday's loss and today's loss, it would have been an absolute slam dunk waterfall kind of two days. Thankfully, we've got a little bit of a bounce. But, that feeling that maybe there is more coming, maybe this is the start of another. India markets here have been correcting, but maybe for the first time, US has not seen any correction at all. Is this a global bit of a shakeout and things like that? With everything which is happening, all the comments we are hearing. So that element of fear, perhaps at the margin as well. Hopefully, things settle. There is that speech later tonight from President Trump at Davos. We'll see what comes out of it. We'll take a quick commercial break here. What to buy, sell today for reverse trades tomorrow. Mitesh is going to be with us for that. Stay tuned.
Welcome back. The other big development in the world of mutual funds is that Motilal Oswal's AMC Chief Investment Officer Niket Shah is all set to move to a new role as a managing director within the company's Motilal Oswal's group's principal investment business. Let's just quickly take a stock of the funds which are managed by him and which stocks those funds hold. Vinny is now joining in with the details. Vinny.
Hi, good afternoon. So talking about the funds that are managed by Niket Shah, it was quite a few over the years, more than a decade that he'd spent at Motilal Oswal as the investment officer. Now, Motilal Oswal Innovation Opportunity Fund, that's the lowest, and they have around 500 crores AUM as of now. Consumption Fund, 1,100 crore AUM. Arbitrage Fund, Business Cycle Fund, around 1,800 and 2,000 crore AUM there, while the bigger funds were the multi-cap fund, which has around 4,500 crore AUM, small cap fund that had around a 5,800 crore AUM, and flexi cap fund a 13,800 crore AUM, while a mid-cap fund, that was the largest one that was managed by him, was around 36,800 crores in terms of AUM. Now let's look at the returns. Most of these funds are recent in terms of the launches that have come in the last couple of years, is what we could say, except flexi cap fund and the mid-cap fund. They have long-term returns as well. So when you look at the flexi cap fund, in the last 1 year, obviously 1 year return is not something that you watch out for in terms of a mutual fund as a whole, but still 1 year flexi cap, mid cap funds have not done well. Previously 3 years they managed a 20% return for both these funds, while for flexi cap there's a 13% year on a 5-year basis, as well as for the mid cap fund it's around a 26% return for a 5-year basis. Now overall, other than that, all these funds just have a 1-year return. The stocks that they hold in these funds, talking about the top ones, which are the largest AUMs, mid-cap fund, Persistent System was among the top holding, more than 10% in terms of a weightage that came in. Coforge was there, 8.9%. We have 197 Communications, Kalyan Jewellers, as well as Dixon Tech among the top 5 holdings. Even for multi-cap fund, Persistent Systems, Kalyan Jewellers, as well as Coforge still are there even in the multi-cap fund. Other than that, there's Bharti Airtel as well as Shelley Engineering, which was among the top holdings. And Persistent System, Coforge, Kalyan Jewellers even makes the list in the flexi cap funds. So these are some of the funds and large funds which they were holding with their stock holdings for them as well.
Okay, thank you very much for that. And some of them have done very well. Coforge, Persistent, which are a part of the flexi cap fund, have given very strong returns over a 5-year period. For the day, the mid-cap index is down over 1%, managed to recover in the last 30 minutes. Credit Axis Grameen is a big mover. MRPL, 9% gain on that. J&K Bank, we chatted with the management earlier. At least for now, the QIP is not happening for the next 3 months. The bank will look at it in the first half of FY27. Stock is up nearly 4.5%. ITC seeing some interest, very large volume, stock up 4%. Sudeep Bandopadhyay, market expert, is now joining in on the show. Sudeep, thank you very much for joining in. Just wanted to get your thoughts in first on the 2 deals. One of them is Restaurants Brand Asia and the other one is Bazaar Style Retail and Cupid. Have you all done any analysis and is there an investment?
I think Restaurant Brand Asia wanted to, there was this deal in the market for quite some time. And I think it's good that somebody with some experience, at least in this entire space, has come in and acquired this stake. So it's good for this Restaurant Brands Asia. Overall, we are positive on the F&B industry. And we think there is significant scope for improvement of performance as far as Restaurant Brands Asia is concerned. We'll have to wait and watch how things pan out. But we are generally positive of this entire space. And of course, this has been very hot with a lot of deals happening in this entire space and pretty much a change of shareholding in almost all the branded food chains in the recent past. As far as Bazaar Style Retail is concerned, again, this is a space where we have been bullish for the last almost more than a year. We believe that this value retail is an area where there is significant growth opportunity. Even if you look at analyze the bigger chains who were into luxury retail, their value retail business, they have all started value retail business, and that value retail business is what they kind of help them to grow and help them to expand, whether it's a trend, whether it's a lifestyle, whether it's shopper stop, all of them, Reliance, all of them have the value retail chains. But having said that, we believe that value retail chains operating exclusively in smaller cities and towns have a significant scope for expansion, and Bazaar Style Retail is one of them. this current deal, I think there are synergies and there are opportunities, and I'm sure this will be value accretive going forward.
All right, stay with us. Sudeep, coming back across to you, but let's get in Mitesh Thakkar, Bonanza portfolio, who joins us on the show. Mitesh, markets down 90 points, had a bit of a intraday pullback, but that got sold into. So tell us individual stocks, though, for a buy or a sell call.
So I have one buy and one sell, one BTST call and one STBT. On the STBT side is Laurus Labs. After a good rally, the stock is now showing first signs of correction. So keep a stop at 1,001, look for targets of around 970. And on the buying side is JSW Steel. Keep a stop at about 1164, look for targets of 1190.
Thank you very much for that, Mitesh. Interglobe Aviation is seeing buying ahead of numbers tomorrow. December quarter was the quarter in which the airline got hit on account of a lot of cancellations, and then the airline had to issue refunds, etc. So numbers will be watched very closely. Get into a break. On the other side, more on the market closing. Welcome back. The Nifty is ending off from the session lows significantly. The low today was 24,900. So from that level, it's been about a 250-point recovery that we've seen in the second half of the trading session. But the Midcap Index, Nifty Bank ending with a cut of nearly 1%. Sudeep, open-ended question as we wrap the trade. Any stocks that are looking attractive now after the fall?
Well, I think from an investor's point of view who have 1 year plus time horizon, this is a great opportunity for picking up good quality stocks which have corrected significantly. I do like Larsen & Toubro. I think it's definitely worth picking up post this correction. I also like State Bank of India. I think, again, it's a great opportunity to pick up from a long-term point of view. As far as cement is concerned, I do like cement. But considering the overall risks in the market, I will stick to Ultratech, which I think is the best of the lot and the biggest of the lot. So I think some of these stocks definitely worth looking at current levels. Need not be picked up immediately, maybe picked up over a period of next few days because market is going to remain volatile now. But definitely good opportunity for building portfolio from a long-term perspective.
On that optimistic note, we'll thank you for joining in, Sudeep. Let's hope, in fact, this is that time that helps build portfolios and hopefully the pain is nearing the end. Thanks a lot for joining in. Well, time to wind down the markets. Last 60 seconds left. It was another day of trade where, in fact, the Nifty wobbled. We were down 250 to 60 points at one point of time. We did recover. The good news is, on a closing basis, we managed to conquer the 200 DMA. What didn't do well? The banks. They underperformed after a while. ICICI Bank did come in for some selling. So that was one of the top losers. Axis Bank as well was down in trade. What helped? Well, you had Eternal. The stock was up close to around 5%, and that was the top gain on the Nifty. It's corrected from 370 to around 280, but today it popped up in trade. Interglobe Aviation, well, the stock was up close to around 1.5%. Some kind of relief coming in with regard to that talk on capping fares. Besides that, metals did well. Hindalco as well as JSW Steel, both of them, ferrous and non-ferrous names, did pretty well in today's trading session. From the broader markets, Credit Access, Grameen, beautiful move out there. Stock up 9.5%. Veranda, well, that stock was up close to around 8% in trade today. Walchand Nagar was up close to around 7%. And a whole host of names were doing a thing of their own on the upside. Even Wellspun Living, well, that was up close to around 5%. Deal, no deal, that one did end with some green.
Lower now for the third consecutive session to wrap trade. We closed off from the session lows, but down 0.25% on the Nifty and the Sensex. Midcaps down 1%. And the other big story was the fall in the rupee. The rupee hit a record low of 91.73 against the dollar. Tried to recover towards the end. Let's see where it closes. And what will the street watch post-market? Numbers from Dr. Reddy's and Eternal. And the other big one, of course, is the Trump speech at Davos.
Okay, well, it's a wrap on this edition of Closing Bell. From all of us, say goodbye. Thank you for staying with us. More comes up on Markets Forward in just a bit.
Cool.
Wild swings on the Lal Street as Sensex and Nifty go on a roller coaster ride. A late recovery helped to recoup most of the losses, but all sectoral indices end in the red. Market capitalization of companies listed on BSE drops below 5 lakh crore rupees for the first time in 9 months.
Rupee sinks to a record low after posting the biggest single-day fall in 3 months. Sustained foreign selling of Indian equities and weak market sentiment take the rupee closer to the 92 rupee mark against the dollar.
SRF slips as pricing pressure from Chinese rivals weighs. United Spirits dips as volumes miss the mark. Shoppers Stop is hit by weak consumption, while Vikram Solar sees orders and revenue slip sequentially. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Sonal Bhutra. With me is my colleague Vivek Iyer. Vivek, good afternoon. It was a choppy session. At around 12:30, we saw that massive recovery, almost 350 points from the lows of the day on the Nifty, but then that got sold into as well. Nifty finally ended below the 25,200 mark. We breached the 25,000 mark as well in trade today. Midcaps underperformed. That index was down 1.14%. In the Nifty pack, 30 stocks ended in the green as we speak, and the advanced decline ratio, that was in favor of declines, but at a point in time, the ratio was 1:5, 5 in favor of the declines as well. So it's been quite choppy. Look at the advanced decline lines. They actually merged at every point, and finally it ended in favor of declines. But it's been very interesting, the session today, with wild moves across the board.
That's right. Good afternoon, Sonal. A very, very choppy session. The only thing that went up consistently was the India VIX. And in fact, like you mentioned, the intraday volatility actually extended even to a whole host of stocks, especially those companies that came out with a set of results. Towards the end of the trading session, we saw a name like Dalmia Bharat from the cement pack deliver a good set of numbers with strong volume growth. That did quite well. But overall, most of the results, especially where there was a slight miss, saw significant selling pressure. Names like Persistent, some of the names like United Spirits, all of these stocks saw significant selling pressure. Well, here's the lineup of what we have in store for you today on Markets Forward. We'll start with the top movers and shakers of the day with Pharma. We break down the reasons behind the rupee's record low levels, analyze key Q3 earnings, and explain why Kalyan Jewellers has been in a free fall for the last 9 sessions. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. So first up, Hormaz joins in from the wall for the top movers and shakers of the day.
You know, not for the faint-hearted. Please don't try this at home. You could use any form of disclaimer for today's trading session, considering the kind of moves that you had. But the recovery on the index today was led by Reliance Industries. And after a prolonged period of underperformance over the last 7 to 8 sessions, the stock ended 1% higher and was the chief contributor in that recovery from those panic low levels of 24,919. TCS was the other contributor along with Ultratech Cement. Both of these stocks ending with gains of around 0.5% to 1.5% as well. So some green seen on some of the index heavyweights in today's session. Earnings were a mixed bag. The good ones were rewarded. Credit Access Grameen's good results came in with a slew of upgrades. The result was a 10.5% up move even in a weak market, even when the markets were choppy. That stock consistently remained higher and ended higher as well. IndiaMART was one such name as well, 6% higher on the stock. SRF, after some disappointing management commentary, fell 7%. And Tata Communications and margins narrowing on a year-on-year basis, that stock too ended with losses of around 5.5%. The sector that did well today was the metal names, goes without a surprise. Hindustan Copper, Hindustan Zinc, again the principal contributors to that gain. Hindalco and JSW Steel also chipping in with their part in this metals rally in today's session. In some of the newsmakers today, Kalyan Jewellers stands tall on that list. Tall on the list of newsmakers, of course, 12% lower on the stock. UPL was down around 7% yesterday, another 4% gone in today's session. And of course, the two deal-making names, Bazaar Style Retail and Cupid, both of them seeing losses of anywhere between 7 to 9% in today's session. And lastly, stocks that ended at a 52-week low in today's session. It's a long list, and MobiKwik, at one point, the post-listing high of the stock was 700 rupees. It's now down to 200. Anup Engineering was down 6, Orient Pro down 6, and Tata Chemicals too seeing some selling pressure today, 5% lower, ending at a 52-week low for this stock as well.
Some interesting names on your list, Hormus. Thank you so much for joining in. We'll discuss some of them in greater detail as well. But the other big story has to be the Indian rupee touching a new low of 91.73 per dollar. And that continued to be the case. It did recover. But let's talk about the fall. It has been driven by sustained foreign selling of Indian equities and weak market sentiment. Dealers also say the RBI has been intermittently supplying dollars. Lata Venkatesh is joining us with more details on this one. Lata.
Well, the story is familiar. Foreign funds are selling Indian shares, buying dollars with that money and repatriating it. And that's the same thing. At the rupee was already on that weak wicket where capital flows are not able to bridge the current account deficit. But what has exacerbated it is this kind of risk-off in the last 24 hours across all financial markets that hurts an already bearish asset even more. We did see the Reserve Bank supplying dollars, but when there is a cascading buying of dollars by foreign funds who are marching out, the Reserve Bank wants to preserve the ammunition, so they weren't supplying in huge amounts. Another factor is that month ago contracts entered into the NDF market is maturing, and that leaves a lot of Indian banks in short dollar positions. That creates pressure around 1 p.m. when you have the fixing of the dollar rupee rate for the day. That added to the pressure. So we saw the rupee at its weakest around 1 p.m. There is little to redeem the pressure on the currency. We can only say that at the moment the rupee fall also has strengths. We mustn't look at it as a matter of despair because it makes imports expensive and therefore protects domestic industry from cheap Chinese imports fundamentally. Because while we have fallen in the last year or so, about 5.5% versus the dollar, versus the renminbi, the Indian rupee has fallen nearly 12% in the last 8 months or so, or in the past year. Therefore, this has its positive payoffs from the import scenario. Exports also become more attractive, but that, of course, are usually annually renegotiated contracts. Short point, when there is a sudden sharp fall, all these positives kind of pale into insignificance because even those who want to bring dollars don't bring in. Exporters stay back. They want to sell later. Importers rush to cover. And foreign investors also wait to see how much the currency falls. Why would they want to bring in something when the asset is depreciating? So sudden sharp falls don't help anyone. But in the long run, the answer to all the instability or differences in prices is a falling rupee. It's also a solution, but not when it is a sudden sharp fall.
Well, thank you so much, Lata, for joining us and giving us all of the reasons behind the rupee's sudden slide today. But it's a good time to welcome our guests. Today, we are joined by Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital, and Shrikant Chauhan from Kotak Securities. Thank you so much, gentlemen, for joining us. Well, Shrikant, let me come across to you first. We saw a sharp intraday dip in the Nifty. We've slipped below the 25,000 mark. Where do you see the markets headed from the current levels?
Yeah, afternoon, Vivek and Sonal. So yes, Nifty has fallen, and importantly, it has broken the level of 25,000, which is something we can say weak for the market. But at the same time, if we consider the overall technical pattern of the day and the way there is volatility, I am of the view that there is still indecision, and at higher levels, we are going to see furthermore selling or maybe profit taking. So we need to be careful at higher levels. I think the market has shifted its range. We were of the view that 25,500 is going to act as major support for the market, but since last 2 days, the market is comfortably trading below the same, and it has broken the important level of 25. So maybe the market is going to spend some more time within the range of 25,500 and 24,900. But if there is a long-term view, then I think the market has corrected to its important level. And here, if there is a medium to long-term view, then certainly we should look for taking some contra bets of going long at important support levels like 25,000 or maybe 24,900.
Take that point, Shrikant. Sudeep, comment on this. There have been a lot of factors which fundamentally are also impacting markets. Do you think we could continue to see this on the back of those fundamentals, be it earnings, be it what's happening with tariffs?
Obviously, the situation is not very good. There are a lot of headwinds, and the market is navigating that. The global news flow is definitely very, very keenly watched, and it's at not at all good at this stage. Corporate results have been by and large okay. I think even the IT numbers, you can say mildly positive compared to the expectations. So I'm not too pessimistic. I mean, what is happening all around us is definitely a matter of big concern. And this massive correction which we have seen over the last few days, I think it's a great opportunity for a long-term investor to start picking up good quality shares. Look, I mean, probably this will continue for some more time, but it is definitely a time for picking up good quality shares from a long-term perspective. There is no two ways about it. Fundamentals, by and large, remain okay. Yes, the raw material prices have gone up in some cases, and the margin may come under pressure in Q4 for some of the companies using metals. But other than that, I think domestic companies should continue to perform well. We, of course, will wait for some announcements which can, probably help the market and the economy. Let's wait and watch for that.
Well, absolutely right. Sudeep, well, one particular stock that did quite well today was Credit Access Grameen. That stock surged nearly 13% in the session after a strong Q3 where there was a turnaround with brokerages such as CLSA, HSBC and JM Financial upgrading the stock. Gaurav joins in with a report card of Q3 as far as credit access is concerned.
Well, yes, if you look at Nifty and overall the market, it was actually a difficult day. But one stock which actually stood strong was Credit Access, and this was on the back of the numbers. And the reason being that if you look at the net interest margins, we saw 60 basis point of increase on a sequential basis. And at the same time, second and the biggest point which market took in a very positive way is the credit cost. Now that has declined almost by 300 basis point on a sequential basis from 8.5% to around 5.5% levels. Now, what are the reasons? First is that if you look at the MFI portfolio, they are seeing the stress is actually falling down. In fact, the collection efficiency, that is actually improving. At the same time, management remained confident. They said that credit cost is going to be in the range of 4 to 4.5% next year, which means there is a room for further decline in credit cost going ahead, although in fourth quarter it may remain stable. Other than that, the ROAs, they are expecting ROAs also to increase to around 4 to 4.5% levels. Again, there is a room for development because currently the ROA stands at 3.5%. They are also confident on the growth guidance. They have reiterated their growth guidance of 20% for FY27 versus what they reported as 8.5% in this quarter. So definitely, all in all, a very good set of number. Management remained confident, and after that we saw brokerages also showing some kind of confidence. We saw HSBC and CLSA actually upgrading their target price as well as a rating for the stock to buy. And let's also not forget about the valuation aspect, because if you look at valuation for Credit Access Grameen, although it trades at 2 times price to book value, but it is still lower than their peak valuation of 3 times that we have seen in December 2023. Let's also not forget about some of the stocks which will be in focus on the back of the MFI recovery that we have seen in Credit Access Grameen. And these will be in the likes of 5 Stars, Spandana Spurti and even Bandhan Bank, because they have not reported numbers yet. But given that Credit Access Grameen has shown some kind of improvement in the asset quality, we may see some uptick in these companies as well. But all in all, in terms of good numbers, we saw Credit Access Grameen gaining in trade today.
Okay, yes, some of these stocks which bucked the trend, so those are on our radar. Kalyan Jewellers was the other stock which slipped nearly 15% in trade on heavy volumes. Remember, Motilal Oswal Midcap Fund holds nearly 9% stake in the company, while the promoter pledge remains nearly 25%. Let's get in Mangalam to tell us what really happened. There have been some management changes as well at the fund holding stake. Mangalam, tell us more.
That's right. You know, Kalyan Jewellers is down in double digits in today's trading session, down for 8 straight trading sessions, and currently down 16% in this week, over 35% from its 52-week high as well. There are 3 reasons which are, plaguing the stock right now. The biggest one, of course, is that this decline has been caused by perhaps some fears around one of its largest institutional holdings, and there being, a churn at the top, Motilal Oswal, where Niket Shah has been internally reshuffled in the organization itself. Motilal Oswal has 9% stake in the company, which has actually increased from 6% same time last December to around now in December 2025 as well. If you look at the other funds as well, while Franklin continues to hold its stake, Sundaram has pared its stake, as has the government of Singapore. It's important because remember, the promoters own sub 63% stake in the company, just below that, but they have nearly 25% of their stake pledge. So with this big decline, will this pledge come up for a little more, or will there be further addition to that pledge or not? has a bit of a concern on the stock. The other factor that we're looking at, retail investors own nearly 6% of the company. This too is a number that has increased from 5% last year, and the number of retail shareholders have increased by 1 lakh. So all these factors make it extremely important for one to track Kalyan Jewellers and the trajectory from here, especially given the underperformance in the stock, despite the strong fundamental performance that we're seeing in the jewelry sector, thanks to gold and silver prices, along with the demand for jewelry, which is more affordable and accessible in nature as well. The third quarter updates for the entire pack, no real questions, but this technical factor has the stock really pressured.
Well, thank you so much, Mangalam, for joining us and highlighting and explaining all of the reasons why Kalyan Jewellers has been under pressure for so many continuous sessions. Well, Sudeep, coming across to you, wonder if you have a view as far as Kalyan is concerned. Clearly, factors beyond fundamentals actually impacting the stock currently. Do you feel it now presents a good value proposition, especially if you're looking at it for a medium or long term, or within the jewelry space, which is your top pick?
Well, within the jewelry space, I have been bullish on Titan for a very, very long time, and I continue to maintain my view from a long-term perspective. But I also do like Kalyan, and I have been mentioning about Kalyan for quite some time as well. And I believe this correction is definitely an opportunity for picking up. May not be, tomorrow itself morning, but just wait and watch and start picking up Kalyan. I think it's a great opportunity. There is absolutely no problem with the fundamentals. Their model of using franchisee for expansion into North India where the margins are higher, West Asia expansion, again through franchisee route where the margins are better, increasing the studded portion in the overall mix, again a margin accretive. So there is absolutely no problem. I think this is very correctly pointed out by Mangalam, technical issues which has been plaguing the stock, and that's why we have seen this sharp correction, but definitely a great opportunity considering what's happening in the gold and silver market.
That point, Sudeep. Shrikant, quickly, if you can tell us anything from the consumption space or the jewelry space that you like technically?
So yes, from the jewelry space, if we consider Kalyan Jewellers, then it has broken important level at 400. It was around these 400 levels in the month of March 2025. And after such a long period, when the stock has broken this level, one thing is very clear that the stock is heading lower, and we may even see the levels of maybe 333. 100 sort of levels in the near term. But if we consider other stocks like Muthoot Finance or Titan, there the relative outperformance is very, very high. And we are expecting furthermore upside from Titan as well as Muthoot Finance. So ideal strategy should be to look for adding them on every dip instead of adding at current levels in one go. So Titan, which is around 4,000 sort of levels, there we are of the view that the stock is going to consolidate some more time within the range of 4,000 and 4,200, but eventually the stock is heading for the levels of 4,500. That's my view.
Well, thank you so much, Shrikant, for your view. And with that, we thank you both, Sudeep as well as Shrikant, for joining us, giving us your view on the markets, fundamentals, as well as technical levels. Well, with that, it's time for a quick break. We'll get to the top corporate voices, along with the key market events to watch out for on the other side.
Welcome back. You're still tuned on to Markets Forward. Let's get in some corporate voices of the day. Persistent Systems Management said a one-time impact from the new labor code weighed on profits during the third quarter. The company expects to remain in the 16 to 17% EBIT margin range in the near future. The management also said that it is confident of achieving the goal of $2 billion in revenues by March 2027.
Supreme Industries Management has maintained its FY26 plastic volume growth guidance at 15 to 17% and overall volume growth guidance at 12 to 14%. However, the EBITDA margin guidance has been cut by 100 basis points to 13.5 to 14%. The company added that prices have begun rising slowly but steadily since January 2026.
Vikram Solar said this recent dip in EBITDA is temporary and expressed confidence in meeting its FY26 guidance. Speaking to CNBC TV 18, the management added that it is ready to expand overseas, including Europe and West Asia, and dismissed oversupply in solar modules as a business risk.
Amagi Media Lab saw a weak market debut. The shares listed at a 12% discount to its issue price. The company's management told CNBC TV 18 that it is targeting margins of 20 to 25% as it scales global business. Amagi stated that only 10% of its $17 billion addressable market has transformed so far, leaving substantial headroom for expansion.
And before we wrap, we bring you some key market events to watch out for. Gaurav Javalkar is standing by with the key events to focus for tomorrow's trading session. Gaurav.
LS, for tomorrow, first is let's talk about earnings because we have got a couple of key companies who will come up with the earnings and the likes of Coforge, Adani Energy, Adani Total Gas, Emphasis, Science. Other than that, we also have got Premier Energies, Syngene International, and from the financial space, we have got Bandhan Bank, Bank of India, Home First Finance, Ujjivan Small Finance Bank, along with others. So definitely these are the key companies which will be on our radar. Other than that, let's also not forget about Interglobe Aviation. Now tomorrow is the numbers, and at the same time, there is a PIL which was filed against Interglobe Aviation, and Delhi High Court is likely to address that PIL. So let's watch out if there is anything to read from that. Let's also not forget about the US market data from the global point of view. This is going to be an important data point in the likes of GDP growth rate, initial jobless claims, core PCE price index, and at the same time, let's also not forget about the takeaways from Mr. Trump. So Mr. Trump is going at Davos for the event. So the takeaways from his speech are likely to come, and these are going to be a key thing to watch out for because from the global point of view, we have seen how volatility has played not only in the Indian market but overall in the global market. Let's also not forget about the Board of Peace Charter announcement. Now that is also something that we will be closely tracking out. And from the European region, now there is going to be a meeting, emergency meetings technically, to discuss the issue over Greenland, and at the same time NATO is also going to have a meeting where Chief of Defense is going to meet and discuss the issues of Ukraine. So these are the key events, and definitely on the back of the macroeconomic events that have been happening and the markets which have been shaken because of that, let's watch out and see if there is anything to read from these events.
Thank you so much, Gaurav, for joining in with all those events. Let's go across to the next important news piece. Zomato's parent company, Eternal, has announced third quarter earnings in line with estimates. But of course, the big news is Dipinder Goyal stepping down as CEO, with Albinder Dhinsa set to take over. Goyal will become vice chairman and he will remain on board of directors as well. Okay, all right. With that, we'll do one thing. We'll take a leave on this edition of Markets Forward, but we'll be back with more news and updates on the other side.
Cool.
Hello and welcome to Business 360. I'm Arundhati Ramnan and here are the headlines that we're tracking for you this evening. Davos awaits US President Trump's speech amid the Greenland standoff. Trump promises to strike a deal on Greenland that will make US and NATO very happy, but he is not ruling out aggressive steps to take control despite striking a conciliatory tone. The global governance system led by the US is facing a rupture and the old world order is not coming back, says Canada's Prime Minister Mark Carney at Davos. French President Macron hits back at Trump's Greenland takeover threat, saying we don't give in to bullies. Rupee sinks to a record low after posting the biggest single-day fall in 3 months. Sustained foreign selling of Indian equities and weak market sentiment take the rupee closer to the 92 mark against the dollar. Wild swings on Dalal Street as Sensex and Nifty go on a roller coaster ride. A late recovery helps recoup most of the losses, but all sectoral indices end in the red. Market capitalization of companies listed on BSE drops below 5 lakh crore rupees for the first time in 9 months. The who's who of India's IT industry interact with Union Minister Ashwini Vaishnav on the AI opportunity at Davos. Minister Vaishnav expects investment in AI infra to hit $150 billion in the next 12 months. Don't write off Indian IT just yet, says TCS CEO Kriti Vasan. Artificial intelligence is changing industries, and India, says Infosys CEO Salil Parekh, expects modernization of infra to become faster and affordable, says growth will compensate for the shrinkage caused by AI. That's an exclusive. Uber will launch new modes of transport in India this year, including train services and luxury offerings, says the company's president Andrew McDonald. Rules out a return to food delivery, says India is among the top 3 markets for Uber and home to the largest tech center outside the US. Zomato parent company Eternal meets estimates in the third quarter. Dipinder Goyal quits as group CEO, passes the baton to Albinder Dhinsa. Goyal says he will remain on the board of directors as vice chairman. India's telecom regulator takes note of telecom companies' tussle against Adani-run Navi Mumbai Airport, says pricing of telecom infra should be fair, confirms it is looking into telcos' demand for a price cap, but holds that for right away, telcos need to dial the union government. Those were the headlines that we're tracking for you this evening, but straight to the top story. The rupee has plunged to a record low after posting the biggest single-day fall in 3 months. Sustained foreign selling of Indian equities and weak market sentiment took the currency closer to the 92 mark against the dollar. Lata Venkatesh is here with all of those details. Lata?
Well, the story is familiar. Foreign funds are selling Indian shares, buying dollars with that money and repatriating it, and that's the same thing. The rupee was already on that weak wicket where capital flows are not able to bridge the current account deficit. But what has exacerbated it is this kind of risk-off in the last 24 hours across all financial markets that hurts an already bearish asset even more. We did see the Reserve Bank supplying dollars, but when there is a cascading buying of dollars by foreign funds who are marching out, the Reserve Bank wants to preserve the ammunition, so they weren't supplying in huge amounts. Another factor is that month ago contracts entered into the NDF market is maturing, and that leaves a lot of Indian banks in short dollar positions. That creates pressure around 1 p.m. when you have the fixing of the dollar-rupee rate for the day. That added to the pressure, so we saw the rupee at its weakest around 1 p.m. There is little to redeem the pressure on the currency. We can only say that at the moment the rupee fall also has strengths. We mustn't look at it as a matter of despair because it makes imports expensive and therefore protects domestic industry from cheap Chinese imports fundamentally. Because while we have fallen in the last year or so, about 5.5% versus the dollar, versus the renminbi, the Indian rupee has fallen nearly 12% in the last 8 months or so, or in the past year. Therefore, this has its positive payoffs from the import scenario. Exports also become more attractive, but that, of course, are usually annually renegotiated contracts. Short point, when there is a sudden sharp fall, all these positives kind of pale into insignificance because Even those who want to bring dollars don't bring in. Exporters stay back. They want to sell later. Importers rush to cover. And foreign investors also wait to see how much the currency falls. Why would they want to bring in something when the asset is depreciating? So sudden sharp falls don't help anyone. But in the long run, the answer to all the instability or differences in prices is a falling rupee. It's also a solution, but not when it is a sudden sharp fall.
So rupee hitting a fresh low there. Thank you so much for taking us through those details, Lata. But from the currency markets to equities, the market witnessed an all-round fall with major pain seen across broader markets. Nifty closed below the 25,200 mark and nearly 30 Nifty stocks closed in the red. The Midcap index swung nearly 1,500 points in today's trade. Prashant Nair joins us now with all of the day's market action. Prashant?
Well, at the day's low, it was a complete bloodbath once again, but thankfully it did not turn out like that. Actually, we recovered nicely. The Nifty was up about 50 points, which means that, from the almost a crash-like situation, the Nifty recovered almost 400 points intraday. And then, of course, it gave back some. So we ended lower, nothing compared to where we were, though, at the day's lowest point. The mid and small cap indices, 1% lower. On the small cap index, around 1% down on the mid cap index. Bank Nifty worse off today. Remember, the Nifty Bank has been much stronger as compared to the Nifty, but today the Nifty Bank was down about 1% or so. The rupee will come up on your screen, and this is the other thing, right? So if the rupee goes like this, just yesterday we were under 91. It closed, that is. We breached 91 and we closed under 91, and from there to go to almost 91.80-ish kind of levels, just incredible, that kind of move. And this at a time when the dollar is not rising against, any G3, G2 or G7 currency in that sense. So, or for that matter, other large emerging markets in that sense. Now, I'll just quickly wrap up stocks here, and I'll start with what was down in the Nifty. ICICI Bank down about 2.25%. Tata Consumer down about 2%. There was Trent and BEL, which were down about 1.5% each. So actually a much better looking screen compared to the last few. Eternal was up 5%, 280 plus once again on this one. Ultratech, JSW Steel and Hindalco looked up in terms of today's session. Now, the broader markets, it was 2:1 once again in terms of declines to advances ratios. I'll start with it was down. Kalyan Jewellers was down 12%, number one volume-led loser. Cupid was down 7% after yesterday's 5% cut. SRF was down 7%, Vikram Solar 8%, Style Bazaar was down 8%, Tata Communications 5% down, TFCIL down 8%, there was Shoppers Stop, Orient Pro Solutions was down about 6%, MobiKwik 1 point. These are all between 7 and 8% losses that you had. On the upside, it's once again precious metals, right? So the silver ETFs all surged between 4 and 5%. Actually, the gold bees were up 8% today. So, financial derivatives of underlying commodities doing exceptionally well. Credit access numbers 10% higher today. Hindustan Copper was up 5%. I think there was MRPL, which was up about 11%. So big one in that sense. And there was something like a Piccadilly, which was up about 12% as well. So a bit of this and that in terms of broader screen, but a big recovery, sort of sigh of relief after what looked like another complete washout kind of a day. The big cue when we come back tomorrow, of course, is going to be whether President Trump and what he says in Davos at the World Economic Forum. Back to you.
So Prashant there decoding what was a roller coaster ride on Dalal Street. But speaking about Davos, let's cut across to Davos, where Shireen Bhan is in conversation with Novartis CEO Vas Narasimhan.
Back, our coverage here from Davos 2026 continues. We've been focusing on technology, energy. It's time now to put the spotlight on what the outlook is for the pharmaceutical industry. Who better than to give us a perspective than Vas Narasimhan of Novartis? Vas, always a pleasure. Many thanks for joining us here at Davos 2026. Let me start by asking you what the year ahead looks like for the pharmaceutical industry. There's plenty of regulatory headwinds likely, courtesy what President Trump has threatened to do with tariffs, reshoring, and so on and so forth. But stripped off that, what do you make of the picture?
Well, look, I think in 2025, we were able to navigate a lot of the geopolitical complexities. For Novartis, but I think the industry overall, The U.S. tariffs, I think we've got good solutions there. I think with the MFN agreements to get certainty on how we're going to approach drug pricing in the U.S. Also, I think a de-risking event for the industry. So I think this year will be much more focused on, at least for us, innovation, new launches, getting more medicines out. So I'm actually quite excited about the year. You know, for Novartis, we have to navigate a big patent expiry. But after that, we expect to get back to really strong growth for the years to come.
I'll talk about Entresto in just a second, but let me get back to what you said, both on MFN as well as tariffs. How have you been able to sort of mitigate both those significant challenges?
Yeah, I think on tariffs, what we did very early was began to adjust our supply chain. So we began to have more medicines on stock in the U.S. in our warehouses, expand our warehousing capacity, and we made a $23 billion commitment. 9 new facilities. We've broken ground on multiple facilities already. So that puts us in a very good place to be able to have supply coming from those factories in the U.S. for the U.S., which then sort of eliminates whatever new tariff comes, it's okay. And then on top of that, our MFN agreement includes provisions that excludes us from tariffs for 3 years as long as we keep investing. So then tariffs are mitigated. And then on the MFN, it took us months, but we came to a place where I think it's a pretty reasonable approach that allows us to maintain our guidance 1 year and 5 year, but gives the president some of the things that he's looking for. The big challenge will be now, how does that Europe respond to that MFN? Because that's going to change the whole European marketplace for medicines.
Well, that is going to be the latest challenge that you're going to have to deal
this year's
with.
Challenge.
This year's challenge. Yeah. But, you know, going back to some of these regulatory headwinds and this reshoring to the U.S., you know, North Carolina is just one of the facilities that you're looking at. What does that do to costs for the pharmaceutical industry? What does it do to costs for you?
Well, interestingly, with those new facilities, we're really leveraging automation, AI to really, you know, enable us to have less labor costs than maybe we've had in other facilities. And so what that means is, across all of those facilities, only about 1,000 new roles, and then, of course, more roles in the ecosystem. But we're using a lot more technological innovation to streamline and get the costs down. Now, they do have higher costs of goods than our existing facilities, but we're able to absorb that, you know, given the overall size of the company.
Okay, let's talk about Entresto, because you know that is where you are going to feel the competitive intensity of generics coming in. How do you deal with that? What's the plan going forward?
Look, I think it's incredible that we have the innovation power that even with the largest patent expiry in Novartis' history, we're going to grow sales. And our ability to grow through that is, I think, one of the unique capabilities we have as a company, that we can keep innovating and new launches allow us to keep growing. And so we'll grow through Entresto. That'll be a first half of the year story. And then in the second half of the year, when we fully lap the Entresto expiry, I think you'll see an acceleration of this business. We guided to 5 to 6% growth for the next 5 years. I think that's really a testament to the innovation power that we had. We've also been very active on the deal-making front. We led the industry in the number of deals last year. That's bringing a lot more innovation as well into the pipeline.
So I want to double down on both those deals. You know, you did a $12 billion deal. Are we likely to see you do more? And any specific areas that you want to focus on?
You know, the deal making will have to continue because, you know, we are approaching a 60 billion revenue company, soon to be hopefully 70, 80 billion of revenues. In order to grow that sized company, when you always have patent expiries, you have to keep the innovation engine full. Now, I don't think we need to set the record for deals every year or lead the industry every year, but we need to be consistent on the deal-making front. And it'll always be focused in our core therapeutic areas and then as well as these new technology platforms. The $12 billion deal we did was in RNA interference, but now instead of to the heart and to the liver, now it's getting into the nervous system. And the muscle. And so that's the kind of thing we want to be at. We always want to be one of the leaders at the leading edge of medicine. And that's the vision we have for the company.
So what's cooking in the R&D labs? What can we expect in terms of the innovation pipeline?
Well, exciting launches this year. We have a new medicine for dermatology called Rapsido. We're already launching that in the U.S. We think this could be one of our biggest drugs, expanding across a range of new indications. We continue to be the leader in radioligand therapy, this new technology to treat cancer. And one area I'm really interested in the long run is called immune reset, where we use cell and gene therapies to really reset somebody's immune disease. So all of these things now are advancing this year. So I think we're on a good track.
Yeah. And when do you expect to be able to get commercial gains from some of these things?
Maybe not in the near term. I mean, I think cell and gene therapy for immunology could be 2028. Radioligand therapy is ongoing. Some of these new RNA therapeutics, we hope to get approvals in the 27, 28, 29 timeframe. Because for Novartis now, the story is less about how will we grow to 2030. It's much more how will we grow 2032 to 2037. And in our industry, that means you have to make the bets today that will hopefully pay off at the end of the decade.
So no change of heart or mind as far as the GLP-1 market is concerned for you?
Well,
still not interested?
I mean, when you look at it, it's very interesting. You know, we're the #2 total shareholder return company in pharmaceuticals without a GLP-1 over the last 3 years. So what that shows you is you can be a leading innovator in the areas outside of obesity and still be a market winner. So there are great companies leading in obesity. I think some of those will actually even go generic, I think, soon in India. So there'll be an explosion of the market in India. But we want to be a leader in all of the other diseases that humanity faces. And we do that. I mean, even as an example, malaria. Like Novartis is the global leader in malaria innovation. So we can innovate in all of these other areas and be very successful.
Well, let's double down on India then, Vaz. The last time we spoke, you were still looking for a buyer for the Novartis India business. Any progress on that?
You know, I think, Shireen, it's really interesting how much focus there is on our company structure.
Yeah.
It doesn't change Novartis' commitment because Novartis Pharma, Novartis AG is committed to India. These are all kind of structural things with our legal entities. So no change in the strategic review of how to structure ourselves. But the most important message I would want to get to all of the viewers, Novartis' commitment to India is absolute. We have over approximately 10,000 people now. We have 25 years in the Hyderabad area now with our Novartis corporate center there. And that commitment is long-term, and that's not going to change.
So, you know, from an R&D point of view, the strategic importance of India, as you highlighted, 10,000 people there in Hyderabad, you know, not just for Novartis, but will India emerge or could India emerge as the CDMO leader, you know, a couple of years on?
I think India has an opportunity, certainly with some of the disruptions you're seeing in China, that in R&D as well as in manufacturing to kind of fill the void, to be a real competitor in the CDMO space. So I think that's an opportunity. We've brought research back to Hyderabad, and so we have a research presence now, basic science research, and that's very much leveraging the ecosystem of partners that we have in India. So I think it's an opportunity to continue to build that up.
Outside of the R&D base that India provides, what about India and the market?
Well, I think that's an opportunity for sure. I mean, I think we still have not seen the market development that I would hope over time for India.
Why do you believe that's the case?
Well, you know, I think the government understandably wants to maximize access to a huge population. And how do you balance that with continuing to also invest in high-end innovative medicines? Now, I do think, and I don't want to always bring up the China story, but China somehow managed to navigate this with their NRDL system that allows you to bring innovative medicines to the broad population. And I think it'd be worthwhile to continue to look with Indian government to look how can you modernize the Ayushman Bharat system to allow you to bring innovative medicines to broader groups of patients within India, for sure.
You know, you said GLP is off the radar as far as you're concerned, but AI in specific, and you know that theme continues to play out. It's a lot more real today in the conversations that we're having. But what is that doing for you at Novartis today in terms of use of AI?
Look, we're all in making sure AI is embedded in every part of the value chain at the company. We've made big investments in R&D with some of the largest partners in the world, so DeepMind, Isomorphic Labs, Palantir, Amazon, Microsoft, to ensure that we have the latest AI in all parts of drug R&D. I don't think you're going to see the benefits of that as quickly as maybe some people expect.
Is that being overstated? Because everybody's talking about the fact that we're, you know, in the next few years, we're going to see you know, commercial cycles shrink. I mean, is that overstated?
I mean, it's probably an overstated sentence, but we overestimate what will happen in the short term and we underestimate the long term.
Yeah.
And I think this is a 7 to 10 year story, mostly because it takes 10 years to develop a new medicine. So this does not happen overnight. So I think you will see accruing benefits from AI, but it'll be in a 7 to 10 year timeline. I think where you'll see benefits much more quickly is in customer-facing operations, marketing, sales, where I think the technology is already good enough. We don't need AGI to modernize these areas. So we're looking to take out multiple $billions of costs out of Novartis by using AI even today. But I think the big win would be, can we find completely new medicines? Can we treat diseases we couldn't treat, even imagine to treat before? And I think AI gives us that potential, but it's a 7 to 10 year project, not a 3 year one.
Not a 3 year one. So, you know, in terms of cost optimization, and that's largely where you're using AI today, how do you make the transition to actually being able to go from optimization to transformation?
Look, I think it's a stepwise process because one of the things you have to do is also upskill your people and get them very capable. Interestingly, a lot of our AI work actually happens in Hyderabad. I mean, many of our top scientists and engineers working on AI are actually based there. And they're the ones doing the innovations on these use cases that will hopefully help us modernize the company. But I actually think the biggest challenge is a cultural one. I mean, in the end, what you're often doing, people keep thinking about the impact on the workforce, but often what you're doing is having impact on the individual's tasks. Certain tasks are going to be done in a different way. It's not that you're going to take out an individual and put in an AI system. And to have people understand how to use these technologies is a multi-year effort. It's a cultural transformation. But we're trying to drive that. We're putting really bold goals in front of people. And hopefully I can sit here in a few years and say we made it happen.
So what is the goal that you're working towards?
Well, right now, I think the big one is on the cost side, right? I mentioned. I mean, I think we'd like to get $3 billion of costs out over the next 3 to 4 years and really not impact our people, but say we're going to do things a lot more efficiently with our third-party spend in some of those areas. But then I think, as I said earlier, in order to grow with AI, we have to discover better medicines faster with AI. That's the real long-term opportunity.
So, going back to India and the bet that you've made there on betting on Indian talent, what will that mean in terms of incremental investments over the next 5 years, in terms of expanding your facility and your presence in India?
Right now, we're comfortable with the 10,000 number, but I remember when I've been here in the past, I said I was comfortable with the 3,000 number, the 5,000 number, and we keep going up. So I think that's more of a testament to the incredible talent and spirit of the people we have there. I mean, I think nobody who visits our Hyderabad site from anywhere in the world at Novartis does not leave completely inspired by the talent and the energy you see at that site. So I think as long as the site keeps delivering, we'll keep expanding. And I think that's the opportunity in front of them.
If the big breakthrough through 2024 and 2025 was on GLP-1, where do you anticipate the next big breakthrough could be?
I mean, I think clearly we hope in neuroscience, where we're making a lot of big bets on both neuromuscular diseases that are more rare, but also on things like Huntington's, Parkinson's, Alzheimer's. I think if we could, for humanity, the next big breakthrough would be, could we really meaningfully tackle one of these diseases? It's much harder. I mean, it's very, very hard. The mysteries of the brain remain, I think, still beyond us at the moment. But that would be the next big breakthrough. We have a couple of big bet readouts coming up.
Yeah.
We'll see how it goes.
Are they looking good?
Don't know. That's the hard part. In this industry, it's just a card flip. I get a call one morning, and I learn what happened with 10 years of effort.
Well, when you do get the call, we hope to hear from you, Vaz. Always a pleasure. Many thanks for joining us here in Davos. We wish you the very best of luck for the year ahead and look forward to seeing more of you in India.
Thank you, Shireen.
Well, that is Vaz Narasimhan of Novartis giving us a sense of what the year ahead looks like for the pharmaceutical industry. Plenty of challenges, but the pharmaceutical industry also responding to many of those and, of course, continuing to bet on their talent in India and growing their presence there. We are going to take a break. The conversations continue here on CNBC TV 18. Don't go anywhere. We're back in a moment with more. Welcome back. Our continuing coverage from Davos 2026 on CNBC TV 18. We've been bringing you global business leaders with their outlook on the year ahead, the regulatory challenges, the macroeconomic challenges, but more importantly, the investments, the bets that they are willing to make at this point in time to ensure that growth is carried forward. Right here in Davos, last year, my guest who joins me today spoke about a possible move to splitting the businesses that they were operating, and that decision has now been taken. In fact, it's been moved forward as well. To give us an update on all things Honeywell, joining us now is the Global CEO, Vimal Kapoor. Vimal, always a pleasure. Many thanks for joining us.
Absolutely. It's always a pleasure to be here.
So let me start by talking to you about that. You spoke to me here in Davos and you said that it makes strategic sense. It's a good idea to split up your individual businesses, aerospace, automation, and you've gone down that path. Hopefully will be done in 2026.
Right. So we will be, so we decided to split into 3 companies. Yeah. We announced that in February of last year. So we completed spin-off our specialty chemicals business. It's a standalone stock now, Solstice Advanced Material, and it's been up and running for about 3 months. And we'll complete the separation of the aerospace business in the second half of 2026. So we'll have, 3 independent companies, each focus on its respective segments. Specialty materials, Honeywell will focus on automation, and then Honeywell Aerospace will focus on aerospace. And each opportunity provides a great platform for individual company to grow, and it's win for our shareholders because they can invest on the sector-specific choices they have. Customers get the more attention via sector-specific companies, and employees continue to prosper in this new structure.
Yes, it's not just 3 different entities, it's 3 publicly traded entities. In fact, the aerospace business will also be the largest aerospace listed entity.
One of the largest
aerospace listed entities.
Yeah.
But let's start by talking to you about the plans as far as automation is concerned, and what the outlook is for that business in specific, and how much you're betting on the Forge platform to help deliver growth.
So automation is a secular growth trend. As the world becomes more productive, you need to put automation in all kind of infrastructure, energy, supply chain, buildings. So that's a core of what we are. And Honeywell has been in automation for 100+ years. As we look ahead, the power of data has to be unleashed, which automation systems create. And that's where the Forge platform comes in. Now, traditionally speaking, we are all used to AI, and AI has been a conversation topic for the last 1 year.
Yes.
But what has become less understood is how does a industrial sector benefit from AI? And because the data from a industrial system is not in public domain, you can't train the data and then put data science on top of it. So that's where the physical AI comes in. You want to have access to data, remove the data friction, solve it for segment-specific issues, because problems of life sciences customer producing drug is different from somebody running a hospital, which has a different problem, versus somebody producing oil and gas. So the segment-specific issues have to be solved using AI, and that's what excites us. If I look ahead, Honeywell next 20, 30 years, it's going to benefit from this whole power of AI in the physical world, and essentially enable the workforce to become more productive, more of an augmentation strategy. And I think the world is going to benefit from more productivity with the power of AI, which will come ahead.
At the end of the day, what is this going to mean as far as growth is concerned? What does it mean when your clients are looking at this as a proposition that also adds value to them, but then adds value to your balance sheet?
So for us, as a standalone company, we look forward to grow a mid-single digit in a typical year. We are a through cycle company, so we are not linked to one particular mega trend at any point of time. Like right now, there's a cycle around AI or data center. We do participate in that, but not in a substantial way. We're a much more multiple end markets company. So we see our earnings growth high single digit on the strength of mid-single digit top line growth. And this is going to be a big part of that we are able to enable our growth through our install base, which is very large. And how do we serve our customer through our offerings by which they can improve their business. So our customers win because they make more money, and therefore they pay us more money. And
so you win as well. So it's a win-win.
Absolutely.
But I was reading your note that you sent out where you talk about the importance of think,
and act, and
learn and act,
yeah.
and learn.
Yeah.
And how are you building that into not just culture, but how are you building that into service and product and innovation?
So, if you look at, an automation system is very simple. You send something and you act on it, right? Yeah, that's what is a closed loop system. It runs and make our life easier. But what it was not doing so far was learning. And learning elements come through AI. So our future state makes our systems, they continue to see, they continue to act, but they think more and learn more. So our future state is going to be a slightly different architecture. So it means we work with all the tech companies to embed their technology into our domain and bring that capability to our system. So historically, we were see and act. Now we are see, think, act, and learn. And just makes our system more capable and produce more economic output for our customers.
For our viewers who are tuning in, and it's a diverse audience, and not everybody will be familiar with physical AI. Explain to us very simply what that does in the near term.
Yeah. So think of, when we think of AI, we immediately start thinking about automation of the task, and it's going to eliminate job. But that's more applicable to the sector where software is the center of the universe. Software code can do that. The physical AI is more of an augmentation strategy. And why it's augmentation? Because in the industrial world, people's skill matter a lot. And as the populations are aging in the world, less skilled people are available. So AI is going to augment the people so that they remain more productive as they are.
So we're going to do away with the people.
That's a fundamental difference. So it's automation versus augmentation. Automation means a task can be totally automated. That's where replacement comes in. Augmentation means I'm going to help you to do your job better. Great augmentation tool example is Google Maps. It's an augmentation tool. If you follow it, you never lose the way. So it means everybody becomes a good driver and don't lose the way. They don't have to ask anybody where to go. So if you take that in terms of industrial equipment, how to operate it, how to maintain it. So the physical AI is all about making industrial infrastructure more productive. The people who run it every day, they got the tools by which they can run their operation in a more sophisticated manner. But the challenge in physical AI is, unlike normal AI, the data is not in public domain. So you have to remove the data friction. You have to train the data for a domain, and you have to bring a solution you can trust. Because probability is not going to work. You can't say that this restaurant is probably very good. It may not be good. There is no may not be. You have to have an output which is highly trustable. And that's a word of physical AI. So physical AI, the difference is physical AI is hard to execute, but the benefits are tremendous in terms of bringing augmentation of the workforce. And that's what excites us. That's where Honeywell Forge platform comes in. We have been investing for several years, and that's going to compound our growth.
Well, speaking of compounding growth, we're also in a challenging environment, and you operate across different jurisdictions and different geographies. We're in a tariff world. We're in an uncertain world. How is all of that impacting business decisions at this point in time?
These are all transitionary things which happens in a business, right? For businesses like us, the tariff did not impact us a lot because we were always manufacturing local for local. We don't move around things a lot. So we will manufacture in US for US, Europe for Europe, Asia for Asia. And implication of tariffs was very modest. It was much.
Will you do more now in the US?
We already were. So if you ask me that what's the net impact of that, Honeywell have 70 manufacturing facilities in US. So do we need 71? Probably not. Do we need to expand some of them? That's purely a business opportunity. But what it does is it makes the local for local strategy much more embedded across the entire universe, which becomes a business opportunity for us. Because now we get to serve customers who need to set up their capacities in different parts of the world. So for us, it's much more business opportunity. But for our own business, the changes are quite modest.
So let's speak about the business opportunities that accrue to you on account of the changes that we're seeing. What does it mean then in terms of new revenue coming your way?
So as US onshoring increases, it builds more industrial companies there, whether they are building more semiconductor fabs, whether they are building more pharmaceutical facilities. Just as an example, all those becomes customer opportunities for us, which the ramp rate will increase as these investment cycle. One great example is near term in the last 1 year, we see substantial increase in our business in LNG because US is exporting far more LNG. So all those facilities are being automated. The technology is being supplied by Honeywell. So that's just one wave of it. So that's LNG wave. Then will be wave for industry like semiconductor and so on. So I think this is a progression, and that progression, that was the point I was making earlier, as more and more onshoring happens, this brings more customers for us. That happens in Europe. That will happen in other parts of the Asia.
So this reshoring or onshoring theme, do you expect this to amplify and gain more momentum as we move forward into an even more fragmented, confrontational world? I just had Vaz Nassim, the CEO of Novartis. They're, adding capacity in the US on account of the
That's a trend generally.
Policies.
Yeah, I think most companies are becoming regional supply chain model. Companies like Honeywell has been doing it for decades, but I think others are following a similar structure, which, I mean, if your economics can afford it, if you can afford 3 factories versus 1, you will do it. But if your economics don't afford it, then it's going to have a different driver, in my view.
Well, let's talk about India, and it is one of your high-growth markets.
Absolutely.
What does that look like today, and what do you anticipate growth to be?
We are, quite blessed to have very strong India business growing at double-digit rate for several years. And I think the India growth story is really playing well for us. We are benefiting from it. Our business has been growing double-digit for, as I said before, for now 3 or 4 years in a row, and we expect 2026 to be same. And fundamental of that is the investment in infrastructure is certainly helping us to grow. As India GCC story grows, that also helps us because those building and infrastructure are also automated by us. And the growth of India requires more energy. Energy infrastructure has a lot of participation from Honeywell. So I think the whole India growth story plays well. But where the story is changing is as Made in India is becoming more prominent, our sourcing activity from India is increasing. So India as a source of buying product for global demand. We are setting up more factory. We set up a new factory in Pune recently, apart from what we already had. We are developing more supply base in India because as they're becoming more capable, it provides us more opportunity there. So that to me is companies like us started domestic business, then we started doing product development, and now we are doing much more sourcing. So to me, it's a third wave of globalization for companies like us.
So if we are now ushering in the third wave, so to speak, as far as your India ambition and your India aspiration is concerned, what will this sourcing opportunity from India look like, make in India for the world?
It obviously is in billions of dollars. I think India will compete in each sector, but I think there are natural advantages in some sector India has. So it's ability to where you create scale, and wherever the scale exists and competitive advantage exists. I think people look at it as it's an optionality, +1 strategy. I will actually not look at it that way alone. If you are competitive and you are best in class cost structure and product quality, whether you are +1 or you are unique or +2, people are going to come to you. So I think we have to look at the overarching value proposition of a sector. And I think the sectors which will benefit from a lot, Honeywell is a big aerospace part of it, which will become a separate company. As an example, we see India becoming a source for aerospace, which is not a big sourcing player right now. But can it become? Absolutely. So those are the unique opportunities which will evolve, which are in very infancy stage at this point of time.
So given what you've outlined for us in terms of growth drivers as well as opportunities, capital deployment as well as M&A, and are we likely to see more bolt-on M&As? You've been fairly acquisitive.
Yeah, so Honeywell has, since I became CEO, we spent $14 billion in different acquisitions across. Now, the assets we buy, they're either US or Europe based, but they always have a presence in India. So I think India automatically benefits from those acquisitions. In fact, many of our acquisition thesis is built upon an asset which we can grow outside US in a big scale way. And India plays a big role in that. So I think our investments globally brings more capital locally. Now, domestically, will we look at acquisition opportunity? I think in our sector, the nature of companies are generally very global. And domestic opportunities are very minor. So
global companies with an India presence.
With India presence, so that becomes a way for us to scale our growth. So we can look at a sector where India could be a big growth engine and really double down on that from an acquisition standpoint.
So 14 billion already done in terms of M&A.
Yeah, we are much more cautious this year because we have to complete our spin. And we're also conscious on our credit, on our rating. We want to stay at investment grade. And, we are A-rated company, so which matters to our shareholders. So we're a bit more cautious till the time we are able to, maintain our ratings. But we'll be always looking at more and more acquisition pipeline. on what's more coming. Because maintaining an active portfolio is a critical responsibility of a public company. We want to make sure that we have a portfolio which is relevant for our customers, which means a lot of work we have to do organically to grow our new products. But it doesn't mean we close our eye and don't look at external world.
So, Vimal, let me end by asking, as a CEO today, we've talked about some of the themes that will shape not just your business, but will shape the sector in general and at large. What are some of the other not so obvious trends that you're starting to pick up that you may want to intertwine into your business going forward?
I think the one thing which is not talked about a lot is the shrinking world population. And that's going to create a driver which is not well thought through at this point of time. Because most countries even have a population replacement rate of less than 2 now. India is almost approaching that rate.
Yeah.
US is 1.6. Many European countries are same rate. Japan, Korea is less than 1. So how do you imagine a world in which people are not, there are less people and there are less skilled people? What are the implications to different sectors? And aging population means, for example, you need more hospitals, you need different type of drugs, but it also means less people available for productive work. And I think shaping that discussion probably looks 10 years away from now. But I imagine that's going to become a prominent discussion in the times to come.
And that's an important point that you make. And even in the context of India, while we keep talking about the fact that we're a young democracy, we're also a fast aging democracy.
Absolutely.
And the replacement rate that you spoke of is a very valid point. But in that context of what you just said, then are we overestimating or overstating what this AI wave is going to do to jobs and white-collar jobs in specific?
I think one has to look at AI. That's why I made a distinction between where AI can do in automation and where AI can do augmentation. And therefore, as a company, we are very focused on augmentation, because in a shrinking population scenario, more people will have to do work, either multitask or younger people have to do the work, which highly experienced people were doing it. So AI is going to play an important role in augmentation versus several roles in which it could replace people. And those are more functional roles. But that's not our focus area, right? So I stay optimistic that, in the world in the future growth, AI will become an important engine by augmenting people, by providing them the skills so that everybody's more productive.
How much of AI do you use every day?
I mean, to the extent, I guess, you use it in terms of reading your emails, summarizing that. Sometimes it's a very useful tool to, develop a document. So I think those kind of co-pilots are interesting way to...
Are you talking to it?
Not yet. I'm not good in using voice-based tools. Yeah, I'm not good at that.
Not yet, but maybe that you learn to do.
Absolutely.
Well, Vimal, always a pleasure. Thank you so much for joining us here in Davos and giving us an expansive overview on what the business looks like, but more importantly, the environment that we're in as well. Always a pleasure. Appreciate your time.
Thanks for having me.
We are going to take a break here, but the conversations will continue on CNBC TV 18. That was the global CEO of Honeywell, giving us a sense of what business looks like and what the trends will be that will shape the future of automation. We'll take a break. Back in a moment.
Welcome back. You're watching Business 360. The Zomato's parent company, Eternal, reported a stable set of numbers in the third quarter. Net profit rose nearly 57%, while revenue jumped 20% on a sequential basis. The company announced founder Dipinder Goyal will be stepping down as CEO, with Albinder Dhinsa set to take over. Goyal will become vice chairman, and Rachna Dhanrajani is here with all of those details. Rachna?
Zomato founder and group CEO at Eternal, Dipinder Goyal, has now announced that he will be stepping away from the role of the group CEO. He passes the baton to Albinder Dhinsa, who has been his longtime friend, but he also heads Blinkit, which is the quick commerce arm of Eternal. Now, their friendship and the relationship goes way back into like their college days and their IIT preparation days, as we know it from the recent interviews of Dipinder Goyal. But the reasons that Dipinder Goyal cites before stepping away is that he thinks, in his view, the position of a group CEO at Eternal should be held by someone who has a singular, sharp focus towards the operational day-to-day functions of the company, and he finds himself drawn towards more high-risk ideas and more innovative and experimentative ventures. Now, as we know it, Goyal backs a couple of ventures. One of his ventures is LAT Aerospace, which is working on hydrogen-powered airships and aviation innovation. Then there's Continue, which is focused on longevity. Within that, we also saw him recently with a wearable, which he calls Temple, which is also focused on longevity. Again, much spoken about on social media. And with that, he passes the baton to Albinder Dhinsa. Now, speaking of the Goyal-Dhinsa relationship, it is often described by industry watchers as very complementary as they go back. And even when Blinkit came into the fold of Zomato, ever since, Blinkit has truly turned out to be the growth bet that Zomato had made on the company, and it has been working on that. So we will be looking forward to as to what goes forward from here. Speaking of Goyal's exit, he has also mentioned that all his unvested ESOPs, which were held by him, will revert back to the ESOP pool, aligning leadership incentives without incremental shareholder dilution. He will continue on board as the vice chairman of the company.
So some leadership changes there at Zomato. Thank you so much for those details, Rachna. But moving on, VinFast India CEO Tapan Ghosh says the company has doubled its investment commitment to $1 billion in India. Speaking to Rachna Dhanrajani, Ghosh added that the company is open to partnering with local manufacturers to boost capacity. Take a look.
We are very much bullish about the Indian EV growth story. And for our parent, Vin Group and VinFast, India is a very important market for the global Vin Group. So, for example, let me just tell you, other than Vietnam, we have our manufacturing plant in India, where we have already invested $500 million US dollar to have a capacity of 50,000 vehicles in the first phase in a 400-acre land, which can be scaled up to 150,000 and even more. In fact, we are so committed to India that just few months back, we have again acquired another piece of land, which is 500 acres. That makes it 400 plus 500, 900 acres. And we have committed an investment of another $500 million, which makes it total $1 billion, to manufacture our e-two-wheelers as well as e-bus in the second plant, which I'm talking about.
Two things here. One is the Thoothukudi plant, which is already operational, but that's a CKD plant, right?
No. So Thoothukudi, we are right now having CKD, but we can have
full manufacturing,
localization.
So are you looking for like partners for local manufacturing?
So we are open to partnership for local manufacturing. We are open to it. As of now, we are actually having mainly CKD, very less localization. But as you must be also knowing that localization depends a lot on the scale.
Yeah.
So we would be increasing localization as the scale increases.
And continuing with our coverage from Davos, the cognizant top brass is betting big on leveraging AI scale growth. Shireen Bhan spoke to the top management at Davos to find out more. Take a look.
Hello and welcome to this special broadcast. We're coming to you live from CNBC TV 18's open studio here in Davos on the High Street, the Promenade. We're joined by a company that is making big, bold bets, in the words of its CEO, as it looks to the next 3 years. Surya and Jatin, many thanks for joining us here on CNBC TV 18. Always a pleasure to have you with us. Surya, let me start by drilling this down to what is happening in America. The focus here in Davos 26 is all about President Trump and what President Trump is doing. But from your client's perspective, what are you seeing in the US today?
First of all, thank you, Shireen, for your show again here in Davos.
Well, across the American clients, based on the guidance that we gave in Q3 and the commentary from the peer group, there is definitely acceleration as we exit 2025 into 2026. So, that could be read as optimism in one format, but the clients will finalize their budgets towards February or March of this year. That's exactly when we'll know if the aperture is opening and if it's opening by how much.
But what is the sense that you get? Do you believe that it's likely to open and be better than the previous year?
There is no negative signal so far from clients on their budgets.
The only reason I'm asking is because there's so much uncertainty and everybody's talking about the geopolitical uncertainty and the geo-economic confrontation and so on and so forth. But you're saying that there's no visible indication of that impacting investing sentiment.
That has leveled out in many ways, Shireen, over the last few quarters, the geopolitical tensions, the tariffs and other issues. So now the clients are feeling the pent-up demand. So while there is no clear signal yet, but there is no negative signal that it's going to be, worse than this year. And added to that, across the industry, we are seeing that there is acceleration in Q4 compared to Q4 of last year.
That's right.
Which makes us believe that, hopefully 2026 is the year.
2026 is the year. What is that going to mean, Jatin, in terms of the kind of growth that we can expect over the next 3 years? I know that Ravi said, the company has stabilized, the turnaround plan that was put in place has delivered the results, but now it's time to accelerate. It's time to go for big, bold bets. What is that going to look like, in terms of numbers?
So let me take a step back and share for first 3 quarters of 2025 on the growth table, our position is second. So we have clearly demonstrated that we are accelerating even if the environment is slowing down or is unsure. As we look at next few years, we have articulated that we want to be in a top tier growth company, relatively speaking, with our peers. We want to continue to expand margins in a gradual manner. And we are making all the right investments. We were the first to invest with Anthropic in creating a go-to-market partnership. We were the first to speak about $1 billion investment in AI. We are putting right stakes on the ground to convert whenever the flow of demand comes. We'll be ready for it.
Well, speaking of the flow of demand and speaking of opportunities, I mean, M&A has been a large part of where the growth has also come, 250 basis points on account of M&A. Do you see that being a big lever and a big driver of growth going forward as well?
I would say yes, not from the quantum standpoint, but the impact that M&A can make in times like this, where it can provide you an exit velocity or escape velocity, which is very different than any other players, because you bolt on something which is really transformational. So yes, it is going to be a critical component of our growth strategy. One of the things that we have always spoken about is AI is our big thing, and we invested in 3Cloud. It is right in Surya's domain, where we have invested in a company which has grown 20%. So clearly it is operating in the sphere of double-digit growth that we are speaking about, and we will continue to invest in businesses like that.
Well, investing in businesses of the future, investing in capabilities of the future. What we are now starting to see the business model pivot to, which I'm hearing from your peers, is outcome as a service. So, break that down for me. At Cognizant, what does that mean exactly? How are you doing deals differently? How are you pricing deals differently? How's the customer expectation, the fulfillment expectation changing?
Actually, Shireen, outcome as a service, the concept is not new. It has existed for many years now. But it's a different story that we did not engage with clients or contract with clients in that format in a broad way. But now with AI proliferating everything, impacting everything, clients are looking for partners who have skin in the game, who can share the risk, and who can vouch for the outcomes. So they're beginning to push us on contracting for outcomes, and contracting for the business outcomes and KPIs, where we co-invest with the clients and share the gains. So yes, we have started structuring some of our large deals in that format. where we have gain sharing, outcome-based, kind of things. But yes, that is going to be.
Is that where the playing field is now moving to?
It is pivoting towards that. It is pivoting towards that. But well, it's while the deals are far and few at this point, but we see the directional pivot in that aspect.
But speaking of deal flow, and it's been good, it's been strong, in this quarter for you as well as for your peers. What's the sense that you get in terms of transformational deals? Are we now likely to move to those being much more frequent? And what is the typical deal size that you envisage going forward?
So if you look at the past 12 to 18 months, Shireen, most of the activity was on the productivity space, leveraging AI to unlock the productivity across the tech stack, across the enterprise. So we have seen a ton of large deals in that format. Now we are beginning to see the deals which are graduating upwards, which we call it as industrializing AI, which includes getting the data layer ready, building the entire tech stack, and then again building the agents and the hierarchies of agents and the orchestration. Recently, for one of our healthcare clients, for the last 12 to 18 months, we have helped them unlock the productivity in their tech estate. Now we are graduating to help them build the entire AI stack. And not only that, we are also helping them build the AI agent hierarchies. So we have structured a large deal with them. And so we are seeing many such deals in the market. And we also want to pivot in that direction because it helps both ways. So.
Well, speaking of making the AI pivot, which as you both pointed out is a big focus and a big priority area for you, we're now starting to see your peers also give out AI-specific revenue. But what do you make of it? Some believe that this is, if everything is AI, then do you really need to move to a different line as far as AI spends are concerned? And should there be a more credible, more transparent way of measuring that?
Actually, we have dealt with it in the digital era. If you recollect in 2014, 2015, 2016, and suddenly we started seeing that everything is digital, so everyone backed off. I see a similar syndrome here. I mean, AI is ubiquitous right now. So AI is in every project we do, in every deal that we sign with our clients. So AI is there everywhere. Rather, the more quantifiable and more credible measures would be what we just spoke earlier, defining the right outcomes, AI-driven outcomes. AI, whether it is driving the business value, business growth, or the margin improvement for clients, or for example, for one of our clients, we have discussed with them on a KPI which includes launching products much faster than they did in the past. Let's say earlier they took 6 or 8 months to launch a product. Leveraging AI, we said we're going to commit to launching it in 2 months or 3 months, as an example. So things like that are more credible than, rather than declaring, AI revenue. And in fact, we were the first ones to go to the street and start declaring the AI projects, which we are still doing. But now the projects are increasing in number, and almost every project has AI component now.
Yes.
So, I mean, I'll just add on to Surya's comments. We have started publishing our own view of what we think is relevant, and that is revenue per employee and profit per employee. Because finally, AI in every shape should drive a superior throughput or superior positive GDP with lesser human effort. So that's what we have started doing. So that was just to round off on what Surya was saying.
Well, one of the big possible events in 2026 is likely to be the regulator's nod to going for a secondary listing in India. And I know that there's a lot of back and forth at this point in time with the regulator. But Jatin, how do you believe that could change things for the company?
I think there are 2 or 3 very important strategic rationale for us to consider it. One is we have a large base of our employees to whom today we probably are not able to offer ownership as easily as we would like to. The second is we are a large brand, large presence in the country, and if we are present on the stock exchange, it only further enhances our employer brand. And third, there are investors in India who know us well, who track us today, but today do not have a direct access to investing with us. So we are clearly something that we find a lot of merit in. As we have discussed, we continue to work with our partners to understand it more, look at how the rules work, and see where this goes. But we are looking at it closely.
Okay, looking at it closely, and we'll know which way the regulator decides to move. But what do you believe, Surya, will be the trends that will shape 2026? I mean, a lot of the AI-related work, and again, I was pointing out that last year, the messaging, for instance, here on the promenade was much more in your face. Everything was AI. It's a little bit more subtle and nuanced today. So are people finding their niches? Are people finding their specializations? And what does that mean then for Cognizant?
Actually, across the spectrum, Shireen, the clients have now leveled out on the hype curve. So now it's not hype anymore, it's the reality. So clients are pivoting more towards, how do they infuse AI across their tech stack? What is the ROI? Because for the last 2 years, a ton of money has been spent at the chip and the infra layer. Now there is a pressure in boardrooms across our clients asking for ROI.
The question staring me literally in my face right now is where AI meets ROI. Is that being answered?
That is going to be one of the significant trends where every single client of ours is going to think about it and do something about it. That is one. And now making AI real. Last year we spoke about pivot from experimentation to scale. So it started happening, but albeit not at the pace that we wanted to. But now there is a forcing function on the client side that they have to adapt and enable this at scale, and then start having the ROI conversation. And these two are going to create friction, and that's going to be a significant trend in my opinion.
We're talking about the opportunities, Jatin, but let's also address what the possible challenges or constraints could be as you try and sort of address some of these possibilities that we spoke of.
Actually, it's a funny way of looking at it, because in my mind, the challenges is also opportunities for IT services company. If you look at a classic AI deployment, the reason why it takes time to deploy is historically we have compartmentalized data. We have created segmentation between environments in a large company, which means it's almost like you won't let an agent move from one part of the organization to other part of the organization to do work. So there is a large opportunity, which we call Vector 2 opportunity, which is really making organization ready to see the full potential of AI. So therefore, I would rather really people pressure test this, and that would really start converting a lot more work for players like us. So it's good for us.
Actually, I want to add a couple more things to what Jatin said. One tactical and one strategic. Tactical aspect is availability of right talent. That is going to be extremely critical, because almost all clients are going to open the floodgates in deploying AI. So having the right talent is going to be the critical. The strategic element is some of the clients are beginning to see change management issues at their end. How they navigate the change management, how efficiently and effectively they get their organization aligned. That will determine the velocity at which this will take off.
Well, gentlemen, it's always a pleasure speaking with you. We wish the two of you the very best of luck as you chart out ambition with execution, and look forward to another conversation here in Davos, and of course looking forward to seeing you in India as well. Surya, Jatin, always a pleasure. Many thanks for joining us.
Thank you very much for having us.
Well, that is the Cognizant roadmap for 2026 and beyond. A lot of AI and a lot of acceleration of growth is what the company is focusing on. For now, from all of us here in Davos, thanks very much for watching. We'll be back again shortly after this break. Welcome back. You're watching our continuing coverage here from Davos 2026 to give us a perspective on how investors are looking at India and, more importantly, the bets that they're likely to make. Joining us now is Manish Kejriwal. Manish, always a pleasure. Thanks very much for joining us here on CNBC TV 18. Before I talk about investments, let's talk about Carney, because that really is the big story out of Davos ahead of Trump's arrival. Then everything else will change. A standing ovation here at the World Economic Forum, basically calling out what he believes is a falsehood of believing that the world and the rules of how we ran the world still exist. What did you make of that?
Listen, firstly, thanks for having me here, Sharon. Always a pleasure. I think Carney was the breath of fresh air that we needed in Davos. If you saw what's been happening, there were two things dominating Davos 26. The U.S. geopolitical stuff, whether it's Greenland or Venezuela or tariffs, and it's AI. But there was no one giving the opposing view. We had the entire U.S. team in advance of Trump's arrival today, whether it's Scott Bessent, whether it's Lutnick, and a bunch of others. And we keep seeing Paul Ryan also, and then, you know, even the governor of California is around in a different capacity. But everyone in Europe was keeping quiet, despite I'm sure there's lots of private discussions. So to see Carney being, you know, I think he's the only person who's been the head of the central bank in two countries, both the UK and Canada. He's prime minister, he's an investor. He's probably as sharp as they get. And before his speech yesterday, a few of us were fortunate to spend about an hour or so with him. And the clarity of thinking was exactly what we needed. And if you look at the points he made, which was essentially, you know, there is a significant change in geopolitics. Yes, we all know that. But we've got to recognize it. And the middle powers, as he calls them, should be doing something together, not to fight against, but just to regroup. And these regroupings happens every few decades. This is one of those. But the way the U.S. has unilaterally appealed and, you know, in a sense disregarded the multilateral negotiations or the institutions, a lot of that is positioning and is a very great way of negotiation. And Trump, to his credit, has done what's right for MAGA and for America. Their focus is getting jobs back to America, and he has no issues if the rest of the world does what they want to. So I think if they're being honest about that, I think Carney's calling them out and saying, listen, this is what you're doing, this is what we will be doing. And he's calling out to the other middle powers, which is basically the rest of the world outside of China, Russia, and the US, to come together in whether it's trade pacts that you're seeing now, which are more regional. And the world cannot become unipolar again. It'll be a new type of multipolarity, but a different type of multipolarity. But I think Carney saying that in the specificness, the clarity, and the lack of fogginess in his mind was just phenomenal.
Yes, he has
the bright smile.
It's been the bright spot of Davos 2026 so far. But, you know, Manish, let's talk about what's happening back home, specifically with the markets as well as the rupee. Now, you know, FIIs have been pulling out, have been coming back in for a bit, pulling. What is causing this kind of apprehension? And also specifically on the currency 91.50 today, you know, how are you investors looking at it?
You know, let's get to the easy part of the question first. As investors, all of us put into our calculations an assumption that the rupee will depreciate between 3 to 5% every year. And this is over the long term, right? So essentially in your models, you have a certain entry price. You assume certain exit parameters. Obviously, the currency has to play a part because the money you get is in dollars. You convert it to make it domestic. You get that back when you sell it, you reconvert it. So if you have that assumption, in most years this is played out. Obviously, this year is larger than 3 to 5%. But as an investor, you can't do much about that. You can't hedge the currency. You have to let it be. And maybe by the end of the year, if this continues, you change your assumptions a bit more. But what does that mean? It means the rupee returns that we need to deliver to have the same dollar return goes up, right? So we have to be either then a little bit more careful of deployments or make sure that we only deploy when the valuations come to an area where we can make the commensurate return in US dollars as well as rupees. So what you will see, I think, from most of us is a gradual slowing down of investments. I think primarily all else, this is ceteris paribus, obviously. So if the rest of the world and valuations remain where they are, I'm hearing choppers, maybe that's the president. But on a serious note on India, I think nothing changes as far as we're concerned. And to be honest, and I don't want to be a buzzkiller here, as far as Davos is concerned, India is not a topic of discussion, right? But if you talk to the investors, the India story is really well appreciated. It's a secular story. And remember, a lot of what the global world has gone through in terms of tariffs has not really affected us. Our investments in financial services is not exposed to tariffs. When you look at consumer demand, most of the companies are almost 100% domestic demand. If I look at Vishal Megamart, which we exited this year, partially exited, only Lenskart has about 10% of its revenues outside of India. So it doesn't make a difference. So except for tech services as an investment sector where you're more careful about the visa and the H-1B visa, the tariffs haven't played a big part. Given what's happening in China and the lack of DPI and returns there, that money's pivoting away from China. So, but it's not coming only to India. It's going to Japan, it's going to India, it's going to Australia. I think Schwartzman was with you yesterday when he said India was his best market.
Yes.
Many investors like that have seen terrific returns in India. The rupee, you've got to keep that outside. So if you look at rupee returns, India's delivered. If you look at DPI as a country which does not show returns, we've shown some of the best returns. And if Schwartzman is saying that, it's probably the same for most other Pan-Asian funds. And remember what the Pan-Asian funds are doing now. If you looked at them circa 10 years ago, maybe 15 to 20% was being invested in India, 80% was in Japan, China, Australia. The rest of Asia remains similar, but China has gone close to zero, so that money is being reallocated. So as far as Pan-Asian funds are concerned, there's more money coming into India, which is why the larger deals which they compete on are getting pricier. But China, I really believe, Sharon, it's today as a market is as attractive as India, right? There's a certain problem which I think is temporary. The money will flow back and we'll go back to normal times. So India shouldn't get used to the pivot from China to India, which started off with Japan actually doing that. It's not a constant. It's a temporary spike for India. We should be prepared for it. And the rupee, unfortunately, is where the rupee is.
Yes, it's clear that the Reserve Bank will intervene as and when it has to. But, you know, what does this mean then in terms of deals for you? As you said, investors may pause, but, you know, is that something that you see happening at this point in time, or do you believe that deal making will continue?
The issue involving deals in India are much more related to valuations. So what have we seen in the last 2 years? The level of exit activity has shot up. Whether it's IPOs, whether it's strategic sales to outsiders, or what we call GP to GP sales. You've seen an increasing number of assets, not for any bad reason. I may have a belief in a company, somebody else may not, or a smaller VC firm may need to invest the company, a high growth company like Purple, which is a Nike competitor, someone like us. We might sell a larger company like we did Manjushri to an Advent or a Blackstone or a KKR. So that's the evolution. So that pocket of money, which is GP to GP, given the plethora of capital, has seen no slowdown. The actual slowdown is only related to valuations. So what happens is the current multiples, you have your margin of error close to zero. So let's say you approved a certain investment at a valuation of 100. If the price is 120, all else being equal, you've got to make sure that the potential areas to worry about, the weaknesses per se, the potential weaknesses, you derive full comfort. So essentially, if you see 10 deals and we're approving 2, you might approve 1 today. But that's again based on entry valuations. The good thing is the exit valuations are equally attractive. So most of us, what we've tended to do in these cases is push the accelerator on exits and pull back a little bit on entry valuations, because investing is 2 big perspectives, what you buy and what you sell.
Yes, what you buy and what you sell. But from an IPO point of view, 2026, what's it shaping up like?
There is, you know, the strength of the IPO is not dependent on foreign capital, but what it's really benefiting from is all the SIP money and all the domestic money, and people like Narain, ICICI Pru, HDFC, and SBI are really the ones driving this in today's market. And even the pricing of IPOs, it used to be in the good old days, Capital and Fidelity and the others. But I do think this is a good development, Shirin, because we're no longer as a market dependent on foreign portfolio investments for the IPOs. It's a much more steadier flow of money. And you probably know better than me, as or most bankers, that if you look at the equity market participation by the retail public, we're at the tip of the iceberg. That transfer into equities, I think, is a secular flow. And what was the tip of the iceberg will slowly descend. So even if you have volatility in the pricing of stock prices, the amount of capital as a whole moving towards equity and probably away from savings or mutual funds, etc. I mean, money market mutual funds is be a secular story for the next 5 or 10 years. And that's the strength. If you look at the AMCs, what was the size of ICICI Pru? It was very large 10 years ago, but now it's super huge, right? 10 years. And 10 years from now, it's going to be that much larger. So I think from an IPO, as far as we retain the quality of both the company, the management, and governance.
Yeah.
That, I think, truly, Shirin, we have to appreciate, has been an uptick in the last 10 years. And we're seeing less of the scoundrels and many more of the real value creators.
Well, that's good news for all of us. But let me end by asking you then, we've seen plenty of deals. Banking was, of course, the big one where we saw a lot of foreign players coming in. Which are the sectors that you believe will dominate headlines from a deals point of view in 26? And also promoter exits. I mean, the likes of VIP and so on and so forth played out in 2025. Do you anticipate that being a big theme the next year?
Let's get to the latter one first, because I really believe that's another secular trend. And as you and I both know, for the last 20 years, what used to be a sort of a sign of shame by selling out is now almost regarded as a sign of smartness, because instead of the next gen scrubbing the chimneys in a sense, they're sitting there and managing money. Now, people like Harsh Goenka and Uday may have different perspectives, but to each his own. But on a good note, that shamefulness or the negativism around is not happening. So I see a significant amount of first, second, third generation business selling. And even the conglomerates, they don't need to sell for liquidity reasons, but they're doing it for efficiency reasons. You see what Anish and Anand have done in Mahindra and Mahindra. They've sold off the insignificant divisions, but the stock price is up, I think, what, 10x or 12x?
Yeah.
I'm sure you interviewed Anish, right? So I think that consolidation in conglomerates, as well as the complete exit is what's going to drive us. And given that some of the larger global guys and us in Kedara have focused on the buyout and control transactions, often in deep partnership with the families, I think that is set to grow. In terms of sectors, Shirin, to your first question, I think it's not difficult. It's going to be mostly financial services and consumer. That's what the opportunity set is. Increasingly for us, and then it goes company by company and firm by firm, we've really invested heavily in people on the tech services side in the US. We've taken the ex-CEO of Wipro and a guy called Abid and two others, Chris Baker. So our involvement for tech services has increased vis-a-vis the last 15 years. And we've hired someone really senior on the healthcare side. So I think eventually it'll be opportunities which come up. What are we most worried about is quality of teams and management and ethics. And of course, at the end of the evaluations.
Well, Manish, always a pleasure. Thanks very much for stopping by here in our Davos studio and taking us through what the year ahead could potentially look like for the Indian markets and, of course, for deal making. We are going to take a break here on CNBC TV 18. The conversations will continue. We're right back with you in a moment.
Welcome back. You're watching CNBC TV 18. U.S. President Donald Trump has arrived at Zurich. He is scheduled to speak at Davos in about 90 minutes from now. The U.S. president amped up pressure over Greenland ahead of his speech. Addressing a press conference in the White House, Trump said they will work out an agreement that will keep both U.S. and NATO happy. But there was no going back on Greenland. He said the semi-autonomous island was vital for American and NATO security as the melting Arctic opens up strategic and mineral routes amid Russia and China's advances. Trump's Davos journey was delayed after Air Force One was forced to turn back due to what the White House called a minor electrical issue. The president later switched aircraft and resumed his journey. Meanwhile, security has been beefed up across Davos, with the road leading to the USA House being cordoned off. Trump is scheduled to address the World Economic Forum and hammer through an agreement to get control of Greenland. Reports suggest that he also wants to launch his Gaza peace board during his Davos stay. Meanwhile, there has been a fair amount of pushback by European leaders. French President Macron hit back at Trump's Greenland takeover and saying that they don't give in to bullies. Canadian Prime Minister Carney was more pragmatic. He said while the re-emergence of U.S. hegemony was a rupture and the old world order is not coming back.
I think that we will work something out where NATO is going to be very happy and where we're going to be very happy. But we need it for security purposes. We need it for national security and even world security.
If governance, cooperation gives way to relentless competition. Competition from the United States of America through trade agreements that undermine our export interests, demand maximum concessions, and openly aim to weaken and subordinate Europe, combined with an endless accumulation of new tariffs that are fundamentally unacceptable. Even more so when they are used as leverage against territorial sovereignty.
An American hegemony in particular helped provide public goods, open sea lanes, a stable financial system, collective security, and support for frameworks for resolving disputes. So we placed the sign in the window. We participated in the rituals. And we largely avoided calling out the gaps between rhetoric and reality. This bargain no longer works. Let me be direct. We are in the midst of a rupture, not a transition.
That's a wrap on this special show, but our coverage from Davos continues right here on CNBC TV 18. Stay tuned for that.
MCX IPF presents A Monk Who Trades. You look thrilled.
Yes, my trading account has been upgraded. It says I can now invest in various other products.
Did you check if these products match your investment profile or risk appetite?
But my broker gave me an automatic upgrade.
I need to upgrade to caviar.
Services can be upgraded or changed only with your explicit consent. Speak up if you notice any unauthorized changes.
I'll reach out and get this sorted immediately.
Did you know? Service upgrades or changes to your trading account require your explicit consent. Issued in public interest by Multi-Commodity Exchange Investor Protection Fund.
This is Network 18, and you're watching CNBC TV 18. Presented by Cognizant, Intuition Engineered. Co-presented by Bank of Baroda, India's international bank. State partner, Government of Telangana, Government of Andhra Pradesh, Government of Karnataka, Government of Jharkhand, and Government of Uttar Pradesh. Associate sponsor, Suzlon, powering a greener tomorrow. RRP Electronics Limited, future doesn't wait, neither do we. And BLS International Services Limited.
Hello and welcome to the CNBC TV 18 special from Davos 2026. I'm Shireen Bhan, and it is my great pleasure to welcome the IT Minister Ashwini Vaishnav, who is leading the delegation here in Davos, to join us for the CNBC TV 18 Davos Dialogue, where we intend to put the spotlight and the focus on India's AI ambition, its AI aspiration. Which will be the layer that India will focus on? What will be the strategy going forward? This is also going to be a curtain raiser to the big India AI Impact Summit
summit that's scheduled to take place in New Delhi in February. To talk to us about all of that is, of course, the Minister. But we have an eminent set of panelists here with us representing the best of Indian tech. And we, of course, have a room full of business leaders, global and Indian, to help chart out India's AI agenda. This is going to be a brainstorm, a big brainstorm at that, a participative consultation here live in Davos to understand the next steps that India must take as it charts out its AI journey. Without further ado, Minister Vaishnav, let me start by asking you. The India AI mission has an allocation of a little over 10,000 crore rupees. Separately, you, of course, have the semiconductor mission, both of them running in parallel. As you look at the AI tier cake today, where do you believe India is best poised, best positioned, and what will be the next steps in this journey?
The AI stack basically has 5 layers. The application layer, which is where the AI would be used. Second is the models layer. Third is the semiconductor, the chip layer. Fourth is the infra, data centers. And fifth is the energy layer. We have to play in all the 5 layers, given the size of our economy, given the way our country and our people are so tech savvy, the way our people have adopted technology in the past, the way our IT services and all the 3 big leaders, top leaders from the IT services are present here. They have been providing services, IT services to the world. So I think, and we are at this point of time working on all the 5 layers. Of course, our very big focus will be on making sure that our IT services companies, they keep that momentum and they provide the AI-enabled services to the world. And we will also be having a bouquet of sovereign models, which, as the world today fully understands, a 50 billion parameter model is good enough for doing 95% of the work in the entire economy. So we will be having a bouquet of models, about 12 of them, which are very focused, which are in the range of 50 to 120 billion parameters, which can run on a very small GPU cluster, maybe 2 GPUs or 3 GPU kind of cluster, so that we can provide the services and AI applications at a very low cost to a very large number of our people.
You know, Mr. Vaishnav, let's address the issue of the AI infrastructure build-out. And what we have seen at this point in time, it's largely been pushed by the US and China. Billions, hundreds of billions of dollars invested in building out AI infrastructure. As you see this opportunity opening up in India with data centers and so on and so forth, the role that the government will play, but more importantly, the catalyst that the private sector can play. We have now seen large companies, multinationals like Google, talk about $15 billion investments in India to set up data centers. You've got Kriti here, TCS and TPG tying up to do data centers as well. What is the plan as far as the AI infrastructure build-out is concerned?
$70 billion investment is already confirmed. It's actually getting rolled out. And we think that in next 12 months, there should be another minimum $50 billion investment, and most likely another anywhere in the range of $50 to $80 billion is likely to be added to this 70. So we should be looking at anywhere between 120 to $200 billion total overall investment in AI infra.
As the infrastructure side is concerned, you talked about sovereign models, and work is on there as well. Companies, private companies like Sarvam, and of course the government is also aiding those developments. What's the update on that front?
The models have come out very well, tested on so many different parameters, so many different matrices. The models have really come out very well, and we have tested them in real cases, real live situations in the last few months. And very soon we should be in a position to launch the entire series of models first. And second, many of our startups are really innovating on the way the models will be created in future. In our understanding, and that is what most of the tech world leaders, they say, this is just a beginning of the multi-decade innovation journey. And the first few models, let's say even if we look at the top 10 models of the world today, they are all just a first set of models which have come out. I think one of the tech leaders said that the brain uses just 3 watts of power, and a typical AI chat GPT kind of a large data center would be using thousands of megawatts of power. So that means there is a whole lot of innovation still to be happen, which has to happen in the future. So many of our startups who are focusing on innovation, on better engineering, how to create that next level of model. Where is that breakthrough in the next model? That is what many of our startups are focusing on, which will bring more opportunities for the country.
So what can we expect by way of announcements? Before I get everybody else to chime in, Minister, what can we expect by way of announcements at the India AI Impact Summit? This is a curtain raiser, so give us a sneak peek into what we can expect.
So the AI Impact Summit has three major objectives. Objective number one is impact. How do we make sure that AI technologies get used? There is ROI, there is increase in efficiency, there is increase in productivity, there is multiplier to the economy using AI. That is one. Number two is, how do we make sure that technology becomes accessible to India as well as to the entire global south? And we have created a model of common compute, 34,000 GPUs which are available as a common compute facility to the entire country. Can we have similar models for the world? The third is about how to keep AI safe. We have seen the harmful impacts of especially generative AI, and how do we keep our society safe from those impacts? So these are the three major outcomes expected from the AI Impact Summit. Of course, there are many global leaders who are joining us. There are tech leaders who are joining us. We will be seeing a lot of investment announcements also there. And we'll also be seeing the rolling out of our models.
The rolling out of the models will happen at the Impact Summit?
Yes.
Okay. The budget is around the corner, sir. Higher allocation likely expected for the AI mission?
These are multi-phase programs. For example, semiconductor. We have the first version of Semicon getting almost on the verge of completion now. We definitely have to look at a 20-year journey where we build this industry in our country to a level which is our real position in the world. Similarly, AI is going to be a multi-phase journey where there will be series of initiatives that we take in AI.
Okay, let me open it up now. And Kriti, let me start by addressing the issue with you from the lens of what TCS is doing. And you aspire to be the world's largest AI services tech company. But from your own lens, as well as the imperatives for India, what should the next chapter in our AI journey as a country look like?
See, if you look at from what the traditional lens, most of the Indian companies are good at, the traditional services companies. I agree with what the minister said. He talked about the 5-layer approach, and what in TCS we call it the infrastructure to intelligence. There are multiple layers from infrastructure. There is a model layer, there is application or the agent building layer, and the experience layer on top. And while many of the IT companies in India have not build their own models, but we should not lose fact that the value actually comes in understanding the business context of our customers, ensuring the data for our customer data works for them. And I think that's our core capability. And most of us are focused on that, and you'd see us delivering value from that.
So there's going to be no change? You're not going to go the LLM way?
I'm not saying there won't be change, but don't underestimate what we are doing. We somehow seem to underestimate or brush aside saying, you guys are not doing models, so your legacy. No. What we actually do is making a real for our customers. Model is one component, but making the models work and work for the customers is the most important. That's where the value is.
Well, speaking of value, and to Kriti's point, there was a lot of gloom and doom around the fate of the Indian IT services sector and what AI could potentially do. But each one of you in your conversations with me have said you see this as a tailwind, but you also see this as a reset. Salil, talk me through what this reset is likely to mean for companies like yours, but more importantly, for the sector and for India at large.
So I think AI is genuinely something that is changing both our company, but the industry and India. What we see are huge, large value creating pools of opportunity. There are 6 of them that we've identified. For example, there's a whole set of work on AI engineering. There's a whole set of work on software development and modernization. And those combined have a large value that all of us, all the industry, for the benefit of India will enjoy. And those are growth vectors that we see coming in the coming years. Yes, there are other places where we see some shrinkage, but this growth we see over the next several years compensating for it. So there are practical examples, as Kriti was saying, as the minister was describing, in terms of where we can help global companies. For example, if you're doing something on modernizing the infrastructure, those things were not affordable for companies in the past. Today, with agents, they will take less time, less money, and those become much more affordable, and we are starting to work on those areas now.
Rishad, just to take that forward, because I think the question that's being asked today is, what is it going to do, not just for global growth, but what is it going to do for growth in India? What kind of tailwinds does this provide? And more importantly, the ROI question as well, because, you know, significant investments are being made. What is the realistic return on investment period that we're talking about?
So first of all, Shreen, I think the way you should think about the services industries, any technological change, I believe is good for the industry, because to make that technology relevant inside of large organizations that are complex and messy, that have legacy, that have data that doesn't speak to each other, that's not organized, that are buying companies, that are spread across the world, you need partners to make that happen, right? So the opportunity for both India as well as for companies in India is to really take this and make large organizations adopt it.
You know, sir, we usually have a situation where industry asks the government what the government can do for industry. Let me flip that around and ask you, what is your ask? What is your expectation of industry as we make this journey?
So we have been working very closely. In fact, I'm on one-on-one conversation with most of the industry leaders already. And that has been the practice in the past also. For example, our entire semiconductor program was basically designed by the industry partners. Same is the case of AI program. AI mission is all designed by the industry partners. The one ask which I've been requesting all the industry friends is, help us develop the course curriculum for AI world, this fifth industrial revolution, so that our students who come out of the colleges, they are well prepared for it. Like in semiconductor, like in 5G, We developed course curriculum, went to AICT. We used the industry knowledge for creating those courses and went to AICT and got those courses implemented. Same thing we would like to do in AI, and all the industry participants are working on.
Well, you know, we are in Davos. The theme of Davos is the spirit of dialogue. So in the spirit of dialogue, I'm going to throw this open and get recommendations, suggestions from each one of our business leaders here on what India must focus on, the India imperatives to meet our AI ambition and our aspiration. Jeetu, I'm going to start by asking you, you've of course been a long believer in the India story. Cisco's been a committed investor in India. You know, what do you believe the next steps need to be? What do we play to ensure that we maximize our strengths?
Well, so firstly, we are just honored to make sure that we continue to partner with India. We've had a fantastic relationship over the course of the past few decades. And, that continues to keep accelerating. I think the biggest reason for the success is the public-private partnership that we have with the Indian government. You almost feel like you're working with a startup. And the agility with which the government works is truly remarkable. So thank you again, Minister, for all the support that you and the others in the government have provided us. I would say that, look to Cisco for providing, technologies for the infrastructure build out of the data centers, low latency, high performance, kind of energy efficient networking that goes across your data centers, safety and security capabilities, and then also the data side of the house, where we've actually trained these models largely based on publicly available data. But as agents start to come about, there'll be machine data that's actually going to be the fastest amount of growth. 55% of the growth is going to be happening with machine data. So I'm hoping that machine data getting correlated with the human-generated data that we've trained the models on provides different insights for resilience as well. So we're excited to work with everyone. I think all the gentlemen on stage here, we have close partnerships with, and I'm pretty sure that it's only going to get closer and closer over time.
Will India be the agent provider to the world? Rishad, Kriti and Salil, let me get a quick word in from you.
No, we should be the solution provider. If agents come in the play, we should focus on building agents out. We should not think about the input material, we should think about the output. So yes, we will build agents, but to solve business problems.
Kriti?
I fully agree. As I said, India will make a real for our customers, whether it's agent or with something else. But our role will be a solution provider.
Salil?
So what was discussed earlier, our knowledge of what's going on in large companies is so deep that we will be absolute solution providers. Already, each of us, the whole industry, are creating so many agents available on different platforms. So very much part of that agent journey as well.
Well, let me also bring in the non-techies into the conversation and understand from them how they're looking at the AI journey. Anant, let me get a microphone across to you. And, from a manufacturing standpoint, what's the kind of adoption that you're seeing, and what do you believe the next chapter will be?
So last evening, we were at dinner and heard an interesting statistic, which I think seems to be intuitively true, that 90% of corporate India is adopting AI in some way. About 10% are able to scale up AI at a larger level, and 5% are able to see bottom line impact. So it's 90, 10, 5. The worry is that over time, the positive is that over time, this 10 will go up to 20, 30, 40. As that happens, productivity will go up. But what happens to jobs? So we are a young country. We do feel some challenge out there. We are looking at our approximate, say we are in the tire business. We find that our factory has about 2,000 people. The next factory may be about 1,000. So we're not talking about 10% productivity. It's about a 50% productivity improvement. So while it's good for ROI, on the other hand, it is a serious job issue.
But Minister, to address the point that Anant was making, and I know that this is something that not just our government, but governments around the world are grappling with, that what does this move towards more AI do in terms of the entry-level workforce? How does it disrupt the jobs market? What will it do structurally to the labor market? Are we prepared for that? How are you thinking about this?
It's actually a very complex problem. And one clear way that we have adopted is to make sure that our youth are getting the right skills, the right training, and the right knowledge about AI, so that they can be the solutions providers, as the three IT leaders have said. They can be the solutions provider to the world. They can be the, for example, what Anand said, if we have to set that next factory, why can't we become the global manufacturing hub? So we'll have to look at the global market as a market, then the absorption of our talent, absorption of our people will be much better.
Nigel, you wanted to come in? We've got the microphone there. Yeah.
Yeah. I think, like the minister said, I think from a Sapient perspective, our belief is there's two stories here, right? There's India for India and India for the world. And I think the India for India story is incredibly powerful with the digital public infrastructure, providing essentially the context for citizen-enabled AI services, probably in a fashion that is almost unparalleled anywhere in the world, not only because you have the public-private partnership, but you have the public-private infrastructure, which I think is missing in so many parts of the world, in particular the global south. And we sit in sort of two camps. We have a lot of engineering and technology folks, but we also do a lot of communication and connecting brands and consumers. And I think that's where the India for India story will probably generate models that can be replicated outside of India, which is the India to the world. And like the minister was saying, whether it's in the context of healthcare, in the context of retail, there are so many unique India models that are actually more apt for the future of where AI is taking consumers and business than historically countries like the United States and others, which have made large investments in legacy, which now first need to be modernized and transformed in order to see the value. So there is a leapfrog element that's pretty powerful.
Sumant?
Yeah, no surprise. I'm going to talk about the couple of stacks that you mentioned out of the 5, which is really the energy and the infra part. India's power demand, as you know, is already growing at 6% a year. So we're already struggling to find a way to provide all of that growth from a supply standpoint. AI demand growth is going to be really, in some ways, on top of that. And as we look to try to localize more and more data centers into India, both for within India, as he said, as well as for exporting to the world, that power demand and power supply is going to become a bigger issue. Now, I know that you've addressed that same issue when you were as Minister of Railways as well, but this is something that is going to actually require solutioning. We are very excited about actually playing in the infra space on the data center side. But we need to do actually some degree of work on making sure that the appropriate substations are created, around the data center locations that are coming up, and that connectivity, for example, has already become a scarce resource. Those are things that we need to address as well, along with the whole growth in AI that is obviously so exciting, and you all are doing so much great work to
And I know, Minister, that you've, of course, also now started to look at the opportunity from nuclear. We've just seen that bill pass through Parliament, small modular reactors. That could be an opportunity that India starts to consider and build out. How do you address the energy challenge as well?
In the AI world, energy will become a very important ingredient. And that's why we decided to open up the nuclear sector to the private sector. The global trend in nuclear is basically of 2 different types. One is, of course, large conventional reactors. Second, there is huge investment, rather huge effort going on in innovation. And I wouldn't be surprised if in a few years from now, we see nuclear plants, which are micro-nuclear plants, not even SMRs, but micro-nuclear reactors which come in a container, some 20 megawatt power coming in a container, and which has its own safety features inbuilt. There is a lot of research going on in passive cooling, where molten salt and those kind of technologies, if anything goes wrong, it just solidifies and the system basically shuts down automatically. And then the safety increases multiple times. In a large reactor, you cannot do that. But in a small container, you can basically say that, okay, fine, this thing didn't work. We can move on to a next set. So those things are happening. So I think this problem will also get sorted out.
So let me wrap this up, because we've got a lot of interesting suggestions, recommendations, comments that have come in. But let me wrap this up. I want to reframe it, because very often in forums like this, you hear about, will India catch up? And I want to reframe that to pick up from what Nigel said. Where will India lead in the AI race? Salil, let me start by asking you 10 seconds.
So India is, I think, already leading. The way we are going to lead is first on talent, and the way we're going to transform both India and the global companies.
Kriti?
Definitely talent. And also, I think there was a point that came up in terms of manufacturing. I think this is the moment. Actually, AI is going to spur India into major manufacturing powerhouse.
Rishad?
No, I think with talent, Shireen, we're going to help consumption of this infrastructure spend that's happened by solving real, purposeful use cases, both for enterprises as well as for governments and citizens.
Minister, the message to investors who are looking at India, both domestic and foreign.
Listen, we have been a country and a population which has adapted, which has used and which has innovated in technology on a very large scale. India will definitely lead in the top layer, the application layer, the usage layer. Certainly we'll have a very significant presence in the model layer. Some innovations which are happening in the chip layer are very, very significant. And if any one of them actually breaks out, we might actually have a major presence in the chip layer also. Infra layer, 70 billion and might go up to 150 billion. Definitely there's a major presence. And nuclear, of course, will be among the users.
We will be among the users. Well, in the spirit of dialogue, we have, in fact, ladies and gentlemen, live here on television, brought to you together many, many disparate ideas, but with a common thread of what India needs to do to set its AI agenda for the future. Many thanks to the Minister Ashwini Vaishnaw for joining us. Salil Parekh, Kriti, Rishad Premji, thank you very much. Many, many thanks to all of our business leaders. I know you've got meetings, dinners, and everything is running on an assembly line, so appreciate you taking time out to join us here. This is important. It's an important conversation for India. So thank you to everyone for making time for us. With that, it is time for us to wrap up the CNBC TV 18 Davos Dialogue. Do remember to send us your comments, your suggestions. We always like to hear from you. We'll see you again after this very short break. For now, thanks for watching. The choppers are flying in. The protests have erupted. Hello and welcome to our continuing coverage here from Davos 2026. I'm Shireen Bhan, and it looks like the eagle may just have landed. It is Donald Trump Day here in Davos. The president did face a technical snag on Air Force One. He had to go back, board another aircraft, and so there was a delay. But all indications suggest that he is now
here in Davos. He will be addressing the World Economic Forum's annual meeting in a short while from now. There will be a reception that the World Economic Forum will host with business leaders. And he's also going to sign the Board of Peace. Of course, big question mark on who else is going to sign up for that. But joining us now for a conversation on all things Trump, tariff and geopolitics and geoeconomics is Geeta Gopinath. Geeta, great to have you. It's all happening right here live on television. Let's start with what President Trump has done to the global economic order and what this reset could potentially mean for global growth.
So, Shireen, as always, a pleasure to join you. Like I say, this movie is not over yet. It's not going to be over even after his current speech. You know, what comes tomorrow could be very different from what he said today. So he certainly is setting the agenda, for sure, for the world, for what's happening in Davos. Everybody is hanging on to every word of what he says on the global economy. So we'll see. I mean, this is a strange time. I think a lot of people expected that there was going to be geoeconomic fragmentation, the geopolitics was going to play a bigger role. But I don't think anybody expected that this would happen within the West, that the US and Europe would be against each other. And that's truly the big news of 2026.
It is clearly the big news of 2026. But Geeta, let's talk about the tariffs for a moment now. And we don't know which way the Supreme Court will rule. And even if it rules against President Trump, you know, all indications from the administration are that they will, in some form or fashion, bring the tariffs back, and the tariffs are here to stay. So far, we haven't seen an impact or a significant impact on growth or inflation. But how are you looking at that?
We should always make the distinction between the numbers that get announced and that make the headline and the actual tariffs that are being paid by U.S. importers. So, you know, if you look at that, and we did some research on this, and if you look into it, the actual tariff rate in the U.S. is about 14%. The statutory rate is more like 24, 25%. So this is a fraction of what that statutory rate is. That's part of the reason why tariffs have not been that consequential for the economy. If you take a 14% number, then I think the way it's played out is pretty much what you would have expected it to. It's added about 0.5 to 0.7 percentage points to U.S. inflation. It has slowed the economy some. It's been a headwind. But the U.S. economy and many other economies have actually benefited from the AI boom, the investment in AI, the stock market boom, and the effect that has had on consumption. Also fiscal stimulus in China, in Germany. In the U.S. this year is actually going to be expansionary. All of those are offsetting the headwinds from tariffs.
You know, I'll come to AI in just a second, but I want to talk about rates and, more importantly, what's happening with the Fed. And you've also come out in support of central bank independence and in support of Jerome Powell. But what does this mean, this sort of DOJ, investigation into the Fed? What does it mean for the Fed, not here and now, but in the medium to the long term? And what does it also signal to other central banks and other administrations around the world?
Yeah, what I worry about is, indeed, you know, it's less about Jay Powell right now because he's got a few more months left and his term is over in May. And I don't think any of these criminal investigation is going to stick. It's not going to play out. But the action sends a kind of a chilling message to everybody else on the rate setting committee that basically says that, you know, if you don't do what we would like you to do, then you could be subject to some serious investigation and the state machinery could be at you. That's what I'm worried about, which is why I really welcome the very strong pushback that has come, not just from central bankers around the world, but also from within the U.S. I think the U.S. Senate, there have been Republicans too who have come out and said that this is really unacceptable. The stronger that pushback is, and there's also an important Supreme Court decision that's going to be made on Lisa Cook. That matters too, and where that lands will make a difference. But this is kind of, you know, this is unheard of that you would ever think that something like this that could happen to not just a central bank, but to the most important
central bank in the world. Yeah. Well, speaking of the central bank, a decision on who replaces Jerome Powell is expected perhaps within the week or, close enough. Kevin Walsh, Kevin Hassett, what are you going with?
I think, it could, what's changed in the last couple of days is that maybe it would not be Kevin Hassett because frankly, that was a fallout of the whole criminal investigation on Powell and Republicans pushing back and saying, no, 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 we want an independent central bank. But that said, I mean, I still think Trump probably places all his trust in Hassett, and that still could be Hassett. Or it could, frankly, it could be neither of them, and it could be another third person completely. You know, we're full of surprises every day.
Yes, and we just have to wait to see how this plays out. But I want to talk about rates, Geeta, and irrespective of what President Trump says and the amount of pressure that is imposed on the Fed, what do you see as far as rates are concerned in the near term?
The U.S. economy is actually in good shape, thanks to, you know, the AI-driven boom that's happening over there. But also consumers are in good shape. The balance sheets are doing well. Labor markets are softening, but still, it's a fairly strong labor market. So all of that, and including the tax incentives from the One Big Beautiful Bill, the interest rate cuts that have happened so far, all of that, you know, create an expansionary force in the economy. So then the question is, how many rate cuts do you expect? And, you know, a couple are being priced in, that there could be 2 rate cuts this year. I think there's a real risk that we could have higher levels of inflation, partly that come from tariff pass-through that didn't happen as much last year, especially if the tariff talk doesn't die down and companies think, well, this is going to be an ongoing game. They can't absorb more and more of it into their margins, which is what they've done. So more of that will be passed through. Nobody in the market is pricing that the Fed would increase interest rates, right? So either because of inflation, the Fed raises interest rates, or if there's a concern about central bank independence and it doesn't do so, both of those will cause, you know, the long end of the yield curve to go up, which means tighter financial conditions.
AI, and that's the big tailwind that you were speaking of, and that's what people are factoring in as far as you know, the U.S. growth is concerned specifically. But you know, there is, of course, the camp that says we're already in bubble territory. But on the other hand, you have people saying, look, the technology is real. The companies that are backing it so far have, you know, their fundamentals are strong, so there are no concerns necessarily there. How do you view what's happening on AI, the kind of concentration of power, as well as the concentration of investments?
So firstly, I think we can have both. We can have that AI is a truly transformative technology that raises productivity growth and GDP growth, while at the same time, the stock markets are overvalued, and it's hard to see how all the current incumbents can make the scale of profits that they need to make to justify the investments. And the reason is because productivity is one thing, being able to monetize it
is an entirely different matter.
Other thing. And given the level of competition we have right now, and it's not just among U.S. firms, and not just those listed on the market, but those also off the market, like OpenAI and Anthropic.
Absolutely.
But then
We're
also
looking to go
DeepSeek in
public.
China.
Yeah.
Multiple sources of competition that exist, and this thing is moving very fast. So it's hard for me to see how, you know, any particular one of these companies has a good enough revenue-generating model, a profit-making model that is protected from new, new developments in this space. So that's why I don't think we should mix the two up. I actually do think it's a transformative technology. At the same time, I do, remain a bit skeptical about the kinds of valuations that I'm seeing, not just of the firms listed on the market, but also the ones that are at this point not listed on the market.
So, and I don't want to go down accident territory, but what could potentially cause an accident on this sort of big AI magical tour that everybody's taking?
So I would say first, if another DeepSeek-like event or two more of those happen, which basically says, okay, you can have another company that comes in, spends a fraction in terms of investment spending, and is able to produce almost the exact same product, then any company that's investing trillions of dollars is underwater. That could be one. Second is if inflation surprises on the upside and the Federal Reserve has to raise interest rates. In fact, that's what happened before the last dot-com bust, was that the Fed raised interest rates by 175 basis points. That was the beginning of the bust in dot-com.
The likelihood of a bust, though?
It's very difficult to pinpoint exactly when that will happen. I actually think some of the bubble was kind of squeezed a bit towards the end of last year. We've seen investors have become much more discerning about where they put their money, which AI stock, because they're all asking the question about who is likely to be profitable and be able to justify the level of investment that they're doing. So in fact, AI stocks kind of moved flat, but in the last quarter of 2025, that itself means that some of the air is coming out of the bubble.
Yeah.
But again, we still have very easy financial conditions. And we're in this world of geopolitics, as you and I are seeing right here in Davos, and all kinds of explosive messages coming out of all heads of state.
Yes.
And if there were truly an EU-US tariff war, because so far, there's been a tariff war, but it's been one-sided, which is the US has imposed it and the EU has not retaliated. But now they are threatening to retaliate. If they do, then I do expect markets will react much more strongly.
Much more strongly to possible retaliatory tariffs from the EU. But speaking of explosive statements from heads of state, I think the one addressed here in Davos prior to President Trump's arrival, Mark Carney. But, to the point that Mark Carney is making about, look, let's not pretend like we were all playing by the rules of the game. What does this mean in terms of multilateralism in general? But to also his point about these medium powers, how do you see that shaping up in this intense sort of geo-economic confrontational era?
The previous order, I would say, of the last 80 years after the Bretton Woods institutions were created in 1944, was held up to an important extent by the middle powers. So it was created by the great powers of US and Great Britain at that time, but it was held up by the middle powers because middle powers are smaller economies. They can't rely entirely on their domestic economy to grow. So for them, it's critically important to have predictable rules because you rely on international trade, you rely on international finance. So I think, what Carney says is correct, that the middle powers have to come together and figure out a way to bring more predictability into the system. And that could very well be that, you have a coalition of the willing. Maybe not everybody is a part of that coalition. Canada is going and making, greater friendship. Yes, they're going to Beijing.
As is Germany.
Indeed, and European Union has signed that agreement with Mercosur, South America, which they've been working on for years.
And likely to ink one with India, which they've also been working on for years.
Exactly. So those are real changes that will happen. And, it's very possible that we will step back from the cliff and there will not be a full-blown tit-for-tat war between the US and Europe. That's likely. But I don't think we're going back to the way things were before 2025.
Yeah, there's no going back is what you're saying. But also, and again, there is a lot of chatter around this that the world is going to get by without the US. The likelihood of that?
Oh, that's going to be very hard in the near term. I mean, it's not possible. Firstly, the exposure the rest of the world has
to the
US is huge. It's not just in terms of the consumers and the large scale of the market that exists, but also just the investment in the US markets, both in terms of bonds, in terms of stock market, equities more generally everywhere. And the dollar, the critical role the dollar plays everywhere. So no, decoupling is not an option at this moment.
And dollar dominance?
Dollar dominance will hang on because of the lack of great alternatives at this point. I think it's been eroded at the margin already. That's been true. Gold is looking very exciting for everybody. They're moving towards gold. But in the absence of any other fiat currency that has the kind of depth of financial markets that the US has, it's hard to move very quickly to an alternative.
I want to talk to you about India, Geeta, and what you make of how India is held up. I mean, growing at 7.3%. The IMF says 6.4% for next year and the year after. How's India placed in all of this?
So India's growth is, one of the highest, is the highest among the major economies of the world. It is going to become the third largest economy. It's just a matter of, a couple of years. Based on current numbers, it would be 2028. If it's able to sustain this level of growth, it will be able to raise per capita incomes, which is the true challenge for India right now. And we are seeing good reforms happening in India. I think the public infrastructure, both the physical infrastructure, the digital infrastructure, both have been, truly transformative for India. But there are challenges with creation of jobs, with land acquisition, with judicial reforms. All of that needs to still happen.
The currency, and we've seen the rupee move to 91.50, and it's been a very swift and a severe fall in the last few weeks. What do you make of that and the implications of that, and whether or not we should see much more active sort of intervention by the RBI.
So to understand what's happening to the rupee, I think we have to keep in mind a couple of things. One is that because there was a loss of intervention by the RBI in 2024, the rupee did not depreciate as much as it would have. It kind of went sideways. So a bit of what we saw in 2025 was just undoing that pressure that was keeping the prevent the currency from depreciating in 2024. So it's a bit of catch up, right? And then there's the other piece, which is the fact that, you know, if you look at Indian equity markets, they've always been viewed as being stretched in terms of valuations. They were more stretched in 2024 than they were in 2025. But you saw a rotation of money out of India back into China, you know, back into other markets, including Japan. And so that portfolio outflow, combined with this tension around trade and tariffs with the US, has added to the pressures on the rupee.
The India-US trade deal, the likelihood of that actually getting done in the next few months?
It's hard, very hard to tell. I mean, I think usually all of this gets sorted out only at the highest level. So it's going to come down to President Trump and Prime Minister Modi.
And actually picking up the phone or meeting with one another, we don't know how that's going to work out. But, you know, what would you be most concerned about, Geeta? We talked about some of the challenges that the world is facing today. What would be your biggest risk that you foresee?
The biggest risk is a financial crisis. You know, we've had 5 years of a pandemic, war in Europe, the Fed raising interest rates by a lot, and still we've not had a financial crisis in any emerging market or any developed market of the world. The expectation is always that there will be the government or the central bank that will come in and save the day regardless of what happens. Governments are now sitting on very high levels of debt. Central banks have very large balance sheets, and they do have to deal with an inflation problem too. So whether they'll be able to come in and save the day, I think is a question mark, and I'm not sure, you know, we can sit comfortably that we will always have an escape hatchet to get ourselves out of a crisis.
But before we get to the escape hatchet to get ourselves out of a crisis, what could get us into the crisis? What could be the trigger that could lead us to the crisis?
If there is a major tariff war, which is two-sided, between the US and the rest of the world, so far it's been one-sided. The only country that's truly retaliated is China. And whenever the US imposed tariffs on China because the markets expect retaliation, you see markets drop. That's part of the reason why there's now a pause on tariffs, you know, the big increase in tariffs on China. If the rest of the world were also going to retaliate, and this was going to be tit for tat, that would be one trigger.
That would be the trigger. But jobs, Geeta, and I want to address that issue because that is an issue that governments around the world are grappling with, including, of course, India. And, you know, as we talk about AI and scale deployment and so on and so forth, what's the outlook on jobs? You know, the World Economic Forum in its report says that there will still be net addition, even though there will be displacement of jobs. How are you seeing this, and whether we are prepared to cope with the challenges?
This is a challenge for India, I think I would say a bit doubly, because given India's size of labor force, given how it's grown, which is since the 1980s, only about 30% of its growth has come from the labor force, right? So, you know, we talk about the demographic dividend, but India's growth has been very capital intensive, even now. And there's lots of reasons for that, including the lack of labor market flexibility, the skills that exist, and so on. So we're starting from that point, and on top of that, you add another automation technology to services, which is where India was strong and exporting, you know, BPOs, call centers. That's where India was getting a lot of its export revenue from. That's going to disappear. Just pure coding, simple exercises, that's going to be affected too. So how quickly all of this plays out will determine whether there's enough time to create new jobs and new tasks for people to get back into. But I am worried.
Well, speaking of new jobs and new tasks, post the IMF, you're back to teaching, you're back at Harvard, and I believe you start on Monday.
I do. I'm going back and teaching my first PhD class back after I return.
And how does this feel, I mean, post the IMF to go back to class?
It's actually great because, in a sense, it's after having seen everything over the last 7 years that I was at the IMF, and particularly turbulent times, though those times haven't become any less easy, it gives me a very fresh perspective on what is it that we teach in academia, and I'm looking forward to sharing that perspective with the students.
Well, Geeta, we wish you the very best of luck as always. Thanks so much for joining us here in Davos, and we look forward to hearing more from you when you visit us in India. But thanks so much for your time here today.
Thank you. Always a pleasure.
Well, that is Geeta Gopinath on a whole host of issues, from tariffs to, of course, AI and the impact that that's likely to have, rates, central bank independence, and more. Catch this interview on CNBC TV 18 at your leisure. It's available on our YouTube page and on our social media pages as well. But for now, we're going to take a break. We'll be right back with you. Stay tuned to CNBC TV 18. Our Davos coverage continues. Welcome back. Our coverage continues here at Davos 2026. It is all happening here. The protests are on. President Trump is expected to speak in a short while from now. And joining us to talk about Wipro, 80 years and on, is Rishad Premji. Rishad, thanks very much for joining us on in our studios here in Davos. Let me start by talking to you about that. I mean, it's an 80-year-old legacy that you're now trying to take forward into an AI era. You know, everyone's talking about what they're going to be able to do in the AI world. What is going to be the USP for Wipro specifically?
There's never a dull moment, right? You know, look, it's exciting. It's exciting to have completed 80 years. We started before the independence of India. We started as a vegetable oil company, and to now become a technology powerhouse is obviously very gratifying, very humbling. And you know, the nature of technology is it's changing all the time. And the beauty of the services model is any change, I believe, deeply creates an opportunity. Because we focus so much on the technology, but the utility of the technology is its implementability inside of organizations, right? And how do organizations scale it and make it real inside of them? And so there's a huge opportunity, and I'm incredibly excited as we look out into the future.
You know, while you say it's a huge opportunity, and I'll come to the opportunity part in just a second, Rishad, but it continues to be a difficult period for the company in terms of growth. I mean, you know, you've been attempting this turnaround, which hasn't quite played out perhaps the way that you wanted it to. Certainly hasn't played out the way that the markets wanted it to. So what's going on there?
No, look, I think there's a little bit of sort of challenges on sort of deals converting into revenue. I think we've had a decent quarter. We were in the midpoint of our guidance. We did a great job on margin expansion. We've guided arguably a little soft compared to what the market was expecting. And I think, look, there's huge opportunity going forward. I think the deals will convert, and once they convert, they will see upside on revenue. The good news also is, Shireen, is a good pipeline. And that pipeline is transacting. The pipeline is on 3-4 different areas. 1, it's on transformation. 2, it's on cost. And 3, it's on AI. So, you know, it will be a bit bumpy at times, but I'm hopeful that if you look out...
How bumpy is it likely to be before it starts to smoothen out?
Look, you'll have to wait and see how that unfolds, right? There's always pressure on cost. There's demand, but there's pressure on cost. And I think...
Are you seeing an added pressure on cost today?
No, you're seeing the pressure on cost that you've seen. You know, customers are certainly focusing on cost consolidation, vendor consolidation. But there are opportunities that are emerging amongst that. You know, I think we've done a neat job of winning our fair share of consolidation. Our order booking is up 25% year on year. Our large deal order book year to date is up 75%. So those things give me comfort that, look, once that order booking converts to revenue, things will look different.
And what will be the tipping point, so to speak, to really get that conversion going?
No, just customers are just delaying in starting up the ramp up. And once that delay sort of unfolds, you'll start to see it.
Okay, let's talk a little bit now about the AI play. What is the opportunity set that you're going after? Is there a number, you know, in terms of the addressable market that you intend to focus on specifically?
Right. Look, our opportunity is how do you take this technology and make it real inside of organizations by deploying real use cases, right? The challenge today for deployment is that there is not enough context understanding, there's not enough domain understanding, there's not enough workflow understanding for that specific company, right? That starts with having the right data that's curated right, fine-tuned into the models, then be able to make it applicable to be able to solve real problems. So there's a huge opportunity, I think, just to drive that journey, both the curation of the data as well as just building out and fine-tuning that data to make it relevant, building out those use cases and managing it, right? We spent a lot of time and effort.
Excuse me, sorry.
We spent a lot of time and effort, Shireen, on building out our own unified sort of suite of offerings around AI called Wipro Intelligence. And there are really 3 components to that. One is we're building out platforms, both industry platforms, so platforms like, you know, in the health space called Payer AI, or you know, in the airline space called TOPS and Chromis, so very specific industry platforms. Okay. And then we're building out delivery platforms, something we call Wings, which will help us run and operate the work that we do for customers today. And then something called Vega, which will help us build out software, help us build out products, help us build out models, help us build out agents. Everything we do today in the organization and work with customers uses one of these 2 platforms, both to deliver work better or to help change the game for customers in these context domain-specific opportunities.
But how is
and so if I may say one more thing. And so the whole journey is about how we lead an AI-powered story for the company that's very consulting-led, right? And so you'll have to further build out your consulting efforts. And so what we've done with our Capco acquisition a few years ago, which is transacting quite well for us in giving us deep expertise in the financial services space. We bought a company many, many years ago in the energy space. We're building that out in a few other industries. So trying to get more and more strongly domain strong as you build out this journey of making relevance of the horizontal technology to be applicable inside of large organizations.
So where are those industries that you want to double down on in terms of focus, where you want to add capabilities, and it could happen by M&A as well?
Right. No, so it'll be where we have customers that we serve deeply, where we understand the process deeply. So it'll certainly be our big industries, you know, banking and financial services, consumer, energy and utilities. Those kinds of industries certainly will be industries where we spend more of our time and effort. We will build them out wherever we understand the context and the value of that specific customer. And that's why it's very interesting as well. If you look at the BPO companies or the BPO opportunity, despite all the noise, those companies are actually doing pretty well. And the reason for that is because they understand the actual underbelly of how things transact inside of the organization. And so there's huge value to bring that understanding together with the technology to disrupt the way you serve.
You know, when we were chatting yesterday on the panel, you know, this business of why didn't you guys use your capital to innovate more, to do large language models and so on and so forth, and has the Indian IT services sector missed the bus in an AI era? How do you respond to that?
You know, everybody keeps asking that question, and look, my philosophy is you've got to focus on where you can drive differentiation within the stack. You can't play every element of the stack. The services model is based on services, which is based on people, which is based on talent. Our strength and differentiation comes in leveraging talent to deliver solutions to our customers, leveraging domain, leveraging platforms, right? And so driving that combination, and that's where our strength comes, and that's what we're focusing on. Significantly AI-fying our talent with basic skills, with advanced skills, with mastery skills, building out the platforms which are both sort of industry-specific and domain-specific. And then, by the way, the other big thing is just the whole ecosystem, leveraging the capability that comes through Wipro Ventures, which is now a $500 million fund, through our partner labs, through our innovation network inside of most locations across the globe. So bringing both what's happening outside the organization, what's happening inside the organization, and your talent to always solve specific problems for customers.
I'll get to talent and Wipro Ventures in a second, but, you know, in light of what you've just talked us through, what does it mean in terms of new revenue streams? What does it mean in terms of incremental revenue for the company, and by when can we start to see that accrue?
Right. Look, I certainly see this year being a year where customers will activate more from the pilotization phase to the more scaling and productionization phase. Use cases still in many cases are low-hanging fruits, they're task-based, but that journey I think is starting to begin, right? So there's going to be more and more activity around how customers spend on AI. There's a huge opportunity from just the whole advisory piece, helping a customer think through the journey of where they want to focus, how they want to prioritize, the whole focus on data, the whole focus on just modernizing your enterprise to be able to leverage the data to be able to solve problems. So with the data, the curation of the data, the fine-tuning of the models, the identification of the use case, the building out of agents, the orchestration of agents, the managing of the use case, the constant development of the use case. So there's going to be, this is the classic services model, how services companies have played out for many years. And I think there'll be opportunities in each of those paths. I certainly see a lot of opportunities, which may seem very unglamorous today in terms of the kind of work around just data curation and data sort of annotation and those kinds of things, right? Which actually are necessary for you to be able to drive any value coming out of the models.
So what could your AI revenue look like?
Look, you know, we're already thinking through how do we define that, because you don't want to get to a place where you're defining a number and the overall number isn't moving, point number one, right? You can see some of our peers reporting numbers and they're reporting very different kinds of numbers, right? And the argument, everything can AI-fy, so arguably everything in your business over time can be that. So we're thinking through the relevant metric closely, and when we're ready, we'll share that with our investors.
So let's talk a little bit about people as well. And as you said that, you know, if you're going to move more down the sort of consulting route as far as building out these platforms are concerned, what is it going to mean in terms of net addition of people, but also the kinds of people that you get on board?
So look, one of the things, if you look at most of the services companies, including us, you know, net we've actually hired people year on year, or, you know, we've not decreased people. And so this myth that the jobs are going to disappear overnight, I'm not so sure that will happen. Certainly there will be productivity, and that productivity will be replaced by more work, and that is something that's unfolding. the way we think about jobs is we think about them in sort of 3 or 4 folds, right? One is jobs that will get disrupted out. AI will replace those jobs. 2 will be jobs that will get enhanced by AI. 3 will be jobs that will get created by AI, which is different than enhanced by AI. And 4 will be human-only jobs, right? And our focus is on how do you get the jobs that are going to get displaced by AI to sort of be retrained, repurposed to move into the second bucket or the third bucket, right? The challenge of the second bucket is a real challenge because you've got to get, it's a big change management agenda as well. You've got to take people along to make them realize that if they don't get AI fluent, they're going to get left behind. AI fluency is the new currency for any job, in my mind, whether it's a tech job or any job. If you're not able to use and work with technology and work with AI, that's going to be a challenge. So the change management agenda, giving people comfort that, hey, look, if you don't embrace and adopt, you're going to get left behind, as opposed to if you do and your job disappears, you're going to get left behind. And so the other challenge for large organizations, including our customers, is just diffusion of technology, adoption of the technology on scale. And so that's a big, big focus, both inside of Wipro and then with customers. You know, it's interesting, Shireen, one of the biggest conversations we have, or the most relevant conversations we have with our customers is you as client zero. So they ask you, look, you're a complex, messy enterprise like the rest of us. What are you doing to adopt AI on scale? What are you doing to take your people along? And that's the most interesting journey for customers. There's a lot of learning there, which we also leverage in our journey with customers.
So how AI fluent is Wipro today?
Look, all of our 240,000 people, almost 100% of them are trained on basic AI skills, including me, including some of our board members. You know, we have about 95,000 people on advanced skilling and about 80,000 people on mastery skills. We have about 1,000 people who are building out these AI-specific industry platforms or delivery platforms or industry-specific solutions. So there's a lot of effort, time and energy that's going in really building out the skills and then leveraging the skills to build out stuff that can be useful to customers.
So is Wipro Ventures going to essentially be looking at how you can enhance your AI capabilities?
So Wipro Ventures is our way of how do you participate with cutting-edge organizations that are building cutting-edge solutions across the board, and how do you bring those capabilities into solutions that you're taking to customers. So many of our investments are in the space of AI, right? From the operations layer to the agentic layer to the scanning layer to the ROI layer. That's the other challenge, by the way, in AI. You know, the challenge is true traceability to returns on investment. And that's still a journey. Most people don't have clear traceability that I'm driving this productivity. Where am I seeing the value to the bottom line? And that also will be a journey which will unfold over the coming, the coming year or so.
So, and here's what I'm trying to understand from all of you. How does this change the business model? You know, this move to AI, what is it going to mean in terms of pricing? What is it going to mean in the way that deals are done? How does it change the business model per se?
It creates an opportunity. It creates an opportunity to participate in a new spend pool. 2, I think it creates a level playing field because there are new skills that are required. So what got you here so far may not get you going forward, right? 3, it will be bumpy because at times you'll have to disrupt yourself and serve yourself customers differently by doing less to get more in the future. And that can be bumpy. And that's why I talked about the bumpiness earlier. And I think 4 commercial models will change. We've all historically priced on a fixed price basis and a time and material basis. And that is changing more and more to be outcome-based, value creation-based. And again, you know, we're early on in that journey, but very open to experimenting with different kinds of models because they'll have to be a win-win situation. So those kinds of things, I think, will change. Now, how quickly it changes, when it changes, it's a journey. You know, if I had a crystal ball, I would tell you, but I don't.
But and to your point about the road ahead being bumpy, and I'm hearing this from your peers as well, that, you know, the move to more outcome as a service model, will that increase the bumpiness, you know, as far as the way that pricing is done?
It'll just make it can make it more lumpy at times. It can make it a little bit less predictable at times. I think that will happen.
Is the market prepared for that?
The market is moving in that direction. Customers are demanding that. So you have to embrace it.
No, I'm saying, is the stock market prepared for that, you think?
Well, the stock market will have to prepare, to prepare to how the models evolve. And, you know, we as industry and we as companies will have to educate customers as to how the model evolves. But the model will evolve, and you can either participate in it or get left behind.
Well, and, you know, so you firmly believe that you're not being left behind, and that Indian IT services companies will continue to lead the charge in their own way in an AI era.
Look, I'm very excited. I'm excited about the future of IT services, Shireen. I'm excited about our future. I think we're driving a lot of the relevant things. I think we're investing smartly on our whole Wipro Intelligence journey. I think it's showing up impactfully in the way the analysts see us, in the way customers see us. I'm excited about the deals we're winning. I'm excited about the deals we're participating in. So I'm just excited about the future, you know. And I'm not commenting on a quarter-by-quarter basis, but I look forward to the next 3 to 5 years, and I look forward to our journey, and I look forward to the industry's journey.
And you think in the next 3 to 5 years, Wipro will look like a very different company?
I think we will have to look like a different company, just given the nature of where the model of services in the AI world is moving. Now, how does that exactly look? I don't know, but I know it will look different.
Well, Rishad, we wish you the very best of luck as this journey unfolds, and may it be less bumpy and smoother than you anticipate. But appreciate your time. Thanks very much for joining us here in Davos. We are going to take a break here, but the conversations continue. And of course, remember, we do have that big address, President Trump speaking to the World Economic Forum. All of that coming to you live here on CNBC TV 18. Stay tuned. We're back in a moment. Welcome back. You're watching our continuing coverage here in Davos. And of course, one of the big focus areas is the energy need to fuel this AI infrastructure build out. Outside of the traditional modes of electricity generation, could nuclear be one of the next new opportunities to focus on? Joining us now to understand what that looks like. And remember, in India, we've just seen the government pass the Nuclear Civil Liability Bill, and that opens up the possibility of the private sector participating. And as you heard the minister say, that SMRs, of course, could be a part of the plan for the private sector, but we could see other options as well. To help us understand where things currently stand and where the world is headed to, we have with us Sama from the Nuclear Association. Thank you very much for joining us, Sama. And that's what I want to build on. Where are we today when it comes to energy provided by nuclear sources, and what's the outlook? What does your report say?
Yes. So as you just said, we released yesterday the World Nuclear Outlook report that provides a summary of where we are in nuclear. So on the one hand, nuclear continues to provide about 10% of global electricity. 2024 was the largest generation ever, so nuclear generation continues to increase. And as you know, it's also the second largest source of clean, carbon-free electricity at a global level. But the good news, what you will see in this report, is that with everything that we are building today, over 70 reactors at a global level, with what is planned, what is proposed, and all the government targets, including this 100 gigawatts in India by 2047, we will surpass our goal of at least tripling global nuclear capacity by 2050. So that is exciting. That is the good news.
Well, you know, if that is what you're working towards, or the estimates are working towards, I want to understand where you're seeing the most build out, because when we talk about renewable energy in the last few years, it's largely been driven by China. And of course, India has also played a part there. On nuclear, who's on the leaders board?
Well, every country in the world, or many countries in the world, are considering nuclear. At the same time, you're right. There are countries that are much bigger, with larger energy demand. So of these, more than 14 gigawatts of global nuclear capacity that we expect to see by 2050, we see that almost 1,000 of those 1,400 are going to be in China, in France, in India, in the US, and in Russia. So those are countries that they are, for the most part, already with significant nuclear parks, and they are continue to increase them.
Mm-hmm. And are you seeing partnerships between large tech companies and companies that could provide nuclear energy as a source?
You mean like AI companies?
Yes,
Oh,
exactly.
no, of course, yeah. This is what is a little bit new nowadays. The large energy users are quite interested in nuclear energy. They understand that nuclear can provide them the abundant, affordable, 24/7 carbon-free electricity and steam that they need. So yes, we are seeing lots of partnership with Google, with Meta, with Microsoft, with Amazon, with many others, but not just AI and technology companies. We are seeing many other sectors of the economy, chemical companies such as Dow Chemical, or metallurgical companies like many in the world. They are all very interested in seeing not just electricity, but high temperature steam for nuclear to help them decarbonize and power their efforts.
And also help us understand what the playing field is in terms of companies that are actually operating in this space. I mean, Westinghouse now, Brookfield is of course the big one,
right.
But what does it look like in terms of geographical presence?
Well, I mean, we have nuclear expertise in many, many parts of the world. Yes, you mentioned Westinghouse in the United States, but also in Canada. We have Atkins Realis with the CANDU technology. In France, we have obviously EDF and the entire French infrastructure. In the UK, we have Rolls-Royce. In Europe, there are many other companies that are bringing also new reactors. And then we have, of course, Korea, very strong with KHNP, very strong reactors. In Japan, well, you have Mitsubishi, you have Toshiba, you have many companies, and then of course you have China, India, Russia. So there is many players in the global nuclear supply chain, and this is part of what is beautiful about nuclear, right? It's truly a global industry where everybody is really working together.
And what are we talking about in terms of private sector investment to be able to achieve the targets that you spoke of?
Yeah, well, we are seeing a lot of interest from the private financial community, private banks, private financial institutions. They are quite interested in nuclear. But in many cases, there is a need to have some government involvement, and I don't mean money, I mean the signals, the long-term confidence, the long-term plans. So once that those long-term plans are put in place, the private capital is ready to invest. And we have just seen this, for example, in the UK, as we'll see, as soon as the government has made clear targets and clear expectations, there has been an oversubscription of private money that has been interested in finance that effort. We are seeing something similar in Sweden, and we are seeing something similar in other parts of the world, in the UK, in Canada, in the US, in Canada.
So, you know, SMRs, and what else? Micro reactors? I mean, what are we talking about? What could we potentially see?
So I think that we are going to see, or we are already seeing, a full spectrum of technologies. So we have obviously the traditional large reactors that are and will continue to be, I think, the backbone of the nuclear industry. But we are starting to see already a few small modular reactors being deployed. We have them already in Russia, in China, and they are starting construction in Canada and in the United States, in Europe. And then, yes, we will also see micro reactors for very specific applications. So I think that what we are seeing is that the business case of a nuclear power plant is being diversified. So we are seeing still the large projects, but we are also now going towards product, things that are more easily deployable, and they can be much more customized for specific applications, like, as I was saying, industrial parks or perhaps remote location, mining sites, things like that.
So, Sama, let me end then by asking you about the safety question, because that, of course, is something that as a consumer you worry about, given the past history. How safe is the move towards more and more nuclear energy?
Well, as I was saying before, nuclear energy is today and has been for the last 50 years 10% or more of the global nuclear industry, the global electricity. So clearly we've been chugging along, providing electricity very safely. And you know, as an engineer, I can tell you, I am a nuclear engineer, and we've been working very hard to learn from the knowledge at a global level, to learn from previous errors, to actually assimilate all that information to become always better, always safer, always more reliable, always 24/7 ready to provide this clean, carbon-free power.
Well, Sama, thanks very much for joining us here in Davos and giving us an outlook for the nuclear energy sector in 2026 and through to 2030 and 2050, the opportunities that throws up, and the private sector participation, and the need that is going to arise on account of the move towards greater artificial intelligence, data centers, and so on and so forth. Appreciate you joining us here on CNBC TV 18. Well, we will take a break here. The conversations continue. Don't go anywhere. We're back in a moment with plenty more. Our coverage here from Davos 2026 continues. President Trump is here. He will be addressing the World Economic Forum shortly, and you can catch his address live right here on CNBC TV 18. But to talk to me about all things Trump and beyond, joining me here is Smriti Irani, who has been a Davos regular in the last few years, but she's here now in a different capacity, in a different avatar, as she champions the cause of gender parity, gender equality in association with the Bill and Melinda Gates Foundation and many other organizations that she's working with. And of course, here to talk to us about all things Davos as well. Smriti Irani, welcome back to our studios.
Thank you for having us.
President Trump here, protests have erupted, choppers are flying in. What do you expect him to say?
I think in the midst of all fireworks, to keep the flag of gender and equity flying is an enormous
Is it at half
task. No, it's a full mast flying very high, and economically so, because I believe that there has been a time where rights-based conversations have happened on the streets of Davos and never found a space on the money table. You've been a witness to our journey in the past 3 years when we set up the alliance at the forum. My basic intent was to find money for women who want to do business and who are seriously and fiscally inclined to show a certain amount of discipline towards creating that ecosystem that businesses need when they want to saunter from ecosystems which are micro enterprises to mid-sized companies or fairly robust enough companies. And in that journey, in that capacity, I come back here to try and raise $100 million for 100,000 women-owned businesses back home in India across 300 cities.
And how's that conversation going?
I have raised the first 2 million.
You raised the first 2 million?
In the past 48 hours.
Okay.
Which means that I still have a few months to go where I raise the whole 100. I am of the opinion that philanthropy can only go so far. It's commercial capital that is much needed. Though it may be sequenced, it has to be contextualized from the perspective of women-owned businesses. We understand that most businesses that are led by women, and especially the smaller units, are challenged with issues of compliance. Many people view it from a perspective of only regulation, but there are compliance mechanisms which they have to respond to with regards to financial institutions. There are compliance regimes that they need to respond to if they want to be a part of a larger procurement or supply chain initiative. And we are trying to find experts here who do take out a little bit of their exhaustive corporate time to pro bono help out such women. So we are trying to build those networks. We've done so, I'm being immodest, but we've done so well enough back home in India, where we've had a lot of regulatory support from institutions such as the ICAI, ICSI, the stock exchange. But now we are hoping to find international partners who can take women in India to global supply chains.
You know, you had a whole host of companies who came on board when you announced the Alliance for Good right here in Davos. What was it, 2 years ago? And you know, what has that experience been? What is the private sector saying at this point in time? What is the ask that they have? Are they apprehensive about parting with capital, given the fact that this seems to have moved off the radar, at least as far as the large American companies perhaps are concerned?
I think given that the ecosystem of philanthropy is fractured due to geopolitical realities, there have been corporates who shy away from rights-based conversation or those enterprises that are so embedded in societal needs that they don't see commercial value in it. They in fact see geopolitical constraints if they align themselves to such ventures. What we are hoping to do through the alliance and what we have established in fact and evidenced for international corporations are things which are particularly helpful on issues of women's health, but also are market compliant. As many at the forum say, they are market-ridden and mission-driven companies. One such example is Mr. Gates telling me just about a year ago that maternal mortality numbers globally are astounding. 700,000 women die every year because they lack basic medical facilities. In fact, doctors and frontline workers lack a PPH strip, which you actually put under a mother who's about to give birth. The blood loss doesn't get computed in time, and that's where it results in the mother's death. And Mr. Gates was of the opinion, can India find one manufacturer that can make the PPH drape as per WHO standards at $1, given the need in the African market for such a device? And lo and behold, we did find that one vendor who ended up making that $1 PPH drape at standards that surpass the WHO standards. And ICMR has been more than kind to help set protocols so that it can be replicated for a global supply chain ecosystem. And I think that is what the alliance has helped establish. This is what Prime Minister Modi has been saying for years, that can India become that epicenter, not only for frugal innovation, but also be a dependable partner in global supply chains.
You know, you talked about health, and related to that, of course, is the issue of pollution. You were speaking here at the World Economic Forum on that issue, and that's a burning issue for all of us who live in India, for some of us who live in Delhi specifically. There almost seems to be a sort of, I would say, an apathy, you know, a malignant or a benign negligence almost on the issue. How do you respond to that?
I think that if there is an understanding of systems across the world which have faced this challenge, one needs to recognize, let's say China, they recognize that 0.164% going up on the air index was costing them 11 million tourists annually. We've seen that these numbers give enough impetus to industry to respond. We've seen that urban design today has to respond to these realities environmentally, but it has to be a comprehensive effort. It cannot only be an administrative effort. And the reason why I was a part of this conversation here at the forum was to understand those realities or those desires that the system needs for a comprehensive and a cohesive convergence of efforts. One recognizes that there is a productivity loss issue which comes with it. Many people misconstrue it as only a challenge with regards to breathing, but Lancet has seen 84 related reports from around the world which talks about its impact on neurodegenerative capacities, cognitive decline. Those are the conversations that need to be mainstreamed. But again, like I said, every country that has responded to that challenge, it is not governments alone that have responded. It is society at large, industry, and those who actually help out in urban design.
Surely the government has to take the first move. The government has to...
And I think the government in the state and the city, especially where you and I both live in, has tried to do its best. But like I said, the impact of those efforts cannot be early staged. It takes a long gestation period for the impact to be seen overall, and we have to keep a cohesive collaboration.
Great to be back in beautiful Davos, Switzerland, and to address so many respected business leaders, so many friends, few enemies, and all of the distinguished guests. It's a who's who, I will say that. I've come to this year's World Economic Forum with truly phenomenal news from America. Yesterday marked the one-year anniversary of my inauguration, and today, after 12 months back in the White House, our economy is booming, growth is exploding, productivity is surging, investment is soaring, incomes are rising, inflation has been defeated, our previously open and dangerous border is closed and virtually impenetrable, and the United States is in the midst of the fastest and most dramatic economic turnaround in our country's history. Under the Biden administration, America was plagued by the nightmare of stagflation, meaning low growth, and high inflation, a recipe for misery, failure, and decline. But now, after just 1 year of my policies, we are witnessing the exact opposite: virtually no inflation and extraordinarily high economic growth. Growth like I believe you'll see very shortly our country has never seen before, perhaps no country has ever seen before. Over the past 3 months, core inflation has been just 1.6%. Meanwhile, fourth quarter growth is projected to be 5.4%, far greater than anybody other than myself and a few others had predicted. Since the election, the stock market has set 52 all-time high records. So that's in 1 year, 52 records, adding $9 trillion in value to retirement accounts, 401ks, and people's savings. People are doing very well. They're very happy with me. Since my inauguration, we've lifted more than 1.2 million people off of food stamps, and after 4 years in which Biden secured less than $1 trillion of new investment in our country. Think of that, 1 trillion, substantially less than that. In 4 years, we've secured commitments for a record-breaking $18 trillion, and we think when the final numbers come out, they'll be closer to $20 trillion of investment. That's never been done by any country at any time, not even close. Just over 1 year ago, under the radical left Democrats, we were a dead country. Now we are the hottest country anywhere in the world. In fact, the United States economy is on pace to grow at double the rate that was projected by the IMF just last April. And with my growth and tariff policies, it should be much higher. I really believe we can be much higher than that. And this is all great news, and it's great for all nations. The USA is the economic engine on the planet, and when America booms, the entire world booms. It's been the history. When it goes bad, it goes bad. You all follow us down, and you follow us up, and we're at a point that I don't believe we've ever been. I never thought we could do it this quickly. My biggest surprise is I thought it would take more than a year, maybe like a year and 1 month. But it's happened very quickly. This afternoon, I want to discuss how we have achieved this economic miracle, how we intend to raise living standards for our citizens to levels never seen before, and perhaps how you too and the places where you come from can do much better by following what we're doing, because certain places in Europe are not even recognizable, frankly, anymore. They're not recognizable. And we can argue about it, but there's no argument. Friends come back from different places. I don't want to insult anybody and say I don't recognize it. And that's not in a positive way, it's in a very negative way. And I love Europe, and I want to see Europe go good, but it's not heading in the right direction. In recent decades, it became conventional wisdom in Washington and European capitals that the only way to grow a modern Western economy was through ever-increasing government spending, unchecked mass migration, and endless foreign imports. The consensus was that so-called dirty jobs and heavy industry should be sent elsewhere, that affordable energy should be replaced by the Green New Scam, and that countries could be propped up by importing new and entirely different populations from faraway lands. This was the path that Sleepy Joe Biden administration and many other Western governments very foolishly followed, turning their backs on everything that makes nations rich and powerful and strong. And there's so much potential in so many nations. The result was record budget and trade deficits and a growing sovereign deficit driven by the largest wave of mass migration in human history. We've never seen anything like it. Quite frankly, many parts of our world are being destroyed before our very eyes, and the leaders don't even understand what's happening. And the ones that do understand aren't doing anything about it. Virtually all of the so-called experts predicted my plans to end this failed model would trigger a global recession and runaway inflation. But we have proven them wrong. It's actually just the opposite. In 1 year, our agenda has produced a transformation like America has not seen in over 100 years. Instead of closing down energy plants, we're opening them up. Instead of building ineffective, money-losing windmills, we're taking them down and not approving any. Instead of empowering bureaucrats, we're firing them, and they're going out and getting jobs in the private sector for 2 and 3 times what they were making in government. So they started off hating me when we fired them, and now they love me. Instead of raising taxes on domestic producers, we're lowering them and raising tariffs on foreign nations to pay for the damage that they've caused. In 12 months, we have removed over 270,000 bureaucrats from the federal payrolls, the largest single-year reduction in government employment since the end of World War II. Nobody thought that was coming, but we had no choice. To make a country great, you can't have all federal jobs. We've cut federal spending by $100 billion and slashed the federal budget deficit by 27% in the single year. It's going to go down quite a bit more from that, driving inflation way down from the record highs of the Biden administration. Every month, they went up and up and up. I promised to cut 10 old regulations for every single new regulation, but instead I've cut, actually till this point, 129 regulations for every one new regulation approved. So every time they come in with a new regulation, we do at least 10, but so far it's averaging out to 129, if you can believe it. In July, we passed the largest tax cuts in American history, including no tax on tips, no tax on overtime, no tax on Social Security for our great seniors. We also provided 100% expensing, that's the one they like, and bonus depreciation for all new equipment and capital investments to help companies expand and shift production to America. They are so in love with that. They build a plant, they're able to deduct it immediately, the whole thing, rather than waiting 38 to 41 years in the old days. This is a miracle taking place. Nobody thought it would ever be done by any country, but it's done by us. It was what made my first term the most successful 4-year term that we've ever had from a financial standpoint. And now we've upped it. This is a 10-year program, not a 1-year program, but you're allowed to deduct everything in 1 year. It used to be 38 to 41 years. With tariffs, we've radically reduced our ballooning trade deficit, which was the largest in world history. We were losing more than $1 trillion every single year, and it was just wasted. It was going to waste. But in 1 year, I slashed our monthly trade deficit by a staggering 77%, and all of this with no inflation, something everyone said could not be done. There were a couple of brilliant people that actually thought I was doing the right thing. I thought I was doing the right thing. Now they all think I'm doing the right thing because they can't believe the numbers. American exports are now up by more than $150 billion. Domestic steel production is up by 300,000 tons a month, and it's doubling over the next 4 months. It's doubling and tripling, and we have steel plants being built all over the country. Nobody thought they'd see that. Factory construction is up by 41%, and that number is really going to skyrocket right now because that's during a process that they're putting in to get their approvals, and we've given very, very quick, fast approvals. In the process, we've made historic trade deals with partners covering 40% of all U.S. trade. Some of the greatest companies and countries in the world. We have countries as our partner, too. The European nations, Japan, South Korea. They're our partners. They've gone into massive deals with us, especially on oil and gas. And these agreements raise growth and cause stock markets to boom, not only in the U.S., but virtually every country that came to make a deal, because, as you've learned, when the United States goes up, you follow. It's really become a staple. In America, I've stopped the nation-wrecking energy policies that drive up prices while sending jobs and factories to the world's worst polluters. They are indeed polluters. Under sleepy Joe Biden, new domestic oil and gas leases fell by 95%. Think of that. And they wonder, why was gasoline going up so fast? The gasoline actually topped $5 a gallon, and some places $7 a gallon, and more than 100 major power plants were violently shut down by incompetent people that had no idea what the hell they were doing. Under my leadership, U.S. natural gas production is at an all-time high by far. U.S. oil production is up by 730,000 barrels a day. And last week we picked up 50 million barrels from Venezuela alone. Venezuela has been an amazing place for so many years, but then they went bad with their policies. 20 years ago, it was a great country, and now it's got problems, but we're helping them. And those 50 million barrels, we're going to be splitting up with them, and they'll be making more money. They've made it a long time. Venezuela is going to do fantastically well. We appreciate all of the cooperation we've been giving. We've been giving great cooperation. Once the attack ended, and they said, let's make a deal. More people should do that. But Venezuela is going to make more money in the next 6 months than they've made in the last 20 years. Every major oil company is coming in with us. It's amazing. It's a beautiful thing to see. The leadership of the country has been very good. They've been very, very smart. The price of gasoline is now below $2.50 a gallon in many states, $2.30 a gallon in most states. Then we'll soon be averaging less than $2 a gallon. In many places, it's already down even lower, $1.95 a gallon. Numerous states are at $1.99, numbers that nobody has heard for years. Actually, since my last administration, we got it down to around those numbers. I've signed an order directing and approval of many new nuclear reactors. We're going heavy into nuclear. I was not a big fan because I didn't like the risk, the danger, but they have the progress they've made with nuclear is unbelievable, and the safety progress they've made is incredible. We're very much into the world of nuclear energy, and we can have it now at good prices and very, very safe. And we're leading the world in AI by a lot. We're leading China by a lot. I think President Xi respects what we've done, in part because I've allowed these big companies building these massive buildings to build their own electric capacity. They're building their own power plants, which when added up is more than any country anywhere in the world is doing. I read recently an article in the Wall Street Journal that China's creating so much energy, and they are. I got to hand it to them. But we're creating as much or more, and we're letting them do that. I'm very proud of it. It was my idea. I said, you can't create this much energy. We needed more than double the energy currently in the country just to take care of the AI plants. And I said, we can't do that. We have an old grid system. And I came up with the idea, you know, you people are brilliant. You have a lot of money. Let's see what you can do. You can build your own electric generating plants. And they looked at me. They didn't believe me. All of the names that are, I think, in the room right now, if you want to know the truth, they didn't believe it. And I said, no, you can't. They came back 2 weeks and they didn't have the plant. They said, we thought you were kidding. I said, no, not only am I not kidding, you're going to have your approvals within 2 weeks. I always say nuclear will take 3 weeks. But most aren't going that. They're going oil and gas. They're even going coal in some cases. Because of my landslide election victory, the United States avoided the catastrophic energy collapse which befell every European nation that pursued the Green New Scam, perhaps the greatest hoax in history. The Green New Scam, windmills all over the place, destroy your land, destroy your land. Every time that goes around, you lose $1,000. You're supposed to make money with energy, not lose money. Here in Europe, we've seen the fate that the radical left tried to impose on America. They tried very hard. Germany now generates 22% less electricity than it did in 2017. And it's not the current chancellor's fault. He's solving the problem. He's going to do a great job. But what they did before he got there, I guess that's why he got there. And electricity prices are 64% higher. The United Kingdom produces just 1/3 of the total energy from all sources that it did in 1999. Think of that, 1/3. And they're sitting on top of the North Sea, one of the greatest reserves anywhere in the world, but they don't use it. And that's one reason why their energy has reached catastrophically low levels with equally high prices. High prices, very low levels. Think of that, 1/3. And you're sitting on top of the North Sea, and they like to say, well, you know, that's depleted. It's not depleted. It's got 500 years. They haven't even found the oil. The North Sea is incredible. They don't let anybody drill. Environmentally, they don't let them drill. They make it impossible for the oil companies to go. They take 92% of the revenues. So the oil companies say, we can't do it. They came to see me. Is there anything you can do? I want Europe to do great. I want UK to do great. They're sitting on one of the greatest energy sources in the world, and they don't use it. In fact, their electricity prices have soared 139%. There are windmills all over Europe. There are windmills all over the place, and they are losers. One thing I've noticed is that the more windmills a country has, the more money that country loses and the worse that country is doing. China makes almost all of the windmills, and yet I haven't been able to find any wind farms in China. Did you ever think of that? It's a good way of looking at it. They're smart. China's very smart. They make them, they sell them for a fortune. They sell them to the stupid people that buy them, but they don't use them themselves. They put up a couple of big wind farms, but they don't use them. They just put them up to show people what they could look like. They don't spin. They don't do anything. They use a thing called coal, mostly. But China goes with the coal. They go with oil and gas. They're starting to look at nuclear a little bit, and they're doing just fine. They make a fortune selling the windmills, though, and I think really that's one that they wouldn't be surprised if it stopped. They are shocked that it continues to go. They're very friendly with me. They're shocked that people continue to buy those damn things. They killed the birds. They ruin your landscapes. Other than that, I think they're fabulous, by the way. Stupid people buy them. The consequences of such destructive policies have been stark, including lower economic growth, lower standards of living, lower birth rates, more socially disruptive migration, more vulnerability to hostile foreign adversaries, and much, much smaller militaries. The United States cares greatly about the people of Europe. We really do. I mean, look, I am derived from Europe. Scotland and Germany, 100% Scotland, my mother, 100% German, my father. And we believe deeply in the bonds we share with Europe as a civilization. I want to see it do great. That's why issues like energy, trade, immigration, and economic growth must be central concerns to anyone who wants to see a strong and united West, because Europe and those countries have to do their thing. They have to get out of the culture that they've created over the last 10 years. It's horrible what they're doing to themselves. They're destroying themselves. It's beautiful, beautiful places. We want strong allies, not seriously weakened ones. We want Europe to be strong. Ultimately, these are matters of national security, and perhaps no current issue makes the situation more clear than what's currently going on with Greenland. Would you like me to say a few words of Greenland? I was going to leave it out of the speech, but I think I would have been reviewed very negatively. I have tremendous respect for both the people of Greenland and the people of Denmark, tremendous respect. But every NATO ally has an obligation to be able to defend their own territory. And the fact is, no nation or group of nations is in any position to be able to secure Greenland other than the United States. We're a great power, much greater than people even understand. I think they found that out 2 weeks ago in Venezuela. We saw this in World War II, when Denmark fell to Germany after just 6 hours of fighting and was totally unable to defend either itself or Greenland. So the United States was then compelled, we did it, we felt an obligation to do it, to send our own forces to hold the Greenland territory, and hold it we did at great cost and expense. They didn't have a chance of getting on it, and they tried. Denmark knows that. We literally set up bases on Greenland for Denmark. We fought for Denmark. We weren't fighting for anyone else. We were fighting to save it for Denmark. Big, beautiful piece of ice. It's hard to call it land. It's a big piece of ice. But we saved Greenland and successfully prevented our enemies from gaining a foothold in our hemisphere. So we did it for ourselves also. And then after the war, which we won it big. Without us, right now you'd all be speaking German and a little Japanese, perhaps. After the war, we gave Greenland back to Denmark. How stupid were we to do that? But we did it. But we gave it back. But how ungrateful are they now? So now our country and the world face much greater risks than it did ever before because of missiles, because of nuclear, because of weapons of warfare that I can't even talk about. 2 weeks ago, they saw weapons that nobody ever heard of. They weren't able to fire one shot at us. They said, what happened? Everything was discombobulated. They said, we've got them in our sights. Press the trigger, and nothing happened. No anti-aircraft missiles went up. There was one that went up about 30 feet and crashed down right next to the people that sent it. They said, what the hell is going on? Those defensive systems were made by Russia and by China. So they're going to go back to the drawing boards, I guess. Greenland is a vast, almost entirely uninhabited and undeveloped territory. It's sitting undefended in a key strategic location between the United States, Russia, and China. That's exactly where it is, right smack in the middle. Wasn't important nearly when we gave it back. You know, when we gave it back, it wasn't the same as it is now. It's not important for any other reason, you know, everyone talks about the minerals. There's so many places. There's no rare earth, no such thing as rare earth. There's rare processing, but there's so much rare earth. And this, to get to this rare earth, you got to go through hundreds of feet of ice. That's not the reason we need it. We need it for strategic national security and international security. This enormous unsecured island is actually part of North America, on the northern frontier of the Western Hemisphere. That's our territory. It is therefore a core national security interest of the United States of America. And in fact, it's been our policy for hundreds of years to prevent outside threats from entering our hemisphere. And we've done it very successfully. We've never been stronger than we are now. That's why American presidents have sought to purchase Greenland for nearly 2 centuries. You know, for 2 centuries, they've been trying to do it. They should have kept it after World War II, but they had a different president. That's all right. People think differently. Much more necessary now than it was at that time, however. In 2019, Denmark said that they would spend over $200 million to strengthen Greenland's defenses. But as you know, they spent less than 1% of that amount. 1%. There's no sign of Denmark there. And I say that with great respect for Denmark, whose people I love, whose leaders are very good. It's the United States alone that can protect this giant mass of land, this giant piece of ice, develop it and improve it and make it so that it's good for Europe and safe for Europe and good for us. And that's the reason I'm seeking immediate negotiations to once again discuss the acquisition of Greenland by the United States, just as we have acquired many other territories throughout our history, as many of the European nations have. They've acquired, there's nothing wrong with it. Many of them, some went in reverse, actually, if you look. Some had great, vast wealth, great, vast lands all over the world. They went in reverse. They're stuck back where they started. That happens too. But some grow.